period. So, of course, there'll be that question of whether Evergrande chooses to exercise this because in August, or earlier in August, last August rather, Country Garden was facing $22.5 million of interest repayments, and they did fail to make that, only just getting through or sneaking through in that 30-day grace period. And you can see there that has really been the big shock to bondholders there, because we've still got a number of dollar bonds that are trading deeply in distressed territory at around 10% of the face value. So Country Garden, even as I say, it has really managed to push out a lot of debt deadlines and reduce the amount of principal or repayments that are due by the end of 2023. Investors are still very wary of what was once China's largest construction company.
Speaking about the big players, Evergrande seemingly entering a new phase where we've got criminal justice now becoming involved.
That's right, Heidi. Yeah, this one came through over the weekend, so not a lot of details that we know so far about this, but what we do understand is that Chinese authorities have detained some staff of China Evergrande's wealth management or money management business. So as you say, it really is a sign that the saga now is starting to enter a new phase. So police in Shenzhen, it is just across the border from Hong Kong, said that actions were taken recently. That's according to their statement that was posted on social media on Saturday night. Now, they've only identified one of the detainees so far, but that was by the last name Du. Du, again, we don't exactly know who that is, but we do understand that the firm's general manager is Du Liang, and that's according to his LinkedIn profile. But essentially, no charges were disclosed. The statement also doesn't say how many people are in custody. So, Sherry, again, not a lot of details around this. It really does point to a lack of clarity across the property sector more broadly, and certainly makes it another key reason that we're watching the property sector over the coming days.
Right. Annabelle Jewelers joining us from Hong Kong with the latest on China's property developers. And be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers, get in-depth analysis from the Daybreak team. Now broadcasting live from our studio in Hong Kong. Listen through the app, Radio Plus, or BloombergRadio.com. Plenty more ahead. Stay with us.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Taking a look at another story that we're following very closely. Union workers at Chevron's LNG facilities in Western Australia continuing rolling 24-hour stoppages for a second day on Sunday, prolonging uncertainty over global supply of the fuel. An official at one union says a decision to continue the strikes will be made daily. The prospect of lower gas exports from one of the world's biggest suppliers has sent global prices higher. All right, take a look at the picture when we take a look at oil and gas trading, and of course oil looking like we could see really some more price action, given that refiners are seeing indications that they're struggling to make enough diesel fuel. Of course, this coupled with those continued cuts we see from OPEC, plus even with the exclusion of improvements in China demand, has seen really crude maintaining those prices with a third straight weekly gain. Tighter markets are still in view. New York crude up by just about 0.2% there, above $90. Brent also holding almost at $94 a barrel. Taking a look at nat gas there as well, we had gasoline prices in the US surging to a US seasonal record on the back of crude's rally, and nat gas prices seeing a little bit of downside. But European gas futures, they have really seen the biggest reaction when it comes to these labour disruptions out of Chevron. Coming up in the next hour, we'll hear why ANZ's Richard Zitzenga think that the Fed will not be cutting rates anytime soon. We'll also be charting the course of the BOJ's ultra-easy monetary policy with Mizuho's Kazuo Moma. That is it for Daybreak Australia, though. Daybreak Asia is next. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
Obviously, we've been seeing the data showing some early signs of life now in China. Can the mood continue to be more positive from here, you think?
So from my standpoint, although the activity data picked up, as you mentioned, I think property is still an area that is pretty gloomy. And I still believe that because property has been a mainstay as sort of a pillar of GDP growth for so long, that still is an area that I think matters the most. And also, from my perspective, the activity data, it's one set of data. And so we need to see that sort of on a sustained basis. And that really remains to be seen. On property side, it really, I think we are looking at pretty dismal numbers overall this year. And, we saw in August the property prices are actually falling.
Yeah.
So this is really all feeding into general sentiment that we're still pretty concerned about.
Any early signs of a rebound? What do you think?
No, so yes, we are seeing a little bit of a kind of cyclical rebound. But, I mean, as Monica said, right, real estate is such a big drag to the economy. We've had huge shocks to private sector aggregate demand. Our thesis has been that policymakers will chronically underdeliver the amount of policy support needed to narrow the output gap and bring it to at least to close the output gap. So we're going to have pretty low inflation deflation. So actually my concern is, there's always a little bit of a mini cycles in kind of the long-term structural trend. So the fact that data is looking a little bit better, if anything, that probably suggests policymakers are going to be more reluctant. Like, for example, this week, we're not expecting any LPR rate cut. We've actually removed our rate cut call from PBOC. We don't get a sense that policymakers are going to be even more kind of motivated or driven to do additional policy support, especially on consumption and private sector. So again, the lingering long-term story is still there. But in the short term, I think, there's definitely signs more on the manufacturing side that you have this destocking cycle, you get a little bit of a cyclical bounce. Yeah. The other thing we're looking for is on the infrastructure side. So the data was still a little bit weak in August, but we had very extreme weather events. So the expectation is maybe, because they're asking the local government to front load all the bond issuance by September and implement the projects to October. So it looks like the government's going to lean more to look at traction on infrastructure to provide a little bit of aggregate demand support. But again, on the consumption side, I'm still a little bit wary. On the real estate, there's obviously still a lot of stresses. So, I think that situation will continue to rear its ugly head again after we're past a little bit of the cyclical bounce.
Citi had a bit of a non-consensus call on where policy goes next. I think the majority of the economists that we've been talking to saying, look, monetary and fiscal needs to be more forceful for the remainder of the year. You're thinking it could be more of a wait and see from policymakers,
Well, I think
right?
It should be, but what I think they should do versus what they will do is different.
Okay.
So I don't really get a sense from PBOC standpoint, given their desire to stabilize FX, their desire to protect net interest margins of the banks, because they're using banks as an instrument of national service to support the economy. I don't get a sign that their policy stance is moving towards aggressive interest rate cuts. And on the fiscal policy, it's more kind of delivering on this year's policy rather than adding more to that. Yeah. Certainly, I'm not getting any signs of sort of direct consumption support at this juncture.
Yeah, I mean, I would actually point out that also on the retail side, yes, there was a bit of an uplift, but if you look at the composition, a lot of this is services, which actually relates to travel, and that travel bump has sort of like passed now from the after the summer. I do expect that they could do another triple R cut, but that probably will be sort of more normalization and stabilization of the liquidity for banks. So I do agree with Joanna that there needs to be a lot more in terms of a coordinated effort between fiscal and monetary, and we haven't gotten hints from the government that they're ready to do that yet.
Well, can we at least find consensus between the two of you that rates will remain lower for longer in China? Let's start with you.
Yeah, I think that's an easy one.
Absolutely. I mean, we're targeting 10-year CGBs, for example, to head lower to 2.3%.
Wow, okay.
So that's,
Because that matters for the carry trade, right?
Yeah.
Yes. So I think because everybody expects lower for longer, and I think in addition you have the headwinds of stronger dollar, and that staying, I think, you're going to have at least a couple quarters of pretty firm dollar, then that, directly sort of feeds in still with a secular trend of weakness for CNH.
It brings to that whole question about the investability of China. We've seen, despite the data turning a little bit more positive, foreign outflows are continuing to be net selling, right, for 6 straight weeks
almost
now.
every day since the start of August.
What can you say about that question on the credit space overall?
So I think the credit space, if you look at on the high yield side, it remains to be seen when we're ever going to be able to have the markets open to a new issuance again. I don't see that in the foreseeable future. I think the outflow, a lot of that has already happened, and also just by force, just from the sheer number of issuers that have, collapsed. Country Garden still is in the balance. In the meanwhile, end of last week, Sino-Ocean has stopped making payments. So I think there's going to be more defaults to come. And by defaults, again, I include, any distressed restructuring or forced acceptance of consents. So, the outflow, I think we are already seeing from local investors, local long only, already sort of reallocating. Overall, I think that it's very clear that the outflows will, in my mind, continue through, I think it affects credit sentiment even when we continue to see the numbers from the A shares, from Hong Kong Stock Exchange as well. That is, the one consensus everybody has is, stay away from China for now.
Yeah, well, just to follow up on that before I bring Joanna back in, the legal enforceability of some of the issues right now in offshore in the high yield space, because that's your wheelhouse. You're not seeing any good information at this point in time to jump back in?
So, I wish we could return back to the, old ways of looking at fundamentals, that there is a price for everything. Unfortunately, there isn't a price for everything in this case, and that's been the hard lesson for all of us doing fundamentals here, especially for China high yield. I think the issue is that for the 2-3 years now that we've seen this suffering in high yield, and through all the defaults restructuring, we haven't seen one precedent that has been a good case study, for everyone. I think everybody at one point last year thought maybe Evergrande would be a case study. Unfortunately, we don't have any good precedents to demonstrate not only a result of recovery, but more importantly, the process. So we don't have a clear framework, and there's been a lack of enforceability both onshore and offshore. So what you see on paper isn't something that you can rely on in a normal way. And so I think very firmly we put China back into emerging market, maybe even towards frontier now as far as analysis of high yield goes.
Yeah, and the 30,000-foot view here, to your point, is you have small cyclical rebounds amid a structural decline. The Japanification of China, whether these are symptoms of a balance sheet recession, let's start with you. Where are you in that conversation? Are we?
Yes, so let me first clarify. Of course, it's not exactly like, everything's a little bit different. It's not exactly like Japan. But when I mean Japanification, it's this economic condition where output always kind of falls below potential or hovering below potential.
Well, no inflation.
So you've got a prolonged period of low inflation to quasi-deflation. And when I say Japanification, there's a level of persistence to that. And that persistence is kind of a symptomatic of the balance sheet stresses and future expectations about future growth prospects. And in those definitions, I clearly think China's already headed towards Japanification. And I think, obviously there's a little bit of difference between China and Japan. So on the liability side, China and Japan both had a significant buildup of leverage associated with the real estate cycle over the last decade up until the peak. But where there's a little bit of a difference, what we're seeing is that in Japan, asset prices really ballooned and then collapsed. And then the ramification of the collapse of asset prices amplifying through the banking sector was what created a protracted downturn in kind of 2 lost decades in Japan. In China, it's a little bit different, only to the extent that we had a preemptive deleveraging on real estate ahead before we even got to kind of the bubble territory. So they're cutting new supply significantly in the hope that you get further, you're faster towards price discovery of equilibrium, so you don't have a big collapse as before. Now, the challenge to that is, I think, as you try to control supply on preemptive deleveraging, You're also controlling demand. You're also destroying demand at the same time. And the lack of countercyclical policy support to offset that income shock. And you did it during pandemic. You did it during so many private sector regulatory shock. So there were so many things happening to demand at the same time, which really created this pressure. Now, maybe the difference between Japan and China is because, in Japan case, the banks really got a huge hit in terms of insolvency, NPLs ballooning. In China, because of the more, kind of muted decline in asset prices and stronger balance sheets of the banks, you don't have that same kind of pressure. Nonetheless, the behavior of private sector in terms of, being very precautionary, being very cautious, that's very similar. In terms of that's why you're seeing a lot of, kind of reluctance demand for consumption and lots of preference for liquid precautionary savings. And there's a lot of other similarities in terms of policy response. Like in that environment, when you're worried about this big shock and chronic shortage of private sector aggregate demand, you also have a big decline in future growth expectation that I think you're also seeing in China. Like demographics are deteriorating even to some cases faster than Japan. People are aging before they're even rich. You've got a lot of productivity growth shocks because of all the regulatory uncertainty on the private sector, not to mention that the geopolitics in China is a lot more complicated with the U.S. than it was with Japan. So that really is driving level of kind of deteriorating optimism, deteriorating kind of more pessimism. So my worry here is the policy response. When you look at the amount of rate cuts we've seen, very little. So real rates, expected real rates is still too high relative to what is the equilibrium. So people in China are just happy to put their money in deposits and safe assets. And this will continue until something changes. But my worry is kind of similar pattern. The policy response has been quite, incremental.
Monica, what needs to change then? What could resolve that?
I think it is a matter. So in my mind, between China and Japan, the difference is that China, I believe, for as bearish as I sound on China high yield and credit market, I do actually think that there's still room if they choose to use it. So first, you do have China still having some growth. In Japan, when, the bubble burst, they didn't have a lot of room there. In order to control asset inflation, they had to keep raising rates. We're in a lowering rates environment. There's still some room in terms of policy, in terms of reserves. There have been people who've even written about an additional shadow reserve. So I think, there's a certain amount that China still has in terms of leeway and tools. I will, say that in terms of price discovery, there is a bit of a difference also with China, where we have seen stories in the primary markets where prices were not allowed actually to lower by so much. It was, controlled. So I don't think we have a real price discovery just yet. It's probably if it were a totally free market, the prices would probably be down even more, frankly, onshore. What needs to happen is really something that is a Fed-style bazooka that we saw out of the GFC, frankly. And I think you really need a type of stimulus that isn't just about selecting which industries. You can't just be focused on EV, semiconductor, hard manufacturing, or, biotech. I think what you need to do is to really put money in the hands of the consumer, and unfortunately, that doesn't really jive with the thinking of the regime.
Central banks, I don't know where to start. Are we almost done with hikes? Let's start there.
It depends which central bank you're talking about. But
everyone.
For the most central banks, yes. I think we're expecting, this week Fed is going to be on hold on Wednesday, but we still have one more hike in November. We've got 4 European central banks. All of them are expected to hike 25 basis points. Bank of England, Riksbank, Norges Bank, and Swiss National Bank. Out of the 4, I think we think 3 out of the 4 is the last hike. There's one more that will have a few more hikes. Interestingly, in Asia, we have 3 central banks. We have BI, BSP, and Taiwan CBC. All of them are expected to be on hold, which is pretty much telling you a little bit of the divergence, because a lot of central banks in Asia have basically been on hold for a long time, right? Even as others still incrementally tighten.
So yeah, I agree with Joanna that I think now it's not, for me, it's not so much about how many more hikes if the Fed hikes, but my opinion in November is it's still on the table. It's 50-50 probably. But I think what's more important is what people are saying and the message that's coming through, because I think for the other countries, for the most part, it's really about, if there's a hike, it's a dovish hike. And then meanwhile, I expect the Fed to pretty much keep their dots where they are around there and still talk as though that they will leave room and will consider another hike. The U.S. Economy is, still going strong. We're really seeing still this theme of U.S. exceptionalism.
The House view, though, for Citi is still calling for a recession in the U.S.
Well, at the moment, that's more into going into next year.
Okay.
So we actually still embed one more rate hike in November. But even though we're calling for a recession, I have to say our economist is putting, kind of more evenly distributed probability distribution around different outcomes. Like we have to have a base case.
Right.
But there's also a decent chance that we may have a delayed recessionary outlook. And we have a non-negligible probability we could have a soft landing. So obviously we acknowledge the latest data coming out of the U.S. The narrative seems to be more supportive of a little bit of a softer landing. But it's just that based on historical evolution of how we get to a 2% inflation target, in order for us to see wage growth slow down, we really need to see more meaningful softness in the labor market, which will lead to a little bit of a recession.
Okay, bear steepening. That's been happening. Does that continue?
So again, because we still have the baseline scenario of a recession, if you look at our rate strategist, I don't think that is his base case view that, this kind of bear steepening we have at this moment is kind of capped out. And then we actually expect eventually 10-year yield to be well anchored. But again, in the short term, that seems to still be kind of what the market seems to be talking a lot about.
Monica?
Yeah, look, we've come from on 210s. If you look at, where we have come from since I last was on the show, it was around 100, and we've come down to around like 70. I do think that will continue for now. Now, that type of bear steepening is also because it's around the story of U.S. Engine of growth continuing. So that, that said, I think that what I agree with Joanna on is that there will be, usually there's a lag effect. And so in terms of the higher rates and higher for longer feeding through, eventually, there is a good probability something will break. On this inversion, I will point out one thing, the 210s inversion, it's actually pretty unusual, the U.S. compared to the rest of the world.
You have some really good insights, Monica, on where these policy support measures around the housing market, where they're probably most felt, which is in Tier 1 cities, which is a very small part, really, of the total housing market. Right.
So a lot of the recent policy easing for housing is really going to help Tier 1, which comprises only about 15% of the total, and I think that all these are also trying to ease on the demand side, but the reality is you can lower the ratio of down payment, you can reduce mortgage rates, but the reality is sentiment-wise, are you going to step out and buy a house if you have no visibility on the prospects of your employment and the income stream? The other part I would say about property is that these measures are, just really, I think, trying to boost a bit of sales in order to help liquidity of the developers to finish projects. I don't really see these measures as big enough to help revive the developers. And in particular, one part that, we talk less about is really on the supply side. On the supply side, the developers simply are so cash strapped that, there's no real land purchases. And so we're looking at, so far, land sales has dropped by 20%, and any of the land sales that has been made mostly has been done by SOEs. It remains to be seen that the SOEs can pick up the slack of the POEs, the private-owned enterprises.
Anything to add there, Joanna?
Yeah, so exactly. I think there's three things we're watching for to see to what extent this will have, have some impact. And I agree. I think the sentiment that I think there's a lot of skepticism how enduring it's going to be. Yeah. I mean, we may have a bit of a pickup of property sales just because we had very weak July, August. There's still some pent-up real demand. But again, the question is three things I think are continuing to hamper sustained recovery. One is, as Monica said, I mean, we haven't really had a lot of policy support to boost people's expectations about their job and income prospects. So that really is missing. The second is, again, I think it's also expectation about prices. Even if we get a pickup of transactions, as long as people don't think prices are going to go up, and in fact, there's still pressure that as transactions pick up, there could be a lot of people unloading market property in the secondary market and also inventory of unsold homes, etc., that if prices may continue to, kind of hover and may even decline, people may still wait. And then the third thing that I think is also going to hamper this is people are still going to be concerned about the health of the developers, including private sector developers, and their ability to deliver on property. And that in itself is also going to be a kind of a potential drag. So again, a bit of a pickup of transactions in the top tier cities, but I think without further supportive countercyclical policy response, there's a real risk this may kind of be really temporary.
What does that mean for the data coming through, maybe not this year, but next year, because you're not going to get the same sort of base effects that really was supporting the data this year, right? What happens in 2024?
So that is the real challenge. I mean, our assumption is we've got a 4.6% growth forecast next year, versus 4.7 this year. So that's assuming you're going to get more additional policy support. That it's just taking a little bit of time. Yeah. This year, it seems like they're just going to lean more on the base effect from last year. And as I said, you may have a little bit of traction in infrastructure. But going into next year, we got to do more. And either central government has to do more. We haven't really deployed the PSL, pledge supplemental lending facilities, to help the policy banks more for infrastructure. I'm really hoping they do something more on consumption, because if you have consumption support that targets, for example, lower income households, you can generate higher multiplier effect on people with higher propensity to consume if you have a more well-targeted fiscal support. But for some reason or the other, I think they're preserving their bullets and not using that yet for this year. That's a possibility we hope could resurface going into next year. But you're absolutely right. There is a risk to that growth risk next year, especially if we get a U.S. recession, and especially if the fact that they've been kind of slow to respond, that the collective trauma of the private sector just accumulates, and the more they become more even hesitant going into next year.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Monday, the 18th of September. European equities are a bit soft today, and actually volume's a bit light. It's a big week. It doesn't really get going this week, though, until the Fed and the Bank of England and some of the data we're going to get. But nevertheless, the market certainly feels like it's starting off on the equity front a little cautious. We're down by 1.5% in Paris. The DAX is down by 1%. FTSE's a little better, down by 0.7%. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Let's talk about these markets, figure out what is happening here. Stock 600 down by around 1.2%. Banks are a feature. SocGen, the update, the new management, didn't go well. Really didn't go well. Disappointment. Expectations significantly higher. They've underwhelmed. You do not want to underwhelm in this kind of a position. That's the factor that's weighing on the Paris market today. There are a few positive signs out there. Ocado's got a very nice upgrade. That's certainly helping out that stock. So there are single stocks that are on the move, but broadly stocks are lower. Euro dollar is flat. We're waiting. We're going to wait for midweek, I think, before we get some movement there. But the story, as I say, which is bolstering the oil sector, but it's still not enough to push it back into positive territory, is Brent crude. It is up by 0.7%. Are we going to $100 a barrel?
So oil is so exciting that Guy and I both have it in our board. That's how cool it is. I jest. But the Saudi oil minister, I should point out, was speaking in Calgary just a moment ago. He says, look, we're targeting volatility, not the oil price. Okay, all right. We'll see if we get towards 100. The S&P, literally nothing to see here. Stocks are doing absolutely nothing. Individually, though, ARM is down by 5%. Bernstein downgrading the company, warning on its growth outlook. And it IPO'd at 51. Still above that, but just headed into Klaviyo and Instacart and potential IPOs this week. This is where the price action, I think, becomes quite interesting. S&P Energy Index, the best performer within the non-moving S&P, up 1%. And, of course, that is the oil price, as we keep hearing about the divergence between oil stocks and oil price, particularly over in Europe, just huge. And that discount actually has to close.
It's going to be fascinating to see exactly if we do get to 100, how it changes the narrative here. Governments are also paying attention to this, and they are beneficiaries in all of this process as well. Competing currents in oil. This was Abigail's chart from a little bit earlier on. It was so good I've decided to steal it and bring it to you once again. Oh, yeah. I think it's a huge compliment to Abigail. Fantastic chart. You can see the channels we've been in. We've had this wedge formation. I'm going to try and do my best, Abigail, on what is happening with charts here. We've broken out to the upside, but you've got this channel which exists at the top end. I hope I'm describing it correctly, which we're at right now. So her view is maybe, just maybe, we bounce off that and come back down again. But if I was looking at the momentum that we have in the oil price right now, Alex, $100 a barrel, maybe not for long, but maybe we'll get there.
Yeah, we spoke with Mike Wirth, the Chevron chairman and CEO, earlier in the last hour about $100 oil.
The momentum, supply is tightening, inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
Question of the day, fairly straightforward one. What economic impact will $100 a barrel deliver, both for the European economy and the US economy? Does it mean stagflation? I think Europe is already, to a certain extent, already experiencing the rollout of that process. Will the United States ultimately follow? And does it take a soft landing off the table? Julian Lee, Eddie van der Volt joining us now to discuss here in London. Julian, I'm going to start with you. Are we going to get there?
I think we might well do. It may not last, but we're seeing more and more analysts coming out and saying, $100 a barrel is looking more likely. They were all saying this at the start of the year. By the middle of the year, there was virtually nobody forecasting $100 a barrel. Now we're starting to hear them say, we may get there, but it won't last, or it probably won't
Well,
last.
even Citi is saying that. They're like, look, we're going to have ex-OPEC supply coming on, and then you're going to get lower oil prices. Eddie, though, what say you? Are we in a new range for oil? Let's say 80 to 100. What does that do for the stagflation thesis then?
Well, it changes the narrative substantially, right? Throughout this year, oil prices were below where they were a year prior, right? So for most of this year, oil and energy more broadly, diesel and all the derivatives from oil had created a disinflationary force in the world economy. Now that's changed around. Even if you just sit at these levels, right, you're not having that disinflationary force, which means that the rest of the basket of goods that you look at needs to do so much more work. Yep. And sure, okay, this doesn't impact core, except that it does, because the reason we don't include oil prices in core is because we'd effectively be double counting it, right? Because people will be paying more to drive things around, right? So you'll be paying more for goods and services and then adding it to the core basket. So it will impact on all levels the economy. And I do think that it's at the same time it's a tax on spending. So it's a stagflation.
Differentiate the picture between Europe and the United States, because it feels different. The consumer feels in much better shape over there, more able to tolerate that higher oil price. Now there's a number of other factors coming together, like student loans, which may exacerbate the situation. But here in Europe, it already feels like we are kind of heading in that direction.
Right, and I think that is a big difference. But I think that's a potential downside for the US almost, right? Because I think we're almost accepting that we are going to hit a stagflationary environment, definitely in the UK, probably in Europe, right? For the US, all the upside is still priced, right? For the US, it's still ignoring all of this stagflationary risk, the risk of a secondary wave of inflation just at the time when growth is slowing. So I think there is probably more downside left to price in the US, or stagflationary realities to be priced in the US, which it isn't just yet.
Yeah. Yeah, 100%. You just have to wonder, though, how long we stay here, and if it's a new range, is that different than the high price? So, Julian, do you agree? Like, are we in a new range of 80 to 100, and is that enough to kind of squeeze the consumer even more?
We certainly seem to be in that range at the moment. I mean, I think, Saudi policy is really what's driving this. They have decided, and they can dress it up in terms of market stability or whatever, but they have decided that the oil prices that we were seeing a month or two ago were too low for comfort for them. They have been prepared to sacrifice volume to boost the price. And as long as they're prepared to do that, then they can underpin this price range of 80 to 100 or 85 to 100, whatever it turns out. And they are showing signs at the moment that they are prepared to extend this production ceiling of about 9 million barrels a day. I mean, this is the lowest they've been pumping for many, many years outside of the COVID shock that they had and that very brief impact of the attack on their oil facilities. But they are showing that they're prepared to cut production in order to boost prices. And consumers are paying the price for that. And of course, the big winner out of this is Moscow.
And to a certain extent, the United States. Alex, this is the thing that I'm trying to figure out as well. The US consumer is going to suffer as a result of a higher oil price. It is a tax. You guys feel it much faster. There is less tax on a gallon of oil, a gallon of gasoline over there. But the US is still a massive producer of oil. And the effect must be, therefore, that much less on you guys than it is on us.
Well, if you look at it from a producer point of view, and Mike Wirth was talking about this, a lot of the inflation costs that you still see in oil production is in the Permian. It is in the U.S. because there's so much activity there. So oil price in some ways does need to be higher because it costs so much more to get a barrel out of the ground. Exporting it, though, sure, that would probably, you'd make a lot more. But again, and those local prices are going to be significant as well. What do you actually make for a barrel of oil in the Permian? We have lost your mic. This is basically the equivalent of a big hook that comes and takes Guy off the stage. Anyway, much more conversation on that coming up. Guys, thank you so much for joining me. Really appreciate it. Bloomberg oil strategist Julian Lee and Eddie Vanderwalt from our MLive team. But oil staying sticky. Brent around $94 a barrel, staying sticky at that higher level. All right, coming up, Chinese car makers are under scrutiny in Europe. We're going to break that down with Mercedes-Benz CEO. That's coming up next. Don't miss it. This is Bloomberg. And as we head to break, German Foreign Minister spoke to our own Anne-Marie Horder on the sidelines of the UN General Assembly about the EU's relationship with China.
And so being a partner in climate issues, being a competitor, obviously, with China with new technology, but also seeing that we are systematic rivals and we have to protect our own vulnerability. And this is where von der Leyen comes in, the Commission President, to strengthen our critical infrastructure in Europe, but also looking at outbound investment screenings.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Powering financial solutions that transform industries. Powering seamless execution in evolving markets. We deliver our entire global bank to power new possibilities for you. Barclays Corporate and Investment Bank, powering possible.
We welcome now our Bloomberg radio and television audiences to a fantastic conversation with Ola Hallenus. He is the Mercedes-Benz CEO. He joins us in New York, as does, of course, Bloomberg's Matt Miller. Ola, great to see you. Thank you very much indeed for taking some time to drop by and see us here at Bloomberg. Ola, the story we've been talking about over the last few days has been all about China. We're trying to work out whether Europe is going to start a fire with China that is going to impact Mercedes-Benz. There's talk of tariffs. There's talk of trade wars around autos and EVs. Are you worried?
Well, it's great to be with you this morning, Guy. No, we're not fundamentally worried. We have a very strong business in China that has grown significantly over the last 10 years, and we're continuing to invest in China to make sure that we bring the product that the Chinese customers are expecting from us. I think it's important in these types of discussions to not forget what has made us so successful over the last decades. It's been opening up markets, free trade, free competition, but also a level playing field. So as long as all of those frameworks are in place to make sure that we can do business in a sensible way, we're not worried.
Well, we have, though, Ola, an EU inquiry into Chinese car imports. Don't you expect Beijing to react with countermeasures?
We will see how this plays out and what comes out of that. And we like to remind people that open markets is what drives growth and also drives wealth creation. In fact, if you look at the history of our company, it didn't take Gottlieb Daimler more than 15 years to figure out that Germany is not the only attractive market in the world, and we've been here in the United States for more than 120 years now. So that companies go global and that competition goes global, I think that's natural. We had the Japanese come to the United States in the 80s and the 90s, then the Koreans, then Tesla came now when we're going into electrification. So let's keep markets open, let the market participants fight it out.
Annalena Baerbock, the German foreign minister, was speaking to our good friend and colleague Anne-Marie Hordern a little bit earlier on, Ola. She was saying that there's a risk that Europe is too exposed to China, that we need to be cautious in our approach to China. Do you think that European, German luxury car makers are, though, at risk of being overexposed to China, that that market has become too big for you and that politics could get in the way? How do you think about it when you get warnings like that from German ministers?
On the one hand, I think we learned a thing in the pandemic, that supply chains can be fragile. And to create some optionality and more resilience into your supply chains is generally a good thing for businesses. This is something that we have already started, especially on battery materials, where we have devised a strategy where we're going to try to, as best as we can over the next years, go into a kind of region for region sourcing. So yes, we do look at different commodities to make sure that their supply chain is resilient. But it would be a complete illusion to think that we can divide the world, the automotive world, into individual regions that have nothing to do with each other. These supply chains, or supply networks rather, are much too sophisticated. There are 5 continents in every Mercedes that is being sold. And that is the strength of market economy, that the invisible hand of the market figures out what the economic optimum is. So supply chain resilience, yes, but keeping the markets open and the market working, I think, is even more important.
You have a strike going on here in the U.S. Well, not you. The UAW is striking on Ford, GM, and Stellantis. You have production here in the U.S., doesn't have UAW workers, but you still got to be prepared for supply chain issues due to the strike. What are you expecting now, and how do you expect it to affect your business?
We don't expect any major impact on our business. And of course, Mercedes-Benz doing business in more than 150 countries and have operations in all major economic regions. We try to make sure that we're competitive, that we're an attractive employer. But at the same time, we're in transformation. The auto industry is getting more competitive, not less competitive. So whatever pressures we have on cost is going to have to be made up in productivity. So I think we have to be very mindful to keep the gain on productivity up and make sure that we don't have costs that run out of control.
But don't you expect, Ola, if they get a 20-25% increase at UAW plants, you're going to have to raise your price, your pay at some point in Tuscaloosa as well. Otherwise, you're going to lose workers to plants up north.
We have been in the United States, in the southeast of the United States with our plant in Alabama and also our commercial van operation in South Carolina now for in Alabama more than 25 years, almost 30 years. And we have always kept lockstep with what's going on in the economy to make sure that we have attractive jobs. So we watch that and we make adjustments as we go along. But at the same time, we look at, how can we do things better? How can we do work in a smarter way, get leaner, because the cost competition is not going to go anywhere.
Ola, do you think that companies such as yourself, companies like Stellantis and Ford, should be guaranteeing that workers that are working on combustion engines will have a place in the new EV world? Should they be guaranteed jobs? Should they be carried through this transition process?
I cannot speak for other automakers, but if I look at what's happening at Mercedes-Benz around the world, and primarily in Germany, where we have most of our operations, yes, we're investing heavily into the new technologies. The lion's share of our capital allocation goes into electrification and digitalization, and we're creating new jobs there. But the fact of the matter, on the powertrain side of things, the net at the end of this transition, which is a 10-year plus affair, is going to be less jobs on powertrain. On vehicle assembly, it's about the same, but we will use demography over this 10-year plus period, our demographics, to make sure that we can get into a position where we do this in a sensible way.
Ola, I drove recently the EQS. It's an electric, Euro-electric SUV. Obviously a very luxurious product as you move even more upscale. At the same time, the Tesla Model X and Model S are getting kind of long in the tooth. If you have lost customers to Elon Musk, are you gaining them back with this new push into, luxury electrics?
What we have seen with the EQS and the EQE, both on the sedans and the SUVs, and here you have some extremely high-tech, luxurious products. We didn't make carbon copies of our combustion equivalents, but really tried to create a complementary offering. And yes, we have a lot of conquest customers coming into those vehicles. People that maybe didn't look at Mercedes before that goes like, wow, Mercedes is going electric. This is interesting for me. So far that plan is working out quite well.
Matt, I have to say, you've got a big smile on your face. You look like you're enjoying driving that car. Is it as good as a nice engine? Are you a convert? Yeah, I've been tracking Matt's history as he's worked his way through this process.
You know what?
I'm wondering if we're there yet.
This is the one electric vehicle that may be able to win me over because of the pedal feel, because of, I hate to say it, I don't want to get flamed, but the fake sound, which I absolutely loved. It really felt like a big block more than an EV. And Ola, are you going for that? I mean, are you trying to make these electric vehicles feel like, the luxury V8s that we long for?
Of course, there's a different sound profile, but the way a car drives and rides, what you expect from a Mercedes, the safety, the quality, how everything just feels right. That is true for an electric vehicle as it is for a combustion vehicle. But for you, Matt, I got a special coming up next year. I know you're a big fan of the G-Wagon, the G-Class, and next year we're going to have an electric G. It's going to blow you away, promise.
I am absolutely looking forward to that. As you know, I have had the V8 version, so I'll see what the EV version is like.
This is a high bar we're talking about here, Ola, so I hope you know what you're doing here. That's a big promise for Matt. Final quick question. Champagne sales are beginning to falter. Luxury goods companies like Richemont are talking about the idea that even upper-end consumers are beginning to feel the inflationary effects. Is that going to be a challenge for you as well? Are you in that kind of bracket? Are you going to be affected by those same forces?
Our top-end vehicle sales for the first 6 months of this year were very strong. But at the same time, you have to watch the macro picture. In North America and in Europe, we have higher interest rates. Those higher interest rates are probably going to stick around for a while. That affects the pricing of capital goods in terms of financing and leasing, and that's about 50% of our transactions. So we have taken a cautious view on the macroeconomic side. That is why we have guided for vehicle sales at around the same level this year as last year.
Ola, great to see you. Thanks for stopping by to see us. We really appreciate it. I know Matt's looking forward to that. Is it G-Wagon next year? I'm very excited. I've heard him talking about it. So this is a big moment. Ola Hallanus, the Mercedes-Benz CEO, and of course, Bloomberg's Matt Miller. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
So, Guy, you were just talking to Ola about one of my favorite stories, and that is apparently the bubbly. LVMH has warned that there is champagne demand softening.
You've been drinking some of it.
Yeah, right. That was what I did in the last block. So this struck me because it's a joke that, like, whatever I'm doing, you should be shorting, and if I'm not doing something, you should be buying. And I hardly drink anymore versus my healthy champagne habit pre-COVID. So I feel like I am a good barometer of these not awesome champagne sales.
So what do? Do you downgrade? Is this good for the Prosecco markets?
Probably.
But it does speak. It speaks more widely, though, doesn't it? People are clearly having to downgrade their lifestyle expectations. You're hearing it from Ola. You've heard it from Richemont recently. Even the upper end of the income brackets are starting to feel the pinch. And champagne is probably the most obvious kind of way of viewing this.
Caveat. The caveat is that nightclub demand. No, nightclub and beach demand for champagne is still totally rocking. This is definitely a I'm no longer drinking champagne alone in my house scenario.
Was that a thing?
No. No. I was definitely with my 5-year-old, so that was definitely not it. But I think that's interesting. It's still the experience, but you're going out, not staying at home.
Yeah, it'll be interesting after the summer. Once all of this kind of revenge is over, are we going to continue to see this happening? The luxury sector is one of the areas of weakness for European equities today. Right down there at the bottom, continues to be an area of concern. Come back a little bit over the last few days. European equity markets are soft going into the close. The close is next. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Monday, a little soft. It's a busy week, but it really only gets going later on this week. Volume's quite light, so maybe the price signal isn't that good. We've come through, cautious start. But you do wonder whether there's a little bit of positioning in the element that in the story that we're seeing here and the elements that are contributing to it. Some of the UK house builders are a little soft today. The consumer definitely is a little soft today, the consumer side of the story. You're also seeing the banks a little weaker. We'll talk about SocGen in more detail a little bit later on the show. So that's the picture. France is down by 1.5. London's a little better, only down by 0.8%. But the traffic has really been one way today. We're down by 1.2%. We're still in a very sort of narrow range. Europe's been in this range for longer than the US, but the US, even the US markets, starting to feel a little bit range-bound. But it's certainly true, the narrative over here. So down by 1.2%. Single stocks, let's focus on them. Just talk through what exactly is happening here. Not exactly the new the start that the new management team over at SocGen would have hoped for. The stock is down by 12.47%. This is the new strategy update for SocGen. Where are we going? How do we be profitable? What are our targets? Didn't go down well. Look at the market, significantly underwhelmed. Ocado with a nice upgrade today. That stock responding quite positively as well. There's an Instacart kind of element around all of this as well, which I think is interesting. And Nordic Semi downgrading forecast. Look at how you get punished if you don't deliver. Look at how much you get punished if you don't deliver on those high expectations that have been set for you. Nordic Semi is a classic case in point. The stock is down by 10% today. So that's Monday. As I say, the week really starts to get, I think Wednesday the week really starts to get going. But tomorrow, we've got a whole bunch of stuff that we're going to be focusing on as well. We've got an interview with this guy, the German finance minister, Mr. Lindner, tomorrow. Future of Finance conference. That is where that is going to take place with Anna Edwards. You've got the IPEM conference taking place in Paris. You've got Kingfisher out with earnings. You've got UNGA destroying the traffic situation over in New York. And you've got EU CPI. I think that probably is the story that everybody in New York is focusing on. But you've got EU CPI. I think that's a later read. But the story, Alex, really gets going Wednesday. You've got UK CPI. We've then got the Bank of England. Of course, we've got the Fed to think about as well. We've got the BOJ. So the first couple of days, Monday, Tuesday, I think are a little bit quiet. Wednesday, Thursday, Friday are going to be huge this week.
Yeah, and to be fair, you probably can't trade very well because you can't get to your desk because of UNGA. So it is all interrelated. Okay, meanwhile, Nouriel Roubini, CEO of Roubini Macro Associates, talked earlier to Bloomberg Television about what the BOE should do.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation.
So he's saying go to 5.75%. Annika Trion is chief economist over at Van Lanschot Kempen joins us now. Annika, I know we do this as a day ahead, but really if the main event's going to be the Fed and the BOE and the BOJ, well, do you think the BOE would go to 5.75 and if not, pure stagflation?
Well, I think the issue is we've come from an era where all central banks were quite synchronized. So, inflation paths were relatively similar, rate paths were relatively similar, and it's now being all unwound from each other. And I think this week is fascinating because the Bank of Japan is in a completely different place. It's still at negative rates. The Fed has accomplished quite a lot on the inflation fight, and the UK hasn't. So, to be specific to your question, we believe the Bank of England still has serious work to be done, more than the ECB and definitely more than the Fed. So more than one hike to go there.
Annika, how much more serious? Like, how far do we go? How far does the Bank of England need to go? And how big a risk is there we get a policy error that actually tips the economy into what could have been a mild recession but could end up being a serious recession?
Well, it all stems on one thing, and that is this 2% inflation target. This target has come about, and this target is giving us a lot of troubles all over the place, including the UK. Why? Because if we are saying that 2% is the correct level of inflation, and if core inflation is significantly above there, which it is in the UK, but it also is in the US, it's very difficult for central banks to argue that they should just stop raising rates. At the same time, if you look at the real economy and look at structural things that are happening, which means structurally higher inflation for longer, whether it's the UK, whether it's the US, it seems strange to destroy the whole economy for the sake of this 2% number.
Longer term, though, if we get inflation expectations unanchored, isn't that the counter argument?
Yeah, I mean, obviously inflation expectations are key, but I think what people are looking at, whether you're talking about consumers or businesses, is price discovery. So if the world gets accustomed to an inflation rate of around 3%, I think we can manage. I think we can get over it. And look at how strong consumer spending is held up thus far. After very high inflation numbers, we get used to it.
The problem with all of this is, are we getting to the point where actually governments rather than central banks are where the challenge really lies? You've got big deficits. That's going to be a problem in the United States, which could end up pushing yields kind of around more than maybe central banks do. Here in the UK, there's structural issues that the Bank of England really can't deal with. Is the right tool now interest rates, or actually is it something that government, the Treasury, should be focusing on, dealing with some of these structural issues, rather than relying on the central bank to fight the battle?
Mm-hmm. I think it's a really good question. You've got to imagine it, as a big table. And on one side of the table, you've got monetary policy, central banks. On the other side of the table, you've got government's fiscal policy. The first issue is that the two sides of the table are contradicting each other. So the central bank's monetary policy is being very, very sharply restrictive, but the fiscal policy is very accommodative. So one side is putting extra cash in consumers' wallets, arguably, and the other side is pulling it out again. So that's strange. And the other part, to your point, there's structural things going on. I mean, look at the world, look at the balance sheets. Consumer balance sheets are relatively healthy. Company balance sheets are relatively healthy. Banks as well, relatively healthy. Governments, they're not healthy. They're debt loaded. So it's a bizarre time at the moment.
That is such a good way of putting it. It is completely bizarre. If you look for this, all central banks are going to come out this week, and it's not just the BOJ, the BOE, the Fed. There's a ton more too. What do you think is going to have the most market impact? Like, where's the volatility going to be felt the most?
So the most interesting one of all three is the Bank of Japan. Why? Because they are just standing out like a sore thumb. I mean, to be in negative rates in this day and age is again, bizarre, right? They're probably not going to do anything drastic, but the hints, the language, they've already started more accommodation with their yield curve control. That's important because if you're the only one being so accommodative, you are exporting that loose monetary policy in the world. So that's really interesting. Regarding the Bank of England, I don't think it's a big surprise that they hike. We're all expecting it. Regarding the Fed, they're expected to pause. They probably continue to pause. The thing there that's interesting is the dot plot, is the expectations that they themselves have around future rates. And, you know, the hopes that people had about rate cuts next year, how that works.
OK, let's talk about rate cuts and where yields are going to go. Annika, is there a danger that we get rate cuts or even just steady rates from the Fed and yields continue to climb higher? And I'm wondering at that point how the economy reacts. We're going to see so much supply coming through. We're going to see QE continuing. Maybe you're going to start seeing sales as well from places like China. If yields continue to climb in the United States, the cost of money continues to climb, how do central banks, how does the Fed react to that?
Yeah, and you said exactly the right word, supply. So let's remember the fact that we've had a 6-9 month period where bond supply, let's talk about treasuries, have been limited. Why? There was the debt ceiling, government spending was funded by the treasury accounts, etc. So with that bond supply coming up, you see the impact on yields, and that impact is quite sharp. So that's definitely taking its course above and beyond what central banks are doing there. And I think, to your point, it makes it quite puzzling. That's why you've seen equities, especially growth stocks, you know, very richly valued equities under pressure because the yields are squeezing through. So yeah, it definitely adds to the complexity of things.
Annika, great to see you. Thanks for stopping by to see us. Annika Trion, Chief Economist at Van Lanschot Kempen, joining us from Amsterdam. OK, just on a programming note, we're going to have an exclusive interview with the German Finance Minister, Christian Lindner. Anna has gone. I saw her with the suitcase this morning. She's off to interview Christian Lindner. We're going to have that interview for you tomorrow here on Bloomberg Television. European stocks are done for the day. Negative session. There's Christian Lindner. I'll show you the negative session in just a moment. We are looking at most stocks being lower. The French market's been under more pressure than most. Some of the luxury names have been down. The real story today, though, is what has been happening with oil stocks. But banks have been a big story as well. SocGen certainly under pressure, which is why the CAC is down. The stock's slumping the most in 6 months. We had the strategy update a little bit earlier on. We're going to talk about that next.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
This is Bloomberg Markets, and you are looking live at the principal room. Coming up, the Rio Tinto CEO Jakob Straussholm joining Bloomberg TV. That conversation 2:30 p.m. New York time. This is Bloomberg. Not a good day for SocGen. Stock down sharply. This after the company announced a few cuts earlier on to its revenue and profitability targets. Here to talk more about the challenges that are facing the newly installed CEO, Slawomir Krupa, is Bloomberg's Alex Rajvandari. Nice to see you. Expectations were very high. How on earth did they disappoint to this degree?
Yes, expectations were high indeed. Analysts in the last month were very enthusiastic about the new CEO, who argued for change and made his point to the board to be appointed because of that. Eventually, well, that didn't prove really to be fruitful today. He made some changes and made some pledges that were very important for the bank. Capital strength is a key element of his new strategic plan. Efficiency as well is cutting costs, but that is sacrificing growth really. So revenue growth targets are being lowered, profitability targets have been lowered too. When, you know, at the same time, BNP has increased its own target earlier this year. So it's really not a good look for the bank within the French market. The payout ratio as well is completely different. I mean, it used to be 50% of the underlying net income, and now it's 40 to 50% of the net. The reported net income, so it's going to be lower. And he indicated earlier today with analysts that the payout is going to be lower. It's fair to assume that it's going to be lower in the first years when the bank is building up capital, and then it might increase. But this is, like, I think, two main concerns for analysts and investors today.
Did he have to do this? Like, this just seems like a lot of disappointment. Like, did this kind of cost cutting, did this kind of focusing on capital buildup at the expense of profitability, like, did this have to happen?
Cost cutting was something that has been floated around by analysts for a while. Its cost income ratio was pretty high compared to peers. However, for the profitability, I mean, it's the thing is that Slawomir Krupa was in a tight spot until last week because SocGen has a history of presenting targets to the market and not really achieving them. And maybe it was easier for him to not do anything.
So honesty, not the best policy here. Could he have just said nothing?
At the same time, what he says now is that he doesn't have his view on the intraday share price. I was with him with other journalists when the share price started to drop this morning. And he said he wouldn't comment on that. That he had his view on the total return for the shares. In the long term, he agrees and argues and insists that his plan is the best for the bank in the long term. And it's a plan that has not a lot of promises, but at least promises that are achievable. This is a change from the ODR era where, you know, there were targets that were presented and sometimes they were dropped a few months after.
Is he blaming the previous administration, the previous management? Is he blaming the ODR era for kind of where the bank is?
Somehow he's hinting at this when with analysts he kind of said a few things about choices that were made that were not maybe ideal, but he's not being very, is not, you know, blaming everything on UDR, but because he was here at the time as well. But I did notice that he said that the plan he presented for the investment bank 2 years ago, all the targets were achieved then. So, yeah.
Fair enough. Alexander, thank you so much. We really appreciate it. Alexander Rajbandari joining us on SocGen. Yeah, it's a big head scratcher. Like, how do you get yourself out of that hole that you just dug there? All right, coming up, world leaders descending on New York for the United Nations General Assembly. We call it UNGA. We call it the traffic nightmare. We're going to discuss what's on the agenda and who won't be attending. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Stock's still going nowhere fast, but maybe a little green. But honestly, not a lot of movement. Abigail's tracking the moves. Abby?
Yeah, small moves, but a little bit more green than we had earlier. The S&P 500 E-mini futures overnight up maybe about 0.2%, then down about 0.2%, thereabouts. Now up a whopping 0.3%. So stock investors really trying to decide after 2 weeks of declines what way to push stocks now. As for some of the movers beneath the surface, because it's not all dull, take a look at Apple up 1.7%, despite the fact that the stock has been breaking down technically to some degree. There were reports that sales of the iPhone 15 may be solid. There's some mixed thought there between Wall Street analysts, but investors clearly going with the bulls. Lennar up 2%. You can see Tesla down 2.6%. 1%. Saudi Arabia and Tesla, according to the Wall Street Journal, talking about some AI production facilities. And then Moderna down 8.7%. I'm not exactly sure why. I'm looking at the news right here, but that's a pretty solid decline. As for the S&P 500 itself, not surprisingly, with this bear and bull or bull and bear battle, let's check in on this chart that we've taken a look at before. Here's the uptrend of the year. And now, over the last couple of months, stalling as investors try to figure out what next. Is there more rate hikes ahead? Is the economy going to slow? Last week, it did seem possible that we're going to break out of the range. Now we're back in the range below the 50-day. There's some lower lows, suggesting, Guy, that we may just see this S&P 500 go back toward the bottom of the range at, like, let's call it a little bit above 4,300. The important thing of any range, though, is not the range itself. It's what way it breaks out. It's still unclear whether this is consolidation before a big move up or consolidation before a reversal back down. Stay tuned. Never a dull day, except for today's small game.
We will certainly, well, today maybe, but it's an exception that proves the rule. Abigail, thank you very much indeed. What are we watching for the rest of the day? Instacart pricing ahead of its trading. That's going to happen tomorrow, debut tomorrow, basically. Watch out for that. We'll have some great coverage. The U.S. Treasury Secretary Janet Yellen, Hillary Clinton, speaking at the Clinton Global Initiative annual meeting. That is taking place in New York. New York's a little busy right now. Also in New York, I think he got here over the weekend, or there over the weekend, President Biden attending fundraising dinners tonight. Of course, he's going to be addressing the UN General Assembly tomorrow, Alex. I'm sure you and New York traffic, very much looking forward to that.
It feels like the trains also get messed up during UNGA. I don't know why they're related, but yet it somehow always happens. And then it's also pouring rain all day today. So all of this just means that Midtown stinks. Getting around Midtown, no good. Bloomberg's Amory Horton is in New York now, covering UNGA here for us. Amory, what's the most important thing you're watching this week?
So the most important thing actually I think probably happened, and that was Jake Sullivan, President Biden's national security advisor, over the weekend in Malta, sitting down with Wang Yi. Xi Jinping's not going to be here at the UN General Assembly. Emmanuel Macron's not going to be here. Mohammed bin Salman's not going to be here. Vladimir Putin's not going to be here. But China obviously plays a pivotal role in what is going on right now, whether it's the war in Ukraine, whether what's happening in terms of export controls. The United States is trying to make sure they're not getting access to advanced technology. And we've seen the U.S. have a number of meetings with the Chinese and their counterparts, but we've been waiting to find out if there would be one between Biden and Xi Jinping. And potentially this meeting with Wang Yi and Jake Sullivan could be the path to that. In November, Xi Jinping potentially could be coming to California at the APEC summit.
Amory, can we also talk about this prisoner exchange? Everybody's focused on the oil price right now. Everybody's trying to figure out where we go from here. Do we go to 100? What's going to happen next? How significant is what happened in Doha today? And what does that tell us about how relationships are developing between United States officials and Iranian officials, and how that's going to evolve?
Well, when you look at the oil market, what we do know from Iran is that there is a lot of Iranian barrels leaving the country, heading to China, and not a lot of the sanctions have been fully enforced. I think quietly that's been happening more. I would say U.S. officials pretty much agree with that. But all of this is taking shape around that prisoner exchange, which happened today, just a few hours ago, in Doha. These are 5 Americans, as well as 2 of them had relatives traveling with them as well. The Qataris and Omanis were really pivotal in making sure that the swap could happen. And for the release of these Americans, also Iranians, prisoners were released from the United States, as well as $6 billion of Iranian funds that have been frozen in South Korea were transferred to Qatari bank accounts that Iran will be able to use for humanitarian aid. This is what we're hearing from the administration. Only humanitarian, medicine, things like that. Although you did have Ibrahim Raisi, the leader of Iran, tell NBC that they can use it for whatever they want. But it does look like this is going to be strictly for humanitarian purposes.
So tie that in then to the relationship right now between the Saudis and the U.S., and if we're going to get any clarity on that, because it does feel like the Saudis have a lot of sway and a lot of hammers to inflict pain on the U.S. through the oil price, but they can exert a lot of energy, no pun intended, to get what they want. How does this all fit together?
Well, when it comes to Iran, it also fits together here along on the sidelines of the UN General Assembly, because what we heard from the Iranian Foreign Ministry is that there will be an intermediary that's going to talk to the Iranians and talk to the Americans. Potentially there is a path for opening up, I wouldn't say nuclear talks for JCPOA, but maybe an understanding of where they are when it comes to nuclear. At the same time, you do have Iran and Saudi Arabia opening up embassies, having ambassadors now. This is a breakthrough for these two main rivalries in the Gulf. When it comes to the oil market, Saudi Arabia obviously can flex their muscles, move the price, even though the United States is the biggest oil producer. We are producing, on track to produce under 13 million barrels a day this year, 12.8. The Saudis are under 10, but obviously they're a huge swing producer. And I think what was a little bit more shocking to watchers of the oil market in OPEC was that Saudi Arabia, instead of just going 1 month of cuts, they went for 3 months of cuts.
Yeah.
This becomes very political because we're heading into an election year and U.S. gasoline pump prices are heading towards $4 a gallon.
Absolutely. So given all of this, what do we think the president's going to say tomorrow?
I think the president is going to double down on the support for Ukraine. Again, this becomes very political because you have Zelensky here for the UN General Assembly, but the more important meeting is going to be not just when Zelensky goes to the White House in Washington later this week, but when he makes a trip to the Capitol. Who is he going to talk to in Congress? Who wants in Congress to have a meeting with him? Because remember, it's very challenging right now to get Ukraine aid across the finish line in Congress. It's not even included in this continuing resolution to keep the government open, the supplemental aid that a lot of Republican hawks want, but some of the far right flank in the House Republicans do not want to see. I think you're going to see the president really want to double down on that when it comes to Ukraine aid and Putin's aggression.
Anne-Marie, thanks a lot. I'm looking forward to having you here all this week. Anne-Marie Hordern joining us on UNGA. Okay, again, stocks going nowhere. Maybe tech up by 0.1%. Nothing to write home about here, but lots of things happening in the next week. That wraps up for me and Guy. Coming up, Bloomberg Technology and Stellantis CEO. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, September 18th. Here are the top market stories we're following for you at this hour. Next up, 100. We're going to speak to Mike Wirth, Chevron chairman and CEO, on triple-digit oil prices, strikes, and more. And the impact of that $100 oil prices could put a dent in the soft landing scenario. We get the take with Bruce Richards, Marathon Asset Management chairman and CEO. And no deal, strike on day 4. The UAW rejects a 21% pay offer from Stellantis. We're going to speak to the Mercedes-Benz CEO on the state of the auto industry. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. That said, there's a lot of news flow, but I got to tell you, equity is going absolutely nowhere.
Yeah, but it doesn't matter, does it? It's all about oil today. You must have written those headlines with a spring in your step.
I really did. I
Oil
was very excited.
is the #1 story. Are we going to do 100? Maybe. It's going to have an impact if we get there, certainly.
Yeah, absolutely. And also, if we're looking at a new range, 80 to 100 versus 60 to 80,
Yep.
which is maybe what talked about, say, 6 months ago, that also might be a little bit different. But different for who? Investors or the Fed?
Okay. Are we going to hear the words crack spread today? Are we,
Yes,
I'm
just
just wondering
said it.
how much jargon.
You just
I said it. You're not allowed to, okay? You are banned from the whole show
Fine.
from using any oil jargon, okay? That's the rule today. No oil jargon.
No.
I can do it. You can't.
Okay, fine.
That's fine. That's
you
where
just
we are.
can't say ESAF, okay?
Okay, I will find a way around of saying that. Sustainable aviation fuel is what she's talking about. So our question of the day is a fairly straightforward one. We've already alluded to it. Does $100 oil mean stagflation, not only for the US economy, but for the European economy, for the global economy? Let's bring in our panel to discuss. Manus Cranny, you can take the strudel out of his mouth, but you can't take OPEC out of his blood. And Liz McCormick, of course, on what is happening with the US economy. Manus now to be found on that side of the Atlantic. rather than less. Manus, I'm going to start with you. As I say, you can take the strudel out of your mouth. You are an OPEC veteran. Are we going to 100? I use the word veteran in the nicest possible way.
It's fine.
Are we going to 100? Are we? Is that the direction of travel, and can we make it stick?
Marcus, good morning, Guy. Good morning, Alex. It's lovely to be stateside. Markets like to test boundaries. They like to test the upper band, the lower band, and there's no doubt about it. The trajectory of the market, the hedge funds are as long as they've been. And this is going to be it. How quickly, probably, do you get to $100? And with what kind of volume and size? So in the first instance, I think everybody likes to try and test the market. And I think that's what happens next. It's not about necessarily whether China emboldens the growth story, but you do have to have a base case of where you've hit peak pessimism on China to develop $100 oil.
And I should point out that he just gave you shade, Manus, because I always call Guy old, so this was like a moment where he could like move that shade somewhere else. So just know that that's part of our show.
Yeah, I can take you back 25 years. I worked with Guy Johnson 25 years ago.
Right.
Shade.
So this is part of the show. Liz, I won't do that to you, but I will say the Fed is completely going to say we don't look at oil prices, et cetera, et cetera. Is that actually true?
Right. But, you know, Chairman Powell has said a few times, like, why we care, because it goes into headline. They're more concerned with core, like you said. But he does say that what they have found is that headline, if it stays high, can bleed into inflation expectations. Because if you and I see higher gas prices from oil, we start to say, oh, boy, maybe inflation overall is going to be higher. So that's why they care a little bit. You know, they do look through that. But it's not like it doesn't matter at all to them. Yeah.
Liz, is this stagflation, though? Is that the direction of travel? We get to 100, is stagflation going to be the story? Because at that point, the soft landing becomes harder and harder.
Yeah, I mean, I think it depends. Like in Europe, there's already so much stagflation talk, right? So that's a different ballgame. But in the U.S., $100 plus, we were saying, could go to 110. It does not help. I mean, in this backdrop, too, on the economic side, like Alex was laying out, the auto worker strike, if that goes on every week, shaves off a little bit of economic growth. In Washington, we have the risk of a government shutdown. Which if that goes on for a while, we haven't had it yet, but by October 1st, if they don't get together with these spending deals, that could slow growth. So that would not be ideal for the Fed. These things on the backdrop, slowing growth, oil, headline inflation going up. I'm not sure it kills. I think the Fed is really, really wanting to pull off the soft landing, but that doesn't help their case for sure.
Hey, Manus, what do you think of $100 oil in terms of what the Saudis want? Like, I thought it was demand destruction in triple digits.
Well, I think we go into a new, as we sat down and you were getting ready to come to I think our discussion was, well, we've got to discover where the new price destruction kicks in.
Yeah.
It may well have been in the depths of the pandemic or whatever. It may well have been at $80, $90. Here you are, you're going to test $100. I want to read to you what Halima Croft sent through just last week, and I like it because I think it gives it context. Completely unimaginable just a few months ago, striking or hyping distance today is $100 oil. The Saudis need fiscally 80 for a real comfort zone. The Emiratis are down at 40, 50 bucks. But for the big mega projects in Saudi Arabia, they need $100 oil. That's what Bloomberg Economics have run the numbers. Today, Prince Abdulaziz bin Salman speaks in Canada. It's going to be interesting to see what his tone is, where he pushes the market, because they took the heat out of the market by going for the extension on the unilateral cuts guy. And they took the heat out of the market by extending that through to December. So in many ways, we already know the shape of the supply constriction and the deficit construct.
And the Russians clearly want higher oil prices as well. That's in the mix there as well. Liz, we talk about what Saudi wants and the price that it wants. What about the United States? The United States is now a massive oil producer. The dollar is in so many ways a petrocurrency. Doesn't the US benefit, therefore, in some shape or form from a higher oil price?
Yeah, absolutely, they do. I mean, you know, it's changed since decades ago. We won't talk about veterans of us anymore. But yeah, we do benefit. But on the flip side, you know, like we're on this cusp of could we get a soft landing? You know, for the consumer, like I was looking at gas prices, I'm like almost $4 again. But then again, it was at $5, right? You know what I mean? So it hasn't kind of get to the core yet. But yeah, oil prices rising will help many companies in the U.S. as well. But they're facing other headwinds too. The slowing consumer, even though we're doing okay, you know, you hear that even in the earnings calls, you know, people are trading down, so to speak, and buying cheaper things. So, you know, I think it'll help, but it's like cross currents, and the U.S. market has other forces at play that are troubling, driving yields higher, and, you know, this doesn't help.
So, Guy, it's interesting you make that point, because you could argue that the administration would want 60 from the demand side, but you know what really helps when you have higher oil prices? EV car sales. So you have to wonder, like, how that kind of plays into the conversation, too, because that's really the impetus. Like, that's where you're going to get a shift. If you get higher gasoline prices that you just can't make, then you're going to want to go buy an EV.
But you can't buy an EV because the UAW is on strike.
Oh, you can't. I mean, maybe a Tesla's.
I'm
and
joking.
they just discounted prices.
I'm joking. Yeah, you can, but what it might ultimately mean, therefore, is if you've got more restricted supply, you've got higher prices for autos, which is another challenge on the inflation front. Used auto prices have come down. Maybe they start going back up again in a meaningful way. That's what we saw in the pandemic. It was interesting. We were talking about this on Friday. During the pandemic, auto prices went sky high because you couldn't get new and you could barely get used. We know because you bought a car at a very elevated
Jasper,
price.
100%,
you may have got a low yield, but you paid a high price for the car. And that's maybe the scenario we're going to end up with again here. And that could, again, just feed back into the inflationary story.
Yeah, and I have to wonder, too, and then you add on something like the consumer spending less because of the student loan debt issue, right, and having to pay more there. But there are all these things that we worry about that we've worried about for like a year, and there are always new things, but it doesn't seem to make a difference.
Right. In the stock market, I think Jess Menton had a great story saying everyone thought the stock market was going to do so bad this year, and people having to revise their forecast because it keeps going. That recession, what do they say, the best forecast recession that hasn't happened yet, being pushed into next year. So, yeah, maybe we surprise to the upside again.
The one thing that I would just throw in here is that we haven't touched on the petroleum reserve in the United States, which is at the lowest. We need to double check the fact, the lowest since the 80s. And herein lies the point. When there was so much vexation between the United States and OPEC in the latter part of the autumn of last year, in that bunker, they released press release after press release. When Jake Sullivan came out, here we are with this, the petroleum reserve here. It's at a low point. That instrument that the Americas had to bolster the gasoline prices that you talk about rising it's not destructive, but it's much less muscular than it was when they last clashed with one another. And they're not clashing to the same extent because geopolitics is now much more important to the Americans with the Saudis, with Iran in play, and Israel.
Yeah.
There's a whole conflux of geopolitics which reduces, and also the SPR, not necessarily as muscular as it was.
Oh my gosh, yeah, like non-existent. Guys, thanks a lot. This was really fun. Bloomberg's Liz McCormick and Manus Kearney, co-anchor of Bloomberg Brief. That's at 5 a.m. New York time. Good to have you on this side. All right, coming up, more insight into the question of the day. Does $100 oil mean stagflation? Bruce Richards, Marathon Asset Management Chairman and CEO, joins us next. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
I've argued that the era of the great moderation of low inflation below 2% and stable growth is gone, and we're entering an area of what I call great stagflationary and financial instability.
That was Nouriel Roubini, the CEO of Roubini Macro Associates, speaking exclusively to Bloomberg TV earlier today. That kind of sets us up for the question of the day. Does $100 oil mean stagflation? And if anything, does it take the soft landing scenario off the table? Bruce Richards, Marathon Asset Management Chairman and CEO, joins us here. He braved the UNGA traffic that is erupting here in New York City. Hey, Bruce, what do you think? Does $100 oil disrupt it?
You know, short answer, no.
Okay.
But there's a yes part to it, too. And so here's the no. Growth here in the United States, well, first of all, stagflation is slow economic growth with inflation. And right now we have very strong economic growth. And what you're going to see is the third quarter, which is the quarter we're in now, which doesn't end until September 30th, will be reported in the third week of October. And it's going to come in, and people don't realize this, not a 2% GDP, not a 1% GDP, but a 3.5 to 4. And here's the reason why. Nominal GDP right now is growing around 6% GDP. We saw that in the prior quarters, and that will hold for the third quarter. But the deflator, the GDP deflator, is slowing to 2. And so it's unlike CPI, how it's calculated, and it's going to slow to 2. If you have 6% real minus that 2% deflator, you might get like a 3.5 to 4% print. And then what does the Fed do when they have November 1st, their next meeting? Obviously, they have a meeting this Wednesday, which they're going to hold and do nothing and say they're data dependent. But when they get that data set, late October, what do they do November 1st, their next meeting? And that is the $64 question. That's the big question for me. So here in the United States, growth has accelerated a bit. It feels relatively strong with inflation. So I'd say no here. But the yes part is just go across the pond to where Guy is, and you look at Europe, and the ECB is calculating for next year growth coming in at 0.8% after having raised rates to 4%. And so there, with inflation high and oil approaching 100, $95, but approaching 100, and Germany already probably toggling on recession right now, the answer is unequivocally stagflation for Europe, yes.
Just walk me through the impact, though, Bruce. And believe you me, we're already beginning to feel it. The energy story is going to rip through Europe in a way that it's definitely not in the United States. But I'm wondering what effect it is going to have on the United States. Is the effect that it slows the consumer down, $100 oil? What effect does $100 oil have on what is effectively a petrocurrency economy? You guys produce a lot of oil.
Yeah,
I'm just wondering whether $100 is a good or a bad thing.
Well, it's great for the energy companies, not so good for the consumers, of course. And the consumers, look, higher wages and, and higher yet, but higher wages is really good. And, relatively full employment with higher wages is great for the consumer. And so looking back for the consumer, been great. But here's 3 things, and one of which you hit on. But first, related to consumer, first is that student loans for 27 million of the 152 million workers here in the United States, about 18% of our working population, have a student loan that they have to now service on October 1 that they haven't had to make a payment in 3.5 years. That's number one. Number two is what you said, inflation. Inflation is still relatively high, and higher oil prices at the pump are going to hurt them. And number three, of course, is the simple fact that all excess savings is now gone. And so all that huge COVID stimulus and huge COVID savings plan that we had among America is now been eaten away. And so the consumer looking forward looks to be vulnerable, and we're starting to see that in some of the delinquency rates going up and some of the credit card balances and borrowing rates going up.
I mean, you're the distressed debt guy, so this is like, yay, good time for you. What do you like? What are you buying? Where is there opportunity, really opportunity now? Well,
the biggest opportunity, I think, is in CRE. So the commercial real estate market and Signature Bank, FDIC is holding an auction, as everyone knows. It's been in the public. FDIC released this information, $33 billion of loans. And here in New York, since we're New Yorkers, Alex, about 2/3 of that portfolio are multifamily loans, and they're selling it in 13 different parcels. We'll be bidding on that. And so there's lots of, I think, product coming out of the banks, because I think Jamie Dimon's right. Don't buy the banks is a theme. And I think he's right, because it's not only the stricter regulations, but it's the higher, I think, loan loss provisions are going to go through. With the higher rates, they're really impacting the consumer, businesses, and real estate. So number one is real estate, and number two are businesses. Do you know that 2/3 of the B3 rated companies can't service their debt without burning cash? And so the cash burn is real, and the number of downgrades is offsetting upgrades by a ratio of 2 to 1 at this point. And so we're starting to see more and more defaults coming through the system, Guy.
Bruce, let's just talk about kind of where we are in this process. If you had $1 in your pocket, you had $1 in your pocket, have you spent half of it? Have you spent 50 cents? Have you spent 25 cents? Have you spent 75 cents? I'm just kind of wondering, are the opportunities now, or are you waiting for better opportunities further down the road? How much have you deployed? How much are you going to deploy?
There's a lot of dry powder. Away from Marathon, there's about $1 trillion in dry powder in private equity, and there's hundreds of billions among the private credit managers that are going to be investing capital in the marketplace. So how much have we deployed? We have a lot of our book that we have in the markets now, earning really nice cash flow. It's the highest return that we've made in a generation. Remember, Fed funds is the highest rate in 22 years. We haven't seen the Fed raise rates by 500 basis points or more in 40 years. And so it's the golden era of credit because we're getting paid such high rates of return for making our investments. And so having said that, we always like to have dry powder to be able to deploy capital in the marketplace. And yes, we have our fair share of dry powder. So the numbers are, in the billions, and we're very well poised to deploy that money when there's real dislocation in the marketplace. And the real dislocation hasn't quite happened yet,
right.
But it's in the process of happening, we believe.
What do you hate? What do you definitely avoid?
Office on 3rd Avenue.
Okay.
Top of the list. But, there's a lot of CRE that's going to bust.
Yeah.
And the more you keep rates higher, the worse it's going to be. There are a lot of companies that are going through some type of structural decline.
Mm-hmm.
And there are other companies that, came up through the SPAC market or too early, got funded in the credit markets, but they're more venture-like that don't really have earnings. And we avoid all that. And so what we like to look for are good operating businesses with good cash flow in place that just have high debt cost service. And, companies in the next few years are going to have a real issue because they're going to pay a lot higher labor costs. You see that with the UAW. You see that in Hollywood. Yep. You see that with what the pilots negotiate with the airlines. The labor costs are increasing, and we love to see labor cost increases. It's good for America. Mm-hmm. It's good for Americans. It may not be good for corporate earnings. What's also not good for corporate earnings are these higher funding costs. Now, Apple and Microsoft are making more money off of the cash and the 5.5% rate that they earn on cash than the 2% rate that they pay on their bonds. And so while the rich companies are in really good shape in terms of debt service, it's the thousands of others of mid-sized companies that really represent the Russell 2000 that are going to be stressed. And so we're going to be there to help them, to provide capital solutions, to provide capital for good operating businesses that just need to make it through.
The big opportunities, the bulk of the opportunities still yet to arrive. That's an interesting line. Bruce, great stuff. Nice to see you. Thank you for braving the traffic for us. I hope the journey back is not too bad. All the way across town. Bruce Richards, Marathon Asset Management Chairman and CEO. Still ahead, we need to talk about Disney holding preliminary talks for its India streaming and television businesses. There's a cricket element to all of this, which is important. Details on that next. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
"7 on the West Coast. Time to go to the startup. Top tech stories from the Bay Area and beyond. Silicon Valley starting this morning. We're not actually going to do that today. We're going to talk about Disney. We're going to talk about what's happening with the business, which is about to change quite significantly. We're going to do it from New York. Technology co-host, Bloomberg Technology co-host Caroline Hyde has kindly joined us. Disney's about to change in quite a big way. ABC, India, these are seismic shifts.
Yeah, these are an asset shake-up, ultimately, where the signal that we've got to take away from Bob Iger is that he wants to focus more on the streaming, the future of parks, and move away from linear television and ultimately some of the asset burn that they've seen there. This really is trying to signal that, yes, we're looking at India, but Reliance Industries may be having an appetite to get more into what is Disney Star, but maybe it's more Hotstar as well, the Disney Plus offering, the streaming offering. We've kind of seen it signaled since Bob Iger went out to Hong Kong back in July and sort of said, look, I'm not that happy with the way in which the assets in India are performing, particularly since they lost the rights to the IPL. I know this is a big one for you, Guy, the cricket. They haven't lost all of their cricket assets there, but they have been largely losing that key element of subscriber growth. But then twin that into the fact that we're thinking about whether or not they let go of ABC, the TV, the cable channels, some of the FX and National Geographic is something that Byron Allen is looking at. We know that Nexstar is as well. So there is a lot of reshuffling going on. And that's not even talking about Hulu and the option to buy the Comcast amount from there back in 2024.
So I've been in this industry for almost 17 years, and I have heard the death of linear TV since the day that I started. What's the level of confidence that people on the street have that something will actually get done?
I think KeyBank, for example, some strategists there were slightly worried by the signaling that they might be getting out of linear TV because they say, well, what does that mean ultimately about the way in which this is disintegrated, the void, the hole that perhaps linear TV becomes, and what it means to the rest of the legacy assets that Disney might have. Yes, you're right. Ever since I got into it, too, everyone's been trying to call the death of linear television. This is close to all that our bones right now, so it's an odd sort of story to be telling about. But the fact that Bob Iger is trying to signal that he wants to get out, I don't think really sounds that great.
Yeah, no, fair enough. All right, Caroline, thanks a lot. We can catch you at 12 o'clock with Ed Ludlow. Coming up here, Chevron CEO Mike Wirth joins us in studio for an exclusive interview. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for All and Hunger for None. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
We welcome now our Bloomberg TV and radio audiences. Today, we are focused on oil as Brent nears $95 a barrel. No better guest to discuss that with than Mike Wirth, Chevron chairman and CEO, joins us now. Mike, it's such a pleasure to see you. Thanks for joining.
Alex, it's good to be here.
Okay, $100 oil. Is that going to happen?
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening. Inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
Mike, good morning. It's Guy in London. What impact do you think $100 a barrel will have on the U.S. economy? What impact will it have on the global economy?
Well, certainly those are higher prices than we tend to see out over the long term, and so I think it will have some effect on the economy. But we've had relatively higher oil prices here now for most of this year and certainly all of last year. The recession that everyone's been talking about hasn't arrived, and so I think the underlying drivers of the economy in the U.S. and frankly globally remain pretty healthy. So I think it's a drag on the economy, but one that thus far I think the economy's been able to tolerate.
Have you adjusted your price deck? Meaning, that's my question, being like, are these higher prices sustainable for the long term?
Yeah, we take a very long-term view on supply, demand, policy, technology. We haven't changed our long-term price, but we really don't change that very often, and not in response to what our short-term. We've been in a volatile market really going back to the pandemic when things came down, the recovery when it was high, the war. So this has been a period of time where prices have been unpredictable and volatile and not what you would call mid-cycle.
Mike, if I worked for you, if I worked for Mike Wirth and I worked for Chevron, would this be my cue to say, Mike, can I have a pay rise, please?
Well, we're certainly seeing, I think you're making reference to what's going on in different parts of the world. We're seeing organized labor, in many different industries now, kind of assertively step forward and say, look, we want to be compensated. We see the inflation in the economy, and we've seen companies recover. We've had a very strong pay program last year for our employees. We try to stay very competitive, and I would expect we'll continue to do so.
That is Guy's way of getting into the strike action that's happening in Australia with Gorgon and Wheatstone. So far, cargoes have not yet been impacted. You're using some non-union workers, right? Is there a point where that would change?
Well, we certainly hope that what we'll see is a negotiated agreement. Others in Australia have reached agreement with these unions. We've been at the table bargaining in good faith, and that's our desired outcome. That said, when we face potential strikes anywhere in the world, we have to prepare to maintain operations. Our products are vital to the global economy and the flow of those commodities, particularly LNG, in a world, as we've seen last year, where it's important to keep economies going, not just in the region in Australasia, but also in Europe. That's our responsibility. And so we do prepare to maintain operations even during an industrial action. And thus far, we've been able to successfully do so in Australia.
Do you think if I'm sitting here in Europe, I should worry about what's happening here? Is this going to be a problem when we get to winter, do you think, Mike?
Well, last winter, Europe came through better than I think most thought, Guy. Now, inventories were high going into the winter because Russian gas had been flowing in. Industrial demand really came off, and then it was a relatively mild winter. We certainly can't count on all of those things happening again, but gas inventories in Europe are pretty strong right now relative to history. And so I would say Europe is set up much better than it was last year. The weather is always difficult to predict, but I feel like Europe is in about as good a place as it could hope to be at this point in time.
That's one of the weird things about looking at China growth, because obviously Europe wants China growth, but the energy sector probably doesn't want China growth if you're in Europe because of the demand pull. What are you noticing in China, whether it's LNG or oil demand pull?
Well, it's been gradual. It's been slower than people expected it to be, but it is coming back. And I think that's one of the reasons why you've seen crude oil prices tightening.
Is that inventory restocking, do you think, or is that end user demand?
It's always a little bit hard to tell. The data out of China isn't exactly as transparent as it is in other parts of the world, but I think it's probably indicative of an economy that is finding some traction and is moving forward. We're going to see record oil demand this year. All-time record demand, right up a couple million barrels a day versus the prior year. It'll grow again in the year ahead. And so as long as the global economy stays relatively healthy, demand for these products steadily marches forward.
Mike, you've mentioned inflation a couple of times already in the conversation. Are you still seeing inflation? Are you starting to see deflation in certain areas? What does the cost side of the equation look like?
Yeah, so we've certainly planned for inflation. What we're experiencing is consistent with how we laid out our budgets for this year. I wouldn't say we're seeing deflation anywhere in a meaningful way. We may be seeing disinflation, right? So a reduction in the rate of inflation. And it tends to be isolated to certain parts of our supply chain, certain geographies, a little bit more than something you would describe as widespread. I think wage pressure is pretty broadly distributed. Other things in our supply chains tend to be focused in areas where there's a lot of activity, like West Texas and the Permian Basin, which has seen a little more pressure than some other parts of the world.
Yeah, so to that point, can you increase, if you take U.S. shale for a second, the Permian, can you increase productivity enough to offset those costs when a lot of your spending in the next, say, 10 years will be in U.S. shale? That
is the big question right now that we're confronting as we're putting our plans together going forward. Thus far, that has been the case. And in fact, productivity at a time when we saw lower inflation was marching forward much faster than costs were, which is why we saw cost of production coming down. I think those are coming into more of a balance today. And I think the forward view, the question is, can you continue to move up that productivity ramp and offset inflation or not? I think it's early to say. The one thing that is sometimes not talked about in this discussion, we've seen a lot of productivity gains on drilling and completions. We're still only recovering about 10% of the molecules that are in place. If we can improve recoveries, that changes the entire economic equation in a very profound way. We're working hard on that. We expect to see recoveries improve over time. So it's another leg of that equation, which is not necessarily productivity on the activity, but it is on the recovery and the economic equation.
What is that? Is that 3+ mile laterals? Is it going to be just different types of enhanced oil recovery? Like, what's the super magic sauce for you?
Yeah, we're working on a lot of different things. We're certainly drilling
You're not
longer.
gonna tell me.
We're drilling longer laterals. We're working on different completion technology to create different fracture geometry so you can get more flow.
Does that all cost more money, though, to do, too?
It does. And so that's why you've got to evaluate the economics of this. We're working on chemicals that can enhance recovery in terms of the interaction right down at a molecular level. And all these things you have to have to pilot them in a lab, you have to pilot them in the field, you have to understand if you can scale them up and if they make economic sense. That's been the history of our industry. The technology tends to solve these things. We've got a lot of smart people in our company and in this industry, and a lot of incentive when you know where those molecules are to figure out how to get them to flow in a way that's economic.
I said to Alex this morning, Mike, that she wasn't allowed to use any technical jargon. I think you guys just about skirted around it in that part of the conversation. You were fine. You were fine. You get a pass on that one. Mike, you talk about the fact that you've got lots of smart people. Do you have lots of smart lawyers? One of the things that Alex and I were kicking around before we spoke to you this morning was what is happening with this California case and the fact that increasingly it looks like climate change is going to be litigated. Is litigation the right way of dealing with this?
In a word, no, it's not. Look, this is one of many such actions that we've seen over the years. Ironically, a number of them filed on behalf of people who have actually profited from and encouraged energy development. Climate change is a global issue. It calls for a coordinated global policy response, not piecemeal litigation that benefits attorneys and politicians. So we do have smart lawyers. We will deal with the lawsuits. But more importantly, we're working on finding ways to meet today's energy demand with energy that has less carbon intensity and still is affordable and reliable for the economy, even as we're investing in new technologies like renewable fuels and hydrogen and carbon capture to build a new energy system over time that is inherently lower carbon. That's a constructive approach. That's where we're engaged. That's where most of my attention is focused.
Okay, so to this point, you guys are going to become majority owner in what could be the world's largest hydrogen production and storage facility. There's that. You do have a huge carbon capture facility next to Gorgon in Australia, et cetera. These things are huge and they're expensive, and some have been around for a while. Hydrogen, though, is new. How do you know how much CapEx to realistically allocate before you're like, this is too big and it's a money suck? How do you see this playing out?
Well, it requires a lot of judgment. You have to spend time. You have to really select. There are many opportunities out there. There's a lot
so
of
why hydrogen, for example?
There are a lot of places you could invest in hydrogen. You can invest in blue hydrogen. You can invest in green hydrogen. There's different carbon intensities. There's different technology pathways. We've got an entire organization that spends all its time working on the technical, the commercial, the practical engineering realities of these things, and looks to find the best places to start. Certainly in the U.S., we've seen some policy through the IRA, which creates incentives. Those aren't intended to last forever, but they can help prime the pump as we bring the technology costs down. The project you referenced is a project in Utah, which is actually very economic today. We'll take surplus renewable power that comes primarily from wind in the western U.S., and when it's more than the grid needs, which happens during certain times of the day, we can use that to convert water into hydrogen. We'll store the hydrogen in underground caverns, and then at other times of the day when you want to bring that power back, we can bring the hydrogen out of the caverns. It can be put into a gas-fired power plant along with natural gas to produce lower carbon electricity. So it's an example of something that's technically feasible. The economics and contract terms on it give us a return on our investment, and it's a platform from which we can then grow.
So great to see you, Mike. We could go on forever, but we have to leave it there. You're also a busy man. Mike Wirth, Chevron Chairman and CEO, thank you so much. All right, we are about an hour into U.S. trading sessions. Honestly, stocks are doing nothing. Abigail's tracking the moves. Abby?
Yeah, it's not just stocks. Take a look at this board. Really no movement here on this Monday, a quiet Monday. Stocks down slightly, fluctuating all around the map, really, but on small moves and also on below average volume. The Bloomberg Dollar Index doing the same thing after its big gain recently, just sort of holding pat here. You can see yields not doing all that much. Earlier they had been higher, now about flat. This is interesting, though. We do have the VIX up a little bit now at a 14 handle. The fact that you have the S&P 500 down, not a commensurate amount, may suggest that some more volatility is ahead for stocks. Now, very appropriate for the conversation that you all were just having with Mike Wirth. And the question of the day, let's take a look at one asset class that is moving. That, of course, is oil. Over the last 3 days, this is the 3-day chart above $90 a barrel. Over this time period, up 3.8% at almost $92 a barrel. Now, the question of the day, of course, begs the question of whether or not we do get to 100. Let's take a look at the technicals. And I was expecting it very firmly to say, yes, we're going to 100. However, when I charted it out, it's not quite as clear. And I say that because you can see this year over last year from the peak, there is this perfect descending trend channel, which we are hitting up on right now. Now, this bluish area, that tells you the buyers are very strong. They want to take oil to 103, 105, somewhere in there. But if they can't get it above, let's say, just basically $92, $93, we could actually see oil move back down in that range. It would be surprising to me, but this chart certainly makes the possibility that we may not even see oil hit $100 in the near term.
Well, that kind of undermines our question of the day, but Abigail, okay, that's fine.
We'll go with it. It's
Abigail,
fine.
Doolittle. Yeah, we'll go with it. The momentum seems to be there at the moment. You never know. Okay, what are we going to talk about next? The UAW, the United Auto Workers strike entering its 4th day. Both sides are very much digging in at this stage. What's going to break this strike? We will find out next. The latest. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
This is Bloomberg Markets. You're looking at a live shot of the principal room. Coming up, Rio Tinto CEO Jakob Stalsheim joins Bloomberg Television at 2:30 p.m. New York time. This is Bloomberg. It is day 4 of the UAW strike. The United Auto Workers and U.S. automakers appear to remain far apart from reaching a deal. Here with the latest, Bloomberg's Detroit bureau chief David Welch. The latest is Stellantis rejecting that, offering that 21% pay rise. The UAW says no. What's next?
22? We'll see.
Fair enough.
Look, I thought this deal would get done somewhere around 20%. That would be what the union wants. But there are other demands on the table, right? You know, this 32-hour work week, which I don't think they'll get, retiree benefits, a pension. I don't think they'll get those, but they do want cost of living allowance, which is, you know, kind of adds to their raise, gives them inflation protection. You know, maybe I think the companies are going to need to improve the formula. They've already kind of decided that they need to offer what they call COLA again. It's just how do you calculate it, and I think that's where they will go back and forth. It'll probably have to be a bigger raise. And then there are other issues. GM's the only one so far that has really absolutely guaranteed employment throughout the life of this contract. And I think Ford's probably there too. The union, there was some kind of tit for tat over the weekend on whether or not there were guaranteed jobs at this plant in Belvidere, Illinois. That's a sticking point. But they're going to need job security guarantees as well. The big question will be, what do they do for the retirees? That I think determines whether this is a very long strike or just another week or so.
Interesting.
David, there does seem to be this sense that we're just negotiating. It's going to get done. Don't worry, a deal will get sorted out. Is there a danger that A, the companies, and B, the financial markets are underestimating just how angry the unions really are?
Look, I think everybody already has. There was, the financial markets have built in a big discount that's in the shares already. That's why when the union does something, when they refuse an offer, you don't see the shares get hit by very much because the market was already there. But I do think the companies themselves also may have, they didn't know Sean Fain, the new UAW president, very well. So it was hard to get a read on how he was going to handle this, and he's done this. All of this has been done in a very different way. And I think that's caught them by surprise, and the market doesn't know exactly how to read it. So, look, this could go on for a while. The one thing I will say, though, that maybe a bit positive, over the weekend, we did see them, unions saying that there was progress made at Ford. And they said that they had a decent meeting, I think, with GM yesterday, and they were going to reconvene with Ford and Stellantis today. those were more positive things than we've heard. Usually whenever there were meetings or offers, Sean Fain would go on Facebook Live and say how terrible the offers were, and you know, how they weren't respecting the work that the members do. So it maybe an absence of negativity tells us that there might be a bit of a pivot here in progress for talks.
We're going to watch the space very carefully, and you're going to help us do that. David, thank you very much indeed. We're going to dig more deeply into this topic in the next hour. Ola Halanus is the Mercedes-Benz CEO. We're going to be speaking to him, as I say, in the next hour. Looking forward to that conversation. Coming up in this hour, we are going to gauge investor appetite for Instacart's long-awaited IPO. That's in today's Wall Street Beat. Sonali is coming next. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
Time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance around the world. And we're taking a look at Instacart's upcoming IPO. Joining us now, Bloomberg's Sonali Basak. If I'm a banker on the Instacart IPO and I'm looking at ARM today, am I nervous?
It's so funny that you say that, because it's the first thing I did before I got on this segment, is seeing how far down it's going. And it's interesting. You have ARM now trading at $57 a share. It was above 60. Listen, I think the name of the game for the bankers in town, as well as the companies, is this idea that these IPOs will not be high flyers. They will have to be smooth sailors. They have to make it into market smoothly. We know that at the top end of the range, it could be worth more than $9 billion in market value. There's an interesting footnote here. This idea that cornerstone investors, D1, a division of Norges Bank, could take up to 60% of the shares. So you have some embedded demand, but getting this onto market smoothly after already upsizing here or increasing the price range for both Instacart and Klaviyo will be an interesting thing before Fed Day, when both of these things are supposed to start trading ahead of.
Yeah, Sonali, it's taken a long time to get Instacart to market. We've been talking about it for many, many, many years. Is this as good as it gets, though?
Great question, because you have ARM, Instacart, Klaviyo all in a row. Instacart has been able to make themselves profitable ahead of this IPO. Klaviyo also showing profitability. There is a very small window to go public this year. When we speak to bankers across Wall Street, they say that the pipeline is building into next year, and you have a lot of companies saying that they want to front load and go public in the first quarter of next year. Remember, we have the elections next year, a lot of potentially volatile events for the market. So yes, it does give a sense of, okay, maybe you're not going to get the $13 billion valuation that Instacart had last year, but a $10 billion valuation, more realistic, as well as a lot of retail interest. Remember how many retail investors were pouring into ARM stock immediately. Speaking of retail investors, remember SoFi is one of the underwriters, the first ever underwriting mandate it's ever had on an IPO in the Instacart instance. So bringing more people into the stock tends to be good for marketing. It gives you stock as currency. These companies want to go public, especially because the M&A route has dried up so much as well.
I guess I'm just having a really hard time understanding the actual proposition, the value proposition for Instacart. Like, when you have grocery stores can just build out their own infrastructure if they want, and the margins are so super thin anyway. And I'm wondering what you talk to bankers about in terms of that part of the story.
Yeah, the margin part is a fascinating one, because on one hand, you have Instacart and Klaviyo in a row. Klaviyo is a very clear AI story. Instacart, they are trying to show you that they can do more with their technology and data and really win on that in terms of bringing on customers. Hence, Pepsi being an initial investor here into the IPO helps give some idea here that their own clients buy that story, that they can keep on continuing on and expand that share. But your point is very well taken. That margin pressure And the fact that there are others that do this is a big question mark when it comes to Instacart. The newer CEO has been able to improve returns clearly, but can she sustain that? That's the post-IPO story, and that's the more important story than the day itself.
It's amazing, isn't it? That process we often think about as being a one-day event. Got to keep going. Sonali, great stuff. Thank you very much indeed. Let's talk about the European markets as we head towards the end of the day this Monday. This week is a bit of a slow burn, to be honest. We really get going, obviously, with the central banks a little later on this week. The data begins to kick in as well. But actually, a little bit of price action to begin the week, a little softness into the European equity markets. Every single sector is in negative territory today. Some of the consumer names are the weakest. Some of the housing names, some of the luxury names softening up today. The market broadly down by 1.22%. Flattish for the euro. Again, I think we're waiting, we're watching, we're going to see what's going to happen here. Obviously, we've got the Fed coming up, plus there's a whole load of data to digest. So euro dollar flat but below 107. 106.72 is where we're trading. The main event, dare I say it, I hate to say it, is what is happening with Brent crude. We're up again. We're up by 0.9%. We're kind of flirting with 95. Are we going to 100? That's the key question. What impact will that have? We'll come back to our question of the day in just a moment. We get to 100, do we get stagflation? We're going to also talk about what's happening in the car sector. European luxury names. What happens with China? What happens with the United States? What happens with Labour? Ola Halenus is the Mercedes-Benz CEO. He's going to join us in the next hour. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
A very good morning. Welcome to Daybreak Australia. I'm Heidi Stroud-Watts in Sydney.
I'm Annabelle Drawlers in Hong Kong. We're counting down to Asia's major market opens.
Good evening from Bloomberg's world headquarters in New York. I'm Sherry Ann. The top stories this hour. Big tech leads U.S. stock declines while bond yields rise on the Fed's hawkish hold. Policymakers seeing another hike this year and higher rates through 2025.
A soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time.
Also ahead, Stellantis is making a new offer to striking auto workers, even as GM's Mary Barra calls the union's demands too costly.
Plus, Alan Joyce said to lose some of his departure payout as Qantas tries to fix an acute loss of trust among customers. Take a look at how U.S. futures are coming online in the Asian session after we saw U.S. stocks and bonds falling in the New York session. We saw a lot of fluctuation. Of course, we had the Fed rate decision today. It was as expected, a hold, but at the same time, of course, we are now expecting another rate hike this year, not to mention higher rates throughout 2025. So we saw Treasury yields rising across the board, the 2-year yield at the highest level since 2006, the 10-year yield already at the highest level since 2007. They're really pressuring tech with the Nasdaq 100 underperforming, and all that risk-off sentiment really being translated into oil prices as well, falling below that $90 a barrel level. But remember, of course, we saw this huge rally of around 30% since June, and those inflation concerns being kicked in. Today, we had data showing a smaller than expected drop in U.S. crude supply, so that didn't necessarily help. But in the Asian session, we continue to see that decline in Asia below $90 a barrel. But, of course, the first rate decision after the Fed came from Brazil. And as expected as well, it was another rate cut of 50 basis points to 12.75%. Now, this is a massive cut. This is a second straight meeting where they have a 50 basis point cut. Brazil has really led the way in terms of tightening and easing as well. Now, the expectation is that this was a unanimous decision to cut, and the central bank saying that we might even see another rate cut of this magnitude again. So we are in that easing cycle in Brazil, but it's not the only country. Look at these countries in South America that have already cut, like Chile and Peru as well. But the big story today, of course, Heidi, was all to do with what's happening with the Fed and where they go from here, right? Because the expectation, yes, was for a hold today, but what happens next? And the debate may be on for their next meeting in November and in December. And this is what Chair Powell had to say.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
And this, of course, comes amidst really heightened debate over what kind of landing, soft landing, a hard landing, a no landing, right? As some would say it, particularly as we're getting this backdrop of escalating energy costs and oil prices. But take a look at what Fed Chair Powell had to say about, whether this is kind of still the end goal here.
A soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that.
Joining us now is former Atlanta Fed President Dennis Lockhart. Dennis, great to have you with us. So first of all, give us your reaction about what you heard today.
Well, I think the committee is feeling its way along now. It's in a phase where, although it penciled in another rate increase, may not follow through with it. It depends entirely on how the data evolve and how they assess the situation in the coming weeks through year end. I also took away that they are signaling in their projections a higher for longer period. They've basically shaved 50 basis points off the year-end lower rate that they had projected in June. That, I think, is meaningful. I thought Chairman Powell was he sort of walked a tightrope. He didn't provide any really firm guidance. He really, as I said, suggested that they are just feeling their way along, deciding what's the appropriate stance of policy.
What does higher for longer, as a dot plot suggests, mean for the economy?
Well, it means that the interest rate level will remain higher into 2024 than earlier projected, and that if there are cuts to be made, in all likelihood, just based upon these projections, which can be revised again 2 or 3 times, but based on these projections, that if there are cuts, they're likely to be in the back half of 2024 and possibly just in the fourth quarter of 2024.
It's interesting when you listen to Chair Powell, it's clearly that the realization of how complicated the territory that's being navigated at the moment, right? He said, as we heard just earlier, a soft landing is still the primary objective. He does also say that it is not the baseline expectation. How do you assess the likelihood that a soft landing or a no landing can be achieved from here on?
Well, I would say right now you have a reasonably encouraging set of conditions working. You do have gradual disinflation occurring while the economy is apparently growing at a very strong pace, well above trend, and looks like we're going to see that momentum fall into the fourth quarter of this year. And the employment markets are rebalancing. There's a lot, I think, that they would view as favorable circumstances that suggest that if they're patient enough with the disinflationary trend, they can actually do it without a lot of damage to employment.
Is a disinflationary trend at risk to you? Because I think it seems like there's not just sticky inflation that we've been seeing, but also perhaps new drivers of inflation, commodities inflation, the energy markets. We're watching, of course, the labour market organisation and strikes that we're seeing as well, potentially adding to wage inflation.
I think there is undesirable upside inflation risk, meaning that we could see either a very sticky inflation that just simply doesn't move for some period of time, or even inflation resurging in some respects. And what I'm keeping my eye on is energy prices, not just the headline energy prices of gasoline prices, which are important, but how energy prices actually course through the economy in the coming weeks and even months. Because even though there's this separation of energy and food in order to get a core measure of inflation, the reality is that there are energy prices in almost all goods and many services, and they are perhaps yet to be reflected in price pressures.
And higher energy prices just means an additional sort of tax when it comes to households, consumers, right? How long can we expect American consumers to remain healthy when they're already eating into their savings from the pandemic?
Mm-hmm. Well, one factor that I think is important is that most households have employment. Almost everyone in the United States wants a job, has a job, or has good prospects of getting a job very soon. And that breeds confidence in the consumer and a willingness to spend to some degree, even while the savings are being spent down. So as long as we have these very favorable employment circumstances, I think the consumer will remain active. There may be some trading down in terms of the price or quality of goods that people buy, but on balance, the spending will continue, I believe.
A lot more questionable is the resilience of the Chinese consumer and the Chinese household, right? To what extent is the Chinese slowdown and the ability of policymakers there to be able to get a recovery back on track a wild card for, global economies, including what the Fed would be thinking?
Well, I think in a very linear sense, the Chinese slowdown probably wouldn't have a tremendous effect on the U.S. economy. But in combination with other things that could happen, some of the other contingencies, it just could add to a collection of headwinds that could really have some impact on the U.S. economy. Now, of course, at this stage, the Fed would like to see some slowdown, I think, just in order to help with the inflation task. But obviously, we'd like to avoid a recession. I don't think China can precipitate a recession in the United States. The two economies are not that directly linked. But I do think it could add to adverse conditions.
And Dennis, I know that Heidi mentioned it slightly a bit earlier, but talking about these strikes from the auto sector, from Hollywood writers, from even in Canada's auto sector, they are facing the threat of strikes at the moment. What does this mean when we have bargaining power returning to the worker? Could this really lead to potential wage pressures down the line? And when does that become a concern?
Well, it's interesting. We're in a new era of strikes. We haven't seen strikes at least of this magnitude for quite some time. And now we have, as you referred to, the auto strike, and also the screenwriters and actors are also honoring that strike as well. It suggests to me that the power has shifted to labor from capital. That's a fairly dramatic and profound, almost structural shift. At the same time, inflation pressures have made union members much more concerned about their cost of living. Those are two major factors at work, I think. And so down the line, if inflation remains high or at current levels and real incomes are affected badly, then you will probably see more labor action.
Dennis, always great to have you with us on Fed Day. Dennis Lockhart, the former Atlanta Fed president. We thank you for your time. Let's get to Bell and the setup as we get into the start of trading. Sort of measured reactions that we saw in the U.S. session. How's Asia looking?
Yeah, that's sort of the same theme that's developing here, really, Heidi, because when you take a look, for instance, the moves in the dollar, we had seen that initial spike following the Fed decision of about 0.4% for the greenback or the Bloomberg dollar gauge. But after that, we've really started to see that dissipate throughout the session, and we're in the early hours now for Asian FX trading, and so far fairly steady going. A couple of currencies, of course, to note, the Japanese yen, for instance, above that 148 level ahead of the BOJ meeting tomorrow. So certainly one that is really shaping up to be quite a wild card decision, what they'll signal in terms of the exit or possible exit away from negative rates. And then also keeping an eye on indicative pricing for the Brazilian real, because as you were just mentioning there, Sherry, we did have Brazil with the first central bank to make its decision post the Fed cutting the benchmark lending rate by 50 basis points to 12.75%. But again, indicative pricing fairly steady going. And then, of course, watching the pound there, because we had seen that weakness coming through, trending lower. The BOE decision also coming up Thursday, very heavy central bank action focus. Again, it really coming down to a knife edge, given that the economic signals there show a rapid, or what is shaping up to be quite a rapid deterioration. But again, as you say, Heidi, in the earlier moments here, really not seeing a lot of direction. Let's change on those, see if we're getting more moves coming across in equity futures, because we're counting down to the opens for Sydney, Seoul and Tokyo, and you can see that weakness really starting to come through here, particularly for the Aussie market there. A couple of stocks to watch, including Qantas, given, as you're mentioning in the headlines there, this question marks over how much remuneration the outgoing CEO, Alan Joyce, will receive. But again, that focus, broad weakness ahead of the session today, Sherry.
Right, Bell, and still ahead, we have more on the market reaction to the Fed's signal of another hike this year. We'll be speaking with the Director of Research at Carnegie Investment Council later this hour. But first, Stellantis makes striking auto workers a new offer as GM's boss says they can't afford to meet the union's demands. An update on the U.S. auto shutdown next. This is Bloomberg. Take a look at some of the big moves in the session today. We're following just a day after going public Instacart because shares dropped as much as 11% to trade below the company's initial public offering price. It ended at $30 a share. Now take a look at Klaviyo as well, because it went a completely different direction. This is a marketing technology firm that began trading today in New York. It rose 9.2% at the close. In the after-hour session, though, we are following FedEx. It's usually a barometer of global growth, given their business. It rose in late trade on a bullish outlook. We're talking about profits that topped analyst estimates. They also raised their earnings forecast thanks to cost-cutting, strong pricing, and also customer switching to the company as well.
We're also watching oil driller ADES Holding attracting nearly $77 billion in orders, Sherry, for its $1.2 billion IPO. That's a subscription rate of over 60 times. That offering was priced at almost $4 a share, the top of the range, taking the firm's value to just over $4 billion. And that IPO is Saudi Arabia's biggest this year.
Now to the latest on the U.S. auto workers strike. The union says Stellantis has made a new contract offer, but officials at General Motors insist UAW's demands remain too high. Bloomberg's Sue Keenan joins us now with the latest. And Sue, the union has been pushing for a wage increase of 36%.
Yeah, 36%, way too high for GM, and they are not accepting that. Their offer was rejected some 5 days ago. But we do know that Stellantis, they make Jeeps and Chrysler models, has made a new contract offer. The UAW not sharing details of the proposal, but they do say they are reviewing it. Now, this United Auto Workers labor action has already made history in striking against numerous automakers, but now, for the first time, 190 UAW workers struck a ZF plant in Tuscaloosa, Alabama, that supplies front axles for Mercedes-Benz vehicles. And while the UAW represents various supply plants, these workers actually declared their own strike. So there is some momentum building here. Stellantis has said it will temporarily lay off 68 employees at its Ohio machining plant as a result of the strikes. And we know that GM is also idled an assembly plant in Fairfax, Kansas. UAW President Shawn Fain has said that more plants face walkouts if GM, Ford, and Stellantis do not sweeten their offers. So again, the union continuing to put pressure by first striking at non-essential plants, but then upping the ante as the days go on. Seems to be part of the strategy.
You know, when you take a look at some of the recent comments, how far apart are GM and the union at this point?
Well, you mentioned those comments. There was an op-ed piece in the local Detroit paper from a GM executive calling the UAW requests untenable. And we know that Mary Barra, in a staff webcast Wednesday to the non-union salaried staff, she said the union's demands were too costly. She also thought that the offer that she made, that GM made, of $150,000 a year annual average compensation was fair, and compared the 67 an hour labor costs at GM to $45 an hour at Tesla. She told her staff that if the union would accept their offer, the company could grow. Again, GM, the CEO, seeming frustrated in her remarks, and yet they continue to negotiate, which is a sign of progress. A deal has remained elusive, though, after several days.
Bloomberg Sukina there as we continue to watch those negotiations. And in terms of labour issues, we're also watching another looming worker walkout, this time in India, just ahead of its holiday season. Coal India, this is the world's biggest producer, is facing a 3-day strike from October 5th. The workers affiliated with 5 national trade unions voted for action over a wage dispute. Coal India produces almost 2 million tonnes of coal each day, powering 70% of India's electricity needs. Power demand usually increases ahead of the month-long Hindu festive season. You can also get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can get that at Daybe Go. You can also customise those settings so you just get the news on the industries and assets that you care about. This is Bloomberg. Well, Qantas may claw back up to 2/3 of the former CEO Alan Joyce's payout after a string of controversies hit the airline toward the end of his 15 years in charge. Bloomberg's Paul Alan Joyce is now with the latest. So this came with the annual report that dropped quite unexpectedly yesterday. So what's sort of this measure that's, I guess, you know, a bit of an olive branch?
Yeah, we'll get to that, the way that this news was delivered in a moment. But yeah, a couple of bonuses at stake here. I'll give them in US dollars. $5.4 million, the long-term incentive payment. That can be clawed back at Qantas's discretion. They haven't said they're actually going to do it, though. The short-term bonus, $1.4 million US dollars, that's not going to be paid until the consumer watchdog complaint over the so-called ghost flight scandal is settled. And that, of course, relates to Qantas selling tickets for flights that it had already cancelled, unbeknownst to the customers it sold the tickets to. So short-term bonus, that's also been reduced by $500,000 as well due to customer dissatisfaction. But, of course, on top of all of this, after Alan Joyce's departure, we heard from the High Court that Qantas may face hundreds of millions in compensation payments to 1,700 workers that they illegally sacked during the pandemic as well. So the chairman, Richard Goyder, addressed all of this. He says, look, the company is experiencing a loss of trust from the community, and the board and management's determined to fix that.
So, Paul, how much is this actually going to improve Qantas' public image?
Yeah, well, image repair takes time, right? Will clawing back, or saying you might claw back the bonus of the departed CEO, going to be enough? let's see. And Heidi mentioned the way that this news got delivered. It was in the annual report that got released at 3 p.m. yesterday afternoon. The national broadcaster, the ABC, said that annual report arrived without warning. 3 p.m. doesn't give evening news bulletins a huge amount of time to prepare, gather reaction either, and that is a well-known tactic among media relations in terms of timing your release. So that's not exactly doing a great deal to improve goodwill either. Also, the board was there during the Ghost Flights fiasco. It was there when the workers were sacked illegally, and through it all offered extensive support to Alan Joyce as well. So we've got the Australian Treasurer weighing into all of this also, saying that Qantas has got a lot of work to do to regain trust. One suspects that perhaps we haven't seen the end of this saga just yet.
Paul Allen there in Sydney with the latest on Qantas. Coming up next, Carnegie Investment Council's Director of Research joins us to talk market strategy as the Fed confirms the higher for longer narrative. This is Bloomberg.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. A soft landing is a primary objective, and I did not say otherwise. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
That was Fed Chair Jerome Powell there. Joining us now is Greg Halter, who's the Director of Research at Carnegie Investment Council. Greg, great to have you with us. So, there is a sense that the Fed, like with everyone else, are just sort of feeling their way through this, right, with a lot of uncertainties now when it comes to the inflation outlook with the resurgence that we've seen in crude prices. Where does that leave investors who obviously want that certainty and that Fed put, if you will?
Yes, thank you for having me. I guess number one point I would make is that investing is uncertain to start with. So for folks out there looking for certainty, that's probably not going to happen. Obviously, you'd like to have a better path in terms of knowing where things are, but there are plenty of cross currents in the economy, not just the U.S., but globally. And that's probably always going to be the case. You know, if it's not oil, it might be student loan payments or this or that or the other. So that's something we're always going to experience.
Where are you seeing opportunities then, given that, a lot of the hot spots that we've seen in the rally so far this year are looking pretty stretched?
Yes, I would agree. Some of these areas have been very stretched. On the fixed income side, we are looking to extend our duration, our maturities at some point in the future. Is that a month from now, 2 months, 3 months from now? That's uncertain. It certainly depends on the data and what the Fed does with rates. But we are thinking that on the fixed income side that we're probably closer to the peak. So at some point, we will start to extend our maturities. On the equity side, there are always gyrations in the stock market. Always companies that fall for whatever reason, might be fundamental, might be algorithmic trading. There are companies out there that have been able to pass through price, and they've been very successful. The waste management companies, railroads are able to do that, trucking companies, even uniform rental companies. So there are opportunities out there. We do always look for macro trends that are happening in the world the U.S. certainly, but in the world. And we've seen reshoring, nearshoring. The infrastructure of the U.S. needs a lot of work, and there are companies out there that stand to benefit.
Are you factoring in a possible government shutdown here in the U.S. later this month, and how would that affect markets, given that this is one of the most recurring events in American politics?
Yes, great point. That seems to be recurring, seems more to be political. I think the market has probably passed that by as being a critical event, unless, of course, it is a sustained shutdown. I don't think that's going to happen some way, somehow. They always seem to get things done. But again, it's that sustained shutdown. If we had it, that could cause some issues. And one of the issues would be a delay in data. And the Fed says data, 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 always looking at the data. And if they don't have it because it's not being produced or provided, that could be a troubling event.
Labor issues, if these continue, when do we start to see people fearing, continued margin pressure on these businesses, and perhaps these issues spreading to other sectors as not just auto?
Yeah, it's a good question. I mean, you have to almost go company by company, and even within the company, it may depend on the product line. There is a breaking point for every company, every person. How much is too much in terms of price? At what point does the margin take a hit? Obviously, that remains to be seen. I think it is very company specific. I mean, we can look at the snack companies, the soda companies. They've been able to get price because they have a brand name. They have pricing power. Are you really going to give up your Kit Kat bar or your Hershey bar if it goes up by 10 cents? But there is a point, and as we heard, as we know, consumers hate the word inflation. It has a very negative connotation. Despite that, they're still spending, but at some point there is a breaking point. I don't know where that is, and I think it is on a company by company basis.
Greg Holter, great to have you, Director of Research at Carnegie Investment Council there. Well, New Zealand releasing second quarter GDP in just a few minutes' time. We will be watching to see if the country emerged from a mild recession, but of course we know the prospects of further economic downturn are pretty likely at this point. We'll be bringing you those numbers as they cross the Bloomberg next. This is Bloomberg.
Watching Daybreak Australia, here's the latest in geopolitics. Israeli Prime Minister Benjamin Netanyahu says a deal between Israel and Saudi Arabia would advance peace with the Palestinians. He made the comments in New York after meeting with U.S. President Biden. The three countries are in talks over a possible agreement which could see Saudi Arabia and Israel establish formal ties.
We can forge a historic peace between Israel and Saudi Arabia. And I think such a peace would go a long way, first, to advance the end of the Arab-Israeli conflict, achieve reconciliation between the Islamic world and the Jewish state, and advance a genuine peace between Israel and the Palestinians.
And President Biden and his Brazilian counterpart, Luiz Inácio Lula da Silva, have launched an initiative to improve labor conditions in their countries. The partnership aims to help workers address challenges like a transition to clean energy technology and forced labor. Biden has taken steps to strengthen his links to labor unions as part of his 2024 White House bid. Indian media have attacked Canadian Prime Minister Justin Trudeau's claims that New Delhi was behind the murder of a Sikh activist in the country. Many called on Trudeau to show evidence to back his claims. The accusations have driven a wedge between India and Canada, with New Delhi warning citizens to exercise the utmost caution in the country. Taiwan's opposition presidential candidate is pitching himself as the best choice to lead the island as tensions with China worsen. The KMT's Hu Yui is polling in third place ahead of elections in January, but is using his experience as Taiwan's top law enforcement official to boost his image to voters. Speaking to Bloomberg in New York during his recent U.S. trip, Hu discussed his plans to keep the peace with Beijing.
The Taiwan Strait must be stable, and Taiwan must be safe. This is my top priority.
So when you talk about dialogue and communication and this responsibility for the leader of Taiwan, I think about former President Ma Ying-jeou and how he met Xi Jinping in 2015. If you were to become Taiwan's president, would you seek a meeting with Xi?
The most important thing at this stage is that we in Taiwan still have to stabilize this area in the Taiwan Strait. Therefore, we must first improve our own national defense armaments and our own self-defense capabilities. Of course, in the process of improvement, we will start with dialogue. With the current situations in Taiwan, in fact, we still have a long way to go.
One thing the U.S. is obviously very concerned about is Taiwan's military commitments. Ma Ying-jeou, the former president, cut Taiwan's defense spending when he was serving his term. Would you cut Taiwan's defense spending?
The situation at that time was completely different from the situation now. At this stage, Taiwan is actually facing constant conflicts, and it is easy to spark a conflict accidentally and trigger a war. Therefore, under the current situation, the defense budget cannot be reduced. If you spend the budget, it will only go up, not down. Therefore, we need to continue to discuss with the United States how to improve Taiwan's self-defense capabilities and which weapons and equipment are most suitable for Taiwan in terms of the entire arms purchase.
When you increase the military budget, let's get specific here. Will you commit to spending 3% of GDP on defense?
In fact, no matter how much GDP it is, the most important thing is to make the structure of the national defense budget meet the needs of all our operations. One day, there may even be a chance to gradually increase it to 3% or above. Of course, that is what should be done. Protect life and property at any cost. With high GDP and high defense budget, this is not the issue. The issue is that you have to use it in the right direction, and it can really make the other party not dare to start a war easily.
You've made clear that as the future Taiwan president, your priorities are increasing Taiwan's military preparedness and also seeking dialogue negotiations with mainland China. How will you balance the two?
Taiwan's leaders should always remember one sentence. Preparation for war is necessary, but avoiding war is a leader's responsibility. When the Democratic Progressive Party was in power, it broke the delicate equilibrium in Taiwan and brought that dynamic balance to the edge of conflict and the imminent outbreak of war. So we have to initiate exchanges with mainland scholars, experts, and people. It stabilized from non-governmental exchanges and gradually moved to official forms of exchanges. Let the trust between each other continue to accumulate and increase again. Let me tell you, it is impossible to return to Ma Ying-jeou's era in the short term.
I want to talk about business right now. If TSMC were to announce that they want to invest more in the United States, what would your response be?
Semiconductors are the lifeblood of our technology industry in Taiwan, and we must allow the advanced technologies to stay in Taiwan. Mature technologies can be deployed globally. We have to enact national security laws to protect the core and critical technologies in semiconductors and prevent confidential information from being leaked. This is our responsibility.
That was Taiwanese presidential candidate Hu Yui speaking to Bloomberg's Scarlett Fu in New York. Take a look at how U.S. futures are trading early in the Asia session. We are seeing downside pressure after stocks and bonds fell. In the regular session, of course, we had the Fed's hawkish skip, leaving the rate unchanged as expected, but signaling borrowing costs will likely stay higher for longer and having perhaps one more rate hike this year. And you can see the NASDAQ 100 futures are underperforming. It was the same picture in the regular session with the NASDAQ 100 falling. We were watching, of course, Treasury yields that climbed across the board, with the 2-year yield now at the highest level since 2006, Heidi.
Yeah, and we are watching New Zealand for those GDP numbers, and it could be a little bit deceptive. Yes, we are expecting to see the economy bouncing out of recession. We've got 0.9% of the quarter-on-quarter seasonally adjusted numbers just crossing the Bloomberg now. That does beat expectations of 0.4% and coming back from the fall of 0.1% that we saw in the first quarter. Year on year, that number is also a beat at 1.8%. The expectations from economists were at 1.2% and extending the growth in the previous reading of 2.2%. Still, though, according to Bloomberg Economics, this is likely just to be a temporary respite. A lot of this will be contributions from the extreme weather impacts that we saw in the first quarter of 2023 as really the key drivers for that rebound. Bloomberg Economics is actually expecting that we'll see the resumption of contraction in the New Zealand economy by the time we get to the third quarter, with that increasing pass-through of higher rates from the RBNZ continuing to really weigh on demand. They're also expecting to see that slump in retail trade, weaker wholesale trade, weakness in construction, and all of this likely to really fail to offset any strength that we see in manufacturing and agricultural output, I should say. We are seeing that bit of a move when it comes to the Kiwi dollar. We are expecting that to be a temporary boost there as well to show that the economy is rebounding in these latest readings. But given that we do expect that resumption of contraction by the third quarter on account of those higher interest rates, it's unlikely that the strength that we see in the Kiwi, if any, will hold. Well, you can watch us live and see our past interviews on our interactive TV function. That's TV Go. You can also dive into any of the securities or the Bloomberg functions that we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for terminal subscribers only. Do check it out. It's at TV Go. This is Bloomberg.
Now, I'm not saying there will be no hard choices, and nor am I abandoning any of our targets and commitments. I am unequivocal that we will meet our international agreements, including the critical promises in Paris and Glasgow to limit global warming to 1.5 degrees.
UK Prime Minister Rishi Sunak speaking as he softened key parts of his government's green agenda, including pushing back a ban on new petrol-powered car sales by 5 years to 2035. Now, Iceland is among the nations most exposed to extreme weather events, with its world-famous glaciers at risk of melting as global temperatures rise. Prime Minister Katrín Jakobsdóttir joined me from the UN General Assembly to discuss her country's efforts to fight climate change and how rising tourism is putting the island's environment at risk.
You can say that the first properly financed and realistic climate action plan was put into action in Iceland in 2018. It was then revised in 2020, so we've been making, very concrete steps ever since my government took office at the end of the year 2017. I think, however, we still are not doing enough, and I have been in the climate summit today, and I think it's very clear that all nations need to accelerate their climate action. We have done many things when it comes to, for example, renewable energy for heating and electricity. We are implementing an energy shift in our transport system. We are subsidizing new green technologies for better use of energy, but also to increase carbon binding. So a lot is being done in Iceland, but we need to do more, and I think that can be said about the rest of the world too.
Tourism is a pillar of your economy, and it's putting a strain on the environment, not to mention that your economy is running pretty hot at the moment. How do you balance those goals?
Yeah, well, as you say, tourism has really grown exponentially in Iceland in the last decade. And that obviously is not just creating effects on the climate, it's also because most of our guests who are coming to us are visiting the unspoiled nature, and obviously it creates a pressure. So we have been, and we are actually have announced that we are putting increased taxes on tourism in Iceland. Not high taxes to begin with, but we are talking about city taxes, etc., for people who stay in Iceland, because we think it's very important that we have that economic factor within that. And a lot of our companies who are working in the tourism sector are finding ways to really turn over to circular economy, turn over to electric cars, etc. So that change is happening, but it is a challenge. It is truly a challenge.
When it comes to women's rights, Madam Prime Minister, Iceland has been a front runner. You have a law that requires companies to get certified for equal pay, for equal work. How much has this helped in achieving equality?
Well, you know, the gender pay gap is actually quite a important factor of the gender gap in general. And we have been diminishing the gender pay gap in Iceland gradually, and increased transparency through that legislation on equal pay has been an important factor. But we're also taking new steps now, because what remains of the gender pay gap in Iceland is really about the fact that we have a gender segregated labor market, with some sectors dominated by men and other sectors dominated by women. And sectors dominated by women tend to be undervalued. And that's what we have created a task force to really tackle this challenge. We are in the middle of a pilot project in the public service, how to really change the value so we can actually start talking about pay equity and not just equal pay. But pay equity is a very important factor for the economic independence of women, and therefore an important factor of gender equality in general.
How big of a sense of threat is it for Iceland, the Russian invasion of Ukraine, as a small country without a military, amid this race for control of the Arctic as well?
Well, we have, of course, we are members of NATO and have been since 1949. We have a defense agreement with the US. But I think when you ask about the sense of security, I think what has happened is that people realize how important multilateral cooperation is, and not least for a small country like Iceland, which builds its existence really on the rule-based order, that other countries follow the rules, do not invade, respect territorial integrity and sovereignty of other nations. So I think absolutely that what has happened in Iceland is that people have become more aware of the importance of the multilateral system. And being here at the UN General Assembly, where we're actually talking very much about the fact that the multilateral system is under threat right now, that it's under pressure right now. We are seeing deepening divisions. I think Iceland is actually using its voice very clearly to support that multilateral system, which is so important, not least for the smaller countries of this world.
Iceland's Prime Minister Katrin Jakobsdóttir there speaking earlier to Sherry in New York. And this, as we look across sovereign bonds trading in the Asian session, of course, these big moves when it comes to U.S. Treasuries were really one of the biggest market reactions at the moment. Just about the entire Treasury curve is nearing the highest of the cycle. The 20 and 30-year yields are looking pretty close. And of course, we had the 2-year yields more sensitive to imminent Fed moves, hitting the highest since 2006. In reaction, the Fed signaling interest rates will be higher for longer and holding that a target range at between 4.25% to 5.25% and 5.5%. This is picture across Australia and New Zealand. We also had really some pretty good data out of New Zealand a little bit earlier, that second quarter GDP beating expectations, but also interestingly that first quarter GDP being revised again to show the economy actually wasn't in recession. That actually has been revised to a flat reading now. Well, coming up in the next hour, we'll get more analysis on the Fed, of course. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Our special coverage of the Fed Decides here on Bloomberg continues right now on the close as team surveillance right now passes the baton along to Scarlett Fu, along to Katie Greifeld, and along to myself, Romaine Bostic, as we take you to the closing bell and beyond. Guys, 13 FOMC meetings we've had, of course, going back to March of last year, 11 rate hikes coming out of those 13. We're back to pause, but Jay Powell wants you to believe that they're going to hike again this year.
Yeah, and it's made clear in the statement of economic projections, right, where they see one more rate hike this year. They also revised up GDP forecasts for this year while seeing lower inflation as well. What I found really interesting was Jay Powell's pushback that the SEP is not a plan. This is simply the median of all the individual forecasts that have been compiled. Yeah. And he made clear that forecasts are highly uncertain. For anyone who's out there trying to craft a narrative based on all those projections, he's saying, you know what, this is hard work and this is the best that we can come up with
No
right
one
now.
would ever craft a narrative.
No. But it's a reminder that monetary policy is an art, not a science.
Well, let's go. Sure. Some people believe that. You sound like an economist. But let's just go through real quickly some of those numbers that we did get out of those projections. Basically, you're leaving the benchmark rate where it is, but making it clear in that dot plot. 12 of the 19 officials right now favoring another rate hike for this year. And they're saying they're going to raise their projections for 2024 as well as 2025. A revision higher on GDP expectations for this year and next, and a revision lower for the unemployment rate, which I thought was interesting, not only for this year, but for the next 2 years out.
And you marry those numbers into what we heard from the man himself in the press conference. This moment really stuck out to me. When asked if a soft landing...
Was it when he pulled out that iPad?
That was pretty good. I do have a lot of questions about that.
It's the best advertising Apple's had in years. Yeah.
You didn't see the stock pop, but in response to a question whether a soft landing, whether it's safe to call that the baseline, he said that he wouldn't call a soft landing the baseline expectation. Yes, it's their primary objective. It's possible, but not the baseline. But then back to Scarlett's point, you take a look at those revised numbers. It kind of looks like they're projecting a soft landing.
But don't read too much into that.
I'm trying not to.
Yeah, I think, though, he wants the market, I guess, to at least have enough sense of urgency that, another hike is going to come, but at the same time have enough confidence that the economy isn't going to fall off the cliff. It was interesting to see the market reaction, of course. We talk about stocks at one point, just a few minutes ago, we're at session lows, and, of course, you had that two-year yield, which everyone's going to be talking about, camped out at the highest level since 2006. Yeah,
moving up, up, at least in the aftermath. It came back down a little bit, but still remains higher, 5.135%. That's the highest in a couple years.
Let's walk you through some of the cross-asset price action. Abigail Doolittle standing by. Abigail.
Well, Romaine, this Fed meeting certainly not a snooze fest, and from a cross-asset class standpoint, lots and lots of movement. And I would say that if we were to title the overall meeting higher for longer, take a look at the two-year yield that you were just talking about. So when the decision came out and the sense that they will be raising at least one more time this year, plus the dot plot being raised for the subsequent years, hotter economic projections, up, then down, and now higher, and at the highest level since 2006, essentially signaling that the market is taking the Fed seriously on the idea that they are going to be staying higher for longer. Similar message for the Bloomberg Dollar Index. Rising rates will support the Bloomberg Dollar Index. And from a technical standpoint and a longer-term standpoint, the Bloomberg Dollar Index is breaking out, suggesting that the rates rising that we're seeing today, that this trend, not just today, over the last several weeks, months, and even years, over the last 2 years, is going to continue. Now, you're talking about stocks. This is interesting because the NASDAQ 100 overnight really treading water, basically into the meeting even treading water, but at this point down 0.8%. So investors, stock investors also taking seriously the message that more money coming out of the system and that valuation, especially for big tech like this, could be made more precarious. If we go to other indexes, we are going to see stocks, I think, basically at the lows. The S&P 500 down 0.5% now, heading toward its third down week in a row. Small cap also down 0.4%, I think below its 200-day moving average. The stocks down 1%, and then that New York FANG index down 1.3%. A hawkish pause, higher for longer. One of those characterizations does seem to be appropriate, or maybe both, for this meeting.
The market reacting right now. Of course, the Fed back in July did hike rates, putting them back on pause today. Jay Powell making it clear that the decision to hold today is based on how far we've come. Take a listen to some of the other comments that he just made at that press conference.
Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
The chairman of the Federal Reserve speaking just a little while ago, a little bit earlier today. Bloomberg opinion columnist Bill Dudley said that there were going to be 5 key things that he was watching in today's Fed forecast, including will there be another rate hike this year? What's the outlook for unemployment? How low can unemployment go without stoking inflation? And what's the neutral Fed's funds rate? And when will rates start coming down? Now that the forecasts are out, let's bring in Bill Dudley, joining us right now, former New York Fed President, former vice chair as well, and over at Princeton University Senator for Economic Policy Studies. And let's start with the neutral rate, because this seemed to be one part of the press conference where he seemed to struggle a little bit in articulating exactly how they're going to assess when they think they've finally arrived at that rate.
I think the message of the meeting was basically 2 things. Number one, soft landing is more likely, because you can see the unemployment rate only has to rise now to 4.1% to get the job done. Back in June, it had to rise to 4.5%. And number 2, economy stronger than expected, and therefore, while policy is probably not as tight as we think it is. So there have been a little bit of an upward movement in people's estimates of the long-term federal funds rate in this summary of economic projections, first in June and again this month. So what basically the Fed is concluding is maybe monetary policy is not quite as tight as we think it is, but they're also very, very happy about how the labor market's unfolding. They basically think a soft landing is more likely, quite a bit more likely. I'm a little surprised by the market reaction. I think the market reaction should be bond yields up because the Fed's going to be tighter for longer. Stock price is sort of mixed. Higher bond yields weighing on stock prices, but more chance of a soft landing. That's a good thing for stock prices. So I'm a little confused by the market reaction.
That's interesting. You mentioned the stock market reaction, because one point you make in your column today is that keeping a rate hike in the forecast, you write, has the tactical benefit of restraining markets, which might otherwise decide that we're done and generate an unwanted easing in financial conditions. Bill, you've been in the room before during these discussions. How mindful are policymakers of the market's tendencies to immediately make assumptions off of each clue that's dropped?
The market's always searching for what the Fed's going to do from anything, from the statement, from press conferences, from speeches. So I do think keeping one rate hike in the forecast does sort of, keep the market from running away from the Fed. But as Chair Powell mentioned in his press conference, it probably doesn't really matter that much at the end of the day whether they do that rate hike or not. It's not like the economy is going to turn around dramatically if the Fed does a quarter point more or a quarter point less. I think the way he's trying to explain why they might do another quarter is to make themselves more confident that they're going to achieve their objective. So let's imagine the data is sort of ambiguous as we go through the next couple months. So if it's ambiguous and the Fed's not really sure that they're actually going to achieve their objective in a timely way with the current level of rates, you do one more rate hike to try to increase your level of confidence. So at this point, it's not really about, do they have to go another quarter or not? It's really more about would going another quarter make them more confident that they're going to have the outcome that they seek.
And Bill, beyond whether or not they're going to hike one more time or not, I think it was interesting that they actually took a few cuts out of next year's forecast, when you think about the expectations for 2024, what should we read into that? Is that the soft landing perhaps coming into fruition, or should we take that as maybe inflation is going to continue to be a problem here?
Well, they didn't really change the inflation trajectory very much. So I think the way I view taking the rate cuts out is the fact that the economy is just stronger than expected. If the economy has more momentum, I don't need to support the economy as much with rate cuts. So I think that's really the message, because the inflation forecast didn't really change in a meaningful way.
We're in conversation right now with Bill Dudley, Bloomberg opinion columnist, and of course a former chair of the New York Fed. I want to bring into this conversation our very own Michael McKee, our chief international and economics correspondent here at Bloomberg, who actually wants to participate in this conversation. Mike, take it away.
Yeah. Well, let me tell you what I take out of this press conference, and then I want to ask Bill what he thinks, because he's the central banker and he has a much better idea than I do of what they're talking about in the room. But it seems to me that there's a bit of an internal inconsistency in their forecasts, in that they've more than doubled their growth forecast. They significantly lowered their unemployment forecast, and yet inflation is supposed to come down. So are they saying at this point that the stronger growth we've seen is not inflationary? And my takeaway from that would be they're done, but they're leaving that extra rate increase in before the end of the year as an insurance policy. And the same sort of thing holding true for the cuts they took out last year. If the economy were to produce inflation, then they have something in there that they can point to the markets and say, we did this. Bill, is that kind of the way people should take this?
I think that's the way people should take it. I mean, I think it's very interesting that before they had the unemployment rate going up to 4.5%, now the unemployment rate only has to go up to 4.1% to do the job. What that's telling them is they're taking quite a bit of signal of the fact that the labor market seems to be getting to better balance, even without the unemployment rate rising very much. So they're more confident that the labor market can essentially normalize on its own, that the Fed doesn't have to generate as much slack in the labor market to get inflation back down to 2%. So, and Chair Powell talked about the increase in labor force participation. He talked about the fact that the ratio of unfilled jobs to unemployed workers has come down. So they're taking quite a bit of positive signal about how the labor market is developing.
Well, if the economy develops ambiguously, as you say, over the next couple of months, would you be surprised if they raised rates again?
I think at this point they probably think that they will not have to, but they know that if they're going to move in one direction or the other in the next few months, it's definitely a rate hike, not a rate cut. So I think it's going to depend on how the data unfolds. And as the press conference, there's a lot of discussion in the press conference. There's a lot of shocks hitting the economy right now. Government shutdown, auto workers strike, the beginning of student loan repayments, oil price shock. So I think the Fed may not actually have the government data in terms of the economic releases if the government shutdown goes on for any length of time. So I'm going to be very surprised if they hike in November, and then we'll see where we are at the December FOMC meeting.
Yeah, we'll see where we are, and that's something that Powell made extra clear. They're going to proceed carefully, cautiously. Bill Dudley, thank you so much. Bill is Bloomberg opinion columnist, senior advisor to Bloomberg Economics, and of course, the former New York Fed president. And of course, our thanks to Bloomberg's Michael McKee in Washington. Here in New York with us right now to continue the conversation after the Federal Reserve policy setting meeting is Torsten Slok, partner and chief economist at Apollo. It's so good to see you here in studio today. Did Jay Powell come across to you as hawkish or dovish?
Well, I think the clear signal they want to send here is that we need to slow this economy more down. I mean, they could have decided to hike rates today. Obviously, that was not market expectations. But I think this was a very hawkish pause. I mean, the whole communication, the way that the statement was written and changed, and what he said at the press conference, it clearly signaled that we can allow ourselves to keep rates higher for longer, and taking 2 cuts out of next year by definition means that rates will be higher for longer. And the fact that, as Bill Dudley just mentioned, the fact that this is happening without any increase in the unemployment rate today is 3.8, and now they see it going up to 4.1. That's really almost a rounding error. So saying the labor market is just not going to change in their forecast, that is quite incredible, in particular when they at the same time say we're worried about inflation, and they're really saying we're worried about inflation being too sticky, and therefore the risk that inflation might not come down to 2%.
Well, Torsten, seizing on the idea that higher for longer is really the takeaway from this decision, from this presser, I want to go right to your notes, because you wrote before the decision that rates and therefore the cost of capital are going to stay elevated for another 9 to 12 months, and credit and equity investors should plan accordingly. What should that plan look like? Because I look at the equity market this year, I see it double digits higher, look at credit spreads, and they're pretty tight.
I know, but what's going on, and he was asked about this also, is that you're seeing both for consumers and for firms, higher interest rates or higher cost of capital are beginning to bite harder and harder. We're beginning to see delinquency rates going up for consumers on credit cards and auto loans. We're beginning to see default rates going up on high yield. If we are going to keep rates at these levels for another 9, 12 months, we should be extrapolating the current lines for what's going on with delinquency rates and default rates. And that runs the risk, in particular in high yield, where default rates are now up to 4.3 in the data for August that just came out, that could continue for the next 6, 9 months. And that's then going to open up a risk that if we begin to see the cost of capital bite harder and harder on companies every single day that cannot either get a new loan or refinance an existing loan, we begin to run the risk, of course, that we'll begin to see more companies defaulting. And on the consumer side, more people falling behind on their payments. He was asked about, are you worried about delinquency rates going up for consumers? And he said, oh, this is just a normalization. But I think the important thing here is, why is it normalizing? Because interest rates have gone up. So I do think that high interest rates are biting both on consumers and on corporates. And they're going to allow that process to continue now for potentially even not only the next 9 to 12 months, but maybe even the next 18 months, because they're going to keep rates higher. And I think that process is exactly what I would call the crystallization of the transmission mechanism of monetary policy, trying to slow the economy down gradually more and more. And that's the process that we're seeing across the board, both for consumers and corporates.
And Powell really did make that correlation, maybe not explicitly, but as explicitly as we're ever going to get out of a Fed chair, when he did talk about this idea that if the economy strengthened or did perform better than what was already in their projections, then we were going to get more hikes here. So he's basically sending that message loud and clear that at least the economic activity we're at right now, that might actually be the baseline, or I should say maybe the top line.
Absolutely, because think about it in credit markets. We are every single day when interest rates and cost of capital, as Katie has just highlighted, are at these high levels. This is having real implications. There are real firms that need to roll over loans. There are real firms that need to think about, do they want to have a new loan? And if the cost of capital stays at these levels for another year, that means that for the next 3-4 quarters, we are likely to see the increase in default rates, in particular for lower rated companies in loans and in high yield, continue to slowly grind higher. And this becomes a difficult process to manage for them, in particular if this starts to spread. Remember, there's about 11 million people who work in the companies that are high yield issuers. So that means that from a total employment perspective, there's potentially a lot of people in the high yield industries that are at risk of losing their jobs if this default cycle continues.
I'm curious, when you looked at the SCP numbers today, the economic projection numbers today, are they pretty much in line with your own outlook?
Yeah, I would also expect the summary of economic projections, as it said, that things are still okay for now, but they are projecting, and that's also what I would expect, that's also what the consensus is expecting. They are expecting that things gradually continue to slow down. Remember, they have two goals, of course. They have inflation and they have employment, and you need to have a soft landing, not only in inflation, we are well on track there, but we also need a soft landing in the labor market. And the fact that they are almost saying that we have almost achieved a soft landing because the unemployment rate is very close to the end goal where they think it will be in 2 years. That's saying that we can get inflation down with no implications for the labor market. That would be quite remarkable when you at the same time think about how companies, as we speak, are seeing default rates going up, in particular, again, for lower rated credits with higher leverage and lower interest coverage ratios.
All right, Torsten, really appreciate your time. Great to see you on set with that instant Fed analysis. That is Torsten Slok of Apollo. Meanwhile, you take a look at these markets. Stocks down, yields up. Bloomberg's Jess Menton standing by with a check.
Okay, Katie, Romaine, and Scarlett, taking a look at the S&P 500, the round trip it's made since the Federal Reserve first began raising interest rates in this cycle back in March of 2022. If you look in that span, the S&P 500 is up close to about 4% in that time frame, but also if you look back where it bottomed in October of last year, up well over 20%, actually around 23% at this time frame. But if you're looking at where things are trading today, not a ton of movement as stocks have been fluctuating this afternoon. Typically, historically, over the past 3 decades, the stock market, usually on Fed days, the S&P 500 does end flat. But going through today, there actually has already been 101 trading days since the last time the S&P 500 has seen a decline of at least 1.5%. So today would mark 102 trading sessions. That's the longest streak since 2018. So it's going to be interesting to see. Apparently, this wasn't necessarily the catalyst that investors investors may have been expecting to see a downward decline there, but something to definitely keep an eye on. Katie, Romaine, and Scarlett.
Jess, great roundup. Really appreciate it. And you know it's a big day because Bloomberg Intelligence Chief U.S. interest rate strategist Ira Jersey is in the New York office coming up from Princeton. And Ira, it was really interesting listening to Jerome Powell. He brought up real yields multiple times. Just to go through some of the headlines here, he said that real interest rates are, quote, meaningfully positive now, and also that they need to stay positive for, quote, some time. When you think about where real rates are right now, you think about 5-year real rates well above 2%. How much of a tightening impulse is that doing for the Fed?
Yeah, I think that the tightening and the real rate environment is exactly where the Fed wants it. So I think the question becomes is how long do they keep it there? And then what happens if, say, inflation continues to come down a lot and therefore real rates just are even higher, right? So one of the things that we looked at in a note this morning was where the market is pricing the expectation for the real Fed funds rate a year from now. And basically where the market's thinking that actually real rates are going to come down a little bit, because this morning anyway, or last night when I put the piece together, everyone thought that the Fed might, be cutting interest rates a little bit more than they think now, right? But I think that the fact is that the market still wants and still believes that the Fed is going to be able to hold the policy rate above inflation for at least the next couple of years.
One question I thought was really interesting was the question on the efficacy of rates. This idea that households and businesses that should be hurting more from the steady increase in rates have actually done okay, in large part because they locked in lower rates, either through 30-year fixed rate mortgages or refinancing before the Fed began raising rates. What did you think of Chair Powell's explanation about how just balance sheets are healthier than we might have expected?
Yeah, so he didn't mention this directly, but it all goes to the long and variable lags argument, right? So it's just a longer and maybe more variable this time, in large part because of what you just noted, right? A lot of basically the terming out of debt, both by the household sector and the business sector, and it's something that's basically been going on since the late 1990s. So this is a generational shift. It just means that it's going to take monetary policy longer to work. It's not that monetary policy won't work. It's just that it takes much longer to feed through the system. When 25% of corporate debt was in commercial paper and it was all 2 and 3 month CP, that affected the market immediately.
Yeah.
There's no more CP as a share of corporate funding, right? So it's not going to affect businesses and business activity as much now. But over time, you have less CapEx, right? Because maybe you're not willing to borrow a little bit more to do that capital expenditure that you would have. But again, that's a much longer, that's a 3, 4, 5 year type of activity rather than, 3 months or a year.
All right, Ira, great to catch up with you here. Ira Jersey over at Bloomberg Intelligence, the chief U.S. interest rate strategist there as we continue our special coverage of the Fed Decides here on this Wednesday afternoon. We continue to count it down to the closing bells as well, which are just about 14 minutes away. And Ira, we want to actually keep you here, Ira, if you can, before we let you go, because you're so good. We decided to ask you additional questions. And I do have one question here about the idea that how many people were betting on the steepening of the curve, meaning investors in the market. And when you looked at the dot plot and the economic projections here, do you think that's going to be enough ammunition to actually see a significant unwind in some of those bets?
Yeah, so I think that's actually one of the reasons you've seen some of the what we call bear steepening over the last couple of weeks, which is people thought that maybe the Federal Reserve was going to cut interest rates pretty aggressively next year. And because of that, you wind up with 2-year yields rallying a lot and 2-year yields much lower. And that was the interest rate, the steepener, and that was a consensus for a while. And I thought that for a little while, too, although I backed off from that the last couple of months. So I do think that some of the move that you're seeing today are people saying, okay, well, look, if the Fed's on hold, 2-year yields aren't going to go down a whole heck of a lot.
I want to follow up on that, too, because, I mean, we're, what was it, something like 18 months from when we first started this cycle. I'm really close to 2 years when you consider when you started to try to jawbone the market. Your expectations when you go back maybe to late 2021, early 2022, compared to your general expectations now here, did they shift meaningfully?
Well, yeah, of course, because we wound up getting much higher inflation than we thought, right? We were thinking that 10-year yields would peak somewhere under 4%. We've obviously peaked above 4%. The challenge with managing money and trying to determine where interest rates are going to go, particularly longer-term interest rates, it has to evolve, right? So getting direction right ends up being much more important than getting the magnitude right, because you can always stay in a trade longer if it's working than getting it wrong and getting stopped out or losing a lot of money, right? So we thought that yields were going to go up in 2022, right? That was a pretty consensus view.
Yeah.
But we thought, again, like 3.3%. Now it's 4.3%. I do think, though, overall, you have to think about, for the longer end of the curve, are we near or at the peak of interest rates? And I think we probably are, but there is a big risk here because we've tested this 4.35% on the 10-year.
Yeah.
If we break through that, there's going to be a lot of stops where a lot of people like buying at like 4.25, but if you get to 4.5, those people are going to get out of that trade, and you wind up with a big spike in interest rates.
What would be the impulse for long end rates to go higher, for the 10-year specifically to reach 4.5? What would be the actual catalyst to drive it there?
Yeah, I think it would have to be a reacceleration of inflation. So basically CPI and the core PC deflator moving up a bit. And then as that occurs, basically even more shifting of expectations for what the Fed's going to do. So I think in order to see, a 5% 10-year, you probably need to have expectations of a 6% Fed funds rate or higher, just because the market is going to continue to think that at some point the Fed will cut interest rates. But if the Fed is still hiking interest rates, then you wind up having a significantly higher 10-year yield as well. So, another 50 basis points or 75 basis points of hikes by the Fed, that might get you close to 5% on a 10-year. Now, that's not our base case expectation, obviously, but that's probably the likely market outcome of that scenario.
All right, Ira, now you can go.
Thanks, Roman.
I think the Amtrak trains are back up and running. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey there, helping us walk through not only his take here on those economic projections, guys, but more importantly, how the market might react should some of those projections get hit. And of course, the big move today is in that 2-year yield, the most rate sensitive part of at least the main part of the curve here, up 7 basis points right now, 5.1587 and change.
The highest level since 2006. We also have the 10-year yield moving marginally higher. One thing that we were trying to figure out yesterday was the big move up in yields as well. And there are different reports, but Canadian CPI picking up, quickening in August after, it had appeared to stabilize, raising some concerns that we're going to see a similar reacceleration of inflation here in the U.S. because the Bank of Canada was ahead of us with the hawkish pause.
Yeah. And it's interesting, too. I mean, we talk about the equity market reaction. We're still around session lows here for most of the major equity indices here. And I was just looking at the S&P sectors, and basically what's leading it right now is consumer staples and healthcare and real estate.
And then you take a look at the NASDAQ 100, your big tech names. The NASDAQ 100 off by 1.2%. I thought it was interesting. It was Bill Dudley, right, who said that, okay, if you take a look at what the expectations are, rate cuts coming off the table next year, shouldn't stocks be higher?
Yeah, he was puzzled by that for sure. I mean, big tech is, so, maybe that should lift the markets overall. Let's not forget that we do have earnings coming out after the bell.
Yeah.
There's still corporate news, and FedEx will be reporting. We'll be all over that.
Yeah, we're going to get FedEx, and I see you got Klaviyo up there. Its debut here on the day. Let's continue this conversation right now as we count you down to the close. Jeffrey Rosenberg joining us right now, BlackRock portfolio manager of the Systematic Multi-Strategy Fund. And Jeff, I just want to get your take right off the top here. When you heard the commentary from Powell at the press conference and kind of the back and forth with regards to where rates might be, where the neutral rate might end up here, this seemed to be just once again him trying to work that magic on the market and keeping their expectations in line with the Fed's expectations. Do you buy into it?
Well, I think that, most of the action in this meeting, comes from the statement of economic projections. And as Powell, tried to lay out, that's not part of the committee's deliberations. It's not a plan, but it is really, the signaling of each individual participant's expectations. And so that was really the dominant story. And so Powell had to kind of navigate that. But I think it was a story that he wanted to tell, particularly in showing, higher or restricted for longer in terms of the 2024 dot. The 2023 did not have the decline. So overall, it preserves a lot of policy flexibility to become less restrictive over time. And I think that's the easier path for Powell to have taken. And I think that's probably a good outcome for him and the FOMC today.
Less restrictive over time would suggest that current policy is sufficiently restrictive. And I fixate on that clause, that phrase, because that's a qualitative, not quantitative judgment, isn't it? What does sufficiently restrictive mean in the current context? Is it a moving definition or range, or is it a fixed target during this rate hike cycle?
Yeah, and as you saw, there was a lot of discussion and a lot of questions on that, and I think the answer is sort of you know it when you see it, which is that the policy rate has the impact on the data, on the economy, and most importantly on inflation that they're expecting. So, most of the forecasts that were written down today, and most of the market forecasts basically say the Fed's going to have success here on inflation, and so therefore we're sufficiently restrictive, and we're about to move the discussion to, are you too restrictive? What about cuts in 2024? Why did you take 50 basis points out of the cuts in 2024? But that may be premature. It's basically, counting your chickens before they've hatched in the form of we're expecting that inflation decline. And if we don't get that expected decline, that's going to be a bigger surprise, noting that, we've had a lot of failures in the consensus forecasting around inflation. Now it's too benign. Now the market is too complacent around the expectations that inflation will go back down to its pre-COVID level. I think that's where the surprise in the forecast may come from. But right now, there's pretty good consensus both at the Fed, in the SEP, and in the market that inflation has been won. The war on inflation has been won, and it's just not as Powell laid out in part of the Q&A. Now it's more two-sided and trying to secure that soft landing that is so much in the consensus, and I think is also reflected, partly in these SEP forecasts as well.
So, Jeff, how high is the hurdle for a rate hike in November? And he himself said that, it probably wouldn't do anything for the economy.
Yeah, I mean, as he said, and I think it's right, one more hike here is not really the make or break story. The story is really that they're going to be high for longer, restricted for longer. We're pretty much at the end of the hiking cycle. Whether there's one more or not, very much depends on how strong the economy is. And as he highlighted, the change from the prior forecasters really about the strength in the economy, contributing to people's unease about how quickly they had penciled in cuts in 2024. So that's really going to be the story here going forward is, does the strength persist? Does inflation not fall as much as forecast because of that strength? And the Fed actually needs to do more or hold at the higher rate. Well, both needs to do more in the form of one increase, but then hold at that higher rate for a longer period of time into 2024.
And Jeff, I'm still stuck on Chair Powell's comments on real rates, these meaningfully positive real rates. And just to recap what we've seen so far in 2023, you have 10-year real yields up about 45 basis points. You look at the S&P 500 up about 15% so far this year at the moment. I know that AI is very exciting, but when does the U.S. equity market start to respect what we're seeing in the bond market?
Well, the discussion on real rates is very interesting because, both you have an increase in kind of the projected real rate into 2024 with the 50 basis points of cuts in nominal rates being taken out at the same time as you basically maintain the inflation rate decline. Yet the discussion also brought about the longer run estimate and effectively the discussion on, what is the real neutral rate? So, right now, estimates for the real neutral rate imply that these are very high and therefore restrictive real rates. But there is this possibility, and Powell talked about it. He admitted that, the resilience of the economy might point to the fact that your neutral rates are indeed higher, that post-COVID structural changes have led to that. And, that will be the kind of historical reckoning of this tightening cycle, that if real rates indeed did go up, that we actually weren't as tight as that as we expected in real time. And that might explain the lack of the inflation decline down to the 2% level. Sort of the easy parts of inflation declines are behind us. The hard part is ahead of us. And whether we achieve that as easily as these forecasts in the SEP are implying very much depends on whether or not these real rates are as tight as we think they are today.
All right, Jeff, going to have to leave it there. Jeffrey Rosenberg over at BlackRock. He basically made it clear here, guys, that I thought he used the phrase here, The hard part really is here. And I just want to quote something. Enda Curran, one of our Bloomberg reporters here, wrote something great in the live blog that we had. And he basically said, it's clear, in his words, it's clear the Fed is now in a much more, quote, complicated judgment territory than it has been. And he goes on to talk about this idea that when you go forward, these next few meetings, it's going to be insane.
What do they say about script writing, that the third act is the hardest?
I don't know. I've never taken a script writing class. What are you doing in your free
Maybe
time?
I revealed too much about myself.
Yeah, what is the script about?
You think about how close the finish line is.
Does it involve me and Scarlett?
No, it's all about the Fed, actually.
Oh, is it?
Yeah,
Okay.
basically, and how hard it is, their path forward.
Hold that thought, Katie Greifeld. We're moving closer to these closing bells. Our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld and Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with our friends Carol Masser and Tim Senovic. Welcome to our audiences across all of our Bloomberg platforms. Here on Fed Day, of course, the big headline, guys, is the Fed holding rates here at the September meeting, but making it clear in those projections that it expects rates to be higher for longer into 2024 and beyond.
Right. And it looks like, Romaine, that the Treasury trade certainly got that memo and that note and that message very clear. Our two-year note now at 5.15. I mean, we're at the highest in since 2006, I believe. So we've really seen kind of a bit of a reset again. I feel like this week and certainly on this day when it comes to rate expectations. And we just talked with Larry Pitkaski over at Good Haven, and he said, I love what he said. I think we're in a higher rate, risk-free environment without existential worries. So in other words, higher rates for longer, get it, but maybe without some big risks.
But here's the thing. When you look at the summary of economic projections, how can you know what's going to happen in 2024? How can you know what's going to happen in 2025? It's you really, as Yelena Shaliatov over at BNP Paribas told us, you have to take anything beyond this year with a giant grain of salt. We just don't know what's going to happen.
So Scarlett, should it not be considered a plan then?
He was very clear that this was not a plan. These are the median, the average forecast among, all these different participants who submitted their numbers. And by the way, economic forecasting is very difficult, guys.
I've heard that before. I heard that today, actually, from Fed Chair Jay Powell.
I mean, not if you have a crystal ball. I don't know. Do you guys not have one?
Yeah, we don't. Let's walk you through the market numbers here. We've been talking a lot about the macro, but it was a pretty busy day for equity markets. Obviously on pins and needles about the Fed, but of course you had an IPO today in Klaviyo and not necessarily the best trading day for Instacart and ARM once again. The net effect of it all is the Dow Jones Industrial Average lower by about 0.2%. The S&P 500 giving back almost 1% on the day, or roughly 41 points, a close right around that 4,400 level, a key technical level there. The NASDAQ Composite down about 200 points, or 1.5%, while the Russell 2000 looks like it's going to finish out the day lower by about 0.9%.
All right, quick look at the S&P 500 in terms of the names, about 173 to the upside, 328 to the downside. So certainly more of that risk-off trade, no doubt about it, and 2 unchanged, Scarlett.
Yeah, volume also slightly lower than the year-to-date average. Let's look at the sector performances here for the S&P 500. It was a down day for the major indexes, as Romaine told us, but there are some sectors that did finish higher, including telecom names, healthcare equipment, and food, beverage, and tobacco. So you're seeing a lot of those dividend plays, those safety plays come out ahead. On the flip side, you've got a lot of those big tech names, media, entertainment, semi and semiconductor equipment companies, and tech hardware, along with software and services, all leading to the downside, all down by at least 1.5%.
All right, a little nervous, making sure that my gainers actually held on to their gains, but let's go to it. Klaviyo, right? The IPO. It's been a big week.
Not all of them said Carol. Can we just get rid of that fourth one?
Darn it. Gosh.
All right. Can you just block out her box?
Wow. Again, I'm here. I can hear this. All right, so Klaviyo up about almost 32% at its highs today in its first day of trading as a public entity here. Finishing up, though, with about a 9% gain. It was oversubscribed nearly, I think, 30 times. So, it's interesting. Limited supply, another one of those kind of IPOs, but nonetheless, a gain, but lost a lot of that momentum that it saw earlier in the session. Pinterest, I want to go there because it's been on quite a 2-day rally, up another 3%. It gained 3% yesterday. Analysts were impressed by Tuesday's Investor Day, saying that the social networking company was upbeat and that the long-term targets look achievable. It's up roughly about 12-13% so far this year. And then Enphase Energy, once again, rallying up 4% yesterday, up another 1.5% today. News Monday, late Monday, after the close at co-director Thurman Rogers bought about $4 million worth of shares. It's the only news I could find, but it looks like still some momentum. Still down more than 50% year to date, and you got about 8% of the float shorted. Initially, a lot of other solar names were higher, which meant the Invesco Solar ETF was up almost 2% at its highs today. But finishing with a decline of 0.1%. So over to you, Mr. Decliner.
Handing it off to me. I'll take it. Let's talk about some of the stocks that moved lower on the day today. In the S&P 500, mega cap tech declining after the Fed's higher for longer message. Apple among the worst performers on a points basis in there. Microsoft there as well. Nvidia, Alphabet there as well. We should note that Dow Jones also reported a note from UBS's David Vogt that questioned demand for the Pro version of Apple's new phone, saying demand was not as strong as it was for the Pro models last year. And then Zebra Technologies, the worst performer on a percentage basis in the S&P 500, down 6.5% today. It's a company that makes barcode scanners, interactive kiosks, and more. Got downgraded to underweight from equal weight at Morgan Stanley. Morgan Stanley analyst writing that the pace of recovery at the consumer electronics company will likely be slower than expected. And then let's check in on Maple Bear. That's, of course, Instacart. The price for that IPO was $30. It closed today just above that IPO price. Yeah. So hung on to that, but still down 10.7% today. This after raising earlier this week, $660 million.
And do you know why it's Maple Bear?
No. Oh. Well, anyway.
Do we have something more important? Let's go to something more important.
Okay.
Well, something more important, I would say, is the bond market.
Yeah.
I know there were some interesting single stock stories, but on Fed Day, of course, we got to take a look at what's happening across the Treasury curve, all the action in the front end. As you can see there, you have 2-year yields managing to rise 6-7 basis points, 5.15%. That is the highest 2-year yield since 2006. You go out the curve, not as interesting. You have 10-year yields. I'm going to call that unchanged. Your 10-year yield about 1 basis point higher, 2 basis points higher, 4.37%. That curve back to inverting rather at about negative 78 basis points remain.
Yeah, we actually still getting some earnings, believe it or not, here. That's kind of the last stragglers from the past quarter. FedEx out with their numbers here for their fiscal first quarter. Revenue coming in at about $21.7 billion. That's a smidge lower than what the street was looking for at 21.84. But operating income does look like a pretty solid beat at $1.59 billion versus a street estimate on average of about $1.34 billion. Here's your forecast here. The company basically saying that it sees full-year adjusted EPS at $17 to $18.50 a share. The previous guidance it gave was $16.50 to $18.50, so effectively just raising the lower end of that range by about 50 cents. You can see the price reaction there, the knee-jerk reaction higher by about 2%.
And, of course, when it comes to FedEx, what's notable, of course, is how it stands in contrast to UPS. UPS had to give big pay raises to its workers who had threatened to strike. FedEx, of course, is, has been cutting costs and has been doing that. And the CEO says that they're well positioned to deliver, they've started fiscal 2024 with strong momentum and are well positioned to deliver improved profitability. So kind of just putting that out there and reminding everyone.
Yeah, they're not apples to apples when you look at FedEx and UPS. We often talk about their different models, but man, investors have been really sitting up and taking notice of what FedEx has been doing in terms of transforming the company. I mean, it's up more than 40% this year. You've got UPS down about 9%. There, of course, have been, concerns with the strikes and so on and so forth. So very different stories for these, but it really does feel like Wall Street investors have taken notice of what the changes they've made.
But it's interesting, too, to look at this report as well as a couple of the reports and to sort of tie that into some of the questions that Powell was peppered with here. This isn't a revenue growth story. I mean, this is cost cutting. And I think this is the fear that a lot of investors have that, that's great in the short term. It gets you through the quarter and it bolsters the stock price. But how much longer do we go like this, particularly if you do believe that rates are going to stay higher? Yeah, the press release, Romaine, literally spells that out. Yeah. It said that first quarter results improved primarily due to the execution of the company's DRIVE program and a continued focus on revenue quality. But, and this is a big but, the improvement in operating results was partially offset by ongoing demand weakness. That's the thing. I mean, it's you can cut costs. No one's poo-pooing that, right? But you can't sort of cut your way to prosperity, more or less, right? And you sort of wonder what the strategy is for FedEx. And we don't want to just pick on FedEx here. A lot of other companies are in the same boat as them. Other blue chip companies are in the same boat as them. And I wonder if that's sort of the next thing that the Fed really has to be mindful of. We've so focused on the consumer and the homeowner, but we forget there's stresses out there for businesses as well.
But maybe against this backdrop, that's good enough. And you can see that in the share reaction after hours. FedEx shares up 2.5%. To your point that, I mean, that's not necessarily growing, that's cutting costs. But you think about some of FedEx's peers, maybe cost cutting is good enough to make it stand out.
Well, and sometimes you have to clean house, right, to get to a better business strategy or business equation. I do also want to mention that, and could be another reason why the stock is popping, company expects to buy back an additional $1.5 billion in shares during fiscal 2024. We see companies doing that a lot, when they've got some excess cash. Again,
so $1.5 billion to buy back the stock.
Right.
Not into CapEx, not into the business.
It's not building the business,
okay, got it.
Paying workers, whatever.
But it allows you to buy time while you wait for things to recover, right? I mean, Jay Powell made it really clear that the economy is doing better and holding up better than a lot of people anticipated, certainly than the Fed anticipated. And so demand might be more muted than it was before the rate hikes, but it's held up for the most part.
No, you do wonder, right? You can't cost cut your way to, a really strong company, but you can certainly make investors happy maybe for a little while. So more to come, certainly, on that story. Guys, that's a wrap. All right, that'll do it for our cross-platform coverage.
Happy Fed Day.
Happy Fed Day.
Good to see 5 of us.
Yeah.
Did Tim say big butt before?
No.
He did. You did. It's
On
a
what?
big butt. You said that.
Oh, okay.
Sorry.
Maybe I did.
I know. I'm being like an 8-year-old again. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will see you again tomorrow.
Stick with us. A lot more coverage coming up here on Bloomberg Television, a reaction to what we learned out of the Fed today, a reaction to what we learned in markets as well. David Balin from Citi, John Taylor from Stanford University, and Raghuram Rajan, former India Reserve Bank governor. All that and more coming up in just a bit. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for all and Hunger for none. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
A down day for equity markets, an up day for yields, the most severe price reaction, the most severe volatility, of course, coming right around the 2 p.m. mark here in New York when the Fed released its decision. The big thing, though, the big takeaway, though, that we learned from that press conference, from Jay Powell, and from those economic projections is the idea that the economy has held up way better than what the Fed had originally projected when it embarked on this rate tightening campaign about 18 months ago. And so, too, did the market. In fact, the S&P, while down about 0.9% on the day, believe it or not, actually is still hovering just slightly above the levels it was at in March of 2022 when the Fed started this rate tightening cycle. So a market that has been through a lot of ups and downs ever since then, but the net effect of is that it's held up and, more importantly, delivered for most investors some modicum of return. The Dow Jones Transportation Average slightly unchanged here on the day. While we did finally see a pullback in the oil markets, we saw a pullback in gold, and we saw a bid come back into the dollar. That's basically the cross-asset story right now, minus what we saw in yields. But let's talk about what we saw in yields today. Of course, there will be a lot of talk about the 2-year yield hitting the highest level since 2006. But quite frankly, most of the Treasury curve right now has been camped out at some of those levels that we've seen back in 2006, 2007, and 2008. That includes your 10-year. That includes your 5-year here. A cycle right now that has us at these, well, let's just call it a cycle high, a generational high, if you will. But if you believe those economic projections, and if you believe the words that came out of Jay Powell's mouth, these lines will continue to creep higher.
Yeah, I like the way you put that generational high. Well, the Fed's ongoing draining of its balance sheet has also removed a backstop for a key corner of the funding space, and that is fueling volatility in the market for repos, repurchase agreements. For more, let's bring in Bloomberg's Alex Harris. I think we tend to forget that at the same time, there's still quantitative tightening happening. Why is this important?
Yeah, I wish we would have heard a little bit more about it in the press conference today, because it is important. And especially if you think about it in the context of these basis trades, the whole foundation of a basis trade is you're taking a position in futures, but you're also taking a position in the cash market for treasuries. And those trades that leg gets financed in the repo market. So now if you're trying to finance basis trades and now you're looking for paper and it's not there and you can't go to the Fed and get more of it because they're backstop, they're not holding as many treasuries anymore, this gets really expensive, and it makes for a very, very volatile repo market, more so than we already see just on typical periods.
But why don't you think that Powell is, at least publicly, doesn't seem to be as concerned about it? I mean, he only really mentioned this once on his own, and I think one of the questions that was posed to him on this, he kind of didn't really even answer it.
I think there's just so many wild cards when it comes to the balance sheet in terms of reserves. The key question when everyone talks about the balance sheet and quantitative tightening is this lowest comfortable level of reserves. What's the total number of reserves that banks need to be holding on to before you hit that point of scarcity, before the markets get volatile and we get something similar to a blow-up that we saw in 2019. And after March of 2023, after SVB and the other the turmoil in the banking sector, nobody knows. And there was a senior financial officer survey that the Fed released in August.
Yeah.
And they were saying that those levels are actually much higher than they were at the beginning of the year. So now the calculus has changed and nobody knows. And it's a big wild card. And I think if you're the Fed, you need to present confidence that this is going well.
But if you're the 19 members here on FOMC, or if you're the staff providing these reports, and you go into that next meeting, October 31st, November 1st, and you have to discuss this issue here, can't you make a case, and I think Powell used this phrase to some degree or another, of normalization, the idea that while there is some ructions going on in the market, it's kind of just taking us back to what, in his mind, where the market should have already been.
Yeah, yes and no. But again, it's like that risk of going too far. And that's what we saw in 2019. And I think that's what really has people concerned, is when the Fed isn't quite sure of where that lowest comfortable level of reserves is, where that flat part of the demand curve is. That's what gets them scared, because if they don't know, nobody knows. And then you risk running into, and creating this volatility and creating this turmoil. And then that causes an abrupt stop to their whole plan. So that means no rate hikes, because how do you communicate that you're stopping the balance sheet unwind while you're still raising interest rates? And communication, let's face it, isn't necessarily the Fed's strong suit in trying to work with these dualities.
Yeah.
All right, Alex Harris, great to see you. I know it's been a busy day for you.
By the way.
You do?
I think it's the best we've had in years.
You think he's doing a good job?
I didn't say good. I just said it's better than what we've had in the past.
He's doing a job. I agree with that. Well, let's ask our next guest that question. We have Andre Skiba. He is RBC Global Asset Management Head of Blue Bay U.S. Fixed Income. And Andre, come into that debate that we just had. When you think about what we heard from Powell and what we've heard from Powell really over the past couple of years, how would you rate his communication job?
Well, hello. Thanks for having me. It's been a difficult message, because Fed is essentially telling you it's all going to be okay on multiple fronts, that growth will come back soon close to long-run averages, inflation will moderate, and unemployment will only tick up modestly. And there is a fair dose of awareness within the market that Fed's projections have changed dramatically every 3 months, quite a few times when you're looking at historical summary of economic projections. And what we could be hearing from the Fed 6-9 months down the line could be very different from the very benign message that we're hearing today. So there is a fair amount of questioning. Is it too good to be true in terms of the forecasts?
Yeah, and I think that question was put to Jay Powell as well when people kept pressing on this idea of a soft landing. What surprised me is that I think for the first time, I heard him say that the soft landing or a soft landing is a primary objective for the FOMC, even though we know it's not part of its mandate. Do you get a sense that policymakers are getting ahead of themselves here in talking up the likelihood of a soft landing? New York Fed President John Williams recently said recession talk in the finance sector has basically vanished.
Look, there is some truth and validity to that concern, that how much are you locking yourself into specific outcomes? But at the same time, Chair Powell was careful not to say that that is their base case scenario. So that still opens the door to responding to changing economic conditions over the coming months and quarters. And at the end of the day, after so many hikes and also meaningful tightening of bank lending standards that is filtering through the economy, it would be really surprising to see everything proceeding very smoothly over the quarters to come. So saying that soft landing is not a base case scenario, we think that is appropriate.
Then when you measure up the market reaction today, and we'll see whether this actually carries over beyond just a couple of hours post-meeting here, but we talk about the direction of the yield curve right now, pretty much across the board. We talk about inflation expectations if you go out at least 2 to 5, 10 years, seem relatively grounded here. And of course, you had the big sell-off on the front end of the curve and somewhat sparing the longer end of the curve. What does that tell us?
Well, higher for longer seems to be the theme of the day. Doves did not get any interesting news from the press conference. So the market is adjusting front end of the rates higher, and the expectations for maybe middle of the year cuts next year have been pushed out to maybe July or September. And look, we will see how the data is evolving. It is very clear that the world can look very different 6 months down the line. So we should be open-minded to Fed adjusting communication further down the road. What was interesting, though, is how some of the FOMC members have changed their long-run rate expectations. So there's been this great debate about what is the R-star, what is the neutral rate, and is there a need for that to increase? And we have now seen the evidence in the summary of economic projections that the range of estimates has actually, the upper band has moved up. And Chair Powell has also admitted that it's a possibility that it's higher than Fed is currently forecasting. And when we're looking at fixed income universe over the coming quarters, how that debate is unfolding will also have meaningful implications for how risk assets are doing and whether people are taking advantage of the current high yields within fixed income or taking a step back.
Yeah, and it's interesting, too. We should point out a unanimous decision today, and we should point out all the meetings we've had going back to March 2022, all but 2 of them unanimous. Anjay, great to catch up with you. Anjay Skiba there over at RBC Global Asset Management. We're going to continue this conversation, our special Fed Day coverage, continuing with David Balin, Citi Global Wealth Chief Investment Officer and Global Head of Investments. That conversation coming up after the break. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
The Fed decided earlier today, and the decision was to leave the benchmark interest rate unchanged. The second pause in this rate hiking cycle, but Jay Powell, as well as those economic projections, signaling that another hike could actually happen this year, and he expects rates to be higher for longer through 2024, maybe into 2025. As to what this means for the global markets, let's get some insights out of David Balin. He's Citi Global Wealth Chief Investment Officer and Global Head of Investments. And David, the market today had the knee-jerk reaction largely to the downside here, at least on a price basis. When you look out a little bit further over the next few months as we try to sort of figure out where the Fed goes next, do you think market sentiment is going to be, I guess, somewhat commensurate with what we heard out of Jay Powell today?
When you look at the macro trends that underlie the decision that the Fed made, they're actually pretty positive, right? They increased growth rates for this year and for next year. They're talking about an economy that is essentially resilient. They're talking about earnings probably that are higher than have been expected. And so what they're talking about is an economy that's going to take a longer time to slow down to allow inflation to get to their target, 2 to 2.5%. So to me, the underlying economics, for the economy and for what earnings could be next year are actually pretty positive. From a rate perspective, what's happening is that you're obviously seeing, higher rates for longer. And if you think about what that does, is it makes investors much more likely to consider the possibility that they're going to consider fixed income more primarily, which is going to dampen what I think equities can do. So the net impact of this over the next year and a half, I think, is going to be pretty positive for equities, but it's going to take 18 months to see that come through.
Wow, 18 months, yeah. So it's going to be, when you look at what's to come, are bond yields going to be driving equity prices then in the near term if it's going to take 18 months for things to filter through?
Well, we're going to see equities go up, I think, over the next year. Let me give you some sort of context for this. The context is that if you think about where we were at the end of 2022, we had been through one of the only 2 years in 100 years where you saw both bonds and stocks go down. In those last two instances, when you look 2 years later, the average 60-40 portfolio is up 20%. So it's possible, and I think it's likely, that we're going to see portfolios, 60-40 portfolios, do that by the end of 2024. So a combination of profits in fixed income as inflation abates, and due to the fact that equities themselves will actually appreciate as earnings actually rebound. 2025 could actually be the first normal post-pandemic year that we have, and I think that's what's going to play strongly into portfolios for clients.
All right, 2025, a year of normalcy, hopefully. And David, since we have you, I want to get your thoughts on some of the recent things that we've seen in the equity market outside of the Fed decision today. When you think about some of the huge IPOs that we've seen, huge by recent historical standards, what could this mean for the IPO market going forward and for the equity market going forward?
Right. So we just wrote a little bit about the fact that the IPO market reopening is a big deal. But it is not something that's going to take place with any great speed. There are several hundred companies that could go public. The valuations, with the exception of the semiconductor company, have been normal, market rates. But I do think the reopening is a big deal in the sense that it's going to drive investor sentiment, more positively. We see the market opening much more for IPOs in the next 6 to 9 months than we do over the course of the next few months. But in general, again, that's a positive thing. We need to see rates ultimately peak in order for the equity markets to really have, some more momentum. And I think the other thing that we should look for is labor, actual employment numbers going down. No one's really talked about the fact that the real Fed declines in interest rates are going to occur when we see labor, initially even more levels of employment dropping and ultimately going negative. The Fed has a great history of stepping in at that point and saying, wait a minute, we've got to support the labor economy. That data could be 3 months from now, could be 6 months from now. But with this level of tightening and with money supply actually negative, it's more likely than not that we're going to see a negative impact, to labor that people just are not anticipating in 2024.
All right, David, great to catch up with you. David Balin there, Citi Global Wealth CIO and Global Head of Investments. Stick with us. John Taylor up next.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Romaine Bossack here with a look at how markets perform here on this Wednesday, a Fed decision day. And the decision by the market, it was very volatile here. Right around 2 p.m. Washington time, we saw a huge spike higher in Treasury yields, and we saw a huge drop lower when it comes to equity prices. That was the net effect overall, with the big drag coming from the tech space. The Philadelphia Semiconductor Index down almost 2% on the day. And as far as the Magnificent Seven, no real nothing really there to talk about today. All 7 of those stocks lower on the day, including Apple and Amazon down for a 5th day. In fact, Amazon now erasing all of its gains for the month of September here. You did see a slight uptick in the dollar. Finally, some perking up in the VIX index right now around 15 here. And a big stay in the crude oil space. The net effect, though, was the WTI pulling back by about 1% here on the day. That's the knee-jerk reaction here on this Wednesday. Of course, Scarlett, we're going to have to wait for the next few days and weeks to get a better sense here as to whether this price action sticks.
Yeah, but that was the knee-jerk reaction. And you look at those red up arrows, red, of course, indicating lower prices for treasuries, and the up arrow indicating the move up across the yield curve. And that is the picture here following the latest Fed decision and, of course, their economic projections as well. Let's bring in Bloomberg's chief correspondent for Global Macro Markets, Liz McCormick. Liz, you recently wrote that the dot plot, the updated dot plot, the updated economic projections would be a key decider for where the Treasury market goes next. What did you gather from this latest dot plot?
Yeah, I really like the dot plot today because I feel like the Fed out-trumped what we thought, because a lot of investors were saying next year what the dot plot shows, they thought they would take away one of the cuts because there was 4 signaled in June, but the Fed took away 2 cuts. So they kind of slashed in half how much easing they'll see next year. So, to me, now it's about, because, the Feds did signal one more hike this year, but whether they do it or not is kind of very marginal. But it's how long do they stay there? And the Fed seemed to really double down on it is higher for longer, and we mean it, and that's why, like Romaine was saying, there was a lot of volatility, but now both short and long end rates are up for the day.
So, Liz, you love the dot plot. I don't know if Jerome Powell necessarily loves the dot plot, but...
remember when he said he was going to kill the dot plot?
That didn't happen. You can't kill a good dot plot. But you made an interesting point before the camera started rolling, actually. The median long-run dot didn't change, but the average has actually been moving around a little bit.
I even brought my wonky papers and
highlights. Is this where you're going to explain us the difference between median and average?
And I was looking, I did take statistics in my life, but I was looking, and even though the long run dot is stayed at 2.5, that's the median that we look at, but the average, which our Bloomberg people are great to put out as well, did go up almost 10 basis points, to like 2.7, say 6 rounding from 2.66 in June, the last updates. And Chairman Powell even said that, there's a chance that neutral rate, what we call the R star, which some people look at that long run dot as somewhat of a proxy, could be getting higher because the economy's been more resilient and other factors. So I see a lot of investors, that's what they're paid to do, kind of deep in the weeds saying, hey, that long run dot may be moving. So we have less cuts coming in next year, higher for longer. And, think of the long run rate for the Fed as kind of the base rate of a lot of policy. Mm-hmm. So if that's higher, that you've got to kind of nudge up rates in the Treasury market across the curve on that.
I'm curious about the market reaction. We were speaking with your colleague Ira Jersey over at Bloomberg Intelligence, and I thought he made a good point here that even if we do start to see an uptick in yields here, is there some sort of threshold where then all of a sudden the market positioning sort of kicks in and then actually exacerbates that move?
Well, I think, one yield my colleague Mike McKenzie and I talk a lot about is 4.5 on the 10-year, right? That people thought, we couldn't get there. And there's a lot of people saying if we break 4.5, then that might be that trigger, because people keep thinking, we can't go that much higher. But then when they do, you start seeing stops triggered. People have to scramble out. And then you see that kind of rapid, those jump moves. So, I mean, I'm old enough to know, like, maybe 5 on a 10-year is not that high, right? So I think Ira's right that you have to watch. Things can go gradual until they don't, right? And you hit these trigger points.
Yeah, I think the more useful dot plot is they just took all those stops that the market has and just published those, made those public. Then we'd have a better sense of what's going on. Liz McCormick, chief correspondent for Global Macro here at Bloomberg. We want to keep the conversation going right now with John Taylor, professor of economics at Stanford University, senior fellow in economics at the Hoover Institution, formerly, of course, with the Treasury, and, of course, the creator of the namesake Taylor Rule. And, Professor, I want to start off here with this idea, this balance that I think Jay Powell is trying to create here, the idea of continuing here with the hawkish policy while still encouraged by a relatively resilient economy. And I just want to read you a quote here, because there were 2 papers that came out, one this month and one that was presented at Jackson Hole, and they both made the same case that, quote, the majority of disinflation has been driven by expanding supply rather than decreasing demand.
You want me to react?
I do.
Well, I think that's missing the point. You remember, it was just a little over a year ago. The interest rate was 25 basis points. So while we have come up quite a bit, it's still not quite all the way. I think I feel a little better if I did 25 basis points as well. But we went 25 basis points to 5.25, 5.5, and that's a good stuff. So I think that's what's happening. They signaled that they were clear about it, but and it hasn't done the damage we were worried about.
Professor, I want to get your take on wages and how they fit in here. Do wages follow inflation or do wages cause inflation? We know that the global economy has seen some big structural changes after the pandemic, and here in the U.S. we continue to have a relatively tight labor market. Is there any reason to expect wages to continue to cause inflation in the future?
I don't think so. I think it goes both ways. Sometimes it's inflation, sometimes it's wages. I think at this point, we have inflation, which is well above 2%. It's not 9.1 like it was a year and a half ago, but it's over, say, 4%, 3.5%. So we got a ways to go to get it down, and that's the main thing, which is affecting wages, and thereby affecting prices. So that's the main goal, and I think we referred to the Taylor rule for a few minutes ago. The Fed has recognized that. They're very close to it now, not far away at all like they were a year and a half ago. So that's a good sign.
And let's talk a little bit more about the Taylor rule, because you have your own function on the Bloomberg terminal, TAYL, and you look at the current Taylor rule estimate, it clocks in at about 8.6%. You think about the upper bound of the Fed rate now, that's at 5.5%. Would 8.6% make more sense, or would you tweak that model?
Well, the one I use says about 6%, so it's really close to where it is. And remember, it was 5.5%, 6% when the interest rate was 0.25. And so that's really what things should be thinking about, what people should be thinking about. I would not recognize going further at this point. I think the Fed is right to slow down a little bit, maybe not pause completely, but I wouldn't go as far as that. And there are different versions. The Taylor rule that I use says around 6%.
All right, you need to share that with us, John, so that way we get it right next time. In all seriousness, we talk about this idea of sort of what that neutral rate might be, how long the Fed keeps it there, and the economic ramifications, if you will. If 5.5 percentage points of rate hikes didn't necessarily destroy this economy, are we to believe that holding it there or holding it even a quarter point higher would do that?
The thing is to look at that inflation rate. It's still 4%, 3.5%, supposed to be 2%. And I think it was good that Jay Powell emphasized that that was their goal. So they're not there all the way at this point. And I think that's what people should be looking at. Whether you look at a Taylor or whatever you look at, that's what's telling you. And so that's a little bit more. I think hold it a little bit longer. If we're lucky, it'll come down faster. But so far, it has come down quite a bit, but not all the way.
Once the Fed does wrestle inflation to 2% and can end this hiking cycle at wherever it does, do you think that resets everything, kind of clears the board so that perhaps we can get back to a rules-based approach to monetary policy?
Well, in many respects, we're already back to it. And so, 5.5, 5.25, 5.5 is very close to 6. So I think they were far away, and I wish there were more emphasis on how far away they were. But we were already back, and many other central banks around the world, the Bank of Japan, the ECB, are following the same strategy. So I think it's a good sign that the rules didn't work so well when they were off them, and they're working better now that you're closer. So let's focus on that. I think that's what I get out of this.
All right, Professor Taylor, always wonderful to catch up with you on days like today. John Taylor over at Stanford University here on a Big Fed Decision Day. Our coverage continues in just a moment with Raghuram Rajan, professor of finance at the Chicago Booth School of Business, and of course he's also former Bank of India governor and former IMF chief economist. Going to get his thoughts on the Fed, and why not? Let's just push ahead to the BOJ as well. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Our coverage here of The Fed Decides continues right now with Raghuram Rajan. He's a professor of finance at the University of Chicago Booth School of Business. He's a former governor of the Reserve Bank of India and a former chief economist at the IMF. And I want to start off, Professor, here with an interesting exchange that we heard during the press conference here, where Powell was kind of talked about his baseline expectations for economic conditions and that proverbial soft landing here, at least as of right now, where I know we're only 18 months into this rate hiking cycle. But at least for right now, it seems that the elements of a soft landing are there. And if you believe their economic projections going out over the next 2 years, that seems to reinforce it as well. Did you also have the same takeaway?
Yes, but look at it. The reason you want to say soft landing is the economy has resisted, all that has been thrown against it and is still, projected to do very well this year and maybe slow a bit into next year. So that's suggesting a resilient economy. But a resilient economy is not necessarily good news for inflation. So it does raise the question, is the Fed right to be as confident about the path of interest rates if, in fact, the economy exhibits the kind of resilience it's showing? Now, what plays into Chairman Powell's statement is that he believes the economy is also slowing. So it needs sort of a combination of circumstances, slowing but not slowing too fast. And the interest rates are doing their job, so they don't have to raise interest rates too much more. Mm-hmm. And it all works out really well. And this is why most people say, yes, it is a possibility, but we must consider other possibilities also.
Given where we're at right now, in your view, how much of that can actually be attributed to monetary policy, to Fed policy? And I'll pose the same question that I posed to Professor John Taylor just a few minutes ago. This idea that, at least based on some economists' estimates, a lot of the disinflation we've seen has come more from the supply side rather than the demand side that we typically associate with the monetary policy tightening cycle.
Well, it is a bit of both, but to the point that it seems more like the supply side. Yes, we have seen supply chains essentially reestablish themselves. All the disruption during the pandemic, that has gone away. So that's been on the supply side. But on the demand side, yes, there has been some slowing, for example, in the housing sector. But clearly, there hasn't been as much slowing as one would have expected with a 525 basis point hike in interest rates.
What about the external factors, the things that Jay Powell wouldn't answer, but everyone kept trying to press him on? Things like a possible government shutdown, the student loan repayments, the strikes that are currently taking place in Hollywood and in the Midwest with the auto workers. How can the Fed be so optimistic about GDP, at least in the near term, when there's so many headwinds out there?
Well, there certainly are headwinds, but there are also tailwinds, right? One of the interesting factors over the last couple of quarters has been productivity growth. Seems really, really strong. So if that plays out, it's not just a blip, but it plays out for some time, that would be a positive factor for growth and would actually be positive for the fight against inflation, because it would mean we can sustain higher wage rates without necessarily that translating into higher inflation. So yes, there are a mix of factors. I think the big unknowns are how fast the economy is going to slow going forward, given what has already been thrown against it. And of course, the factors you mentioned, the withdrawal of fiscal support, for example, because of higher student loan payments having to be made. And of course, the inflationary effects of these strike settlements, not so much in the direct impact, but what it sends as a message to what appropriate wage rates might be in the economy.
Strikes, of course, a big unknown. Another big unknown is what's going to happen with energy prices, what's going to happen to the price of oil and this incredible rise that we've seen over the last few months. What is the read-through from higher energy prices into inflation expectations and thus into Fed policy?
It absolutely matters, right? Because one of the worries is the higher inflation caused by energy prices. Fuel prices at the pump are very salient for people. As they see that and start thinking, yes, inflation is back with a vengeance, and then that starts feeding into wage effects, and that becomes the second round effects that central banks really fear. So we're not done, which is why I think Chairman Powell made it very clear that he wasn't in any way saying mission accomplished, that there's a long way still to go. And some of these, blips can turn out into something more that requires more Fed action. So I think the message that we have to take away is so far so good, but a lot remains to be done. And really, we don't have a whole lot of economic models to tell us how this is going to play out.
And of course, the Fed is just one of many central bank decisions that we have this week. The action starts again tomorrow morning. We get the Bank of England decision at 7 a.m. New York time. I know there was better than expected, cooler than expected inflation out of the UK today. Do you think that's a game changer for the BOE?
I mean, it does seem that the BOE is somewhere near the, near a point where they will feel comfortable pausing and watching. I don't think any central bank at this point is going to say it's done. The question is whether they go with another rate hike given their higher rates of inflation, or do they say, well, we've seen enough, because the UK economy is seemingly slowing, and that should be on their minds. But I think the more dramatic question for central banks is really for the Bank of Japan, as every other central bank is raising rates quite a bit. And the Bank of Japan is still figuring out at what point it gets out of its out of its yield curve control, and then gets to start raising interest rates. So the Bank of Japan is really far behind. The two big pressures, of course, on it are exchange rates, whether the Japanese yen plummets even more. And the second, of course, is the betting against their holding the yields at where they are in the markets, basically turning against the Bank of Japan and trying to push yields higher.
All right, I'm going to have to leave it there. Professor Raghuram Rajan there. He's a professor of finance at the Booth School over at the University of Chicago. He's also a former Bank of India governor, as well as serving a stint as the chief economist at the IMF. Scarlett?
All right, well, let's talk about FedEx, because amid all of this, FedEx did report earnings, and the company managing to handle the fallout, of course, of a costly labor fight this summer. Actually, that was UPS that did that. FedEx didn't have a labor issue, but we do want to bring in Bloomberg Intelligence senior analyst Lee Klaskow to give us a little bit more here. And I'm glad I brought up the labor issue, because certainly that provides a contrast to FedEx here. FedEx managing to post profit that topped estimates because of cost cuts. As Romain pointed out earlier, this might be something that investors like in the short term, but it's not a long-term recipe for success, is it?
I would have to take the other side of that trade, because I think what they're doing is FedEx for a long time is considered somewhat of a fat organization with a lot of bureaucracy, and that they're trying to thin down not only the corporate structure, but they're also trying to make their operations more efficient. So I think the cost cutting is not cutting to the bone. I think what they're doing is they're trying to create a more fluid network, a more efficient network, and a more profitable network long term. The issue with FedEx for the longest time has been on execution. I think what this quarter shows us is that they are executing on their plan. They have a plan to reduce costs by around $6 billion. You saw that in the earnings print. They beat expectations around 83 cents a share. And so that's, driving the stock up in the pre-market. They increased the low end of their guidance for the full year by 50 cents. I think that's, I think that's probably a little conservative given the 80-cent beat. Maybe they're just trying to be a little conservative, just given, where we don't know where the outlook's going to head from here.
Yeah, absolutely. Here, now the numbers look good, and we're looking at the after-hours trade. They're up 6% here, Lee. When we talk about some of the things that maybe aided not only what we saw in the most recent quarter, but what could aid them further here, I know they benefited to some degree by some of the concerns about the strike at UPS, which of course never actually happened, and then some concerns, of course, also about what happened with Yellow and whether some of that business actually ended up in FedEx's with FedEx.
Sure. So on the UPS side, yeah. So when the labor contracts were going on and there was a risk of strike, some shippers looked to divert freight away from UPS to FedEx. Now it's up to FedEx to see if they can win that business, if that business is going to be sticky. I would guess that some of it is not, but they probably could keep some of it. So that's net a good thing for market share. As it relates to their freight business, which is their less than truckload business, Yellow, which was at one time one of the largest LTL carriers out there, it went belly up. And that is an opportunity for them to win share. What I would say is not all of Yellow's freight is something that FedEx might want to carry because it's not necessarily profitable freight or good freight that an LTL carrier would like. They like palletized freight, stuff with typically that have low cargo claims. Yellow is known to have a lot of that non-palletized freight, and also they shipped a lot of glass and TVs and things like that. But definitely a market share opportunity for FedEx. So not only can they cut costs, but they do have some opportunities to win share in that business, that LTL business, which is called FedEx Freight.
All right, Lee, always smart, and thanks. You actually taught me a new phrase today, palletized freight. I wasn't familiar with that, but I understood it. Lee Klasko over at Bloomberg Intelligence. A look at FedEx. FedEx posting profit, the topping analyst estimates, and actually nudging up its forecast going forward. Those shares up 6% here in after-hours trading. And so we wrap up our coverage here on this Wednesday afternoon. A push ahead to what the markets will have their eye on Thursday. That's coming up after the break. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk with a heightened awareness of what's possible. CME Group, where risk meets opportunity.
A busy Wednesday, and of course, financial markets already looking forward to another big central bank decision tomorrow.
Yeah, Bank of England, 7 a.m. They did get a CPI print today.
They did. Cooler than expected. You saw the odds shift around a little bit. We'll see if it actually changed the needle at all.
And we're going to come back to the U.S. and interview with James Bullard, formerly of the St. Louis Fed.
I've missed him. We don't hear enough from him.
Well, you're going to hear a lot from him tomorrow. We're also going to get some economic data, Scarlett, including jobless claims.
Yeah, high-frequency data and, of course, jobs of paramount concern for everyone following the Fed decision. There's also Philly Fed and existing home sales as well.
And on the political front here, the president is going to be meeting with the Ukrainian president, Volodymyr Zelensky, at the White House tomorrow. This has been fun, guys. You want to do it again?
Let's do it again.
All right.
Is there another Fed special coming up?
We're going to do a BOE Decides tomorrow. Stick around. Balance of Power is coming up next. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Wednesday, the 20th of September, interesting day for European markets. Real estate is up. House builders are up, certainly in the UK. A surprise downside out of the UK on inflation sends everybody scurrying to what exactly the Bank of England is going to do next. Is it a 50-50 call? That's certainly what the market is pricing. So real estate is up. The auto sector is having a really good day as well. We're going to dig into all of this. The big question, are we there yet? Which I think applies to cars and central banks. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Stock 600, there you go, we've retaken 460. We're kind of back towards the top end of the range. We're up by 0.9%. The rate story is significant today. So REITs are up very nicely. House builders are up very nicely in the UK. The reason for that, the expectation now is that maybe the Bank of England is done. And for obvious reasons, that has a big impact on commercial real estate and the housing market. So Taylor Wimpey, one of the beneficiaries of that. Delivery Hero is up 5.84%. It's actually up on an upgrade, but you're seeing some of the other delivery stocks trading very nicely on this idea that actually we could see a court case in New York City allowing some of these names to make more money from that market, and that seems to be having a positive effect as well over there. So basically we're talking over here about what is happening with rates, what is happening with buildings. The car sector is up very nicely as well. We'll talk about that in a moment, and we're definitely talking about food. But that's your food, Alex, not my food.
My expensive now. Delivery food. Okay, S&P up 0.2. Honestly, I wouldn't make too much of it. Volume is very light headed into the Fed, but some interesting things underneath the surface. Pinterest is one of them, one of the top stocks overall being traded today. It had an investor day yesterday, and the analysts upgraded the stock. They feel pretty good about it. They see the long-term targets are achievable, and the outlook was pretty good. Two-year yield down by 2 basis points, but same deal. Yesterday, we did reach a cycle high for the 2-year on a closing basis, so we are very elevated here. Dollar yen also interesting, a little weaker into the meeting, but we also had some verbal intervention from Japan. Also, Treasury Secretary Janet Yellen talking about the fact, like, yeah, okay, you go ahead and intervene as long as it's to protect volatility. So it did feel like a little bit of a paving the way as a stronger dollar just continues to crush certain areas of the market, Guy.
Yep. It's going to be interesting to see. The BOJ could be a non-event, but we could get intervention, which would be fascinating, particularly if the Fed sounds maybe a little bit more hawkish today. That could be a fascinating kind of counterpoint. Let's talk a little bit about what is happening here in the UK, because I think today, actually, the UK has provided some interest. I think the Fed could be a bit of a snooze fest later on. Am I allowed to say that? The Bank of England tomorrow could be a coin toss. And the reason for it is the data that we saw today. It came in softer than anticipated. CPI headline 6.7, the estimate 7%. That's down from 6.8. Core 6.2, down from off an estimate of 6.8. RPI, which actually an amazing amount of things still get priced off. The old inflation measure 9.1 versus an estimate of 9.3. So actually the numbers are better than anticipated. However, I think there's a whole load of factors you need to bear in mind here. One of which the component parts, which dragged us lower, because we were all thinking that gas prices would push us higher, were very volatile. We're talking about hotels, we're talking about airfares, those kinds of things that bop around quite a lot. So just bear that in mind. And actually, I think you need to take a step back. These numbers are still very high.
Yeah.
And as a result of which, does the Bank of England have more wood to chop, Alex?
Yeah, I mean, you still have a 6 handle for core, like still 6.2. I mean, I don't know. It feels really far from are we there yet. But traders are pricing in a 50% chance of a quarter-point hike by the BOE tomorrow. That is less than it was yesterday. Here's Seema Shah, Principal Global Investors, earlier.
There is a chance of overdoing it, but also from central bank speak, the concern is always going to be about inflation becoming really entrenched. So they have got a very difficult balancing act. I would say that today it's too soon to think about a pause. But are they going to continue to hike every month, every meeting? Probably not, given the unveiling data.
So you got Andrew Bailey in the driver's seat. You've got Ben Broadbent in the back seat, maybe a few of the others. And the question they're asking is, are we there yet? We've all asked that question, and as parents, we've all heard it. The question is, are we there yet? And if we are there yet, is it Hugh Pill's kind of Matterhorn, or is it Table Mountain? I think there's many ways we can go on this. Nora Al-Ali of Bloomberg M Live and Bloomberg's Justina Lee joining me now on set to discuss. If you're Andrew Bailey, you're in the car. It's a British car. We're not going very fast. It's rattling a little bit. Are we there yet?
I'm going to say I hate to be Andrew Bailey tomorrow, only because it's a tough balancing act for the Bank of England tomorrow. Yes, they have inflation coming down or slowing unexpectedly, but it is still quite high, as Alex says. I don't think we're there just yet. I think we get at least one more hike out of the Bank of England. We've had it.
Is it tomorrow?
Let's see, right? I mean, the Doves are in charge. They are in command. We've seen that in their recent commentary coming out. We've seen the concerns about growth in the UK taking center stage. Housing really feeling that pinch. Rents in London quite high. I can go on and on. The
Quite
list
high.
is, that list is quite long, right?
Yep.
But at the same time, we're at the crescendo. This is it. This is the opus. Do we stop now, or do we just keep going for that one more hit?
So it's like, are we there yet? No, but maybe close. And you can kind of see that with Nomura Goldman Sachs. It didn't take them long at all to say that we weren't going to see a hike tomorrow. Justina, what do you think? Are we there yet?
Oh, well, I kind of want to take Nora's approach and sort of dodge the question a little, because I think that, obviously today's... I think that's sort of generally the strategy when I come on this show. Because, today we did get some really positive news on the CPI front. But you have to kind of look back a little to the, higher than expected growth and pay. And I think that could probably still worry the BOE. But you also have to balance that at the same time against kind of other signs of slowing growth, all across the UK. But I think all in all, it's probably, a good sign that we might not be in this like stagflationary quagmire at least.
Okay, that's a challenge. You can't come on and say things like that. I'm going to dodge. No way. Hike tomorrow? Yes. You're only allowed to answer yes or no.
No.
There we go. We've pinned her down. Okay. No hike. So Nor thinks a hike tomorrow. Justina thinks no hike tomorrow. Okay. If we look forward and try and figure out what happens after that, what is it? Is it Hugh Pill? It's not Hugh Pill. Hugh Pill watches this programme clearly. Is it the Matterhorn or is it Table Mountain?
Well, I feel like the BOE could kind of follow the trajectory that we're seeing, for the ECB and the Fed as well, which is that even if they pause, they're going to send a very strong signal. The rates are going to stay elevated for a long time. A lot of people are kind of wondering today, is the Fed going to project another rate hike in the dot plot? Are they going to, hammer in the point that there's not going to be rate cuts for a long time? And I think that's sort of the key here, because the inflationary indicators are all going in the right direction, but they're still much higher than, what policymakers can tolerate. And of course, there's also the factor of oil, which is sort of, I guess, the big question mark here.
Okay, so my question actually becomes related to what we're going to see here in the U.S. If the Fed hikes today, I'm wondering if that makes Andrew Bailey's job really hard tomorrow to not hike.
Do you really think the Fed is going to hike? That would be a massive surprise.
I said, okay. Let's say they don't.
That's a huge if.
But if they do a hawkish pause, a quite hawkish pause, and if we see kind of cuts being moved out in the dot plot, does that change what Andrew Bailey is going to have to deliver tomorrow? What do you think, Nora?
Okay, I'm going to have to think about that. You're putting me on the spot. So let's say we do get a hawkish pause, which is what I'm expecting to come out of the Fed. I do expect also the Fed to push out those, those cuts that we are expecting them to come in 2024. I think there's going to be a lot of hawkish commentary here. We're going to get a lot of talk about, the resilience of the economy. We are seeing it, sort of starting to struggle now, but we haven't really seen that take hold in the U.S. But in the UK, you are starting to see those cracks quite obviously. And then you have the PMIs come right after the BOE.
Exactly, Friday.
I mean, what a terrible timing here for the BOE. But I do think it does make the BOE's job easier, because if you still have a very hawkish Fed, you can potentially weasel out that 25 basis points without anyone really looking.
But isn't the danger that the policy mistake is being made at that point?
Which is?
That they over-tighten, that they're doing too much. That there is lots of evidence to suggest that the UK economy is slowing down. There's lots of evidence the German economy is slowing down. That the French economy is slowing down. These are our closest trading partners. They are slowing down rapidly as well.
Look, I get that, right? We're putting a lot of weight on monetary policy. Monetary policy alone is not, it can't clap by itself. You've got two hands, fiscal and monetary, right? You've got that kind of support coming in. We're going into an election year, Guy. There's going to be a lot of stuff that's going to come in that can aid the UK economy, hopefully, potentially, right? There's a lot of prospects. Inflation as a measure is something that's really hard to predict. It's something that, economists, I can throw out a number for you next year and it could probably change time and time again. But the one thing that we know what we've got in our inventory, from economists to monetary policy makers, is that, those interest rates come up, they come and subdue demand. We have seen that demand quite robust still, and we need to rein in on those inflation numbers. At the 6% handle, core inflation is still too high for the Bank of England to appear as dovish tomorrow, and that's my call.
Justina, last point to you. What asset are you going to be watching tomorrow? Because I'm looking at the cable rate below the 200-day moving average. Where are we going?
Yeah, that's an interesting one because obviously for a while the pound kind of benefited from the tightening expectations and that trajectory for the BOE. But more recently, it's kind of weakened. And I think the attention has turned a little bit as well to the UK's economic prospects.
Right.
Because they kind of are not looking too great right now. But I think if we do see the BOE slowing down and possibly not kind of putting, rating in economic growth as much, and maybe if we do see some better economic numbers, that could be good news for the pound. But I mean, are we going to see those better numbers? That's the question.
Yep, totally with you on this one. All right, guys, thanks a lot. Really appreciate it. Looking forward to tomorrow and kind of price action there. Nora Ali of Bloomberg M Live and Bloomberg's Justina Lee. Thank you very much. So more on the question of the day. Are we there yet? What does the yet look like? What kind of mountain does that look like? Chris Watling, a Longview Economics CEO and Chief Market Strategist, joins us next. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
I think we're not there yet. We're at a rest stop. And then the question becomes, by building on the analogy, is it the destination or the journey? We may decide that that journey is long enough. We've come far enough. There'll definitely be a pause. I expect the data dependency. I don't think, based on the previous conversation, there will be too much focus on fuel prices. But I do think a pause is likely and continued data dependency.
Even David, Monitor CIO, speaking to Alex Me in the last hour, taking us to our question of the day, which of course relates to central banks and where policy is ultimately going. Folks, are we there yet? Joining us now to discuss, Chris Watling, Longview Economics CEO and Chief Market Strategist. Chris, if you're the Fed, if you are the Bank of England, if you're the Bank of Japan, like the Bank of Japan hasn't even got out of bed yet and started the journey, but if you're the Fed or the Bank of England, are we there yet?
Well, I tell you, I mean, you certainly hope so. I hope they are, because personally, I think they've overdone it. I mean, money's far too tight in most of the Western economies, and actually, whatever way you think about inflation, I reckon it's licked. It seems to me that the job's done.
Chris, come on, wait. What? The job's done, but there's still a six handle on core inflation in the UK? Come on.
The job's done in the sense they've done what they need to do to complete the job, and it will complete itself. So if you look at inflation, whatever way you really think about it, if you look at it in terms of monetary aspects, which I think this has been the first proper bout of monetary inflation we've had for a long time. If you look at it from that angle, money supply is telling you it'll dissipate quite fast. If you look at it from the way the central banks think about it, inflation expectations or perhaps wage price spirals, but let's keep it at inflation expectations. They've come down a ton. Or, even the labor markets are softening across the West now. So, yeah, I think the tightening's in the tank. It's working its way through the system, and they don't need to do any more. So whether or not they do any more, maybe they'll do one. Who knows? But it's really by the by. It's not really where the debate is now. I think the debate is going to move on.
Okay, so let's talk about if we're there, where is there? So on this show, we like to claim ownership of the whole kind of mountain story. Is it the Matterhorn or is it Table Mountain? If we are there, is it the Matterhorn or is it Table Mountain? Are we going to stay up here for a while, or are we going to be cutting hard and fast?
Well, it's Table Mountain until they have to switch to the Matterhorn. That's not the answer I'm supposed to give, but that's basically how it'll go. They'll hold them high until it becomes clear to them they've got to cut them, and then it'll be the Matterhorn, because then I think we'll find the economy's pretty weak and inflation's coming off fast. So in their minds, they want to hold their higher for longer, but that'll change, I think, when the data changes. I think that's the key thing to watch here.
Chris, you guys have been very persistent on your negative view of where we're headed for the economy. It hasn't yet materialized, though. Maybe the UK is in a different place. But why? Like, what do you think is going to tick? Like, what's the tipping point where that outlook's going to come through?
Well, it has taken longer than perhaps we expected and many expected, but I still think that the setup is there. That's the key point. And why has it taken longer? Well, I think it's this sort of amount of stimulus that's been in the system. People like to talk about this idea of rolling recessions. I would say what we have had is really tight money working its way through the system and working its way through the stimulus. And one good way of thinking about that is the amount of excess savings that households have had and the fact that they're nearly done after 18, 24 months of spending them. So, you can see it in many aspects. We had a bit of fiscal this year in the States that's added some support, one or two other things like that. But it seems to us we're getting to what I would call sort of the stimulus cliff. We're running out of road on that stimulus in the tank. And elsewhere, we see the effects of tight money. I heard you Guy mentioning earlier how tough it is in terms of construction and resi and housing in Europe. I mean, some of it is terrible. I mean, U.S. mortgage apps at 27-year lows. The mortgage market is dead. So there are lots of signs that tight money is working. It's simply a question of when, not really if. I think that's the key point.
You could argue that loose money, one of the biggest beneficiaries of loose money was the equity market. Does the opposite apply now? Should the opposite apply?
Well, I think it will. Again, I mean, you look at the stock market, you look at the US, you think, goodness me, everything's wonderful. And then you dig down into the detail, and it's really only 10 stocks. And then you look across the rest of the globe,
Chris,
and most markets haven't done much.
It's not 10 stocks. There's a whole bunch of stocks out there that have been... You look at stocks like Deere and some of the big industrial names. They've had really good runs recently. I appreciate that tech has done very well. But the US equity market is being supported by a broader range of stocks than simply just tech. And I appreciate that it is not every stock has done well, but that market continues to be maybe broader than we think it is.
Well, I mean, you can cut it any way you like, and one can create a lot of stats. But I mean, 10 stocks has created, I think, a couple of $1 trillion of market cap in the S&P 500, and 480's created 50 billion or something. I mean, so there is a wide gulf, and the leadership up until the middle of the year has clearly been tech, and that's been driving this market higher. So yes, one or two stocks have good moves, and other stocks have terrible moves, but in the balance, it's really been about the Magnificent Seven. So and you look at Europe as a market as a whole has done nothing since February. You look at Australia, it's done nothing for 2 years. It's a long old list of markets that haven't really gone anywhere. So I think it is classically late cycle when you look at the stock market. Yeah. Tech is part of that, and maybe energy is part of that as well. So I think the stock market should follow. But as always, the bond market starts signaling these things first, and people get fed up waiting for it in the stock market and give up on their call. And then eventually it comes through in the stock market. So, I think we're getting to that point. I'm not sure exactly which week, which day, but I think we're getting there, and the tight money will start to bite in the stock market as well at some stage.
Okay, Chris, so what are you doing? What's your best call?
What's my best call? In terms of global asset allocation, I think you should go long duration bonds. I mean, there's a big debate out there of bond yields on the US 10 years going to 5% or higher, or are they attractive at this sort of level? And you look at 10-year bond yields, they've been backing up for 3 years. There's this whole debate about there's too much issuance, et cetera, et cetera. Everyone's selling treasuries. But, once, there are actually households in the US are buying it. And once the market turns, I think you'll find that institutions start buying this bond market as well. So we like that. We like gold. We're negative on equities globally. Yeah. We've been selling the pound in the last couple of months, but that's a bit oversold short term now. I mean, there's a ton of stuff you can do.
All right, Chris, hey, we got to leave it there. But good stuff. We'll get you back. Chris Watling of Longview Economics. Always good to see you. Golds and long end bonds. There you go. All right, this is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, My knowledge expands, and I see things more clearly. Better decisions. Aon.
We want a level playing field for our companies. And what we see is massive subsidies in the EV sector in China, which is, of course, unleveling our playing field. And we do not accept this in the internal market for our companies. So we do also not accept it for Chinese companies.
Ursula von der Leyen speaking to Francine a little bit earlier on, talking about the idea that the EU is marching now towards the idea that it's probably going to impose some sort of a tariff structure on Chinese EV imports. That is likely to generate some kind of response. We'll wait and see, Alex, what that ultimately looks like. But it's really interesting what is happening here in terms of the EV market and how fast it's developing in Europe. It is at a pace. And the real question now is, can governments continue that process? And if we get any kind of oscillation, are we going to see that ultimately being thrown off course? Today, we've got really strong data. Today's data super strong in terms of the car sales across the European Union. And it's largely being driven by EVs. And you've seen that reflected in stocks like Volvo today. But if we start to get some vacillation, if we start to get some shifts, are we going to see maybe some of the momentum being taken out of that story? In a few minutes' time, the British Prime Minister is going to make some announcements, we anticipate, at a press conference, which is going to basically water down the UK's green approach. If we start doing that to the car sector, what happens?
Yeah, and I mean, to put it in perspective, potentially deferring by 5 years a ban on the sale of cars. So you can make an argument, well, it's 5 years, guys, what's the problem? But this kind of policy helps de-risk the demand part for companies that are going to be putting money into EVs and spending a boatload on CapEx in order to do that. And the transition just isn't there yet. You take that demand certainty away, and there's going to be some big problems. Ford, for example, not happy about this.
Absolutely, and you can understand why. They're making big investments. They want that demand to be there. This forces that demand. 2030 versus 2035 is a big chunk of change. And this is the difference. And it's not just the car sector. It's really interesting. We're likely maybe to see some of the home heating system, the boiler story changing as well. Maybe some of the dates, some of the targets there start to change as well. Germany's already made some of those changes as well, watering down its proposals.
Yeah.
I think the other takeaway from all of this, though, is that in certain key sectors, this journey is very difficult. And the danger is that politicians are realizing that some people are going to get left behind, and it's going to be a difficult, harder journey for some. And that was not the original promise. The promise that everybody was going to be taken on this journey together is maybe beginning to fray at the edges, and the politicians are realizing that. Yeah, just to jump in here on this, Stellantis is laying off people citing the strikes, the UAW strikes. In part, that's an EV issue. It's a Toledo plant in Ohio. They're laying off at 68 employees. There's more coming because of the strikes. Anyway, the close coming up next. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Green on the screen. European equities catching a bit. It's got nothing to do with the Fed. I think it's probably more to do with what is happening with the rate expectation story over on this side of the Atlantic. FTSE 100's up 1%. You've seen certainly REITs doing well today. You've got house builders doing well today. This is UK inflation, comes down more than anticipated. Maybe making tomorrow's decision on the Bank of England more of a coin toss. Takes us back to our question of the day. Are we there yet? Are some of these central banks actually at the point where they can say enough is enough? Well, the market's certainly pricing a bit of that today. DAX is up quite nicely. CAC's up by around 1%. Car stocks are doing better as well. We saw some good car data coming out of Europe a little earlier on as well. Plus, you put this with the tariffs narrative. That's a positive picture for a sector that's been really underperforming. So cars have done better today. Stock 600, one-way traffic, as you can see, from left to right. We've been basically going higher and higher and higher. We've retaken 460. We're up by around 1% on the session. Volume's okay as well, but we are still waiting for the Fed. Let's talk about the single stocks. I mentioned the housing stocks, the REITs. Taylor Wimpey is the example I've pulled out today. That stock up by 5.5, nearly 6% today. Pearson's a little bit of a stories in the markets today that aren't rate related. Pearson's one of them. Its CEO has stepped down a little earlier than maybe some had anticipated. This is a continuing theme, isn't it? It seems to be all change at the top of many of these large companies here in the UK and across Europe. And then we've got Just Eat, and this comes back to Alex's Chinese food, which apparently is not expensive when you start, but when you add on the delivery charges and the tips and everything else, is expensive. And then it could get even more expensive. So basically, this is my short way of saying there's a court case in New York City, which looks like it's going to go ahead, which may mean that actually some of those charges go higher, or at least there is the option of taking them higher. Just Eat is one of the beneficiaries of that. It is up by 7.3%. Expensive Chinese food. Let's talk about the day ahead. You've got a Riksbank rate decision. You've got an SMB rate decision. You've got a Norge Bank rate decision. You've got a Turkish rate decision. You've got a South African rate decision. And you've got a BOE rate decision. There's a lot of rate decisions coming up. This is a lot, isn't it? I think actually there's some excitement here. The Fed may be a bit of a non-event, Alex. I think some of these could produce some surprises.
Yeah, that is a lot to filter, which brings us to the question of the day is, are we there yet? You could literally apply it to the Fed or any of the other central banks that Guy just mentioned. Liz Martins, HSBC UK economist, joins us now. Liz, in terms of the BOE, are we there yet?
I think we're very close to being there, whether they hike tomorrow or whether they in fact hold. And I think the chances of that, of course, have risen significantly following the downside surprise on inflation this morning. I think it is the end of this tightening cycle. So, we actually are forecasting one more tomorrow, taking us to 5.5%. But that's it. After that, that is all, folks, we think.
Yeah. We're getting into Looney Tunes as well. Maybe that's appropriate too. Liz, is it Table Mountain or the Matterhorn?
Well, look, if it's Table Mountain, I think that's a picture of success, right? That is a picture of an economy that hasn't slumped into recession, that hasn't seen unemployment spiking, that's still got relatively resilient demand, which is keeping wages and inflation higher than the BOE would like. If we're looking at the Matterhorn, that's telling me that either, inflation has melted away, and we'd all love to see that, but perhaps I'm a bit skeptical there, or something's gone very badly wrong. So in our central case, it is Table Mountain. We're muddling through, and rates are on hold through 2024. But of course, there are some red lights flashing around the economy. I think most worrying for me is the latest unemployment numbers. I mean, unemployment has quietly crept up in the background from a low of 3.5% to 4.3%, higher than the BOE was expecting it to be at this time. And that makes me worry that risks are rising, that yes, the economy is going to be in a worse place next year, and therefore the risk of a Matterhorn scenario may be increased relative to the Table Mountain one.
Liz, what just really perplexes me, and I know that you have a hike penciled in for tomorrow, is how quickly other shops erase their cut forecast for tomorrow based on inflation that still has a 6 handle. And I'm really struggling to understand how this all makes sense and why we're so convinced that inflation is going to continue downward. As Guy points out, a lot of the inputs are volatile.
Yeah, I mean, I have sympathy with my counterparts who've made that decision. I do think it's on a knife edge. Yes, it's with a 6 handle on the year-on-year, but if we look at the month-on-month, it was lower than seasonal averages. The momentum seems to have come away. But is 1 month's data enough? And especially the BOE, don't forget, will probably have seen this data on Monday, so they've had a couple of days to think it through and make a sound assessment. And they may well agree with you that, there are components here that are volatile. Pay growth is still very, very strong. The supply side issues in the economy haven't disappeared overnight. And therefore, it may be too soon to declare that the inflationary beast has been tamed.
In terms of kind of the external forces that are at play here, to what extent do you think they're looking at what is happening in the Eurozone in particular? The German economy is slowing down rapidly. These are, despite protestations amongst some big trading partners of the UK, if they are slowing down rapidly as well, is this something that the UK can fight against? Is this something that the Bank of England can fight against? Is it inevitable that the gravitational effect of the Eurozone is going to have a big effect here in the UK?
I think, weaker global conditions certainly don't help. And it's not just the Eurozone, but other economies around the world where we are seeing some signs of slowdown. But I think the BOE will have a closer eye on domestic demand. It's domestic demand that's pushing up services inflation, labour market inflation, and those kind of things. So yes, it always takes into account what's going on around the world, but I think it will be more worried about what's going on here.
And Liz, what about fuel prices?
So fuel prices are interesting because obviously they push headline inflation higher, but they're kind of what we call bad inflation in the sense that they actually squeeze demand. So they actually reduce our incomes. If we're spending more on petrol and heating our homes, we have less money to go out and spend on, going out and services. And that's the bit the BOE is really interested in. So ironically, higher inflation from that actually might mean lower inflation from everything else.
Yep, it's those delivery fees. So Guy, I just want to update you. The Prime Minister Rishi Sunak, speaking at number 9, is talking about the issues with climate and sort of how they're changing their perspective. He says we have a new approach to climate change. And this really begs, ties into the fiscal part of it. So the U.S. is pumping a lot of money on the demand side and the supply side into it. If we have other governments like the UK paring back some of that, how does that wind up affecting the growth scenario, Guy?
It's going to be interesting. This is partly driven by politics. Certainly driven by politics. What happened there's a constituency which used to be Boris Johnson's Uxbridge, which was expected to fall to the Labour Party in a recent round of by-elections. It didn't, and one of the reasons was there was a lot of anxiety within that constituency about the ultra-low emission zone in London. And the cue the cue that gave to the Tory party was do less on green, and that might win you some votes. But it's going to be interesting to see how that ultimately affects the internal party politics, but also kind of, as you say, how it affects the investment story in the UK. I can't remember what the geography of Downing Street looks like. He's inside. I can't remember if it's number 9 or number 10.
Number 9.
They kind of blur into one.
It's 9
within that building. It's 9, is it? Okay, so that's where the Chancellor is. Okay, but I'll take that on advisement.
Take that as a win. But Liz, I think that this does bring up the point of where's fiscal, and is fiscal hurting or helping? Obviously, you can make the argument that fiscal is hurting inflation and making it persistently higher in the U.S., but it's also helping to support growth.
Yeah, I mean, in the UK, we haven't had as big kind of fiscal programs, but we have seen actually government support making quite a big difference and probably muting the impact of monetary policy on inflation. So, for example, actually the scale of the real income squeeze we've just been through doesn't look that different on a chart to 4 other squeezes that we've been through in the last 20 years. And part of that is all that support we had from the government, the energy price guarantee, the cost of living payments, and so on. And the other thing is not fiscal precisely, but the government stepping in and saying, oh, well, if you are struggling with paying higher mortgage rates, you can extend out the term or you can switch to interest only. And that's, again, it's muted the impact. So it doesn't feel like the two engines are quite working in concert. And then the other issue that I think you were mentioning before is this kind of policy predictability that businesses prefer to see, and this kind of instability that I suppose we're seeing at the moment.
Yeah, and you're getting that through the tax code as well. Liz, great stuff. Thank you very much indeed. Always appreciate it. As you say, it's on a knife edge. Liz Martins, HSBC's senior UK economist. OK, final numbers. A little bit of tick lower during the auction, but not by much. These are positive numbers for European equity markets, largely responding to some good car data, car sales data, and, of course, obviously that downside surprise coming out of the UK on CPI. Coming up, the sweet spell of success. We're going to be talking about the shares of Coty, the maker of Burberry and Gucci fragrances, jumping on strong demand for beauty products. We'll certainly be talking about that, my area of expertise. The Prime Minister, though, as Alex says, speaking at number 9. This is him addressing the changing targets that the UK now has on its green agenda. The Prime Minister working from home. This is Bloomberg.
We've made things like renewables far cheaper. Just consider offshore wind, where costs have fallen by 70% more than we projected in 2016. And people are increasingly choosing to go green. Look at how demand for electric vehicles has consistently outstripped forecasts. Now, given all these things, I'm confident that we can...
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
This is Bloomberg Markets. You're looking live at the principal room. Coming up, Diane Swank, KPMG's chief economist, joining Bloomberg Television at 2 p.m. New York time. This is Bloomberg.
I really felt like we could set ourselves apart by me really being that person that has been the founder, that believes in the founder, that wants to really help that company grow and thrive and really support them, because I've been there and seen relationships work and not work.
That was, of course, Kim Kardashian. Speaking, you couldn't see him, to David Rubenstein. You can catch the full interview on the David Rubenstein Show, peer-to-peer conversations tonight. That is happening at 9 p.m. New York time on Bloomberg Television. That's our way of pivoting to our next subject, the beauty brand. Coty brought a 20% stake, of course, in Kardashian's makeup brand 3 years ago. It's a stake that she would like back, apparently. Coty shares, meanwhile, having a bit of a cracking day today. This after the company came out and boosted its sales. This is a company that makes Simone Foxman lots of different kinds of fragrances. It basically licenses fragrances from the brand names to a whole range of different brands. And I understand that the Burberry Goddess brand is working very well for them at the moment. Why the upgrade? What is happening here that's caught us all by surprise?
It's really the prestige fragrances, the most expensive stuff. And in fact, the brand is getting into launching even more ultra-premium prestige fragrances. But you brought up the Burberry Goddess. This was something the company launched back in August. And it was really a very successful launch, they said. That was part of the statement that they came out with today. This goes for $100 for 30 milliliters. So that's the kind of price point we're talking about. And again, I think a reflection that the wealthy consumer is pretty strong, despite some of the weakness that we're seeing from the lower end consumers.
Which is such a great example of, say, Jefferies and Goldman Sachs disagreeing on what to do with, like, the LVMH. Like, Jefferies sees the weakening demand in China and the U.S. Goldman does not. So it's really hard to, like, understand what the direction is there. Do we know geographically for Coty, like, what's doing well?
Actually, Asia was not a bad place. EMEA was not a bad place in these most recent results, the little tidbits that we got. Remember, they came out with earnings just about a month ago, so that's part of why Bloomberg Intelligence really called this upgrade unexpected. But really, outperformance across segments. And frankly, some signs that the Asia travel demand is coming back, albeit slower than everyone had anticipated. But, you know, most of their market is split between the U.S. and Europe. There's possibility of expansion in Asia, but it's not something that's an enormous piece of their revenue.
Skincare matters, I am told. Is that where they're going next?
Invest in your face, Guy. Invest in your face.
Yeah, that's where everyone sees a huge opportunity for Coty. That is something that Tsunabe, the CEO, has really pointed out as the next stage of growth. She came in September 2020 and really was tasked with a turnaround for the company. She was the 5th CEO in 5 years. Skincare, she says, that is top of mind for her next. They've had some success so far with some CoverGirl, other consumer-oriented pieces of their business. That consumer retail is a smaller bit of their business, but we do expect them to really ramp up from now.
I mean, I'm actually 55. You just wouldn't know it. I mean, I'm kidding. I'm not. You don't have to laugh that hard. Okay, so we mentioned in the introduction that Kim Kardashian wants her stake back. Is that just like, hey, I just want the money, or is that something to do with Coty, or what?
So from what we understand, and Bloomberg's reported on this pretty extensively, Kim Basine had a story out just a couple weeks ago about Kylie Jenner also wanting her stake back. It appears that both of them have some sort of concerns with the way their brands are being managed. Now, Coty owns about, I believe, about 20% of Kim Kardashian's skincare company, whereas it owns 51% of Kylie Jenner's company. But the challenge is that these things are pretty expensive, and we don't know whether Kardashian Kardashian or Jenner would really be able to come up with the kinds of money that would be necessary to bring these things back. You know, Coty might not mind. There's been pretty decent sales growth for both of these names, but has been really trying to focus on reducing its leverage. We shall see.
Yeah, we shall see. I had to say, remember that Kylie Jenner highlighter, really good. Highlighter. All right, Simone, thanks a lot. Simone Foxman joining us from Bloomberg. You missed that conversation. I think you were out on that point. Hey, so we're seeing more. I know you're sad about it. So we're seeing more headlines from Rishi Sunak guy. UK is delaying the ban officially on the sale of new petrol diesel cars until 2035. It's just basically like we're ahead of everybody else. Let's just slow down so the consumer doesn't get hurt.
That certainly seems to be the message, isn't it? So what do you do now? You're about to go and buy a new vehicle. There are tax benefits still for buying EVs, particularly for company owners. And I'm wondering, does this affect your decision-making process? Do you now go out and say, you know what, I think the kind of, I'm going to buy another car, or if you're thinking about the kind of the vehicle after that, what you're going to be doing? I think this is really interesting. And if you're a company, do you want to invest in the UK right now? And as you say, Ford's already pretty ticked off. I think there's going to be plenty of others out there as well.
Yeah, but if you're a consumer, maybe you appreciate the choice. It's up to you now, not the government, which I'm sure many here in the U.S. might argue they would rather have.
Yep.
Anyway, coming up, stocks going absolutely nowhere. Bonds, dollar, barely moving. We're waiting the Fed's decision. We're going to have another preview for you next. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
Stocks a little mixed. Volume going nowhere. Abigail Doolittle tracking the moves. Abby?
Yeah, a lot of asset classes going nowhere, Alex. Take a look at this board. Basically, small moves right across the board. Everybody waiting on the Fed, and it's pretty much priced in that they won't be doing anything relative to rates in terms of a hike or a cut on the day. But will there be color about what's ahead? Stocks and crude oil, yields, bonds, the dollar, all waiting for more of this color, the true treading water day. Now, it's interesting because, of course, yesterday we had a number of the yields on the day going above levels that we have not seen since 2007. The 10-year yield punching above that critical 235 level, now backing off. It's going to be interesting to see. There are some technical people that think that it's going to come back in, although that chart suggests to me that we could see an equal move higher. One reason that could happen, if we take a look at the Bloomberg Dollar Index in a chart, now, a golden cross or a death cross, they're not uniformly golden, bullish or bearish. It depends on the market. But here's the Bloomberg Dollar Index. You can see a golden cross was put in back in 2020. It was bullish, at least in the near term. We had another golden cross back in June of 2021. It was clearly incredibly bullish. Right now, guys, we are on the cusp of a golden cross. I have seen it sometimes when you're watching for one of these crosses and it doesn't actually happen. But this seems very likely. It's also strong because the 50-day moving average is sloping upward. That 200-day moving average is flat to sloping upward. That tells you that the buyers for both the near term and the long term, they like the dollar index a lot. So we may see some strength, which would suggest yields could, in fact, keep climbing.
I think the global economy is really ready, or the financial markets are really ready for significantly more dollar strength from here. Abigail, thank you very much indeed. A lot of people are still calling for weakness from here. What effect could that have, particularly as we work our way around the world into the emerging markets? Is this going to be potentially, could this be the catalyst for that BOJ intervention that so many people are now waiting for? What are we watching for the rest of the day? After the bell, FedEx. Watch out for those numbers. This is a useful tell on what's happening with the global economy. President Biden still very much in New York. He'll be holding a bilateral meeting with the Brazilian president, President Lula. You got JP Morgan CEO Jamie Dimon speaking at the Detroit Economic Club. Look forward to that one a little bit later on as well. Plus, of course, the main event, a Fed decision, 2 p.m. New York time. 30 minutes later, you get the Jay Powell press conference, 2:30 p.m. Alex, is it going to provide any excitement? Are we going to see fireworks?
Yes, because that's why you want to watch. But the fireworks will come from Mike McKee Bloomberg's international economics and policy correspondent, because I don't know if you guys know this, but he asks the best question 93% of the time. All the analysts that write up the research after all quote the answer to Mike's question. I think last time it was Jenna Smilik in the Taylor Swift economy, but nonetheless, it's usually you. All right, Mike, you know your question yet?
Well, I said earlier this morning that my kind of underlying question to Jay Powell about all of this is, given all of the known unknowns out there, to quote Donald Rumsfeld, like oil prices, like the government shutdown, like the UAW strike, et cetera, et cetera, et cetera, how much confidence do they have in whatever they are forecasting today? Because a lot could change in a very short period of time. Yeah. So I think that would be a key question for them. You take a look, Guy, at the Bank of England. Yesterday, there was an 85% chance they were going to raise rates, and now the futures markets show less than a 50% chance.
Are you really asking the Federal Reserve Chair if he knows what he's doing?
Sure, why not? It's not a question of if he knows what he's doing. It's how does he know what he's doing if things could change so much? We'll get a market reaction this afternoon. A certain amount is priced in. We'll see what happens when they release the dot plot about what their future plans are, or what they're thinking, at least for right now. But then we're going to see markets change and go all over the place between now and November 1st, especially if we get a government shutdown and we don't get economic data. Then what do they do? And how are they going to make a decision? So it's going to be very interesting to see what happens after this meeting. This may be, we were talking about it here with the economics team, this may be the last quiet meeting we have for a while.
Oh, and are they all going to agree as well? That's another factor. Mike, I know you're going to make it succinct. I know you're going to make it pithy and to the point. And I'm sure everybody will be quoting the answer to that question tomorrow morning. Mike McKee, looking forward to it a little bit later on. We're going to have some great coverage for you as we work our way through this process. The Fed decides. It all kicks off at 1:30 p.m. New York time. Coming up, Andrew Baikali. I think I'm pronouncing that right. I can do this next bit. Klaviyo CEO joining us on Bloomberg Technology. Ed Ludlow, Caroline Hyde next. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
The consumer is stretched here, right? We have to pay attention to that.
Whichever way you look at it, inflation is too high. The Fed has to rethink.
Rates can still move higher, and I think that's a really important thing for us to remember.
The market is not fully bought into this disinflationary trend idea.
I think we're actually going to go into a mild short recession going into next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Big day coming right up, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P slightly positive. Big data points a little bit later this morning. US retail sales. Before we get there, an ECB rate decision. And later on today, a deadline, TK, for a big union taking on the Detroit Three.
Huge day. I didn't even know where to begin with all that. I'll start with a count-up clock from inflation yesterday. The follow-on of people digging into inflation, John, clearly shows many see disinflation, and that's what Lagarde is to confront today. Is Europe going to see what the U.S. sees right now? If they raise rates today, are they doing it at exactly the wrong time?
Do we get a hike? We're split right down the middle. Just go into the economist estimates. There's some big banks out there calling for a hike from the ECB a little bit later this morning, Bramo. Citi, Bank of America, HSBC, Goldman, BNP Paribas. Take your pick. There's a long line of them, a long list. And I think that list is growing after what we've heard in the last couple of days.
I have to say, Kit Jukes put it the best, where he basically said the market has been priced
since the mid-year that the ECB is going to raise rates from the current 3.75% to 4%. The question is just how are they going to do it? Are they going to do it today and then hold and indicate a hold, or are they going to hold and then indicate that they're going to raise rates further? The biggest surprise is any variation from that particular iteration of decisions.
I think like the airlines yesterday, American Airlines, and what we're seeing there, I think Helene Becker joins us today, which is wonderful, an informed voice. But there is disinflation in the air. And yet in Europe, we're talking about inflation. And I just think this Thursday is a huge pivot point and a real point of tension.
Does this smell like disinflation to you? UAW, big union, taking on the Detroit Big Three with like 36% pay raises. This is what's on the table, according to the president of that union.
Even if you get the 20% you mentioned yesterday?
Ford has proposed 20% over 4 years. GM has offered 18%. Stellantis has offered 17.5%. And based on reports, TK, there's still a big gap between the two.
Huge gap.
And we might not close it by midnight.
Let's get the date calendar here. Amy told me 10 p.m. tonight is maybe where they get out front of this and pick a union. There may be an announcement before midnight tonight. Cinderella's going to come out with a pumpkin, and before that, we're going to find out maybe
the strategy, by the way, is quite interesting.
Yeah.
They won't name a location. It could be in several locations. It could be a limited strike initially. They won't tell you, Bramo, because they don't want to allow the manufacturers, the auto companies, to plan for the potential strike that could happen starting at midnight.
They want it to be maximally disruptive without the maximum economic hit. This is what I see. And so that's the reason why at 10 p.m., as Tom mentioned, you're going to hear from Sean Fain as he comes out and tries to detail where they might try to start the strike.
But with the news flow today, and I think for all of us on radio and television, it's like there's no countdown clock today. It's just never ending. It's going to go through the entire day. I
think we've got an ECB one, TK, to use.
Yeah, but then you listen to, I said to somebody yesterday, I said, this is maybe the most important press conference Lagarde's ever held.
It's certainly the most uncertain
everything.
One. Yeah, an indecisive ECB. They've got to make a decision a little bit later today.
Somebody's going to go, well, is Germany driving the bus or is Portugal driving the bus? And her answer will be interesting.
Well, if Germany was driving the bus, I'm not sure what they'd ask for, given where growth is right now in Germany.
Yeah.
Traditionally, they'd be saying hike, given where inflation is, but they've got a tough economy.
This is a fascinating day. I'm going to also point out on the data, John, as you started, the VIX 13.30. These are terrible markets.
Well, let's get to it. Equity futures, given all the drama we just talked about, they are positive on the S&P 500 by 0.3%. Yields are a little bit higher by a single basis point, 425.85, and a euro TK going absolutely nowhere, 107.29.
Again, Swissy gives back here. It's not giving me a lot of angst and fear this morning. The major issue I have is, do you think the white titanium iPhone says me?
Oh, you're thinking about it?
Should I go?
This might happen.
They have like these subtle green, brown, darker titanium. Or should I really do a color reach and go for the white?
Are you doing a family plan?
I'm doing.
Is everyone else
when you got
upgraded?
vet and kennel fee, everybody else is on too.
Have you managed to construct this in a way that you're hardly paying any money?
I am. I think I have. And I did it off the Apple website, and they go right into the carriers. Dan Ives nailed this. Nailed it. AT&T clearly is the most desperate, and the other two are sort of kind of like following on.
Are we going to find some space to talk about this later? Maybe.
Yeah,
Perhaps.
I don't.
Okay.
I mean,
I have a feeling this is what you really want to talk about, not the ECB, not unions, not the data that's coming out a little bit later.
I just figure I can find a white iPhone in a bar faster than a black one.
Ramos, save us.
All right. Well, we're going to talk about maybe the time frame for some of the other decisions where Christine Lagarde is going to come out and talk about her iPhone purchases. No, she will not. 8:15 a.m. we get the ECB rate decision, followed by an 8:45 a.m. press conference. Christine Lagarde has a very difficult needle to thread. She is looking at inflation of about 5.3% in the euro region, still way too high. The expectation that they're only going to downgrade it to 3% next year. Stuck between a rock and a hard place. You got to imagine she might say the S word. Stagflation, the nightmare of central banks. 8:30 a.m. we get U.S. PPI and retail sales. I am actually more interested in retail sales and the potential for a negative headline print, even with what we're seeing from gas prices that have been climbing. Auto prices and auto sales volume has been coming down. Again, can consumers keep absorbing the price increases that companies need to charge to break even, at least with the same types of margins? And at 11:59 is that deadline for UAW negotiations. I am watching the 10 p.m. Press conference of Sean Fain. I think that will be really interesting to understand their strategy, John, as you were talking about, of how they plan to wage a war against the auto manufacturers without losing enough clout in terms of wreaking economic havoc at a time of a pretty sensitive moment.
Got something like 14 hours to close that gap. Let's see if we can. Joining us now is Ben Gutteridge, the investment director over at Invesco. Ben, wonderful to start the programme with you this morning. Let's start here. What is there to like about the US equity market currently?
Well, I think quite a bit, actually. You know, I think the backdrop is of resilient growth and a policy cohort that will probably decide to go on hold from here. That type of mix, resilient growth, more accommodative or less hawkish policy could fuel yet more gains in the US equity market. Of course, with all the other long-standing tailwinds for the US equity market, including sort of innovation and a place where shareholders can enjoy the spoils of that innovation as well.
Ben Gutteridge, you were at Loughborough. Is that how you pronounce it, John? Loughborough, did I do okay? Loughborough.
Nice.
Yeah, thank you.
That's right.
One of my heroes was there. Eric Pentecost is a giant in my mind in economics. Is the systems within the Eric Pentecost textbook, are they still in play? Like at Invesco every day, are you literally making up the theories as you go? Or is this actually finance and economics from our models of the past that we can use now?
Well, a fascinating reference. Doesn't come up much, but I mean, we're not making it up as we go along at Invesco. I can assure you of that. But my job isn't so much making economic forecasts as investment forecasts. And if our view is that, rather than pinpoint economic forecasts, if the economy can be relatively resilient, coupled with policy that's as I say, it would take a hike, take a pause on hiking, and so is relatively more accommodative. That's like a nice tailwind. I mean, recessionary risks do linger as we move into next year. They're quite material, but for the time being, end of cycle stuff isn't such a bad period to be an equity.
Within your wheelhouse, and given what you just said about a resilient economy, does 60-40 work?
Well, I certainly think the 60 works. The 40 should do a bit better. I mean, clearly it's been a dreadful part of the portfolio for some 18 months. So that the maths of the bond component looks a bit more asymmetric. Looks like there should be a little less downside relative to the past. But also, if we have this sort of disinflationary narrative, and that the CPI report yesterday sort of supports the idea that it still is that the trends are still disinflationary, ex-shelter, but that should sort of come through. Leading indicators on rent suggest that the shelter component can come down. Then a disinflationary backdrop would be okay for the 40 as well. It would always encourage a little bit more diversification and alternatives and real assets and a bit of cash, but not too troubled by a 60-40 portfolio.
Ben, it feels like trading the end of a cycle is like dancing on the head of a pin, trying to figure out when you can capitalize on the very tail end of the momentum, the increasing disinflation, the policy hold before recession sets in. How do you know when it's over, when the end of cycle season has just reached the end?
Well, I mean, that's sort of the point, is it's very difficult to know. So sort of swinging too defensively there are some risks in that. And I think end of cycle behavior does lend itself to investors moving towards areas where there's more perceived areas of secure growth, and that would be like loosely defined technology, certainly US equities. But if you're of the view that the recession, all recessions are obviously awful, but that this recession, end of cycle event might be relatively mild versus those more recent recessions, then that encourages you to be a little bit more overweight equities. Yes, we've got to brace ourselves for volatility, but perhaps it might not be so punishing as in past end-of-cycle events. And that, as I said, encourages the modest overweight to equities.
The areas of growth that you mentioned are focused in the U.S., and you are overweight more in the U.S. than elsewhere. In Europe, where does that come from at a time where the ECB is facing stagflation, where the banks are passing along these higher rates without the prospect of more loans? You're facing a lot of headwinds, so how do you get enthusiastic about European equities?
Well, it's quite hard as you've laid out. I mean, the valuation is a starting point, but but there isn't too much thereafter. Clearly, the economic headwinds are a bit challenging. Policy, it's on a knife edge, isn't it? But certainly you would think, certainly based on how they behaved during that sort of financial crisis wobble at the start of the year, I think they want to show their inflation-fighting credentials. So policy not yet getting favourable, and clearly China, the impact that China has on the European economy also a challenge. So I would look to the ECB to get more accommodative and for Chinese policy to get firmly more stimulative before moving more assertively towards European equities. Maybe not too far away, but not at the moment.
Ben, just quickly, hike or no hike later this morning in 2 hours?
I would say hike.
Hike? OK. Ben, thank you. Ben Gutterich there of Invesco, joining the team. A long list of people looking for a hike a little bit later. The median outlook in our survey suggests no hike, but it's so split right now for the ECB. And a lot of people started to rethink about what we might get from the European Central Bank, because we get a set of forecasts a little bit later this morning. And we had a report from Reuters a couple of days ago suggesting that maybe in the 2024 forecast for inflation, that's revised higher to above 3%. TK, I've got some good news for a certain Manus Cranny, our friend from Dubai, moving to New York. Do you want the good news?
Please.
Manhattan rents topping. Right on cue. So Manus Cranny is basically calling the top of the rental market in New York City.
He is. He's locked in for a 5-year, I don't know. He's got a view of the East River, and, he's got the whole thing.
All good stuff.
All good stuff. He's large. But thrilled to have Manus come here and bring, what the problem, folks, that you have with Manus Cranny is if you're at breakfast with John Farrow and Manus Cranny together, you only understand about one every 4 words,
You kept up yesterday.
Between the British accent and the Irish accent.
It's only slightly rude to the whole of the United Kingdom, Tom, and Ireland as well.
I'm offended, and I'm not even there.
Do you want the bad news, Bramo? It's still 4,400.
That's exactly what I was going to say.
Median rent for new leases signed last month, 4,400, unchanged from the record set in July, according to the appraiser Miller Samuel and brokerage Douglas Elliman. Yeah. I guess another spot of good news, Lisa, you would expect August to be really hot. And based on leases signed that I can see in this data, it wasn't that hot at all.
So the good news, as you said, that prices are topping out. The bad news is they're still up 35% from where they were in August 2021. So it still is really expensive, and they don't necessarily expect price declines. And this is something we heard from Jonathan Miller.
As I said yesterday, I think it was with Paul Sweeney in the 9 o'clock hour, and I said, when you're analyzing inflation, you got to wait a couple hours. You can't do it two minutes in.
To get the full breakdown.
You got to break it down like a David Rosenberg would do. And the answer is yes, services popped a little bit, core services. But the rest of it's going the other way, 3-month annualized. And if you take a present rent calculation, it's very 3-ish.
Very 3-ish. Is that what we're calling it?
3-ish.
Okay.
3-ish.
Lisa mentioned 35% higher from August 21.
That's a level up.
Up 7.3% from a year ago. So,
yay!
I'm not going to pretend it's any good.
Rate right now, maybe
Manhattan
3-ish.
rent. Terry Haynes of Pangaea joining us next on the looming UAW strike from New York City. Good morning.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
We're making progress at each of the 3 negotiating tables, but as you just heard, we're still very far apart on our key priorities. To win, we're likely going to have to take action. We are preparing to strike these companies in a way they've never seen before.
The deadline is midnight tonight. That was UAW President Sean Fain outlining the organisation's plans to strike against the big 3 automakers as the negotiation deadline nears. On the table, an offer from UAW of a 36% pay raise coming back at them, according to President Fain. Ford proposed 20% raises over 4 years. GM offering 18%. Stellantis offering 17.5%. There's still a wide spread there, TK. Can we close it through the rest of today?
How Teamsters was that? I mean, I think the Teamsters thing a couple of weeks ago changed the debate, the tone, the body language of these people. This guy I knows he's got his union behind him.
Has he got the president behind him too?
Don't know.
Emboldened by the White House as well.
That tone of voice, I didn't hear 2 or 3 years ago.
You know, have they really been emboldened by the White House? This is a damned if he does, damned if he doesn't kind of moment. And there hasn't been that much, based on the number of reports, there hasn't been that much involvement by the White House. They get involved and they fail to stave off some sort of strike. They're bad. Yeah. If they get involved and there is some sort of strike or they get to some resolution that hurts anyone, then they're bad. Like, either way, they're not going to be looked at well if they get involved.
There's a bit of lose-lose to this, TK, going into this one later.
Yeah. You talking ECB or you talking Joe? Or
no, I was talking about the strike that would potentially happen later on this evening, TK.
Yeah.
UAW. I didn't switch to the ECB.
I'm fascinated.
I can talk about the ECB if you want.
Who the company will be. That's lose-lose too.
What does she think about it?
But I'm fascinated who they pick is the strike company.
Maybe they go through three in different locations. The TK. I think they're being very cagey about the strategy because they don't want the automakers to plan for it.
Okay, we'll see. Terry Haynes will be up then. He'll be.
Let's see what Terry's call is: strike or no strike.
Right now, we've got a 2-hour conversation with Terry Haynes, a news flow out of Washington extraordinary. He's with Pangea Policy. I'm going to digress here because he's the only one that'll remember this, and then Lisa and John have some serious questions, including UAW. There we were, Terry, on the couch in 1968, and LBJ in Vietnam said, "I give up." David Ignatius dropped a bombshell 2 days ago. Amory Horton and I went back and forth on it right away. When is Biden going to do an LBJ?
Right now, I think never. They've put a situation in place here where he's the only alternative in the party. That there really isn't another alternative, and everybody else is staying on the bench. And, you've got the Washington chattering classes going on about the need for change, but there's no alternative. Folks are not thrilled about the prospect of Biden standing aside and having a free-for-all that potentially.
But that's the Democratic Party. Come on, back to Grover Cleveland Alexander, the 2-term president in the 19th century. That's the way the Democrats do it. When have the Democrats ever been a smooth operation out of a campaign? They're supposed to have, a complete mess to get to the convention, right? In the smoke-filled rooms.
Well, historically, there are two things I could say about Democrats are. The first, insert the Will Rogers comment about belonging to no organized political party. The second, though, I will say that when it's time to whack somebody, as they say in New York, Democrats are much better at that than Republicans are. That said, I don't see the situation changing with President Biden anytime soon.
So, Terry, do you expect a strike or no strike? And how is this White House going to deal with it?
My instinct is, Lisa, and it is instinct, is no strike. And I will tell you why. Simply that they're not negotiating in public. That's always a good sign, whether you're talking about politics or union negotiations. And the union was very clear about, kind of what they wanted, which was kind of get back in front of the wage train and protect their workers in an EV transition. By implication, they're also being clear about what sort of overreach there is. Number one. Number two, the automakers are motivated to have some sort of a resolution. And thirdly, as you all pointed out in the intro, lurking in the background is the White House, which very much wants a resolution, and I think we'll try to apply some pressure to get one.
Well, it seems like there hasn't been that much involvement from the White House. There were a number of reports talking about specific individuals involved, which haven't been at the very top. It's been the acting labor secretary, Julie Su. Again, they haven't really named a full labor secretary at this point, certainly not someone who's been out in front. Gene Sperling, a White House advisor, also has been a liaison to this. Other than that, there really hasn't been that much involvement. Do you think that was a political mistake?
I think having Sperling and Sue involved is an indication of serious engagement by the White House. Gene's a very serious guy. The labor secretary you would expect to be involved, and she probably pushed to be involved. So those seem to me like the right people. The question to me is what what both rhetorically and in a bully pulpit sense Biden is willing to do. This is somebody who claims that he's the most pro-union president ever. So Franklin Roosevelt is spitting in his grave, among others. But that UAW created the American middle class and deserves an appropriate contract, and Biden sees the negotiation as essential to pushing the EV transition forward. For all those reasons, the White House is going to have to stay involved. I think you accurately pointed out the two bad choices, but the downside is potentially worse than the upside. But they've got to get involved for the upside.
What is the ideal outcome for this White House?
No, the ideal is a contract that is accepted by all sides, that shows real movement forward, that the president can push to say this pushes my ideals about union ownership, union membership, union participation, and frankly, he gets the endorsement of the UAW, which has been hanging out there.
Right. Terry, I went back 2 years to Politico, looking at union discussions between Trump and Biden. Do you have any knowledge or perspective if UAW line workers are supporting the former president or the present president?
I don't have anything granular on that. I will say that there is has been for some time a major disconnect between what union leadership wants their rank and file to vote, or how they want them to vote, and how those rank and file actually vote. I mean, they're the same hotbeds in Detroit, in Pittsburgh, and the like are all places that were heavily for Trump and made the elections much closer than they did otherwise. I wouldn't expect that to change much, frankly.
Terry, got a bit of breaking news, sir. Thanks for being with us. Terry Haynes there of Pangaea Policy on the latest with the strikes, potential strikes, a little bit later on today. Here's the breaking news for you. The reserve requirement ratio over at China gets a trim of 0.25 percentage points. The cut will be effective from September 15th. So a slight bit of easing, Tom, on the supply of credit, not necessarily the price of it, but ultimately easing the reserve requirement ratio for Chinese banks over in China.
Just in the last 24 hours against this, I mean, there's the whole financial thing, the property thing and that, and deflation, disinflation, all blah, blah, blah. You know what? A lot of the zeitgeist is the economy is still doing okay. We got to remind ourselves, is this a 3% China GDP, 5%? Dare I say, could it be more, even with all this financial upset?
4 is the number you hear a lot of, Tom. Yeah. A lot of revisions away from 5 towards 4. And Lisa put that on the long list of action we've seen from Chinese officials over the last couple of weeks, the last month.
Which is the reason why the moves have been, easing talk, easing light, not necessarily that aggressive, which raises a question how far they're going to go.
I think we need a surveillance road trip to Shanghai.
I'm sure you do.
3 of us on the deck there.
That doesn't shock me, Tom.
I can just looking down the Bund.
Yeah.
Bramo on the Bund. I like that.
An easing posture over in China. Sarah Hewen of Standard Chartered on the ECB next.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon. The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
PBOC out a moment ago with a reserve requirement ratio cut, just a small one, 0.25 percentage points, but that on top of everything else we've seen from that nation over the last month, an easing posture out of China. Your equity market on the S&P 500 positive by a third of 1%. Lots to look forward to. US retail sales, a straight deadline for Detroit's Big Three, and an ECB rate decision just around the corner. Equity futures higher on the Nasdaq, up by 0.4%. Into the bond market, the 2-year closed above 5% on Tuesday. Broke back below it yesterday, still below it right now, up by a single basis point to 4.9776. The 10-year 4.2565. Tom, into retail sales a little bit later this morning.
Yeah, we got a do we have a countdown clock for retail sales? Come on, we're slipping, Amy, in the control room. We need a countdown clock on retail sales, and we need a count up clock from when the ECB announces to get to Lagarde's president.
You want to count up from it?
I want to count up. Lisa and I, you were gone
Lisa,
yesterday.
it doesn't have to make sense.
You were at a meeting. You were at a meeting yesterday.
You were saying this yesterday.
You were at a meeting yesterday with your people, and Lisa and I were like advocating for a count up clock off of inflation.
You want to count up afterwards,
Yeah,
so you can say like 21 minutes since.
So McKee can give us further data.
Sure. All right.
You know,
we'll work
works
that out, Tom. We'll figure that out.
Peter Cheer, with a really smart Zero Hedge, published it out of Academy of Securities, a really smart note
What did he say?
on real rates. He said real rates matter, and the key thing, Bram will comment on this. I usually look at the 10-year because I'm a lazy equity guy. He said the 5-year is more important. The 5-year real rate, inflation-adjusted rate, is what the pro over at Academy Securities looks at.
Everyone's been saying they want the belly of the curve, right? Isn't that the sort of consensus call right now? And so that perhaps is what Peter Scheer is talking about. No, Tom, he's not talking about you. He's talking about just in general. And this is something we keep seeing, John, as people try to capitalize on bonds that might not be trash, although Ray Dalio might think they're trash.
Everything's about you, Tom. Everything's about you. Don't worry about it. You'll upset him.
Dalio was what, at Milken?
Yeah.
I think so, yeah.
They interviewed him, and to get this right, he doesn't like bonds priced down yield.
Cash is no longer trash because cash has a yield. And, yeah, basically.
I mean, look, Joe and Tracy interviewed Bill Gross, and it's like a legit deal. They're qualified. Bill Gross is running $1 gajillion.
You're suggesting that Ray Dalio is not qualified?
No, I just think Ray's. Come on.
His assessment.
Wait a minute. The last time we heard from Ray, cash was trash, right?
Something like that. That was a few years ago.
Okay,
fair. That was a few years
ago
when rates were at zero.
Okay.
Basically, there's a spare seat around the table, and Ray is welcome anytime. Is that the message you'd like to send?
Yeah, I think Ray can come in and we can clarify,
okay.
Clarify cash.
I'm pleased we've cleared that up. In foreign exchange, the euro has not had a close above 108 for about 2 weeks. We're at 107, 107.31.
What do you think
totally unchanged. 8 weeks of dollar strength is what I think, TK.
Yeah.
And if you want a toxic brew, Lisa Abrowitz, then you've got one. You do not want a weaker euro and a higher crude price in Europe. That stuff is brutal. And that's where the ECB is right now.
If Christine Lagarde does not take a somewhat dire tone today, I think she'll be tone deaf. That's what I'm thinking, that she has to signal how difficult their decision is at a time where they want to support the euro, and they have to hike rates one more time in order to support the euro. But they also are dealing with a very difficult economic picture, downgrading growth with a German recession.
I totally agree with what you're saying in terms of oil. She's going to take a different tact for one reason only: oil.
Tough spot.
Yeah.
The energy story. Under surveillance this morning, the United Auto Workers and the Big Three automakers remaining far apart in talks on a new labour contract as the midnight deadline approaches. UAW President Sean Fain saying in a Facebook Live, "We are prepared to strike these companies in a way they've never seen before." The Ford CEO, Jim Farley, said the union hasn't made a, quote, serious counteroffer to any of Ford's proposals, adding, "We're here, we're ready to negotiate, but it's sure hard to negotiate a contract, Tom, when there's no one to negotiate with."
Yeah, well, it's there, and it's Ford, and I don't know what they're going to do. Why do you go after the one company that didn't go bankrupt? Politically, to go after Ford, to me, would be odd, given the government challenges of the other
You think
two.
they pick one somewhere else?
The tradition is they pick one so they can strike longer. They can the fund that they have will last longer. This goes back 100 years.
If you wanted to maintain public support for what you were doing, pick the one which no one's ever heard of, Stellantis.
I don't
Doesn't
disagree
that make
with
sense?
that. No, John,
if you strike
I think you're onto
Stellantis
something.
and you're sort of somewhere, I don't know, pick a state wherever, and you've never heard of Stellantis,
Totally.
what does that even mean?
Which is the reason why, and I hate to read too much into a small price move, Stellantis shares are down pre-market.
I'd be beating up on
and GM. Yeah. What are you going to beat up on? Go ahead. Keep going.
I'm giving them my strategy for union negotiations. I'm probably not best placed to do that.
I think you're perfect.
Just a call on the ECB. The ECB rate decision 2 hours away, with markets split on whether President Lagarde will pause or deliver a 10th straight rate hike. Jeff Yu, BNY Mellon, one of our friends on this programme, weighing in, saying, quote, "We have to acknowledge the hawkish shift in expectations over the last 2 weeks. The risk-reward heading into the decision is not good for the euro. The euro is absolutely unchanged." And your third and final story, we're on IPO watch. SoftBank's arm pricing its IPO at the top end of the range, selling shares for $51 when trading begins on the chip designer later on this morning. The IPO is the biggest of the year, with Bloomberg reporting it was oversubscribed, Lisa, more than 10 times.
Still, though, just to give you some perspective, valuing the company substantially below the $64 billion of just a couple of years ago at $54.5 billion. So, yes, substantially higher, but it's a small portion. And Tom, honestly, you were right to point out this is basically a marketing shtick to try to get as many people into the market as possible.
Bring up the screen again. For those of you on radio, you're not missing it. Lisa's killing this. Bring it up again if you would, Amy. I don't know if it's not in the trash bin yet. Down at the bottom, there's all the numbers, the math, and all this. And John got merch when he went to the road show. Great. SoftBank maintains 90% stake. I still don't get this modern IPO stuff. What in God's name are they doing other than to cash out a bunch of bakers? Mizuho had a good day. Dominic Constam's probably buying breakfast.
Oh, Mizuho's making money on this, right?
Rashudo and Constam are buying breakfast.
Do you think you can learn anything from this IPO anyway, given the nature of the company that's been listed?
I'm not qualified to answer that. I defer to Anurag Rana.
Okay.
He was the one that would do it. Let's jump into it. We go to Europe, and I want John to lead this conversation because the first time I saw John Farrell was on the lawn of the Otmar Issing ECB building long ago and far away. Sarah Hewen qualified to talk about this most important
I love about your story
meeting.
of meeting me. He forgets when we actually first met.
You got that right.
Years before that. Sarah Hewen, head of Europe and America's research at Standard Chartered. That's closer to the truth. Sarah, welcome to the programme. Hike or no hike from the ECB in a few hours' time?
It's on a knife edge, isn't it? I mean, we think no hike. If you look at the data, the economy is close to stalling, if not already turning down. There's a very weak outlook for the for growth. Inflation, sure, it's still higher than it needs to be, but core inflation has come down, and we think that this sort of growth outlook will bring inflation pressures down further. The issue, of course, is the small nudge up that we've seen in inflation expectations, and importantly, the fact that the inflation forecasts for this time around are going to have to be revised quite substantially. It's quite tough. We recognise it's quite tough for Lagarde to say we're on hold, but by the way, we expect inflation to be higher this year and next year. So very much a knife edge.
Sarah, if Germany and a German recession can't bring down inflation, what will?
We'll get there in the end. I mean, recession ultimately will damage the labour market. It will dampen wage growth. It will restrict businesses' ability to pass on price increases, which has been a big part of the inflation story, don't forget. And you get to your 2% inflation target. I think what we're questioning is how far are they going to be focusing on their forecasts for next year's inflation, how far on the medium term, 2025. The forecasting horizon has always been 2 years. Where are we going to be in 2 years' time? If they up their forecasts for 2025 inflation, then that shows that they just don't believe they're not going to be able to meet the target as under the current policy stance.
Sarah, you're expert on this, and of course Standard Chartered has a wonderful European and particularly Eastern European look. How homogenous is the ECB today? Americans will go Germany, Portugal, or maybe we'll look at core and we'll say something about Italy or Greece. We're uninformed. Is it cohesive in a meeting today, or is it cats and dogs arguing that Lagarde never talks about?
I'm sure there are very robust discussions, put it that way. And I'm not sure that it necessarily relates to the domestic economies as well. There are really across the board weakness in the euro area to a lesser or greater extent. And the hawks on the ECB Council and not necessarily those that are in economies that are doing well. But there is a sort of big split. You can see very clearly that some policymakers are very concerned about the growth picture and feel very strongly that that is going to be bringing inflation down. They're really concerned that another rate hike will tip the economy into a deeper than necessary recession. Others just feel that you cannot stop while you have headline inflation and core inflation at 5.3%, sort of 2-3 times the target.
Right now, we're talking about how Christine Lagarde, the ECB president, is between a rock and a hard place. So, too, is the euro. And there's this real question of how much the ECB is watching the euro and hoping it stays at this level. What is the level at which the ECB starts to sweat about imported inflation at exactly the worst time?
I think that we're still some way from that. We've always seen in the past when the euro gets to parity that is the point at which we get verbal intervention. There are so many bigger problems, I would say, for the economy at the moment than the value of the euro. The euro is obviously helping the region's exporters. Imported inflation anyway is not what the policymakers are concerned about at the moment. They're concerned about domestically driven inflation. So even though we are seeing higher energy costs, and that is a worry, I think the concern over higher energy is equally balanced between the impact on inflation expectations, which will drive them higher, but also the drag on growth, the headwind to growth that in an environment which is already pretty much recessionary.
Do you expect Christine Lagarde to talk a lot about the long and variable lags that maybe are coming to the fore more quickly in Europe? Can you speak to how much they're going to speak about a hold being restrictive increasingly as time goes on?
I think that that's a very good point to make. As inflation comes down, if rates are staying unchanged, we can already see the impact on financing conditions, on credit availability, on the growth in the money supply, which has slowed very dramatically. So I think that they will emphasize the point that policy is restrictive and will stay restrictive for a long time. The mantra may well be that rate cuts are not on the horizon. They will want to send the message that higher for longer, rather than give any impression. Certainly, they won't give any impression today that they are done, and they will want to send the message that policy is set to stay restrictive until they are confident that the inflation target is within reach.
That decision about 90 minutes away. Sarah, thank you. Sarah Hewen there of Standard Chartered. It's about 30 minutes after that, you'll hear from President Lagarde in the ECB news conference, and somewhere in between you're going to get some forecasts from this European Central Bank, which could show inflation next year forecasted to be above 3%, which is why there are many economists out there predicting we get a rate hike from the ECB. Sarah Hewen is not one of them. Up next on this programme, Helene Becker of TD Cowen on the airlines. We've got to talk about the downgrades to the outlook that we've seen from Spirit, from American Airlines. The airlines this month on the S&P 500 down more than 8%. From the July highs, we're down more than 22%. Higher labour costs, Tom, higher fuel costs, and maybe even softer demand and lower ticket prices that they have to confront through the rest of this year.
And the partition of economy to business is just extraordinary how that's maintained. I look at one flight overnight, and the ratio of business fares to economy was 5 to 1. How do you run an airline with a 5 to 1 ratio between the cost of the fancy people up front and everybody else in back?
What's your go-to? Still New York to Paris?
No, I'm looking New York to Paris as a base fee. Everybody wants to go. Then also EWR.
It's not like a busy travel corridor in America. It's like
to LAX as well. New York
to
LAX as well. It's gone down. It's way down.
Like the glamour routes.
Way down. The kids are traveling like they're going to dinner in LA. They come back in the midnight.
Helene Becker of TD Cowen on the airlines coming up next from New York City this morning. Good morning to you all. US retail sales and ECB rate decision and a strike deadline later on for Detroit's Big Three. All of that is coming up.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
We've already seen a lot more struggles with the pricing going forward as people are starting to pull back on their travel. So I think that is a big issue and why we think we're going to go to a recession. Higher energy prices is going to continue to cool spending by the consumer. As we approach $4 a gallon, I think that's going to conserve people's what they have to spend, and that's going to further lead to some weakness by consumer spending into the year end.
Earlier this summer, it felt so good to be an airline. Not to be a passenger on those airlines, to be an airline. That story has changed and changed quickly. We start September. On the month, we're down by more than 8% for the airlines on the S&P 500. That was Larry Adam there, the Chief Investment Officer over at Raymond James. TK, yesterday it was Spirit, it was American Airlines. It makes you wonder this morning, who's next?
Yeah, I mean, the zeitgeist thought it's got to be United, Delta, maybe Alaska steps in that. John, I looked at the return of the S&P index. Thanks for your help on that. Where pre-pandemic, they're like negative 13%. At the bottom of the pandemic, when they got $1 gajillion worth of government support, they've made like 8% per year. In the last 10 years, this index is up 4.4% per year. Is that any way to run a business?
The chart of it's amazing. If you look at the run-up through the summer, oh, look, everyone's going to Greece. They're going to Italy. I'll pay anything. Please fly me there. And then all of a sudden...
And we did.
Fuel prices higher, Lisa. Labour unions want a slice of it. And now we're talking about softer demand and lower ticket prices too.
Where do they cut costs? This is my question, because they're still hiring people and having to offer up big to get people in the door to even keep the thing fully staffed. They've already cut your peanuts. They've already cut your the size of your seat. They've already cut your overhead compartment. They've already cut your line order. So at what point do they have the room to even begin to shrink expenses in a way that doesn't materially impact demand?
I love it when TK gets personal. The seats are ridiculous. TK flying business class. Just picture this. TK flying business class and there is still no space. I've got photos of it.
Yeah,
there is still no space.
I believe it.
I mean, I get on and the pilots look back through the door and laugh at me. But I'm on the flight. We're going to keep the airline name out of this because I don't want Helene Becker in trouble. And the food was so bad. I said to them, why don't you just serve Swanson TV dinners? Just give us our youth.
But
give
you
us our
pre-order.
childhood.
I pre-order with American.
Oh, do you?
I always pre-order with American, yeah.
You like to pre-order? I got an email.
I like to pre-order, yeah.
Yeah.
Just get ahead of it. Get the meal that you want.
Okay, so, we blew up yesterday with American Airlines. Who knows today? Joining us now with experience, she has seen this before, with TD Cowen, Helene Becker. Helene, thank you so much for taking time out. I just want to go to the shot here, out 12 months, out 36 months. What's your single best buy of these beleaguered airlines at this moment?
Yeah, so we like Copa. It's a mid-cap airline company, Copa Airlines, based in Panama. They've got a 4% dividend yield, and their commitment is to raise the dividend, to pay out 50% of adjusted net income. So every March, they'll look at this year's net income and then adjust the dividend. We've moved away from the domestic U.S. airlines. As you know, last time, Tom, I was here, it was United was our best idea. And we've kind of moved away because of the things you three have been talking about all morning. The idea that people aren't traveling as much, the hybrid work environment is coming to a bit of an end. You can't keep taking your kids out of school to go traveling every weekend.
Keep it up, Helene. Mrs. Keen's watching at home. Keep it going. Come on.
And so what winds up happening is demand goes down, and that's what the airlines are saying. We had our conference in Boston last Wednesday, and we had Alaska and United, Sun Country and Allegiant update. And then yesterday at another conference, we had American Spirit and Frontier.
Elaine, so you're in your conference. It's all friends, and I know that, and there's nobody watching, so we can talk frankly here. American people, after what they went through with the pandemic.
Yeah, it's really awful. I was in Washington earlier this week at a conference, and the message from the industry to government is you need to fix air traffic control first and foremost. We're short 3,000 air traffic controllers in this country, We train a net about 500 or 600, which is a 5 to 6 year backlog. And that's just to keep things flat. We're down so much relative to where we should be. And it impacts the entire network because it causes airlines to burn extra fuel. They don't manage their they can't manage their day-to-day operations well. And from what can the airlines do? Well, they're not getting productivity improvements with these expensive contracts that they're giving. So the only thing they can do is keep raising prices, but that destroys demand. And the focus, I think, will be on more seats per departure, but they have all the wrong aircraft for that. So that means more CapEx at a higher interest rate. So the industry is getting its margins squeezed. There's not a lot they can do from an productivity perspective because they're doing less flying with more people. You've got fuel costs going up. Brent's over $90 a barrel right now, and that's not changing in the short term from what I've heard from our energy analysts. And so the outlook is really getting very concerning for these airlines because we're expecting 2024 to see flat to down earnings versus flat to up earnings.
Given some of the difficulties that you've just mentioned, Helene, do you believe the pandemic is a convenient scapegoat or the reason for some of those problems?
So I think I think they're using it as a scapegoat, but frankly, I think these problems existed before. You guys who know, I've been talking about the looming pilot shortage for 10 years now, since December of 2013. And so when you think about that, we've been talking about the air traffic control shortage for 5 years. So nobody's paid attention. And now they're saying, oh, it's because of the pandemic. No, it's not. These problems were going to exist. The pandemic just intensified it and made it worse than it otherwise would have been by encouraging many people to retire 1 to 3 years ahead of time.
Helene, how much are airlines going to become credit card companies? And that's basically where they're going right now. Everyone has to get an American Express labeled with their corporate logo, and then they get all sorts of perks, and everybody who actually flies, forget about it.
Yeah, so that's a whole nother thing, because isn't Congress going through this this process right now where they want to change the whole way loyalty programs work and take away a lot of those benefits that airlines receive? But yes, that's the place where airlines make money, right? They can get remuneration from the credit card companies. They have the ancillary fees because once you have the airline ticket, they charge you for bags, they charge you for seat assignments, some airlines charge you for water, and so on. And so that's where the revenue benefits are going to come in, because those are high margin sectors of the revenue pie. But as far as ticket prices go, that's really what they have to do. They have to raise ticket prices to cover higher costs. And
yeah, but they're not. Come on, Helene, they're not raising prices. I mean, prices are coming down,
right?
Yeah.
Prices are coming down, so margins are getting squeezed, and that doesn't bode well for stock prices.
Is this a business? It's a crazy business.
Helene, do you want to answer that one? Is it?
Well, I've been doing it a long time, as you know, and I've seen this movie before, Jonathan, as you observed, and it doesn't end well.
Helene Becker, when you say it doesn't end well, are you saying we're going to lose some airlines here?
I think at some point in the second half of the decade, the answer is yes. Not everybody's going to survive this looming downturn. Deja vu all over again.
Do you think we need mergers and acquisitions to avoid that?
Yes, absolutely. We need fewer. Having fewer airlines hasn't helped either, right? Because everybody complains about the service, and I complain too. I pre-ordered my meal on a flight home Friday night, and she gave it away. She gave it to another passenger who might have had more status on my flight than I did. But
did you kick up a fuss, Helene? I just want to understand how you responded to that. What did you say?
I said, you gave away my meal. What were you thinking?
Is she the one? Is she? If you're LAX to New York and they're landing in Kansas City, is it Helene Becker?
It's a thin line.
They didn't load my meal coming back from Jackson, going through Dallas.
Yeah, they didn't load mine either.
I was very relaxed about it. It's okay. It's
really
not their fault.
I'm getting more like they're so beleaguered. Every seat's taken.
Were you more relaxed about it so that they didn't land the plane in Kansas?
I was very relaxed about it because it was a few hours away.
And
I was going to eat at Dallas. The selection of food at the airport
finding on
there is
every
fantastic.
flight now. I mean, Helene's was the high ground on this, but what I find on every flight, there's always one idiot. And the flight
Tell us more.
attendants-
Who is
the
that
flight
idiot?
attendant-
Only
Are you talking
one.
about passengers
they're
or
not
staff
me.
here?
But there's just always they're focused on one idiot who's like
I know
they
what you
got to
mean.
take care of him.
Kicking up a fuss.
Yeah.
Yeah.
She
Different
was great.
cabins, TK. Elaine Becker there of
Elaine,
TD
thank
Cowen.
you.
That's
Copa.
usually in first.
Copa, Panama.
Yeah. Latin American Airlines are where it's at.
You go to
Yeah.
Buenos Aires, which is a long ways away. We could do the
It's
show
like
from
straight
Buenos
down,
Aires.
straight down for.
Summer in Buenos Aires.
Make that
November.
happen, TK. Yeah.
Yeah, we could do that.
Great exchange rate for you. Michael
start
Showler,
dinner
Market
at like
Field.
10 p.m.
Up
Unclear what it
next.
is.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for all and Hunger for none. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
The consumer is stretched here, right? We have to pay attention to that.
Whichever way you look at it, inflation is too high. The Fed has to rethink.
Rates can still move higher, and I think that's a really important thing for us to remember.
The market is not fully bought into this disinflationary trend idea.
I think we're actually going to go into a mild short recession going into next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is positive. Near session highs up by 0.4%. Later on this morning, U.S. retail sales and jobless claims. Before we get there, an ECB rate decision. Later on tonight, Tom, we're expecting a news conference from UAW, the big union taking on Detroit's Big Three, because 2 hours after that, 10 p.m. that news conference potentially, Tom?
Yeah.
Midnight is that deadline to strike a deal with Detroit's Big Three.
I just went to our engineers in our control room, the team that we've got with their interns, and they use GPT, and all that AI stuff.
How's that working out?
I want 3 countdown clocks today. We need 3.
What are your 3 events?
8:30,
Data, the
10
ECB?
p.m. No, 8:30, like ECB economics.
Okay, we're counting up.
10
from that.
p.m. Like Lisa says, she's staying up for 10 p.m. when the union speaks, and then 12 midnight, we'll see if the Cinderella comes out and gives us a strike.
Pick a story. Data, ECB, strikes.
It's a tough call. That's a really good question, because I think retail sales become more important because of inflation yesterday. But I got to go with ECB. I think from an historical standpoint, it's not, folks, for those of you in America, this isn't the Fed. It's going to be different.
So much harder for President Lagarde today. So, Lisa, let's go through what this ECB is stuck between. Inflation forecast for next year, which might be above 3% based on recent reporting. A growth outlook that may have to be downgraded based on what's going to happen with Germany. Potentially a contraction for all of this year. Then you've got this rally in crude, this weakness in the euro. Put it all together. Doesn't sound great, does it?
It's the nightmare for central banks, which is stagflation. It is the worst recipe that any central bank has to deal with, which raises the question, especially if the market is expecting the ECB to eventually, before the end of this year, get to 4% and then hold. Why not just raise to 4%? And then say, we're done. This is going to be something that will become increasingly restrictive over time. And we understand that inflation is a major problem. We also understand that we've got weakening growth. This is where we're going to sit and see what happens.
That's the ECB. Let's talk about negotiations here stateside between the Big Three and UAW. This is what's on the table at the moment. UAW started at 40% for a pay raise, came down to 36%. This is the offer so far, according to the union. Ford has proposed 20% raises over 4 years. GM has offered 18%, Stellantis has offered 17.5%. And Tom, there's a real feeling that we can't close the gap between now and tonight.
based on the Bloomberg discussion yesterday, I'd say we can't close the gap. And to me, it's like the Teamsters. I said in the last hour, this is, well, if you're the head of the union, how do you not behave like the Teamsters? And you just say, this is the way it's going to be. We're going on strike.
Why wouldn't you?
What are the consequences if they go on strike? They don't build cars. I get it. What happens on the inventory lots? I have not seen enough work about to the three automakers who gets hurt the hardest and how soon they get hurt.
From what we've heard about EV inventories, Lisa, maybe it wouldn't be a bad thing at some of these places.
Exactly. But actually, they've got pretty hefty inventories, so they might be able to clear them out if the workers stop manufacturing. What's at risk for them to do this, Tom, is a good question, but there are some real things at risk, including moving factories out of union-friendly states, which we've already seen, to the south, possibly not necessarily getting the support of the White House if they're really pushed against the wall, if it creates too much economic damage. They could push too hard. And I think that is in the balance, and that seems to be evident.
Isn't Elon Musk and Tesla just sitting there rubbing their hands together, loving every second of this?
I imagine so. He was in Washington, D.C. talking about artificial intelligence, and he could afford to because he's not dealing with this.
Did you notice that they put Musk and Zuckerberg there in the East
Opposite
Wing?
ends.
It's like a meeting with Putin. You know, Putin with a long table where you sit at the end. And
if you want a nice read, Tom, during the show, because sometimes you're not following.
Some free time.
If you want a nice read, have a read of Secretary Granholm's trip across America in electric vehicles. That one is somewhat entertaining. Equity futures on the S&P 500 positive here by 0.4%. Everyone's sitting there now on Google. In the bond market, yields unchanged, 425.25, and in the FX market, Lisa, the euro basically unchanged, 107.36.
So the ECB decision, 8:15 a.m., 8:45 is the press conference with Christine Lagarde. Curious to see how much she sees inflation coming down by 2025, considering that the Reuters report has it at 3% by next year. 8:30 a.m. To me, this is the biggest deal, is retail sales in America. And we are going to get PPI as well and jobless claims. But retail sales will show how much consumer spending power has been eroded by higher gasoline prices and by inflation just more broadly. And we have seen gas prices rise to some of the highest levels going back more than a year. And 11:59 is the deadline for the negotiations. But we're all watching the 10 p.m. press conference with UAW President Sean Fain. Do they start to indicate that they're going to go after Stellantis in particular? Or is it going to be something targeting each of the particular big three because they want to make this unprecedented? They want to be able to say, we're going against all of you and demanding our right. How far can they push, considering a weakening labor market and the fact that technology is moving out?
You should go and ask people on the street. There's going to be a strike at Stellantis, and they'd be like, what's Stellantis? Who is Stellantis?
A beer company?
It's Chrysler
Jeep.
It's Chrysler Jeep.
No, they are. But do you
What's
think
the French company?
how many people in this country do you reckon who know who Stellantis
I think
are?
a lot of people don't. But isn't it like the French company Peugeot and his Jeep? Yeah. Whatever.
Yeah, sure, whatever. Michael Schell, CEO of Marketfield Asset Management. Whatever, just a European car manufacturer, Michael, it doesn't matter, whatever. Can we talk about these labour negotiations? And welcome to the programme. A question we've all been asking around this table is whether these are the dying embers of a hot labour market or something that's going to stay with us for a while into next year. Is this rear-view mirror stuff or forward-looking?
I mean, I think the auto workers are something of a special case. It's a small number of companies and it's highly skilled labour with a very organised union. So it's difficult to extrapolate from that and say this is the entire labour market. But I think as far as the labour market's concerned, it's still a very tight labour market. You're not creating jobs at the pace that you were. But there's absolutely no sign of that switch being flipped and for workers to start being laid off. So, I think power is still in the hand of a worker rather than the manager.
You synthesize equity, bonds, currencies, commodities, particularly a commodity analysis. Is $90 oil an opportunity for you, or is it the new market field headache?
I think it's an opportunity. I think that the energy sector remains very cheap versus oil. I think oil is moving higher. I think you had a lot of mistaken analysis earlier this year with people convincing themselves that you were going to have an extreme surplus in crude oil. And I think if you look at particularly U.S. inventory numbers, it's on the skimpy side. And demand seems to be okay. So, I think the way the market's priced, if crude can continue to move higher, get through that 93, 94 level that it stalled at last fall, I think the energy sector should follow.
Does that mean that that is disinflationary or inflationary at a time where people are looking at retail sales to possibly come in with a negative read as a result of higher costs?
I think gasoline is still fundamentally affordable at current levels. I mean, the thing about gas is we sort of look at $3 gas, $4 gas, $5 gas, and over 15 years, it's really not the same number. So, a number which was really not affordable in 2008 and caused tremendous problems on top of a mortgage crisis. Look at what personal incomes have done in the last 15 years, whatever sort of metric, that you use. I think gas remains affordable at current levels.
Given that, it seems like you're a little more concerned about inflation going forward, a little more concerned about valuation in bonds right now, specifically the long end, than some people, talking about duration risk as more of a significant concern. Can you speak about how contrarian that has become as people sort of start to expect things to sort of have a soft landing and revert back to a lower inflation norm?
Yeah, I mean, I think, look, I saw you had a story about the inverted yield curve and how long it's been inverted. I mean, the way I look at that, it's a subsidy of long-term borrowers. In other words, the Fed wants rates at 5.25%, 5.5%, and the 10-year yield at 4.30 makes it much, much cheaper to issue long-term debt based off that benchmark. I think the danger that we have is that the long end of the curve starts to misbehave, that investors at the long end of the curve look for significantly higher yields. Fundamentally, there's no reason why the 10-year couldn't be at 5% instead of 4.3%. And then that is when monetary tightening starts to finally be transmitted to S&P 500 type companies. And as I say, I think that's the risk. I'm not worried about an organic slowdown in the US economy. There's no sign of demand falling off a cliff. It doesn't tend to just happen because the yield curve's inverted. I say if you look at we look at this sort of, I call it an uneasy equilibrium. In other words, nothing's really happened for the last 90 days in any significant market. I think what would trouble me is if we start to see the long end of the curve really break out of its resistance levels.
Okay, well, I got to rip up the script here and go here. Mr. Dalio at Milken Institute agrees with you, and it's as simply we've got not a likelihood, but a sobering reality of price down, yield up. Does it solve itself quickly, where it's a one-off and we move back to some form of stability we've known, or is there real risk that we sit there for a while?
I think that these things tend to break out and then continue where they are until there's a problem. So, as I say, if we saw, let's say, a 10-year yield around 5%, I think it would stay there until it causes economic damage, and then you're in a downturn, and then yields bottom. But I don't think we're going to go back and see.
Yeah, but John, help me here. What does a 5% shell yield do to the mortgage rate?
Well, it depends when your mortgage is up.
Well, no,
right?
but, I mean, within the present market of 2024, 2025.
Well, based on where we are at the moment, so we know that the outstanding mortgages, something like 9%, are paying 6 and above at origination. TK, that's going to take a long, long time. So let's take mortgages out of it. Michael, can we live with 5%?
I think certain portions of the economy can and certain portions can't. As I say, it makes it harder to use leverage to generate income. Something like commercial real estate is much, much more vulnerable than residential real estate just because of the way that borrowing takes place in that industry.
Michael Schau, this was great, as always, of Market Field Asset Management. Looking ahead as well to UAW in this negotiation deadline with Detroit's Big Three. Bloomberg's Craig Trudell on the looming auto workers' strike. He's going to be joining us very shortly. He'll be catching up with us in about 5 minutes' time. Plenty of economic data in America as well. Jobless claims, retail sales, PPI today as well, Lisa?
Yes.
PPI too. All of that in a mix at 8:30 Eastern Time. Before we get there, at about 8:15, you'll hear from the ECB. Rate hike or no rate hike from the European Central Bank and President Christine Lagarde. 30 minutes after that, you'll hear from Christine Lagarde herself in a news conference in Frankfurt, Germany. If you are just joining the programme, welcome to the programme. Equity futures on the S&P positive here by 0.45%. Coming up, Madison Fuller of JP Morgan Investment Bank. TK, tons to talk about with her a little bit later in the next hour, about 48 minutes away.
Everybody's got to rewrite, redo. I mean, I'm sorry, it's Labor Day, it's the start of a new season. There's so much news flow here the first 15 days of September that somebody's actually got to publish a 10-page report. We believe. In every single asset management house right now.
That's what it starts with.
Is going, we believe.
We believe.
Michael knows this garbage. We suggest.
We're guessing. We're guessing. Arista just said,
suggest.
we're guessing. We're guessing.
We believe.
Do you want to throw in some national politics in America? New poll from the Washington Post, Monmouth.
Missed that.
46% of potential Republican primary voters in South Carolina support Trump. The state's former governor, Nikki Haley, she comes in second. Tom at 18, Tim Scott at 10, Ron DeSantis all the way back with 9%. All the way back. That's the spread right now. I know South Carolina is unique given Nikki Haley's presence there, but Tom, is that an indication of just how big the gap is between Trump and the rest of the primaries?
And, each state's different, but yeah, the answer is yes. That is an indication of where we're heading, and it'll be interesting to see how Mr. Trump adapts to this, the language, who he supports, etc.
Does he have to adapt to anything?
Yeah, I think he's a cagey guy. He's seriously looking. He's going, okay, who's going to be my VP candidate? It's not going to be Mike Pence.
You think?
Good call. Yeah, I'm trying. But the answer is, he's going to be strategic about it.
Next year, it's going to be an interesting one, isn't it? Equity futures on the S&P positive here by 0.4%. There's a little bit of a lift in this equity market. Yields a tiny bit higher by not even a basis point. On your 10-year, 425.45. It is ECB rate decision day. Your euro is going absolutely nowhere. 107.33 from New York. Good morning.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
The UAW northern part of the industrial belt part of the country is going to shrink no matter what. And in that situation, the incentives for the union are to get as absolute much as they can. This is going to be a difficult dynamic going forward for the economy.
Former Treasury Secretary Larry Summers on Wall Street Week with David Weston on the negotiations between UAW and Detroit's Big Three, and picking up on the sense of things that other people share, Tom, that perhaps this is the last big opportunity to extract as much as you can out of Detroit's Big Three. And it's interesting to hear from the likes of Ford bring up the very viability and sustainability of the company based on what's on the table at the moment.
It is. It's going to be, it's history making. And of course, all of this is the heritage. And critically to your good insight, John, Joe Biden is looking backward on this. I don't think he's looking forward. Yeah, he does the EV chat and that, but his heritage is so steeped out of Scranton in what, in my youth. And for him, it was, early politics. It's a huge backward look for the president. I don't say that in a mean way, but it's a lot of nostalgia going on.
If he's looking forward, TK, it's a 14-month time horizon. Let's be clear about that. Let's be clear about that. The election just around the corner. Looking at markets right now, equity futures positive by 0.4%. There is a lift here. Yields unchanged on a 10-year, 425.25. Crude, new highs for 2023. Once again, just short of 90 on WTI. 89.68. TK, we're up here by a little more than 1%.
We're going to do something really special here. If you have a grandfather who grew up pretty darn poor and did pretty darn good, he would only drive a Cadillac. And that Cadillac, when you stepped in it as a little kid, had a plaque on the bottom of the door where you stepped in, and it said, Body by Fisher. We go to Lansing, Michigan. He happens to be in London, but our Craig Trudell lived the UAW, he lived Michigan, and he lives what Joe Biden remembers until Fisher Body went out of business, I think, I'll say the 80s, 90s, maybe 2005. Craig, really honored to have you on today. Is this UAW behind the President of the United States, or has he lost them?
I think the UAW absolutely appreciates that Biden is much more of an ally and an ally to be trusted than the alternative in Donald Trump, the front runner on the Republican side. That being said, this is not a sort of cut and dry story. I do think that there are concerns about the fact that Biden has this long history of not being able to necessarily deliver on what the UAW has wanted in the past under the Biden administration. And that being said, there wasn't much that Biden could do. This is a union that's been, weakening for some time and absolutely is trying to sort of mount a comeback from decades of having to give up a lot of concessions for the fact that these companies were upside down.
But I'm going to assume your family was involved with UAW 724 in Lansing, Michigan. It's a changed union. If you were to go into that union hall like your grandfather went in years ago, what would be the different body language today? I hear a lot of anger, like they're saying, we're going on strike.
Yeah, I mean, I mentioned, this idea that this union was dealing with the fact that these companies were upside down. They had, they were paying so much for, retiree health care and benefits that it was putting them at this huge disadvantage to the likes of Toyota and Honda in the U.S. We got to this point over the last couple of decades of, undoing so much of that problem that was sort of, keeping these companies back. And that's led to this, deep sense of resentment that even as these companies have, gotten to a place where they're in a much healthier position, there's sort of a feeling in places like Lansing, Michigan of, hey, wait a second, these companies are healthy on our backs, right? And we've seen, these companies pay, good wages, but, for new workers, much less than workers who've been around longer. And so, they don't want this tier system anymore. They want, the sort of pay and benefits that their predecessors in decades past were able to enjoy. And there's a real question of whether or not that's feasible in this sort of modern paradigm that we're in.
Let's say we can't close the gap. Let's talk about tomorrow. Craig, how do you organize, plan for the potential for a strike if you're Ford, GM, Stellantis, when you have no idea where those strikes will take place, at what scale, in which locations? How do you prepare for that?
I think it's such a tricky thing to prepare for, and very much by design on the part of the UAW. So much about what we've seen with these negotiations have been unprecedented. It's a small thing, but in the past you used to have the union and the car maker executives, shake hands over a table at the start of negotiations. The UAW said, we're not doing that. This time around, they're not picking one company at a time to target and to negotiate contracts with, and then trying to sort of replicate that contract with the other two. They're kind of, negotiating with all three and threatening to strike all three and be strategic about which plants they strike at, and to really sort of, put the management on the defensive and not know what's going to happen here. And so I think the short answer here is they can't plan for this, and it does, really complicate things and make it a lot messier than what we're used to.
And on the flip side, when does the UAW kill the golden goose? When do they go too far? Have people put a number on what levels then really break the backs of some of these companies in terms of profitability and competitiveness?
I think one of the really interesting questions here is, whether we get to a point where the UAW is able to negotiate contracts that are attractive enough to interest, the sort of next generation of battery workers that are going to make, what the workers used to make engines and transmissions in the U.S. that powered cars. Can the UAW sort of, get enough from these companies to leverage into organizing more of the U.S. auto industry? I think, in the past, because of the position that the union has been in of decades of concessions, there hasn't really been an ability for the UAW to go to the rest of the industry and say, hey, come join the fold, be represented by the UAW after all these years of givebacks. And I think that's one of the things that sort of gets to the complication of whether or not there is a competitiveness issue. The UAW would make the case that yes, this would put these companies at a disadvantage, but we're going to go out and sort of claim the next sort of victim here. I don't think they would use that language, but they're going to try and leverage this into organizing more of the EV and battery supply chain in the U.S.
Craig, I know you don't have the answer to this question, but I really want to understand how you're thinking about it. What does this industry look like in 10 years, given the spats that we're seeing with China and Europe and China, a big effort from the United States with the Inflation Reduction Act? What are we heading towards here over the next decade?
I think it's such a difficult time to really sort of answer that question. And I think that's one of the challenges coming into play here from both sides. For the union, you don't know whether you're negotiating with companies that within the years of this contract may have to close some plants that are building engines and transmissions because of this transition, from the combustion era to electric. You don't know to what extent consumers are going to, still want to drive, gas cars and be reluctant to go to electric vehicles. And the same can be said for the companies, right? You look at Ford, a company that, has made a lot of noise the last few years about the transition that they're going to make to EVs. Just in the last few months, really sort of change its tune and put more emphasis on hybrids. And we saw that just this week with the Ford F-150 hybrid. So there is so much to be said for the uncertainty facing this industry going forward.
There is nothing easy about this. Craig, thank you, sir. Craig Trudell out of London on the latest. TK, nothing easy about it whatsoever.
That was fabulous. He lived it. He and his family
He's
lived
fantastic.
what Joe Biden's talking about.
Mike McCormick, TD Securities, up next. ECB rate decision, about an hour away.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Equities on the S&P positive by 0.4%, 1 hour away from data in America. We'll talk about that data in just a moment. Equities up on the Nasdaq by 0.4%. A little bit later, a strike deadline for UAW, Stellantis, GM and Ford. All of that around the corner. Going into the ECB, your bond market's shaping up and looking like this. 2-year, 10-year, 30-year, 10-year, 4.26. Yields up a single basis point. 2-year, just shy of 5%. 4.98. 18, Tom, up a single basis point on the day.
Huge response to the kid from Lansing, Michigan being with us. Craig Trudell, I'm told, will join us tomorrow to see what we see tonight at 10 p.m. and midnight.
And we really don't know what we're going to see tonight at midnight. Just this big spread between what's on the table, something close to 20% from the auto manufacturers, and what UAW would like to see, which is 36 right now, Tom.
We'll see. I don't even know if we'll get the numbers tonight or that. We'll at least get maybe some of the path forward here on strike and who's involved, including Stellantis.
45 minutes away from an ECB rate decision. The euro shaping up as follows. The euro against the dollar, 107.32 and going absolutely nowhere. Coming into this week, 8 consecutive weeks of dollar strength against a weaker euro. And Lisa, there are many, many reasons why that euro has been weaker.
You know, we're talking about the UAW strikes, and it pairs into this story, actually, because Europe is the crux of so many of the difficult stories, of some of the manufacturing questions of transformation with China. And they're just stuck between a rock and a hard place. How does the ECB handle and inject monetary policy into this mess, this toxic brew of different things. I mean, essentially, I can use that for this particular region with genuineness, because honestly, this is a difficult scene.
Javier Blas moving the market right now, making it more difficult for Christine Lagarde, for the president of the ECB. She's going to enjoy Brent crude breaking through $93 a barrel.
Toxic.
92.99 is not 93.00.
Get the euro on the screen and leave crude there. Crude at 93 and the euro at 107. And if Nomura's right, threatening to break down to 105. That is a terrible, terrible blend mix for the ECB and Christine Lagarde.
And I saw yesterday somebody modeling out a rationalization to get to 100 a barrel. My puny brain can't remember what it was, but in some form of futures market or looking at Saudi light, which I do follow, which is the Saudi Arabian light oil, you can interpolate the extrapolate out. And right now we're at 100 a barrel under some measurements.
It's the rally that surprised big time.
That made no sense at all what I just said.
I'm moving on, Tom. Put pressure
Javier
on
Blas is listening
prices.
over in Europe. He's going, what in God's name is
Retail sales expected to ease on depleted savings and student loan repayments upcoming. Jobless claims last week. 216,000. Lowest since February.
We have a clock.
We're looking for 225 in about an hour from now. I want to turn to Europe. Different story. Important, though. China's lashing back at the European Union after Commission President Ursula von der Leyen announced the new probe into subsidies for China's EV makers. The country's Ministry of Commerce saying the sector has gained an advantage through, quote, hard work and its own strength. The threat of potential duties weighing further on Chinese EV makers in Hong Kong trading with down across the board there. This is some real tension here. How do these manufacturers in Europe compete with these companies in China? How do these manufacturers in America compete with these companies in China as they make this transition, Lisa, which is increasingly expensive on top of the wage demands happening here domestically?
Add on top of that, that China accounts for about 2/3 of global capacity for processing lithium, which is the main ingredient for a lot of the electric vehicle batteries. So they are coming at this with a strategic advantage from the outset, and they have just plowed into the European market. The European market is trying late, very late, to fight back with some sort of limitations to what the Chinese automakers are bringing in. The U.S. has already done that. You know, it's a little bit rich for China to be arguing this on a lot of levels, but I will just say this to me is a debate and frankly, a war that's very much worth watching and really goes to the crux of
I'm so glad you brought
challenges.
that up. I looked at it yesterday and burst out laughing. Are you kidding me? We're lecturing the Chinese a totalitarian regime on capitalism.
Precisely.
I felt like it was at Davos. You know, it's a Thursday night at Davos, your third cocktail party. You don't know who you're talking to, and they're talking about stewarding responsible capitalism.
I'm totally with you.
Are you kidding me?
Europe's a mess, Tom. Europe wants to set the rules. Everyone else wants to make a business. The United States has said enough. Let's have the Inflation Reduction Act. Let's support this transition to EV.
Do we want EVs?
China,
I don't have a consensus on
centrally planned. Let's go. And Europe is like, slow down.
Yeah.
We don't have a plan yet.
Exactly.
Just follow the rules, please. Otherwise, you can't have access to this market. Just the European way. And to your point, does the demand even exist
I'm asking.
to make this transition?
I mean,
These
I live in a
governments
bubble.
are desperate, Tom, to convey their pro-climate credentials. For good reason, I understand all of that, but it's increasingly costly. The average family now, can they afford an EV?
No, they can't afford a new car. The issue is John and I live in a bubble, moving around in our Bentleys and our Ubers. You lead a real life, Bramo. Are people out there actually able to charge up EVs?
Yeah, actually, when you drive around and you look at all of the gas stations on, different highways, you can see EV chargers
And are
everywhere.
people lined up, waiting in line, arguing about how long it takes?
No, but at the same time, there are electric vehicles, even some dented ones, which means that they've had them for some time.
You've got to read the Granholm story.
This is another.
Have you read the Granholm story yet?
No,
You've got to read the Granholm story.
I'm not going to be doing it during the show.
Should I interview her again?
Please. Yes, let's do that again.
Good luck.
I don't think that's going to happen anytime soon. Rents in Manhattan, let's finish on that, showing signs of levelling off. The median price for new leases was unchanged from July to August at $4,400 a month. Appraiser Miller Samuel saying new leases for August are down 14% from last year, may continue to fall. Median price in Brooklyn, remember that was cheap, $38.50. Northwest Queens, record high, $3,900. The good news, they're not going up so much anymore. The bad news, they're still around $4,000 a month, Tom. Just brutal.
I'm popping the HP 12C here. We got the right calculator here. This is the one Mark McCormick would use. $4,400 a month is $52,800 a year. You got your taxes, federal, state, New York City tax.
What do you have to own?
Let's say, well, I'm going to go 30%. You got 176,000. You have to have 176,000 to pay roughly 1/3 of your income.
That's pre-tax. Pre-tax.
Yeah, pre-tax.
176.
Yeah, that's a big nut.
That's nuts.
It's nuts. It's not. And Jonathan Miller, we'll get him on here at some point with his great work. Mark McCormick's lived this. He's got 8,000 square feet overlooking the East River. He joins us right now with TD Securities. Mark, it's a breath of fresh air to have you on because we can actually talk about the markets and not this insane news flow. Bracket the euro right now. What is your conviction on where the euro will be 6 months from now?
So yeah, if we're going 6 months, we actually think euro will be higher, which is definitely out of consensus. It's not fitting the news flow. It's not fitting the themes that people are talking about. But these are the things that have been basically in flux the entire year. We started the year with strong U.S. data. Then we had the shift to the China reflation theme. Then we basically have moved back to King dollar through the summer with the bear steepening of the U.S. curve and essentially the focus on China real estate. But what's happening with the euro is really a function of what will happen with China and the U.S. evolving again on those themes in the next 6 months, which what we expect is by Q1 of next year, U.S. is in a recession. Fed is moving towards cutting rates. We think China starts to get its mojo back. We see the housing market and some of the financial indicators we're tracking in China are starting to stabilize. And while the ECB is basically going to be done around either now or at 4%, essentially the move for the euro will come through the combination of all these different global factors, which would help insulate it basically between this 107 to 110 range we've been trading. So on that perspective, a weaker U.S. economy is stabilizing China, basically reinforces topside euro 6 months from now.
Within that triangulation, what is the most opportunistic trade right now?
The opportunistic trade right now is actually interesting because it's not euro. It's actually playing the lines around the dollar. And I think one of the things that's been very interesting as a feature in FX is if you look at the dollar rebased through the entire year, it's done nothing. So it sits between a very strong LATAM and a very weak Scandinavian and even SEMA currencies where basically the dollar sandwiched in between the two of them. So if you think about the themes that are working, carries working, terms of trade, you talked a lot about commodities in your last segment. The relative divergence in commodities, energy's up 30% in 3 months, base metals is down. So if you think about the things that are working in FX, the trades that we like capture these different themes, especially relative growth. So we like Swiss franc lower against the Mexican peso. We like China renminbi lower against India. We also like sterling lower versus CAD. So those three are currency pairs are definitely ways of kind of not really looking at euro dollar, but playing all the different major global themes are actually very impactful and actually the things that are driving performance in FX.
Let's just sit on the euro side of the cross a little bit longer. Mark, in about 35 minutes, we'll hear from the ECB. 30 minutes after that, a news conference with Christine Lagarde. How toxic is it to see crude at the height of the year and the euro near the weekend of the range of the year as well?
Yeah, it's not a great backdrop. It does fit into the stagflation concept. I think part of it, though, is do we want to put too much evidence on one manufacturing PMI, one round of PMIs? What's interesting is the context around European growth has changed. Like, we're not looking for a recession early next year. And again, we're looking more for a bigger slowdown in the U.S. So if you think about the context of the growth, Germany's weak, but the other parts around Europe are actually quite strong. So I think for the ECB, the challenge here is, yeah, they're lagging behind the U.S. in terms of controlling inflation. They are dealing with elevated inflation numbers that they want to continue to keep inflation expectations in check, while again the economy's slowing. So our bias here is that this is a coin toss. We're leaning towards them actually not hiking. But again, maintaining credibility around the fact that they can hike once again. They are highly data dependent. And the other thing that's going to be very interesting for this release is U.S. retail sales comes in basically right around the time when the ECB is meeting. So we're going to deal with another very critical U.S. data dump because the dollar and the euro in particular are following hard economic data surprises, which means retail sales, inflation, industrial production, real data, not the survey, not the soft data, is what's driving the dollar. It's also what's driving the euro. So if we have the ECB essentially in our base case on hold, but essentially following market expectations that they hike, and we get the weak retail sales number we're looking for a very big downside miss in the control group, that actually stabilizes the euro, given where positioning and valuations are at in our models right now.
I've got to squeeze this in. You just threw out a bone. Let's put some meat on it. Did you just say the US is going to underperform Europe next year?
Yeah, we're actually looking for a significant slowdown. So I put it in this context from the base effects of where we're at now. If you look at the strength of the data, the strength of the narrative, the focus on like King Dollar, U.S. exceptionalism, no one's even considering that the U.S. economy is going to slow into a recession next year. So our call is that the U.S. slows into recession, and as a result, you have to get much more Fed tightening. Because even if you basically go with the baseline here of where the Fed would go on pricing and where inflation goes, they're still in super restrictive territory. They're not actually changing their monetary policy stance if inflation drops and they only cut by the 100 rates that are priced in. So essentially in our call, U.S. slides in recession. We continue to lose momentum through the labor market, through the credit side, through the banking channel. And as a result, the U.S. slides into a recession early next year, which we're not looking for in Europe. And as a result, you get more Fed cuts than's priced in through 2024. And again, we're still not looking for the ECB to kind of move as aggressively. They're just kind of lagging behind. And China, again, is the other side of this where, a more supportive China environment would actually help to stabilize euro in a slowing U.S. environment.
It's quite a call. Mark McCormick, thank you, sir, of TD Securities. Yeah. If you're just tuning in, welcome to the programme. We're positive here on the S&P by 0.3%. The euro going absolutely nowhere, 107.32. That decision 32 minutes away. Bramo, that's quite a call from Mark McCormick. Recession in America next year. Outperformance, relatively speaking, from Europe, given Europe's position at the moment.
I think it's fair to say that that's contrarian at this point, especially
just a bit.
Given where yields have been. It's pretty contrarian, although I will say his point about retail sales is notable, that the sort of barbell approach of retail sales in America expected to come in disappointing could offset some of whatever happens over in the ECB to at least give a bit of a reprieve to the euro.
Yeah, and we've hardly talked about it in the news flow today, but retail sales are going to be an eye-opener and frankly as valuable as what we saw yesterday in terms of lining up GDP.
Up first, retail sales a little bit
we
later.
Need 3 countdown clocks.
8:30 Eastern Time. Retail sales in America about 45 minutes away, 46 minutes away.
Yeah.
And then we've got jobless claims and PPI as well. Lots coming up a little bit later, including this. Patrick Anderson of Anderson Economic Group on the looming UAW strike.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
We're making progress at each of the 3 negotiating tables, but as you just heard, we're still very far apart on our key priorities. To win, we're likely going to have to take action. We are preparing to strike these companies in a way they've never seen before.
That was the UAW President Sean Fain outlining the organisation's plans to strike against the big 3 automakers. The deadline hours away. Some fantastic research has come out of the Anderson Economic Group over the last week or so, calculating this, Tom, that just 10 days of strikes against GM, Ford, Stellantis would reduce US GDP by $5.6 billion and likely push the Michigan economy into recession. That data, Tom, coming from the Anderson Economic Group.
We're going to get right to this. It's so important, and we are so honored. Our team has just done a killer job of giving you original, informed voices on this part of America. It was great to talk to Craig Trudell growing up in Lansing, all of the Fisher body work that he knew in his family. And now we speak to someone also in Lansing, but truly expert on America's union and non-union auto business. Patrick Anderson owns the High Ground, the Anderson Economic Group. He is first call for everybody you can know at Honda, Toyota, obviously Detroit and Dearborn, and obviously a member of the Bow Tie of America card carrying
Is it a
group.
big club?
Thank you for the bow tie this morning.
It's a small
Patrick.
club, yes.
It's a small club and a suspect at that. Patrick, I want to take with you not the usual UAW blah, blah, blah right now, but I want to go down to Interstate 75, down to Kentucky, down to non-union Auto America. Do they win with this UAW strike?
You are driving the correct road here, my friend, my well-dressed friend. This is the big issue. A bigger issue than how much of a wage increase you get this year is, do you have a sustainable set of companies that can win in a competitive marketplace 2 and 5 years from now? And in fact, you don't have to just go down I-75 and go on US 23. You have non-union automakers in Kentucky, in Ohio, in Georgia, in Alabama. You also have competitors in California. You have competitors in South Carolina. So yes, the most important competitive issue here isn't how much do you pay in wages, it's can you sustain your company making products that Americans want to buy 2 and 5 years from now.
Mickey Maynard, the New York Times, she lived and breathed Michigan. She just owned it, Livonia, Michigan, and all that. And she wrote a classic article 15 years ago in the Times about the end of Detroit. Now, I guess they sort of salvaged it and things are okay. But do you, as a grizzled pro, worry about Michigan 10 years from now?
I worry about being grizzled, actually, but I also worry about Michigan 10 years from now. And that's why you see our coverage or our analysis point to the things that are structural. And why we pointed out that, for example, the request to go back to what's known as the jobs bank and a defined benefit pension plan are existential and bankruptcy risks for the automakers. And I absolutely understand this. And when I look at Detroit and I look at Chrysler and General Motors, I say there's no rescue coming if these companies go bankrupt again. And the goal here isn't to avoid a strike. The goal is to have a sustainable automobile industry. And when you see this kind of rhetoric and you see the kind of demands that UAW Sean Fain is making, you see it's a real risk. And at this point, basically, I mean, that $5.6 billion is probably an underestimate of the losses that will be incurred if the UAW goes out on strike.
Patrick, the research that you've done has been the research cited in every publication over the past couple of weeks as people try to understand.
All independent work by Anderson Economic Group, but of course, Detroit's a small town. And of course, I understand that they're reading it and talking about it. And I think some of the statements that come back are, in fact, comments on this. President Sean Fain made a comment yesterday about all those analysts being wrong. Well, I hope he wasn't talking about me. I actually it never said that they don't have the right to strike, or never said that they don't have a reasonable request for higher damages, higher wages. But it's also clearly the case that when you go on strike, you are causing damage. That's the goal. And the first people that get damaged are your own workers. They lose wages. But all these suppliers, and in this case, auto dealers, one of the things that's different between this time and in 2019, when the UAW struck General Motors for 42 days, is there's very little inventory now. So if the UAW goes on strike, like they're threatening to do, within days, automobile dealers across the country won't be able to sell cars. Within a week, they'll have parts difficulties. And, you know, there are other car makers and other dealers out there that are representing Honda, Volkswagen, Toyota, Hyundai, Tesla, and customers will not be interrupted in buying those. So I hope the UAW and Ford and GM and Stellantis keep in mind the goal here is to have a sustainable, profitable industry that pays good wages and not just get, a quote win at the bargaining table or a big dollar amount. If you can't stay in business, you don't win a strike.
But Patrick, isn't that part of the strategy that we might hear at 10 p.m. today from Sean Fain, that they're not going to go after all of them all at once? They're going to target things and that maybe try to just be selective about the damage so they can prolong the negotiations, kind of buying more time.
That is absolutely what this tactic has been announced. And I have to remind people that when you don't have a contract, the other side doesn't have a contract either. And this is not a de-escalation. This is an escalation. When you go out on strike and you decide to strike individual plants, what do you think the companies are going to do? I don't have an answer for that, but part of the answers are that you actually increase the damage and you harden the positions of the other people out there. Maybe they don't keep the plants open. Again, that's not my decision to make, but it's a real possibility.
Patrick, you're in Lansing. We had a really good conversation with our Craig Trudell, who grew up. His grandfather was Fisher Body with all the legacy there, World War II, in the 50s, the 60s, the 70s, Cadillac boom. You know the story. And we had a great response. And a guy out on Twitter had a really smart note and his observation where he said, look, what's the union floor? Is it red or blue? And he suggested just possibly the union floor wasn't for President Biden. Is the union behind the president, or is he looking at another time and place?
A wild card in this, and something that I've pointed out and that Sean Fain has pointed out, is something that we've never had before. We have huge taxpayer subsidies going to build battery electric plants, joint ventures with Chinese and other foreign automakers, to build cars that right now represent substantially less than 10% of the U.S. market. And here, the auto workers and the taxpayers are actually kind of on the same side. There's a great deal of skepticism about whether this makes sense, about whether it's a good expenditure of taxpayer dollars. And for the point of view of the UAW and the automakers, it's an extremely risky business decision to invest so much and actually shut down plants that are making products that Americans are buying and that are making money for the automakers. So that's the wild card in this. It's not part of the wage demands, but it is definitely underneath it, and it's definitely worrying the White House, and it's definitely a wedge between the UAW, a traditional supporter of Democratic presidents, and this Democratic president.
Patrick, this was excellent. Thank you, sir. Patrick Anderson of the Anderson Economic Group. We'll be sending him a slim tie as well at some point.
Yeah, we
in
should.
The future.
Absolutely.
We should do that too. Just to mix it up a little bit.
Absolutely.
Bramo does not approve of that. Both sides.
I mean, what are you talking about? Why is everyone projecting everything onto me?
Just the face we're pulling as you.
It's Thursday.
I think that
if we had the Bramo cam up, I'm sure it would show that Bramo did not approve.
I believe I saw that.
I think people should wear whatever they want to wear.
Okay.
Within reason, you know.
All right. Sure.
Do you think he'd actually wear the skinny tie? I don't think he would. I think
Slim,
he'd use it.
Slim. Madison Fuller of JP Morgan Investment Bank is coming up a little bit later. We've got an ECB rate decision about 20 minutes away. After that, we've got some interesting economic data for you. We've got jobless claims, PPI, got retail sales as well.
Slow day.
Then 15 minutes after all that data, you'll have a news conference with Christine Lagarde, Tom, the ECB president.
For those in America, this news conference is going to be really, really interesting. An opening statement, and then the Q&A, John. You've been in that room. Wow. It's going to be...
multiple questions, a lot of follow-ups.
I find it more enjoyable.
At some notes.
You know. I think McKee should go over and get the last question.
I'm anticipating that.
Yeah.
McKee on tour would be very cool.
Pretty good. Yeah.
That would be very cool. From New York City, this is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
I don't think we are close to stagflation at all. Look at the positive momentum in this economy.
The services piece, which is what Powell cares about, is still running much hotter than people expect and want.
Higher energy prices is going to continue to cool spending by the consumer.
The ammunition is drying up for the consumer to some extent.
The market is more worried about inflation than maybe it needs to be.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's the quiet hour here on radio and television. Nothing going on except 3 countdown clocks. In 14 minutes and change, an ECB ruling, John. I guess that trumps all, including what we see through the evening, the UAW strike possibly to come.
Well, let's deal with the next hour first, Tom. So
Yeah.
in about 14 minutes, as you say, an ECB rate decision. 15 minutes after that decision, tons of data.
Retail sales. Yeah.
PPI, jobless claims. 15 minutes after that, 8:45 Eastern Time, we have a news conference with Christine Lagarde, the ECB president. And Tom, there are some banks out there who think this governing council is about to hike interest rates. Goldman is one. Citi is another. Bank of America, HSBC, they think the deposit rate could go to 4. I can tell you, based on a range of estimates at the moment, we are split right down the middle. And the reason things have changed is off the back of a report a couple of days ago from Reuters suggesting that people around this decision are going to be looking at forecasts showing CPI next year not above 2%. Above 3% for 2024. Does that change the calculation that this ECB needs to make in 14 minutes?
What's the so what for Americans? And the answer is it's right now a global movable feast. Action in China today on rates. Even Ukraine had a rate adjustment lower as well. And I would suggest what happens in Frankfurt here in 13 minutes, 7 seconds, it does affect Chairman Powell. It does affect America.
I would say this, that Frankfurt is exposed to all the wrong stories in a way that the United States is not. The slowdown in China, the fragility in the energy market. Think about what Europe's exposed to on the energy side at the moment. The United States, thank goodness, has output near all-time highs in America right now for crude. That's the good news. The bad news for Europe, Brent's in the 90s. The euro is weakening. Germany's potentially in recession for the whole of this year based on forecasts we're going to get from the German government. And inflation is sticky high.
Okay, give me Brent intraday here. Lisa, right now Lagarde's looking at her Bloomberg terminal in Frankfurt. She's got the one with the big screens, you know, like 4 screens.
With everybody
and all that. And she's looking at Brent crude, $93.18. Brent is on the move this morning.
They have a very difficult situation right now. And the key question to me is how much of this is a global story and how much is a Europe-specific story? What is the differentiation of inflation in Europe versus the U.S.? Are we seeing disinflation at a time where wages are going up, where services sectors are still sort of leading, but sort of kind of falling off as well in Europe? Right now, it seems like the market is expecting the ECB to get to 4% by the end of this year. Why not go now and then just say we are now done for the foreseeable future, and we are going to see how much damage is being inflicted?
John, Brent crude in euros, we usually don't talk about that, in euros, from the end of June, up 31%, annualized, up 261%. What else do you need?
Nailed it.
Did
This
you
is why
okay
it's
there?
so toxic, Tom. To have
Javier
Brent
Blas
at
taught me to do
93,
that.
the euro at 107, and if Nomura's right, we're going to 105 and it gets worse. This is a mix, the blend you don't want to see at the ECB. Energy prices picking up again, just as the euro starts to weaken again because the economy's not doing well.
Data check. I'm going to go right back to Brent crude here. $93.16, up $1.28. You're going to get a 90 print on NYMEX here in moments.
Totally unchanged on the euro into this decision. 12 minutes away. 107.30 against the dollar. Yields a little bit higher on a 10-year in America, up a single basis point to 425.85. And equities, Tom, elevated through most of this morning. We're up by, let's call it a third of 1% on the S&P.
Right now, and this is an important conversation, all the kids are back in college, and every once in a while you get a kid that goes to school and they do what's called a double major. There's Williams, PP&E, and other schools around America. Wharton's got a wonderful double major in computer and business. And then there's South Bend, Indiana. They pieced together a couple of years ago an economics double major, and one of the outputs of that is Madison Fowler. She joins us now, J.P. Morgan, London investment strategist there. Madison, South Bend, I know, steeped you and steeled you for the cacophony we're in right now. My head is spinning. What will you listen for from Christine Lagarde?
Sure, thank you for having me. I think what's really key to listen for there is, are we going on to more of a hawkish hold, or, is it more of a dovish hike? And I think that's quite important. But I think at the same time, though, even going into this meeting, we did pencil in about one more hike from the ECB for the balance of the rest of this year. And, I think when we think about, is there a debate over whether it's this meeting or whether it's in a future meeting, I think the ECB is very clear that they want to be closing this chapter on rate hikes. But I do think that Lagarde will be really trying to preserve that optionality. And so I do think that she'll be using uncertainty as a tool in order to do that.
Madison, are they confronting stagflation?
I think the risks for stagflation are certainly higher in the euro area than they are in the U.S., for instance. So the ECB is in a tough spot because we've seen growth start to, I think, unwind more quickly than expected. You can see that in the PMI data, especially the services figures, which have decelerated more quickly than anticipated. But at the same time, inflation remains quite high. You have both headline and core prices still above 5% on a year-over-year basis. So that's quite difficult from a policymaker standpoint. We still do think that inflation will continue to cool over the balance of the year as the labor market should hopefully cool. We are seeing a rise in some of the unemployment numbers. But yes, to your point, the stagflation risks are certainly higher.
They're set to forecast inflation above 3% for 2024. Madison, do you see it coming below that by year-end next year?
I think it's difficult. I certainly think that if you don't see inflation fall more quickly, I think the conversation is certainly going to switch into how long does the ECB need to hold interest rates at this really elevated level for. And from that perspective, I think it's really difficult to see the ECB starting to cut rates really at all in 2024 until you start to see that inflation number start to move lower.
That said, there was something that Mark McCormick of TD Securities said, which was highly contrarian, where all of this, yes, higher than expected inflation comes on the heels of stronger growth in Europe than the U.S., which is his prediction. Can you get on board with that?
I think it's harder to see higher inflation if growth is weakening in the euro area. So at some point in time, these two things start to reinforce each other. And so if you see growth momentum continue to weaken quite considerably in the euro area like we are today, at some point in time, I think you do have to think that inflation is going to follow. It's just going to take, I think, a little bit longer than people were otherwise anticipating.
So do you think that right now what we're going to hear from the ECB, from Christine Lagarde, is patience? Are we going to hear this sense that you can wait and you can see how things progress and maybe just pull a Jerome Powell and basically hint that it's okay if it takes until 2026 to get inflation down to 2%?
Yes, I think that's fair. I think that's part of the reason why they're using uncertainty as a tool in order to preserve that optionality of doing that. But I think so long as they are seeing continued progress towards, moving towards those goals, I think that's a positive indicator. And I do think we also need to keep in mind that the ECB is a single mandate central bank with price stability, that 2% inflation goal, really important to them.
Away from the ECB remit, Madison, I'm fascinated by the JP Morgan position in the continent of Europe and the United Kingdom as well. Do you find U.S. equities relatively attractive right now from your desk in London?
I think in the short term, yes. I will take a step back. At the start of the year, we did come in with a view for European equities to outperform the U.S. from a broad market basis, and I think that did track. But as the euro area economy started to slow, as we saw momentum shift, we, I think, transitioned that call away from the European broad market and more so into European national champions, which are companies that are based in Europe, but multinational companies that are leaders of their industries and are still demonstrating a degree of pricing power. So I think it's more about where in Europe you're really focusing rather than a U.S. versus Europe conversation.
She has the chat so down. If you say something tracked, that means you sort of kind of like got it right. That tracked.
I think Novo Nordisk. When I hear her talking about those themes. Madison, thank you. Madison Fuller there of JP Morgan Investment Bank. With us around the table, I'm pleased to say, going into this rate decision from the ECB, Eric Nelson, macro strategist at Wells Fargo. Good morning to you, Eric. Rate hike or no rate hike from this ECB in 5 minutes' time?
We think it's a pause, John. Obviously, finally balanced, and we had the Reuters decision the Reuters report earlier this week. I would not say that this is something that I'm fully buying into as a signal of what the committee is actually going to do. And look at the speech from Schnabel a couple weeks ago. I thought that was actually pretty balanced. I think if she really wanted to push for a hike, she would have. And I think she's probably the most prominent hawk on the committee at this point.
So question. Forgive me for asking this because we don't really know the answer, but why do you think they leaked it? What do you think the purpose of doing that was?
The question is, who's they, John? Was it a rogue hawk or two who wanted to push for a hike and push pricing, or was it, the overall committee? And that's what we really don't know.
There is this question, though, of whether they're going to emphasize patience or whether they're going to emphasize their primary mandate, at least in name, which is inflation. What would be the justification for a pause, given that inflation really hasn't come in as much as they expected, especially if they increase their inflation forecast for next year?
Yeah, this is challenging optics, right, Lisa? I think you have to look at not just the growth situation, but also the pace of hikes. Right, they've done a lot of tightening, almost 500 basis points, 450 basis points or so. They've come from negative territory. So I think even just skipping here is justifiable, even with inflation where it is, given the growth outlook. The question is, how do you communicate a pause?
I mean, we just got moments ago West Texas Intermediate through $90 a barrel. The Eric Nelson rally in Brent continues. We're at $93.27 as well. What's the so what here for Americans? You've got great perspective on this. Why do Americans care about Europe in a monetary and not even having a combined fiscal policy mess?
Yeah, I mean, certainly it's a massively important economy in a broad global scheme. But I think if you look at the sort of the policy outlook here, right? I mean, you have the ECB having done almost 450 basis points, and you really are seeing a spillover into the economy, the real economy now, the credit conditions. The question is this something we should be thinking about for the U.S. as well? And you look at lending standards, you look at lending conditions in the U.S., you are starting to see some transmission of policy.
John, anecdote as we await for the ECB decision. A hotel in Paris,
now.
A hotel in Paris. 480.
Oh boy.
And then the demand of it is now 800, and I just looked, and it's just under $1,300.
It's getting expensive.
Dollars for the same damn room I stayed in at 480 not that long ago.
That's the foreign demand.
That's the American madness about Europe that
Let's
colors
talk
us.
about domestic demand. Can domestic demand in Europe hold up? Look at where the euro is. Look at where crude's trading right now. The euro's at 107. Some people, Nomura, call him 105. Crude's through 90, WTI through 93 on Brent. Surely that higher energy price, that weaker euro, it's just brutal for the Europeans at the moment.
It's a nasty mix, John. I think the question, and back to Lisa, you brought this up with Mark McCormick's comment about relative growth. The question is not so much obviously you want to know what's happening in domestic demand in Europe and, on an isolated basis, but on a relative basis. Can the U.S. recession be deeper than Europeans' recession in the first half of next year? That's certainly possible. From a real policy rate standpoint, can the Fed cut more than the ECB next year? I think absolutely. So that euro, dollar story can turn as we get toward the ends of the year. But right now, where I'm sitting, it looks pretty negative for the euro.
So 105 in sight for you next couple of months?
I think 105, 106 is where we head.
But for next year, what are you thinking about?
I think we can see a rebound back toward 110.
Okay. It's a pretty tight range, though, isn't it? 105, 110?
Yeah, but these guys do. They play 2 pennies. You
side.
and I are looking at big decisions.
I wanted some big numbers, Tom. 115, 120. Here's your guide for the next 45 minutes or so. In about 2 minutes, an ECB rate decision. 15 minutes after that decision, some data in America. US retail sales, PPI, jobless claims. Jobless claims last week, the lowest we've seen going all the way back to February. They've come down, down, down over the last month.
And they model it back a survey from what, 216 back to 225?
Still exceptionally
Do they just guess that? Is that like a dartboard guess? How do you do that?
TK, without a doubt, Bramo, we do call that a guess, don't we?
We always do. I mean, honestly, this is just basically a rough estimate, which is the reason why nobody really trades on it that much, unless they do, in which case, if it comes out surprising. I think retail sales might be the most important event, though, of the day.
I heard people say that in anticipation of CPI. That maybe more than CPI, retail sales was like the data point of the week.
100%. Couldn't agree more.
The countdown clock says we're selling the ECB nut right now. We sell retail sales after.
It's related.
I was trying to do that.
It's actually related, though.
I was going through the clock, Tom, the next hour, and then you'd wanted to talk about claims and all that good stuff. So the ECB in 30 seconds, data after that. After we get that data at 8:30 Eastern, I'm going to complete this. 15 minutes after that data, you get a news conference with President Christine Lagarde. Going into this rate decision from the ECB, we're split right down the middle. No hike or hike. You take a guess at home. Going into it, the euro looks a little something like this on euro dollar. At the moment, we're at 107.31. We are totally unchanged on the session as we anticipate this rate call from the ECB. I'm looking at the German curve with yields coming in a basis point point or two right across the curve. The 2-year in Germany at about 3.15. The 10-year in Germany down about a basis point. There is your rate hike from the ECB. They come in with a 25 basis point move. We go from 3.75 on the depot rate to 4%. On the marginal lending facility, we go from 4.50 to 4.75. On the main refinancing rate, we go from 4.25 to 4.50. It is a 25 basis point rate hike from the European Central Bank. We were split right down the middle on no hike or hike. We get that hike. The euro looks a little something like this, actually dropping and weaker against the dollar, 107.10. We're negative here, Lisa, by 0.2%.
Seeing inflation this year at 5.6% versus the prior forecast of 5.4%. The key here will be communication at this point. Is this the last one? Is this going to be Christine Lagarde coming out and saying, this is it, we're now going to wait? And that might be a cleaner message than a hawkish pause.
The call for 2025, they see inflation slowing to 2.1% in 2025. So, Tom, what we've got here is a 25 basis point hike and a ton of estimates as well. The growth estimate for GDP, Tom, for 2023,
there it is,
0.7%. The previous forecast, 0.9.
Lawrence Summers walked by me yesterday in our acclaimed food court. We you enjoyed greetings, and this is a Larry Summers report, and the basic idea here is inflation. No, the growthiness of this will be on the data screen in 10 minutes.
We've got Maria Tadeo alongside us in Frankfurt, Germany, inside the headquarters. I just want to share with you the lead paragraph from the statement. Inflation continues to decline, but is still expected to remain too high for too long. The Governing Council is determined to ensure that inflation returns to its 2% medium-term target in a timely manner. In order to reinforce progress towards its target, the Governing Council today decided to raise 3 key ECB interest rates by 25 basis points. Maria Tadeo from Frankfurt joins us right now. Maria, what stands out for you?
Well, Jonathan, it is a hike, which, as you see, there had been a lot of volatility in market sentiment. But of course, it was that report that came out by Reuters. Then Bloomberg confirmed it, that the European Central Bank saw inflation actually spiking next year in 2024. And that was a crucial year, Jonathan, when it comes to the transmission. The entire decision, and we talked about this many times, hinged around the idea of transmission. If you believe transmission was strong enough, you could pause. If you believe it had not, then there was a case to make this rate hike. I think, to me, it also makes sense because, Jonathan, when you come out with a report like that 48 hours before a decision, you completely change sentiment in the market and provide this platform for a hike. Today would have been a massive U-turn not to hike. The other thing to me that is interesting now, beyond the actual decision, but the language, is that they reinsert this idea that the European Central Bank will maintain sufficiently restricted levels when it comes to their monetary policy. Again, it is always a balancing act. They hike. It sounds hawkish. I wonder, though, in this press conference, how is Madame Lagarde going to balance it out with an economy that clearly is now in a downturn, and they're hiking into this downturn. And it's not just Germany and manufacturing. We should make that clear. It is now spreading across the euro area, and it's also now spreading into services. So it is an economy that is weaker. And this is a nightmare scenario they said they wanted to avoid, by the way, when they started hiking into a downturn.
The elephant in the room right now is the energy story. Maria, I'm just working through the forecast in their statement, so let me share it with our audience. The September ECB staff macroeconomic projections for the euro area see average inflation of 5.6% in 2023, 3.2% in 2024, 2.1% in 2025. An upward revision for 23-24, downward revision for 25. And as they point out, the upward revision for this year and next year mainly reflects a higher path for energy prices. How much of this is about domestic price pressure, and how much of it is about just being exposed to this higher energy story?
Well, look, this is a complicated picture for the European Union, because we know it's not just the energy prices now, which have dropped dramatically and significantly, but it really is the second round effects, the repercussions on the fallout that is done for the European industry. Again, you're at the mercy of a complicated energy space for the European Union, and they're very clear that as long as the war in Ukraine continues, and I am sure she's going to reference this war, they are facing a volatile scenario. The other issue, of course, that features into the energy story is the implications for growth. Again, they're cutting their growth projections, which again should not be a surprise, because you had Paolo Gentiloni on the show, and he already did that and cut their their forecast for growth. The question is whether we're heading into stagflation or not. That is a word that, for the time being, everyone wants to avoid.
Well, Maria, you're living this viscerally. I mean, you're really, really steeped in this. Dovetail the growth forecast markdown, essentially a run rate of 1% to be charitable for 36 months, with oil at $93 a barrel. It doesn't compute. To me, the inflation story's almost been pushed aside.
Because the growth picture is bleaker. And again, that was the whole argument, Tom, and you make a good point as to why this market was split. And not just the market, but really the governing council going into this meeting, again, suggesting this is an economy that is weaker. There is obviously a downturn that is manifesting. And of course, this is a single mandate central bank, but it doesn't operate into oblivion. It does it in a way where obviously the economic perspective matters. And again, it goes back to this idea and some of the criticism of the ECB, I should point, from a number of countries that they missed an early window to hike. Then obviously inflation was not a one-off, but it was entrenched now in this economy. And now they find themselves in a situation where the prospects for growth are challenging. They're difficult, of course, and you continue to hike. So yes, Tom, it's not just about inflation. I think it's a very fair point to say the economy also featured in this conversation, not so much to tip the balance. Obviously, the European central bank has now gone for this hike. The question, though, is whether she signals this is the last one, precisely because all of the issues that you mentioned.
There's a strong hint of that in the statement. Maria, thank you. Maria Tadeo there in Frankfurt. So this is what you've got. 25 basis point hike. Upward revision to the forecast for headline inflation for this year and next year. Downward revision, actually, for core CPI. The bulk of that, an energy story. A cut to the growth forecast. For every single year, basically. They now expect the Eurozone economy to expand by 0.7% in 23, 1% in 2024, 1.5% in 2025. We're about to get a strong hint of what you may hear in the news conference with Christine Lagarde from the Governing Council for the ECB. This line right here, Tom, based on its current assessment, the Governing Council considers that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Is the ECB telling us they now believe, based on their forecast, they are sufficiently restrictive?
I'm in the camp where you're dead on, and they got a single mandate. I get it. It's a different set of rules than Jerome Powell has. But to me, John, everything has been overwhelmed in our analysis by oil over the, I'll say the last 2 weeks, but frankly, over the last 3 months, let's call it. And the growth forecast, to me, I know it's not what they do. We're not supposed to talk about it. Rates. You know what? They're in recession.
Energy is at the heart of this. The growth outlook is absolutely terrible.
Yeah.
The market at the moment, I think, picks up the scent that they're done. The euro's weaker off the back of it. Break of 107, 106.97. That can change in the news conference, of course. You look across the German curve here, Lisa. Got a move of 5 basis points to the front end. On a 10-year, you're down 6. The 2-year is back to about 3.11. That's the initial knee-jerk reaction off the back of that statement.
Well, it's easy to read the statement that way, also saying that past rate increases continue to be transmitted forcefully. In other words, the rate increases are still acting with some sort of lag.
Eric Nelson, your thoughts on this one?
I think the market's telling the story right now, John. You look at the yen, and it's strengthening pretty meaningfully against the euro. The growth fears here clearly accelerating. To Lisa's point, policy transmission working its way through. And to your point, John, this sounds like they're done. Now we'll have to hear what Lagarde has to say. I think the markets will still be in flux here. But if they communicate this as a one and done, I don't see how the euro rallies here.
How much are they going to try to signal that the inflationary push is entirely from energy, and they've got to be cautious with that? Really lean into that story, given the fact that they actually downgraded, as John was saying, their core expectation for inflation both next year and the year after.
Yeah, I think that's certainly a sensible thing to do. I think that the challenge here, though, is if that's the communication you opt for, then why did you hike today? If the upward inflation revision for 2024 is mostly energy driven, and supposedly you hiked on the back of that, I think you have to balance that communication. So, look, it's a single mandate central bank, but they do have increasingly focused on credit conditions and growth, and I think they're becoming more concerned about things on that side.
Before we got this, you said that you expect it to be sort of in a 106, 105 range for the euro. We're already breaking down from that 107 level, 106.97. Can you revise your forecast based on this preliminarily, just sort of like back of the envelope? Does this make you more bearish on the euro than you were before this announcement?
I do want to hear what Christine Lagarde has to say. But I think if this is a one and done, and the the GDP forecasts are coming down, and this is the way they want to play this, look, maybe you do get a bit of a short squeeze into the next couple days if it's hawkish and there's reason for rates to in the short term at least to move higher, but I continue to want to fade that, and I think the curves will keep flattening, and we'll be back at 106, 105 in a couple days.
With your Johns Hopkins economics, that Keynes was right. When the facts change, Eric Nelson changes. What does this oil and growth matrix of Europe do in the foreign exchange space? To me, we're a place where we weren't 2 weeks ago. Certainly, we're at a place we were not at the end of the summer, call it August.
Yeah, I think part of it, Tom, of course, is the oil story, but also thinking about natural gas prices, right? So,
thank you. Well said,
let's talk about both of those. I mean, on the oil front, it's only gotten worse, and it's probably going to get worse before it gets better. So that's Europe being one of the largest energy importers and oil importers out there. It's going to be another downside risk. But the question is, what happens to gas prices? And storages are still quite full. There's a lot of people worried about European winter and natural gas, and to the extent we see that gas prices actually go the other direction, head lower, could be a bit of an offset to think about.
Let's put a bow on this and just reflect on where we've been over the last 18 months. It's easy to get carried away. We've got a strong suggestion here the ECB might be done. They're going to say they're data dependent. That could change. We may well hear that on repeat from President Lagarde in 20 minutes' time. Did you ever think they'd get to 4% on the depot rate when this all started? I never dreamt of that. I never thought we'd get anywhere near 4%, and here we are.
Absolutely, John. I think I remember back in 2021 and 2022, I think people thought that 1 or 2% would have been, kind of the 2011 moment or the 2008 moment, right? Another farcical hike.
It may well still be.
It's possible. It's possible. But look, this is there's been a lot of tightening done here, and I think you're seeing it really filter through here, more so than you're seeing in other economies, and I think that speaks to the sensitivity and also the level of neutral rates in Europe.
Raises the hard question. We had a decade, the best part of a decade of negative interest rates and QE forever. Are we ever going back? Are we done with that now?
Not for a long time, John. I never say never, but I think the genie's out of the bottle here. I think the question here is, especially if we're looking at even the BOJ is talking about rate hikes, and that tells you where we are.
What a change. What a change. Eric, great to experience it with you. Eric Nelson there of Wells Fargo. If you are just joining us, this is what we've had from the European Central Bank, a 25 basis point hike. We take the deposit rate from 3.75 to 4%. They've upgraded the outlook for inflation for this year, for next. They've actually had to bring in the outlook, take it down for core CPI. All of this, a strong suggestion that driving that headline story is crude prices, it's energy. The growth outlook is absolutely dreadful, but ultimately the next move, TK, sounds like a pause. Looking at this ECB statement that we get this morning, and I'll share that quote with you all again. Based on its current assessment, the Governing Council considers that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Are they done?
I'm going to go back to Keynes. When the facts change, I change. Lagarde has changed. She's not the same Lagarde as at Jackson Hole. Absolutely flat out. The way oil's moved here, the way the Saudis have manipulated the price, she goes up on stage today different than the conversation at Jackson Hole.
She has a free pass to pause, to actually be done now, because this is what the market is expecting, for her to be done. And
She's
this is what the market is processing.
And you're right, the single mandate's overwhelmed.
So at this point, she can come out and say, we want it to be sufficiently restrictive, not maybe in those words, in the not more fanciful words that you just said. We got there, and now we see. Now we wait, and we get a sense of how much this transmission policy is going to work through the system.
And with TK, though, Bramo, you get the feeling that in the last 2-3 weeks, Tom, this energy price move has really encouraged the hawks to go into the Governing Council meeting in the last couple of days and make a change. I'd be interested to see what the thinking was behind this move, because we certainly didn't get a strong guide towards an interest rate hike, Tom, from President Lagarde when you sat with her in Jackson Hole, Wyoming. In no way, shape or form was there any suggestion at all they would sit down and deliver 25 basis points today.
And this is the heart of the matter, and Matt Boesler was great in the Lodge explaining this to me, Patrick Lane and all the rest of it. She wants a more omnibus 60,000 view, a longer-term analysis of what we're going to do. I get it all. Crystals and pyramids, great. That was the name of the speech, and I was honored to speak to her. You know what? oil moved. All of a sudden, it's like Mike Tyson hitting you in the face.
Yeah.
And I'm sorry, this is a different press conference than I expected, sitting there, waving with her at the Elk. Hi, Elk. How you doing?
Everyone's got a plan, Tom, until they...
And that's happening right now. And to Eric's brilliant insight, can that come over to the United States?
You said crude made a move. We're through 90 on WTI a little bit early this morning. The euro with a break of 107 at the moment, 107 flat, negative a third of 1%. The next stop for this story, data in America, retail sales, PPI, initial jobless claims. Mike McKee dropping by to get up to speed on that. Mike McKee, what do you say?
Well, let's forget about Christine Lagarde and what she thinks for a few minutes and think about what the market thinks Jay Powell will think, with retail sales up 0.6% on the month of August. That is significantly higher than the 0.1% that was forecast. Ex-autos up 0.6%. And the retail sales control group, waiting on that one to come in here. Hold on just a second. That's being calculated as we speak. A couple of other numbers. Initial jobless claims, 220,000. Now, we don't know what the revision is yet. It was 216 last week, but it does tell you that we're still in a very low claims environment. Continuing claims are at 1,688,000. PPI has just come in as well. PPI for final demand up 0.7%. That's a significant increase over the 0.3 the prior month and 0.4 expected. If you look at the core, which we look at as ex-food, energy, and trade services, that's up 0.3 compared with a 0.2 rise last time. So we are seeing some inflation pressures at the basic level of the wholesaler. So we are seeing some problems with inflation, but retail sales so far not being affected. Retail sales control up 0.1%. That is a lot less than the 1% last month, but it's better than the 0.1% decline that was forecast. So retail sales strong. Jobless claims are weak, which could be translated as strong. And PPI does show some inflation pressures. You guys check the markets. I'll see what made up the retail sales report.
Mike McKee, thank you. It gets better for America just as it gets worse for Europe. Compare and contrast the front end of the curve in Germany and the United States. The 2-year in Germany, the yield is lower. In America, the 2-year is higher. An upside surprise on retail sales in America off the back of that. Yields up on a 2-year by 5 basis points. We're back through 5% on a 2-year. In the FX market, the euro 106.63. We're negative there by 0.6%. TK, what a mix in the last 15 minutes. Going into President Lagarde in about 13 minutes' time.
DXY, the blended average, I believe it's 54% weighted euro. DXY index, a traditional dollar index, is nicely through 105 and goes out to new highs over the recent number of months. Watching oil, it really hasn't changed off the shock of what we saw in the last hour. And, the bottom line with the news flow here, we just continue. We have retail sales. Michael, give us the control group. And then we got to go to Helene Becker's conversation earlier. Oh, yeah. Meanwhile, back at the races, Ed Bastian wanted to get into the news flow.
Energy at the epicenter of the outlook for inflation in Europe. It's at the epicenter right now for the outlook for the airlines in America. Just to get you up to speed on the latest from Delta, sees third quarter adjusted EPS of a range of 185 to 205. They had seen previously 220 to 250. They still see full year adjusted EPS of $6 to $7. The estimate there, 658, just marginally lower. We had some downgrades to the outlook yesterday from Spirit. We had it from the likes of Delta right now. We've heard it from American as well. It's Delta right in front of us at the moment. You put it all together at the moment, it's all about energy. Higher fuel prices hitting the airlines. In Europe, it's hitting the outlook for inflation. Lisa, in America, just as the ECB comes out 15 minutes ago and downgrades the outlook for growth for every single year, we print a big upside surprise on retail sales in the US.
This is almost the worst case scenario for the euro heading into this. What would have been worse is if the ECB had come out and not hiked rates and said that they were done. Otherwise, basically, this is exactly what people did not want to see. The US outperforming and the European region showing itself as not flat on its back, but something like that. The clarity here to me is that the US economy has enough momentum with the surprising data to the upside again and again to withstand the higher oil prices. Does Europe? And that, to me, is one of the key questions at a time where they're battling both inflation and waning growth.
Yeah, I look at it and it's just a great day for news flow. This is a really key day in the year, John. I mean, it's just,
That's
all
amazing,
the things
TK,
going
yeah.
on. It's amazing. I mean, your head's spinning. There's
Let's
no
put it
other
all
way
together for you.
to put it.
If you are just joining us, I'll do my best to wrap up the last 20
luck with
minutes
that.
or so. 25 basis point hike from the ECB. We were split right down the middle. The outlook for inflation for next year, above 3%. That was widely expected, according to reports we had going into this ECB rate decision. The outlook for core, actually take that in a little bit. The bulk of this move for headline inflation in that forecast is all about this move in energy. And that contributes to this downgrade to the outlook in the third quarter for Delta. Then we get the US data. US data surprising to the upside. Retail sales strong, headline 0.6%. The control group, plug that into GDP, positive 0.1% for the month of August. The estimate, negative 0.1. So things better in America, worse in Europe, and they might have to stop raising interest rates because the growth profile is absolutely terrible. Yields are up on a 2-year in the States by 5 basis points and back through 5%. In Germany, the 2-year is lower by 3 basis points. So yields up stateside, yields down in Germany. What does that mean? Stronger dollar, weaker euro, break of 107 in the last 15 minutes, 106.66. All the wrong numbers over in Europe right now, TK. That currency pair down 0.6%. And it's up to President Lagarde to pick the message in about 10 minutes' time.
We're going to see that from Christine Lagarde. We welcome all of you on Bloomberg Television and Bloomberg Radio. And this is a great honor. Just as a small aside, I was with John Riding when we learned of the Madoff scandal. Far before that, he wrote essays in economics that synthesized his Bank of England, his Fed, long ago at Bear Stearns and now at Breen Capital. And to have John Riding with us on this historic moment for the ECB is an honor. John, one of your great, great essays was the putting green of the Fed. Is Christine Lagarde on the golf course? And does Christine Lagarde have any clue where the pin is on the green?
Well, Tom, thank you for referring back to a note that I think goes back to 2004, maybe earlier, so no one knows what we're talking about. The idea
That's why the show's so popular.
The idea was, back at the time, the Fed was making very small moves in raising rates, and Bernanke was talking about lagging the putts, but I was saying that, are they even on the fairway? Because they were so far from neutral. Now, this is a very different story. We are clearly on the putting green. We're certainly on the putting green in the U.S., and maybe it's a gimme come next week. Some of these inflation numbers, a little bit of a warning with CPI yesterday and PPI today.
You live this. You live this at Bank of America. Yeah. They invented the ECB. Duisenberg came in. Trichet, John screwed up. Is that the proper answer?
Had a couple of difficult moments in 08 and 2011.
This is an historic moment for Lagarde this morning. You say she's on the putting green?
No, I said the Fed was clearly on the putting green, and maybe it's a gimme. The ECB, I still think, is probably a chip shot away from the putting green, but they're not driving off. They made a huge adjustment, but inflation in the Eurozone's 5.3%, projected to go higher. It's still significantly above the policy rate, so they have negative real rates. Now, I know that rate hikes can't do anything about oil prices. Rate hikes can't make the winter milder in Europe and ease any potential gas situation. But a mistake that was made in 2021 by central banks around the world was in allowing supply chain issues, energy price issues, then war in the Ukraine issues to filter in to the broader price-setting behavior. And that's what central banks have to push back against. I think the Fed so far has done a pretty good job. I think the ECB isn't quite there yet. Well, and I think they have to be very careful not to tell the markets that they're there and that this is the last rate hike, because what do markets do when you think you've got the last rate hike is you look for the first rate cut, and that's way too premature. Just a word on those retail sales. Not quite as strong as you think, because I believe there was a downward revision to the July increase in the control group from 1% to 0.7%. I don't know what the June issue was, revision might have been, but the U.S. consumer is strong. In the third quarter, GDP now was 4%. I don't think it's probably going to, for consumers, real consumer spending, I don't think it's going to change very much on that, the Atlanta Fed's estimate. It's not that the U.S. is roaring. It isn't. But it isn't yet falling into recession, perhaps unlike the Eurozone, given the size of the interest rate adjustments.
Is the big takeaway here that the central banks are almost done, or pretty much done, and now we have to look at the underlying economy and how strong the economies are, and that Europe is not nearly as strong as the U.S., cannot withstand the oil price shock that might be coming down the pike, and thus is in a worse position with the euro set to fall?
Well, I think the Eurozone is in a worse position, and then you have fiscal issues in a number of countries. There was some brief mention of Japan. I would say that Japan is in an even worse position because they haven't even begun to consider hiking rates yet. And yet they've got an underlying inflation rate that continues to go higher and is above 4%. So if the U.S. is much better placed than the Eurozone, which is, as I said, maybe it's a chip shot away from the green of monetary neutrality, but the Bank of Japan's still in the clubhouse.
They're in the bunker, the ball's plugged. It's so much worse than you're describing. Surely, in Europe right now, they've had to downgrade the growth outlook. They've had to upgrade the inflation outlook. They're basically doing their best to signal the pause without signaling a pause. Do you sense any decisiveness out of this governing council whatsoever this morning?
I don't know. We'll have to listen to the press conference and the questions and see where that goes. But let me just go back. Back in 2021, maybe even in 2020, when all of these extraordinary efforts during the pandemic and much needed were being done, I warned multiple times that if you do too much or you don't pull it back soon enough, you're going to end with an inflation problem. So the consequences of what we're seeing now isn't the consequence of the ECB hiking to 4.5% from negative rates. It's that they left those rates there too long, as the Fed did. But the Fed did a better job of catching up. And that puts them in a better position now. I think the ECB still has a little bit of catching up to do. And yes, there's probably a recession out there, may well be in recession, but you know, it's like omelets and eggs.
I got to squeeze this in. John's going to go to Lagarde here in 3 minutes, so we got about a minute and a half for a killer question for our audience. You nailed that we would have higher inflation. It took a while to get here, and maybe the path was stranger than we thought, but you nailed that we would get to this point. Should our listeners and viewers be afraid of the new rate environment, or can America adapt and prosper in this rate environment?
I think after the adjustment, America can adapt. I don't think we're going back to the very low interest rates that we had pre-pandemic. You just look at the housing market. You've got a 7.5% mortgage rate. And I bet if you ask most people a couple of years ago, mortgage rates were 7.5%, what would the housing market be doing? No, I don't think anyone would have imagined it could be as strong as it currently is. Now, that's not to imply everything's rosy. And I still think the U.S. faces a recession in 2024, but the glide path to that is so much stretched out because of all the cumulative excesses. The large number of jobs, 1.4 jobs still for every vacancies for every job seeker. Still a little bit of excess savings from the pandemic, but that's mostly worn down. It's a very, very long glide path. And I just think people might let the guard down a little bit too soon on the recession chances as some firms have,
Interesting.
I think, for 24.
Okay. John, I don't remember the last time we had a 20 minutes like the one we've just had, Tom. Last 25 minutes or so.
This is a huge
Incredible,
deal.
right?
It's a huge deal. Yeah.
Tons of economic data stateside. Want to get back over to Mike McKee just for a second look at the data we had in America, Mike. Big upside surprise on retail sales.
And an upside surprise on PPI, and both of those attributable to oil. You guys nailed it at about 8:28 this morning, just before we got the data. Oil prices driving this up. Gasoline station sales up 5.2% in the month of August compared to just 0.1% in the month of July. We did see in retail sales a number of things that point to pretty much normality, including a 9/10 rise for the second month in a row in clothing and a 5/10 rise in health and personal care. So people got their haircut, they bought new school clothes. It was a typical back-to-school season. The other thing in PPI, it's a 2% rise in the price of goods, which the Labor Department attributes to oil prices. 60% of that rise to oil prices. So PPI being pushed up by oil, and so are jobs, so are retail sales, rather. The jobs numbers, 220 for jobless claims last week, revised to 217. So a slight rise, but still historically low. So at this point, it is hard to see a lot of bad news other than energy in these reports this morning.
Mike McKee, thank you, sir. As Lisa mentioned privately in the chat a little bit earlier, 1-2 punch for the euro right now. Data great in America. In Europe, I've got no idea what the outlook is. For inflation, it's higher on headline, at least. For growth, it's lower. The euro, a break of 107, 106.81, as we anticipate that news conference beginning with ECB President Christine Lagarde.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
It doesn't look like we've got a major issue with the economy at the moment. The economy's been relatively resilient.
Central banks have carved out in the last 6 to 9 months a focus on core inflation.
2024 should be a better year for earnings with the market.
We are seeing inflation coming back down towards where the Fed would like it to be.
In the end, higher for longer means there's going to be further tightening here in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The week begins right now, live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is positive by 0.2% on the S&P 500. Hours away, TK, from Chairman Powell and that news conference.
And it's a different news conference than it was a couple days ago. Between the United Kingdom inflation coming in a little bit, I love what Paul Krugman said. We'll talk about Krugman's essay on disinflation here in a moment, but it's a changed outlook to the press conference than it was even 48 hours ago.
I'm told that it's a coin flip going into the Bank of England tomorrow. I will say this, 7, it's not 7, it's 6. Bramo, does that make a difference to you? The good news is it's not 7. The bad news, it's still 6% inflation in the UK.
The idea here is UK inflation did come in softer than expected. This is a positive, but how much of a positive? And you raise a good point. To me, the key distinction here is that the core measure actually came in much more than expected. So stripping out food and energy. How much are we going to be talking about the difference between core and all in, what you feel when you go to the store?
Oh, that's going to be a theme today. I mean, we're there. We're there where we're slicing and dicing like David Rosenberg, what you do with inflation, disinflation, maybe parts of the world deflation. But the central bank story to me is they're completely data dependent, and that's what you're going to hear from the chairman today.
And this market is running with higher for longer, that's for sure. Cycle highs on a 10-year yield in the last 24 hours, Lisa. New cycle highs going into this Fed decision. Crude at around 95 on Brent. We pulled back a little bit on WTI, but we're right there on crude. So the headline versus core conversation, how do they navigate that a little bit later in the news conference?
I'm not sure, because if you take a look at goods inflation, it's starting to reignite. And so at a certain point, oil feeds into that. The question to me is, how much is it being driven by demand? Can you be bullish on oil without being bullish on the economy, right? I mean, basically, aren't you seeing the kind of growth, which is the reason why people say, look, yes, yields are going higher. Yes, oil is going higher, but it is doing so because there is that demand, because there is that strength.
The heart of the matter, and to start strong today with Ben Laidler, I think says so much about how the gloom crew has gotten it wrong, is there's a resiliency to corporations, to market participants of working in a new interest rate environment. First thing I looked at this morning, John, the 10-year real interest rate, it's at that 1.9x level. To go through 2% is going to be a change agent if we see that this afternoon.
Are you throwing shade at Bramo?
And Bramo.
No, I'm not throwing shade at
it.
I just, you talk about disinflation, John. You don't see it on radio here, but behind John, John, I'm looking over at St. Paul's behind you, and there was inflation in the crumbs that they were serving tuppence a bag.
Right? Is that what you saw this morning?
I pulled out the farthing, and the farthing didn't go as far as they used to go.
Before we get deep in that nonsense, let's talk about a headline that came out in the last 24 hours. Amazon, holiday hiring. Bramo, 250,000 logistic workers. Pre-pandemic, that number was 200K. What was the number last year?
150,000.
It's getting better, right?
To me, this is actually really important. And there are people who say, well, actually, this is because more of the shopping is going online. Ironically, maybe people don't want to drive because gas is getting expensive. But either way, you're looking at a robust projection for a holiday season at a time where people are worried about that savings cushion supposedly going away. Where is that? It still seems to be there. If Amazon is hiring that many more workers and offering $1,000 to $3,000 bonuses.
So do the UAW workers double dip? Do they go over there and move boxes around while they wait for
I'm not sure
Detroit?
That's how it works, TK. We'll get you the latest update on the UAW negotiations a little bit later this hour. Let's turn to the price action on the S&P 500 this morning. And good morning to you, up by 0.2% on the S&P. Yields pulling back just a little bit. We're down 2 basis points on a 10-year to 4.34, but had a little look at cycle highs in the last 24 hours. And Lisa, if you want to blame something, I guess the move started after Canadian CPI.
Yes.
This was down to Canada, apparently, in yesterday's session.
And it came in lower than expected, kind of similar to what we're seeing in the UK. Today, the focus really is going to be on that 2 p.m. FOMC rate decision, followed by Fed Chair Jay Powell giving that press conference. The forward look, the statement of economic predictions, the dots. The concept there is what people are really going to be watching. A hawkish pause. God, we're going to have to be talking about that in the band that Tom created in high school today.
Is this 6:30 p.m. tonight? Are we into the surveillance sleep, or are we doing this?
We're doing this. We're going to be here.
Yeah, my people haven't told me.
A Fed special is happening.
1:30 p.m. Eastern or 6:30 p.m. British time. Meanwhile, today, Bank of America CFO Alistair Borthwick is going to be speaking around 7:15 a.m. Eastern time at a Bank of America financial CEO conference. JP Morgan CEO Jamie Dimon speaking at the Detroit Economic Club at 1 p.m. I am curious how much they indicate that this strength has further room to go. And the savings cushion, do they push back against that at a time where it seems like people are getting raises and can actually push forward?
I'm interested in the fact it's in Detroit, which is kind of timely, right?
President Dimon, do you think that he's going to be trying to do this?
I'm not saying that. I'm just saying it's a timely conversation,
it is,
given what's happening.
How much is he going to weigh in on this? He's been known to be rather blunt, so it'll be interesting to see whether he comes out. And aftermarket, we do get some earnings, including from FedEx, which has gotten a boost so far this year from Yellow and UPS and some of the union negotiations there. I'm curious what they say about their labor and potential negotiations.
Always important.
Lisa, thank you. Joining us now, Ben Laidler, Global Market Strategist at eToro. Ben Laidler, constructive on this equity market. Max Kettner, HSBC, sat in your seat yesterday. He said we need to think about what could go right next year. You're the master of what could go right. What could go right?
Wow, you want me to give you the whole list?
Is it that long?
Listen, we're living sort of Goldilocks macro, right? I mean, growth is a lot better than we thought it was, and core inflation, it continues to fall, and I'm pretty comfortable that that's going to continue. That has taken the biggest risk off the table, which I think has given the rally you've seen this year, which is that the Fed was going to have to keep hiking whilst inflation was sticky and sort of drive us into recession. That's now gone, and the earnings cycle is now turning up. And it doesn't have really very much to do with the real economy. It's very tech-led. Inflation is now falling enough to take the pressure off profit margins. And probably the third and least important one is that the economy is sort of hanging in there. So looking forward to next year, which I think is going to drive this sort of fourth quarter rally, is return to double-digit earnings growth, and the Fed and, frankly, the rest of the world beginning to cut interest rates and keeping valuations high.
I want to go back to your process, and he mentions Max Kettner of HSBC yesterday, which I think the dovetail here is really important. You say right now the wall of worry remains high. You are the ultimate anti-gloomster out there. In late 2018, I believe it was, what was your process to push against the wall of worry then? What's the Laidler process to stay bullish and resilient?
You just got to look at what really matters. I mean, there's always a wall of worry by definition. The day there isn't is when we're all just, horrendously complacent and we're about to sort of trip over our feet. But, that wall of worry is huge right now. I mean, we're worried about bond yields at, 4.3, 4.4%. even though we're getting no validation from break-even inflation, we're getting no validation from sort of copper prices. This is classic US sort of exceptionalism. UAW strike, yeah, so a third of US manufacturing is autos, but we probably need a bit of a slowdown right now. And you could say the same about, potentially a government shutdown. It's an unorthodox way to slow the economy, but hey, maybe that's what we need right now.
Okay, everything that you just said, and I specialize in worry, would make me very worried. And I will tell you that person after person has come on this show and displayed an amazing display of lack of worry. Not only that, but you can see, yes, exactly what you're saying. Yields are high, and people have seemed to be shrugging it off, saying that we have already seen the bulk of the effects of monetary policy tightening. So doesn't any of this stuff catch your eye and make you think that maybe we could see some of those lag effects pick back up next year?
Yeah, totally. This is as good as it's going to get for the U.S. economy. I mean, the nowcast, the Atlanta Fed is nearly 5%. Unheard of. That's absolutely going to slow from here. The impact of 5% Fed rates is coming. It's just delayed because, corporates have refinanced and mortgage holders have, 30-year fixed rates. But, it is coming and the slowdown will come, except it's a soft landing. It's not a hard landing.
So are you saying that slowdown has already been priced in, or do you see that actually coming in the prices in certain pockets, albeit not big tech in the U.S.?
I think it's more a sector argument than a market argument. I mean, why am I not jumping into, growth cyclicals to small caps? And the market is sort of nibbling at them, but, they're not running away with you. And I think that's your biggest tell, that the market doesn't think that this growth story is sustainable. This keeps me in sort of long duration. I know some of these long duration assets, have been a tough slog, but, I do believe the underlying pressures of inflation continue to ease. Growth will slow. The laws of economics are not broken. And therefore, stay long tech, stay long bonds, stay long these long duration assets.
To stay out of Europe?
For now. But I think Europe's going to be the surprise next year. I think, Germany is pretty miserable right now and is leading Europe into recession. But give it 6 months and I'm sure we'll all be talking about the German recovery and, how that cyclicality works both ways.
Is that an FX trade or an equity trade?
I think it's probably an equity trade. I think central banks are super interesting. I mean, Bank of England's about to go on hold. That leaves us with 3 of the top 4 central banks in the world on hold, waiting for the cut, which will take a while, but it'll come. And then, this weird outlier in Japan where they haven't even started hiking yet.
That's a story for Friday, TK.
I noticed, and John has been very good on this, for example, the luxury pullback. Bernstein was out today saying in some ratios, luxury is already back to 2008 levels. Have we had a correction, even if it's not a market SPX correction? Have we had in certain sectors substantial enough correction where you say, wow, there's value?
Yeah, we're definitely seeing it. And, the consumer is not sort of homogeneous. I mean, we are seeing, you mentioned Amazon earlier on. People are shopping online. They want to save money, and they're not They're shopping less for luxury. They're shopping less in department stores. They're buying less big ticket, so credit-dependent items. So, there's a lot going on under the surface here. But and you're seeing that play out in luxury. And, LVMH has been dethroned as the biggest stock in Europe.
In the Laidler bubble, what are you hearing from institutions? Are they buying the Laidler optimism, or is everybody under the table at Claridge's hiding out in 40% cash?
I think institutions have been late to this party, have been late to the rally. I think everyone else, whether it's corporates or retail, has been out front or never gave up.
Why is that? Wait, the institutions are the smart guy, right? You told me that, John.
I never said that. They're called the smart money.
Why are they behind?
Good question. You'd have to ask them. But I think sentiment's moved a long way. I don't want to say everyone's bearish, but to the extent people are bearish, it's sort of long-only institutional managers that I think have been very late here. And and one of the reasons I think you got a fourth quarter catch-up, right? I think people look at that year ahead and think, do I really want to be carrying 5% cash?
That's the classic Laidler charm there. Why he's beloved, long only buy side.
So one thing that you said in there, Ben, and this kind of feeds into tomorrow and the Bank of England, you said they're going to be on pause. And that is essentially what people had interpreted with today's lower than expected inflation read. Is that basically what that means? That anything that comes in disappointing, the balance of risks is, oh God, we can't do anything?
I think they're going to do a sort of 25 basis point last insurance hike, and then they're done, right? To your earlier point, I'm not cracking the champagne open that inflation's only at 6% in the UK. That still leaves us with, the highest rates of
I said the same
any
thing.
market we want to be compared to, and the highest inflation of any market we want to be compared to. But, it's a step in the right direction. Markets trade on the incremental data point. They're going to watch and wait, right? Everybody's data dependent. If the numbers, don't come through, then, maybe there's another hike there. But I think the base case is one more hike and they're done.
That's tomorrow's story. Ben Lader, thank you, sir, of eToro. Later on this afternoon, the Federal Reserve. Front page of the business pages here in the United Kingdom. Rishi Sunak, the British Prime Minister, under a little bit of pressure, supposedly because he's about to push out the ban of gasoline vehicles, Tom, back to 2035 instead of 2030. The first question I had this morning, reading the pages, who's next?
Yeah,
it's the reality
totally
check
agree.
for Sunak and for pretty much everybody else. And this transition's going to take longer.
I think it's almost our secondary theme on this Fed Day Wednesday because it's just so important to see the retreat of elites in the United Kingdom. Granted, it's take the x-axis out. I don't see any concept retreat. But you wonder what's behind it if the people still say, you're kidding me.
On a practical level, the policy uncertainty for big auto manufacturers just continues. I mean, Ford came out and said, wait a second, whoa, we're making this huge investment on electric vehicles. You got to stay the course with all of your incentives and your plans. This is a very tricky thing.
Do we want... There's a lot of electric vehicles in London. That's my observation.
They're expensive, Tom. They're expensive.
Yeah. I mean,
how are we having a conversation about a cost of living crisis at the same time as trying to get people to
totally
buy
agree.
67,
I mean, those cabs cost a fortune. Those Chinese cabs made in Coventry.
Patrick Armstrong of Parimi Wealth coming up in the next hour. Your equity market positive from London. Good morning.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
I don't think this one's going to be a major oil spike either. I think we are going to find that the demand responds pretty quickly to these price hikes, and it slows down, and oil prices come back down, not dramatically, but at least they stop going up.
Ed Yardeni Research President weighing in on this crude rally in the commodity market this morning. We're negative 0.8% on Brent. We're down more than 1% on WTI. The call on this program earlier this week, and Rita said of Energy Aspects looking for triple digits in the next couple of months. Equities right now going into that Fed decision shaping up as follows on the S&P 500, positive by 0.2%. Yields a little bit lower, backing away from cycle highs on a 10-year, 434.27. We're down a single basis point. And there's that move in crude, Tom. $90.22.
Maybe back a little bit, $1 or $2 or whatever, but still elevated to say the least. And then there's 18 shades of crude above that, including Brent crude, the global price. Because of time, we're going to get right to this. When Javier Blas walks into a room at some confab of the great and worthy stop. He is encyclopedic on global oil. His book won all sorts of awards, The World for Sale, and he joins us here with his great effort for Bloomberg News. Javier, my book of the year is Robert D. Kaplan, The Loom of Time. It's about the greater Mediterranean on out east to Afghanistan. And the single best chapter in it is Kaplan's huge clarity on the Saudi Arabia we think we know, but it's not the Saudi Arabia of our youth. What does the new Saudi Arabia look like in terms of oil? What is MBS doing on oil that we need to know about?
I think that when you think about the new Saudi Arabia, you could just think about two words that many leaders in Saudi Arabia use today: Saudi first. And that really shapes oil, shapes geopolitics, shapes power, shapes the economy. Every decision they're going to take is going to be thinking about what matters for Saudi Arabia, thinking about Saudi Arabia first. And on that sense, they really want to keep prices as close as they can to $100. They say they don't target oil prices, and well, the truth is they do, of course, target oil prices through supply, demand, and inventories, and they're trying to keep prices as close as $100. That's what is good for Saudi Arabia. That's why it comes Saudi Arabia first. Do you see in all your work, and particularly looking at their marginal desire to stay at $100, that will reduce demand? If we have $8 gasoline, petrol in the United Kingdom, if we have $5 plus petrol in the United States,
does it reduce demand?
It will reduce demand, and obviously it could contribute to higher inflation, higher interest rates, and therefore lower economic growth. So the Saudis are playing a very difficult game of how high they can get without triggering the negative consequences. So far, it has been good for them. Demand seems to be holding. There is a lot of talk about weaker demand, but in the reality, it's like this recession in Wall Street that has been coming for the last couple of years. In reality, demand is fine. We are at 103 million barrels a day. That's an all-time high. Demand has increased year on year by about 2 million barrels a day. That's historically very good. 2024 is a bit of a question mark. The Saudis are running into risk, but so far it's working for them.
Are you suggesting they have a higher tolerance for economic stress abroad now?
I think so. I mean, in the past, the call from the United States will have already been made, and the Saudis will have acted, and it will have not really let the oil price to go much higher than $100. And at the moment, they're just not picking up the phone the way that they used to Washington, because they are putting it all and foremost their national interest first. So yes, I think that if the U.S. is suffering, the Saudis are going to say, well, you need to do something about it, then we can help later.
What do you think underpins that change, that breakdown in that phone call that used to happen between the White House and Riyadh?
I think that above all, the Saudi Arabia needs the money. If MBS, Mohammed bin Salman, the Crown Prince, wants to transform the Saudi economy, he needs the money.
So it's not international politics, this is finance.
I think it's just finance, and I think it's a lot of it is national politics. It's about what the Saudis need. I was in Riyadh earlier this year, and I was in the outskirts of Riyadh. There is a new capital emerging, it's Al Diriyah. There were 60 cranes, construction cranes. That is costing a lot of money to the Saudis.
Which raises a question. If they're really looking for targeting that $100 a barrel, does that mean that oil prices can remain high even without the growth to underpin it? That basically Saudi Arabia will cut production enough to achieve that regardless of the backdrop?
No, I think that the commodity cycle and the economic cycle is always going to play a role. And if the global economy weakens next year, then the Saudis are going to have to accept lower oil prices. They already cut production significantly this year. They are producing 9 million barrels a day, which is relatively low for historical standards, at least for the last 10 years for the Saudis. And that in part was to accommodate a huge increase in Iranian production, very quietly, not making much noise. But Iran is this year the second largest source of incremental oil supply into the market. So the Saudis have accommodated that. They cut production. I don't think that they can continue cutting production even deeper into 2024 if the global economy weakens. But certainly they are going to try to keep oil prices as close as $100 as they can. And let's not forget, for Saudi Arabia on Arab Light, which is the benchmark that they care, the price is already at $100.
There's also a question about other areas of production, in particular the U.S., which has been serving up a record amount of production. There has been question about how much that can increase. How much is that a swing factor that could materially alter the price going forward? It
is a massive swing factor. We have seen at the moment that the price of WTI, West Texas Intermediate, has gone above $90. We have beginning to see an increase in the rig count in the United States, but clearly there is a question mark whether we are going to see more U.S. production. At the moment, what we are beginning to see is a plateau.
Javier, I want to be very quick here. We're in Davos, the great and worthy were assembled. Javier Blas walks in, the room falls silent. At the table next to you is Savita Subramanian of Bank of America. Folks, she lifts her S&P call today. Subramanian was ordered by Brian Moynihan to do ESG. She did brilliant mathematics on ESG. Is there a new ESG? When you see Sunak in London capitulate, when you see what happened at British Petroleum, is there a new ESG out there?
I think that we saw peak ESG about 18 months ago. I call it a bit the ESG bubble, and reality is starting to sink in. We have seen Prime Minister Sunak watering some of the commitments on net zero. And I think that we are going to begin to see more leaders. It's difficult to meet net zero. It's going to be costly. The easy part, the low-hanging fruit, has been done. Until now, it was all win-win. It was green and cheaper. Now it's just more difficult. It's a lot of trade-offs. It's going to be green, but a bit more expensive. And we have not yet had that conversation with the voters. We said to everyone that this was great. It was going to save the climate and bring prices down. Now it's a much different conversation. I'm not saying it's wrong, but it's a different conversation.
It's changed big time. The question I asked this morning, Javier, who's next? Who's going to push out some of these targets?
I think that we have already seen Japan within the G7, and I think that Germany and France are really on the fence.
Yeah, Javier Blas of Bloomberg. Javier, thank you. Just some news coming out of the UK. This from Goldman. UK interest rates have peaked. Their line reads as follows. The BOE likely to keep rates on hold tomorrow. Consensus for tomorrow was a hike from the Bank of England, 25 basis points. We spoke to one guest who suggested you get a hot print, they might be going to 50. Maybe now, Lisa, after that downside surprise, this Bank of England backs away. That's the call Goldman is making this morning.
Which is the reason why the pound is softer versus the dollar. But if you think about it, this is kind of counterintuitive, because if you think inflation is actually coming down, shouldn't it be stronger if that actually gives more of a pass? I mean, this is where the currency differentials are really kind of raising some questions.
I guess this morning, at least, the explanation is you lose some of that rate support. You've got the two-year yield down by about 13 basis points, Tom, and sterling weaker off the back of it.
Yeah, and some of the forecasts out, you follow more than I do, John, because you're paid in sterling and you really care about it. But the answer is we're down to 120, and we had somebody the other day. We had somebody the other day talk parity. You turned white.
Parity on euro dollar, not on pound sterling against the US dollar. Yeah.
I mixed my pairs.
Different.
Thank you.
Different currency pair, TK. Alsa Linios will straighten things out of RBC on the FX market. Alsa's going to be joining us next. Your equity market more broadly on the S&P, positive here by 0.2%. Your Federal Reserve decision a little bit later for the Bank of England tomorrow. Goldman Sachs says no hike.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
New price target at Bank of America, 4,600. Savita Subramaniam, the upgrade, up from 4,300. Right now, equity futures positive by 0.1%. More on that upgrade a little bit later. On the Nasdaq futures positive here by 0.14%. A sleepy, snoozy start to the week. Several central bank decisions coming up a little bit later. The Federal Reserve this afternoon. Bank of England tomorrow. A feeling that things have changed over at the BOE, given that inflation print a little bit earlier this morning. Goldman first out the gate to say we are done. No hike coming tomorrow morning. More on that a little bit later as well. Let's turn to the bond market. 2-year, 10-year, 30-year. 2-year yield in America in the Treasury market still north of 5% and very close to cycle highs. On a closing basis, a new closing high, a new cycle high on a 10-year, just short of that now, down about a basis point or two to 434.27. I just want to finish on foreign exchange, turn to the euro just briefly. The euro shaping up as follows against the dollar, 107 and positive by 0.2%. That's the cross-asset price action under surveillance this morning. The Fed expected to hold rates at today's 2 p.m. Eastern decision. However, investors waiting on clues from the so-called dot plot and economic projections as a tight labour market and crude prices add to inflation pressures. Chair Powell's news conference kicks off at 2:30. Our coverage begins at 1:30. Might as well bring you the lineup. Stacked show, TK. Kathy Jones, Charles Schwab, Matt Lazzetti, Deutsche Bank, Diane Swank, KPMG, Citi's Andrew Hollenhorst, Citi, alongside Mike Gapin at Bank of America, believe. We've got one more to come here, and that one more comes in November.
What's important here is some real eclectic calls, not only on the real economy, but also on the rate guess that everybody's making. I'm fascinated, as you mentioned, Subramanian in the equity market, how people are amending, and directionally to see Hollenhorst come in would be important. We haven't seen that yet.
Let's turn to UK inflation, falling to the lowest level in 18 months ahead of the BOE decision on Thursday. CPI coming in at 6.7% year over year versus the 7% expected. Sterling weakening to the lowest level since May as traders pare back hike bets. And that paring back of hiking bets, Tom, goes to Goldman Sachs. Goldman say we've peaked. Goldman say no hike tomorrow.
For our U.S. audience, what's important here is to triangulate. And like euro-yen, we across the pond have you triangulate to euro sterling. They're both weak versus the U.S. and that tug of war. How does that play out, John? You follow this day to day.
So Lisa raised this question, and I think it's a really important question. should sterling be rallying off the back of no more hikes, given that we might not damage growth anymore? And I don't think the answer to that is as obvious as you think. This morning, it's fairly intuitive. You lose some of that rate support, the front end of the curve rallies. We're seeing that in the UK 2-year, and sterling weakens off the back of it. But do we have a better outlook for growth off the back of a Bank of England, Tom, that might be done?
This is the ambiguities. And, you know, Matt Luzetti, just as one example, with us this afternoon on our coverage, he said, yeah, there's going to be a slowdown, but his brilliant call was to push it out from his original call. He said, this is out a long way out, and we're still waiting, and we've been wrong on a UK slowdown. You look at something like the GDP input to Newcastle of that game last night.
I'm not talking
and
about
that moves
that game
the needle
last night.
up.
There will be no conversation about that
There'll
game
be no
last night. We're done with that.
What else
did you
do
get
we
any
have?
Instacart shares? Did you get any shares?
No, I did not. You got your
Okay.
usual 8,000.
Instacart easing in this morning's trading after gaining as much as 12% in Tuesday's debut. The IPO raising $660 million, marking the year's fourth biggest public offering in the United States. Semiconductor designer ARM raising $5.2 billion last week in the biggest listing of the year. Can you take any signal from this, TK? These two listings we've had in the past week?
I believe it was Zero Hedge. Had great charts last night. ARM goes up, enthusiasm rolls over, and it sells back to the initial opening price. And for both of these companies, very different. You know what it's about? The first conference call. That's really what this is about. You get away from the hoopla, and you get out the first call, second call, third call. And then
those quarterly earnings.
Yeah, quarterly earnings.
Like the questions from the analysts.
Do you think they understand they've got to go on the phone and explain what's going on?
I think ARM understands that. Instacart might have to figure that out.
Yeah.
ARM's got a history of doing that, Tom, as you know.
That. We are having fun today. It's an extended day for us here in London. It's been wonderful. Our team's put together a great eclectic set of voices for you to frame out, well, the path to 2024. Elsa Lingos is hugely qualified. Global head of foreign exchange strategy at RBC, tour of duty, working in Europe with different institutions to look at the political economics of the moment as well. You know, to you, I can say, like, what's Euro going to do, or what's sterling going to do? What are they going to do if they actually get disinflation? Can you call a disinflationary trend in place yet?
Too soon for that, but I do think this morning's CPI data will be very welcome news from the Bank of England perspective, because they'll feel like finally their policy measures are biting and they're removing some of that tail risk of stagflation.
How many months or quarters do you need to establish a disinflationary trend? Not the data dependency, the media's focus on one surgical point, but what's your timeline to say trend in place?
Well, I think it's also the composition of inflation, right? Because we've seen headline inflation come off on energy prices. In fact, if anything, now ticking back up again, as we saw yesterday in Canada. So really what we're focusing on is that core measure, or even more so the super core measure. What's happening to those demand-driven components of inflation? And are those weakening enough to signify that we're going to get to target?
And Paul Krugman with a brilliant essay out, folks, wheelhouse for the Nobel laureate on trends. He looks at disinflation, and I love what he says about plain vanilla inflation. John Farrell's family in England is living plain vanilla 6% plus inflation. Do people like you and these elites, do they look at plain vanilla inflation?
I mean, you see plain vanilla inflation across the board, right? And I think that's the important part about the current rise in energy prices. Because for all that central banks like to look through those and focus on core inflation, if headline inflation goes up, comes down a bit, goes up again because oil prices or commodity prices don't really come off, what does that mean to your average consumer? Their kind of lived experience is that prices just keep going up.
I can't believe we're sitting here and we've got this note from not the Bank of England, from the Goldman Sachs team on the Bank of England, suggesting we're done here when inflation is in the high sixes. Can you make sense of that for our audience? If we were in the high sixes in the United States, we'd be talking about the prospect of a 50 basis point hike from the Federal Reserve this afternoon. Why are we talking about the Bank of England being done with inflation in the high sixes and wage growth pushing 8%?
I think it's the wage growth that's more important, right? Because don't forget, the Bank of England looked through high inflation in the immediate aftermath of the GFC. And there was a long period where Mervyn King was writing regular letters to the Chancellor about inflation being outside the target band, and yet, you know, they were happy to leave it whole near zero. It's that which is the difference. It's the fact that they're happy to look through it if they feel like their policy is working. And I will say this morning's data do make tomorrow's decision much more finely balanced.
Simon French of Panmure Gordon was in your seat yesterday. He suggested that this Bank of England has a communication problem, a credibility issue. Do you agree?
Yeah, it's hard to say they don't. And I think more than anything, it's the inconsistency in the messaging that people struggle with. I mean, sure, this is a particularly difficult time to be forecasting. I think economists have struggled with that on the sell side and the buy side. But from the Bank of England's perspective, it's the fact that that message seems to change every month rather than just sticking to this data dependency mantra.
You speak 14 languages. You've got parchment and physics from Cambridge. I want you to talk about the physics of Christine Lagarde's speech at Jackson Hole. You've lived the ECB theory, the ECB process, if you will. Is there any hope in prayer that the ECB can get away from the data dependency that she despises?
Sadly, not really. And I think the reality is that you've got so many competing views on Governing Council. You saw that just over the weekend, right? They had that announcement last week, and then they already came out with voices saying, oh, we should be doing more, we're not quite done yet. And it's that kind of cacophony of voices which ends up with the data dependency.
Well, you two are expert on this, John. You've lived it as well as Elsa. And what I find fascinating here is the simplistic American view of Bundesbank versus Portugal. Now, it's not that way. You both know it's richer and more complex. To be honest, my good friend Christine Lagarde doesn't have a chance on this. There's no chance that they're going to take a more holistic, longer Philip Lane trend.
Here's the difference.
In policy.
Under Draghi, who was not a consensus builder, he would bully the Governing Council into a corner and say, we're doing this. And he'd have to get the Bundesbank to come along. Lagarde is a consensus builder, but she gets an easy time of it now because Germany's the weak spot. Germany's the weak spot.
Do you agree with that?
And what I don't hear from the hawks on the Governing Council, they're not screaming rate hikes. They're not screaming rate hikes at all. So how much of a deal was there actually to strike on the Governing Council last week? People make out it was a deal between doves and hawks. The hawks that I'm hearing from aren't that hawkish at the ECB, are they?
Well, they're a lot less hawkish than they used to be because, as you say, Germany itself is feeling the weakness. But also Draghi, in many ways, had to do that, right? Because it was a crisis situation and that forced his hand. Whereas now, we're not really there. We're kind of in a situation where central bankers have a bit more time to assess, to be data dependent, to build that consensus.
I teased this a little bit earlier when we were assessing what was happening with sterling. And Lisa raised the question, I think it's a really important question to ask regarding the UK and sterling. But I think we can take this broadly to Europe and the euro. How important are rate differentials for currency pairs at the moment? When you see developments in the UK, is this kind of development meant to be sterling weaker or sterling stronger? What does it mean?
Fully agree with Lisa that it's ambiguous. Right? I've heard a lot of people, probably more from the sell side than the buy side, trying to talk up sterling as this carry trade. There's much better carry out there. I mean, if you really want carry, you're going to Mexico, you're going to Brazil. Like, the UK is not necessarily where you're going to get it. But at the same time, the fact that, like I said earlier, you kind of remove some of that tail risk of stagflation, that's a good thing. And from a policy credibility perspective, it's good that the Bank of England is finally, seemingly, getting inflation under control.
What is your question for Powell today? You're in the press conference. McKee gives the last question. They go, Lingos, you're here. We'll give you one. What's your question to Jerome Powell today from your EU perspective?
I'd be really interested to hear how he's thinking about the run-up in energy prices and the feed-through that will have to headline inflation.
Well, wait. Well, stop the show here. Halima Croft. Okay, you've got someone who's pretty good at this, right?
Yeah.
What does the wonderful Halima Croft... Halima, wonderful to see you. Thanks so much for stopping by. Halima Croft, what does she say about this move to 100?
I think she's been bang on the money with that call. Now that we're there, it becomes a lot less obvious that we continue further from here. But she was very open and talking a lot about it earlier in the year, and the markets were just ignoring it for a while. They were ignoring the supply cuts, the production cuts. We're here now. We feel the impact.
Can Powell ignore this later on this afternoon?
I mean, let's see. It's a very short intermeeting period between September and November. December is probably the time they need to make that call.
Do you think the Bank of England can ignore it a little bit more? I'm just wondering, who is this more important to? Governor Bailey?
Ultimately,
Ueda? Powell?
Ueda we can almost forget about. The Bank of Japan are not doing anything anytime soon, and even when they do, it's going to be tiny. Now, I'd be most concerned in the ECB's position. Energy importer, you still have that regional difference between US energy prices and European, and they're the ones really that are facing the economic weakness.
We are staggering beyond Duesenberg. Through Trichet, John mentions the wonderful Draghi of Italy and now Lagarde. Is the ECB a more mature institution now, or are they still making it up as they go, as they did when Marsing was there?
Absolutely more mature, and you've got to remember they've been now in existence for over 20 years. They've been through several crises that's knitted them together. But more than anything, the fact that it's the core now feeling the weakness, I think
Yeah,
that
John mentioned that.
Naturally brings
I didn't
them
mention
together.
that. John mentioned that.
Jane Foley talked about the prospect of parity on the euro in the new year. Are you going there yet? Can we finish there?
Come, we got ECBs. Come on.
We've had 104 for
Okay.
year-end forecast since the start of the year. And that hasn't
Congratulations.
changed. But we looked into 2024 and actually said, why should it stop here? Why should it bounce back? We've got 102. Could we get to parity? Sure, maybe. I just don't think we'll stay there long.
Okay. Bold. Elsa, thank you. That's quite a call so far in the year. We'll see how we end it, but quite a call so far. Elsa, thank you. Elsa Linios there of RBC. They've got 104. We're trading at 107. 104 was quite a call at the start of the year. You have to imagine. Go back to the start of the year. All the happy talk around China reopening, what it might mean for Europe and TK. That story is not the story going into year-end. In fact, Lagarde talked about that in the news conference of the ECB just last week. The tailwinds at the start of the year, China reopening, lower energy prices, they have gone and they have developed into headwinds going into year-end.
Yeah, and I think into these 3 central bank meetings, what our audience needs to pay attention to is this is a movable feast right now. There's no cast-in-stone belief going into October, dare I say, to that Fed meeting in December. We're literally, John, making it up as we go. And it feels that way, folks, putting the show together. Day by day, we're making it up.
Day by day. I think we can say the week begins today, a little bit later on this afternoon. Chairman Powell, a decision from the Fed, non-decision for many, no change expected. The forecast will be closely watched, changes to growth projections, inflation, the dot plot as well. Then it's on to the Bank of England tomorrow and the Bank of Japan on Friday. To preview all of that, Bruce Kasman, JP Morgan, looking ahead to those 3 central bank decisions. He joins us next, live from the City of London for our audience worldwide. Good morning.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Three big days coming right up. The Federal Reserve a little bit later on this afternoon. The Bank of England tomorrow. Then on to the BOJ, the Bank of Japan, and Governor Ueda on Friday. The price action set up as follows going into all of that on the equity market. Futures, just a little bit positive here by 0.2%. Yields coming in, TK, a couple of basis points. Your 10-year, 433.
The price
67.
action here that matters is, can John get decent tickets for Arsenal Tottenham on Sunday? What do you think?
I'm trying to hook it up.
Yeah.
Arsenal's the home team, though.
What I find,
Tottenham.
and this is the only city in the world where I religiously take taxi cabs. I love them. If you mention English football to anybody driving a taxi cab,
Yeah, they've got a team.
That's entertainment. That's entertainment for the whole trip.
I prefer the West Ham fans.
Yeah.
The West Ham fans, proper London cab drivers who have got things to say about British football.
I've had so much fun with this. We're going to pause on this right now. Bruce Kasman coming up here in seconds on an important day, important conversation with Dr. Kasman. I had so much fun last night following a boring 0-0 game. It wasn't boring. What is the symbolism that Newcastle went in there and survived AC Milan?
Pretty impressive. They've not been in the Champions League for about 20 years. So to go to a stadium like that, and for some of those players, Tom, they probably never thought they'd be playing an occasion like that.
To walk in a field
in a
like that,
stadium
yeah,
like
very
that.
cool.
To walk out to 80,000 fans, and we talked about the atmosphere, the acoustics of the San Siro, to survive that. And they did survive an onslaught. Compared to the shots on target at Newcastle, I think one.
Oh, it's
for AC
terrible.
Milan.
It's completely one-sided.
Completely different in terms of the statistics. But yeah, they got out of it alive, and fair play to them.
And just to educate idiots like me, they do it again at Newcastle.
There will be a return leg. I think that return leg is in December.
Yeah.
But the challenge you've got, TK, when you're new to the sport, is understanding the tension of European football, understanding the tension so that you can enjoy.
Is it
when they
nationality
don't
in
score.
cities and,
Yeah, the tension between the two clubs.
I
but
don't
also
see
the
it
tension
anywhere in
within the game
America.
itself.
Anywhere in America. Maybe NBA, but not even there.
I was always told that Americans didn't like European football because it was too slow and low scoring. And then I look at American football, Tom, and the ball is hardly in play.
Oh, they've ruined the game.
And all you've done
Don't
is
get me going.
call 1 goal, 7
Yeah,
points.
yeah.
What's the difference?
It's run by committee
I'm going to get
now.
so much hate mail a little bit later
No,
on.
but what's
that.
important on this, and this is the change, what we hate about English football is everybody falls down and gets hurt. And they've really diminished that.
They need to clean that up.
They clean that up.
And I think the officials, the referees, are going to try and
Yeah.
do something about that.
There's your football moment for the day. We're having a lot of
We
fun
are
here
done.
in
No more
England
Newcastle AC Milan.
doing
No
this.
more of that.
As John mentions, the week starts today. For Bruce Kasman, it does not. On Friday evening, Kasman, along with the dreaded Dr. Ferroli and others, put out their weekly prospects. The way things are moving, it could be daily prospects. Kasman of J.P. Morgan joins us this morning. Bruce Kasman, what will you listen for from Jerome Powell today?
Well, I think the issue really when the Fed certainly stays on hold and certainly also continues to maintain a hawkish bias is how on this color are we talking about their confidence that they're done here. And I think, of course, they're going to continue to maintain that bias. They're going to give us some sense of progress on inflation, some ongoing concern. I don't think we're going to get a strong message. And quite frankly, I don't think it's going to tell us that much in a world in which the data is going to decide what the Fed is going to do over the next few meetings.
Our optionality, our ambiguity, our degrees of freedom, and all the other mumbo jumbo buttresses up against Michael Ferroli's arch call on potential GDP. That goes into our start. Do you have a low statistic on potential GDP? Does that give you a low R-star, that goal that Jerome Powell says he's trying to get to?
Well, I think there's two things here. One, which is perhaps most important, is potential GDP is low, but cyclically there are a number of forces which have raised what interest rate is consistent with stabilizing inflation and stabilizing utilization rates. So I think that's what's operational for the current environment. The second point, Mike and I have both been writing about the hints that U.S. supply side performance is actually improving. We've been running 250,000 a month on labor supply this year. Productivity growth, which has been stuck in the low ones, looks like it's moving higher on an underlying basis. It's too early to get confident about this, but it does feel to us that U.S. supply side and performance is actually improving here.
I know you and Bob Michael aren't on speaking terms, but just the few times where you've got to get together and dovetail your economics into Bob Michael's fixed income, which I believe is price moving against yield. Can you make a yield call here? If we get Kasman disinflation, do yields come down?
I think it's going to be a while before yields come down. If we're right, inflation is going to stay sticky here. The Fed is not going to have the room to ease anytime soon. The economy is not really at material threat of going into recession anytime soon. So I think, 4% 10-year yields, 5.5% policy rates is going to be with us for a while.
Bruce, you touched on it, and I think it's a really important aspect dimension of the Federal Reserve conversation today and into this decision and news conference, the extent to which this labour market has rebalanced. Do you think that rebalancing is close to complete then, Bruce?
No. We have a very tight labor market. We still have very elevated wage inflation. I think we're seeing good signs on the labor market that things are moving in the right direction. But whether we get all the way back to what is consistent with the Fed achieving its inflation target, I think is still not by any means determined. From my point of view, I think it's more likely that things stick at a level that's going to keep the Fed uncomfortable over the next year.
Does that mean low unemployment with elevated inflation or higher unemployment with elevated inflation? Because one mix is a lot more toxic than the other.
I think it's most likely the unemployment rate stays below 4%. I think it's most likely that wage inflation stays at 4% or higher. I think it's most likely in that environment the Fed is not going to have the opportunity to ease. And the question is whether or not that restrictive stance over time undermines what is still a pretty healthy U.S. private sector and eventually causes an end to the expansion, or whether the supply side improvement, whether some of the other supports can carry us along here and put us on a path to a soft landing. I'm in a boil the frog scenario, which is the first one I described, but I think it's still a pretty close call here as to how the environment plays out over the next year or two.
I mean, Bruce Kasman, what's so important here is simply there was a pandemic. Are we beyond the pandemic? Are we beyond supply side studies where we're getting back to Kasman 101?
Look, I think I hope we're beyond the pandemic in terms of its impact, direct impact on economic activity. But I think there's two issues here. One, we're still in an unwind of some of the pandemic dislocations. That's what inflation coming down is about. That's what some of the normalization going on in service sectors are about. We're not quite done with it. We're starting to get closer to the end. And then we're dealing also with the reverberations of this pandemic on a more lasting basis. And a couple of them are the damage done to the supply side globally. And I also think the health of the private sector balance sheet, which is a really weird thing to say, comes out of such a bad event as a pandemic.
Bruce, let me expand on this with one thought, and you pick up on it. Can China export disinflation or a deflationary trend? What does JP Morgan see of domestic China exported out across the world?
I think China is exporting deflation and goods pricing to the rest of the world. Chinese production is picking up right now. You see import prices in Europe and the U.S. from China going down sharply. We think global industry is starting to pick up. China's benefiting from it. So I think the Chinese economy is going to be weak, but not hit the fears, I think, of a real disaster that people expect. I think global industry is picking up. I think China is going to keep a lid on global goods price inflation, as among other things, for a while, except, of course, for what we're seeing in oil.
So, Bruce, just before you go, I've got to do a little bit of housekeeping. The takeaway from this conversation, high for longer, got all of that. Can we just play with the dot plot a little bit and get out to 2024? What do you think that dot plot will look like later on this afternoon?
Well, the most important is probably 23, and it looks like you're going to have a divided committee. We're on the side of them still having the median voter with a dot, but it's a close call. I think regardless of that, and regardless of big changes in the forecast for 23, the 24 forecast is still going to have something close to 100 basis points of easing. It's still going to have a big drop in inflation. It's still going to have an aspiration that we get an unemployment rate up to 4.5% without a recession.
And you don't buy it, Bruce?
I'm skeptical. I'm not pounding the table on it, but I'm still skeptical we can heal here without more damage being done to demand.
Bruce, thank you, sir, for the update from JP Morgan. Bruce Kasman there on the outlook. The takeaway here, Tom, high for longer. There was an interesting word that Bruce just used, aspirational.
Yeah,
aspirational.
That was absolutely brilliant, and the best part about it is John asked the correct question. I don't give a damn about the dots, folks, and thank God Farrell brought up the dots, because a lot of our audience, and particularly Global Wall Street, cares.
They care about the dots. Yeah. Patrick Armstrong, Plurimi Wealth. He joins us next. Equities up by 0.2% from London. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for All and Hunger for None. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
It doesn't look like we've got a major issue with the economy at the moment. The economy's been relatively resilient.
Central banks have carved out in the last 6 to 9 months months of focus on core inflation.
2024 should be a better year for earnings with the market.
We are seeing inflation coming back down towards where the Fed would like it to be.
In the end, higher for longer means there's going to be further tightening here in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The Fed decision a little bit later on this afternoon. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Bramo just stepped off. She's going to be back a little bit later. And your equity market on the S&P 500, we're positive here by 0.2%. A lift to the equity market, TK. Hours away from Chairman Powell, that press conference, and all those lovely forecasts you look forward to, including that dot plot.
The dot plot, can't wait to see that, Jewel. What I'm going to look at is the dot plot that is the voice of the Standard & Poor's 500. John, rounded up 4,500. It's showing a resiliency. It's an equity market. Big amount of money that's saying they believe in the Fed, they're going to get the job done, and they need to be in equities. And you wonder at the margin, like Savita Subramanian
She's
today,
on board.
Going on board, and others, Ben Laidler with that optimism, Anastasia Amoroso with her optimism, etc. That's the Fed story today. The stock market likes what it sees.
If Savita goes to 4,600 from 4,300 over at Bank of America, I think we should talk about Max Kettner earlier on this week,
Yes.
Tom. Just yesterday, Max saying people are too focused on what's going wrong. He wants to focus on what could go right next year relative to very downbeat expectations around China and around Europe.
And we just heard from Bruce Kasman some enthusiasm there about China. You know, he gave a typical J.P. Morgan, hedged it out. He's going to blame it on Feroli if he's wrong. We understand that. But the bottom line is there's an enthusiasm here away from country to country domestic politics. We'll talk the UK politics on ESG here down the road. We don't need to do it now. But it's a ferment.
Sure.
It's a positive ferment here into these meetings.
If you are just joining us on Bloomberg Radio and you missed the conversation with Bruce Kasman over at JP Morgan, it's worth going back over. Bruce ultimately is on the high for longer page. How he referenced the dot plot and the projections over at the Federal Reserve, he used this word aspirational. He said it was aspirational, Tom, to look out next year to expect inflation to come in without too much damage to the labour market.
Yeah.
That's a man who does not believe that we can get inflation back to target, down towards 2%, without real pain in the labour market. Have we made progress on that so-called rebalancing in the labour market? Yes. Have we made sufficient progress? Bruce says no.
We've lost perspective of a fully employed America. The answer is we're at 4%. Bruce Kasman said he doesn't think we go above 4%. I have no wisdom on that other than to say that's the oddity of this cycle, and that's what the Fed has to deal with, is their dual mandate has become a single mandate. They're very ECB-ish.
Very
It's like
ECB-ish.
they're ECB-ish, looking at rates, inflation. Oh, yeah, jobs, that's fine.
ECB last week, tomorrow the Bank of England, Friday the BOJ. Let's get to the price action. Your equity market on the S&P 500 shaping up as follows on the S&P. We are positive here by 0.2%. Yields are coming in just a little bit, down about 2 basis points on a 10-year, 4.3407. In foreign exchange, the euro 107.03, sterling weaker against the dollar 123.64. A soft inflation print out of the UK that we can discuss, Tom, a little bit later.
Yeah, I would do that a little bit later. But the answer to me, you know, as we dive into the brief here, John, is there's disinflationary tendencies out there. People are like, I don't really care about it. They're rationalizing disinflation, and it's in the air. Paul Krugman's essay in the New York Times, I think, really captured it.
Let's get to the morning brief for you. Coming up a little bit later, 2 p.m. Eastern Time,
We'll be here.
FOMC decision followed by Fed Chair Jay Powell giving that news conference. Plenty of questions, I'm sure, about the projections they'll release in the SCP a little bit later. 2 speeches to look out for. 2 speakers off Wall Street. The Bank of America CFO, Alistair Borthwick, speaks at 7:15 Eastern Time, so about 10 minutes from now, at the Bank of America Financial CEO Conference. And this one here, JP Morgan CEO Jamie Dimon speaks at the Detroit Economic Club at 1 p.m., given the tension of this labour market, Tom, is in Detroit right now.
Secretary Dimon will be there. and we didn't talk about this in the last hour, but we're going to stop the show right now and talk about this. There are many people out there that wish that Mr. Diamond would migrate, as Mellon did, down to Washington to be bankerly. Can you do that in this time, in this day
Treasury
and age?
Secretary?
Yeah, I don't know. But he's there in the crucible today of the American labor movement. It's extremely well done.
Shall we reflect on what UAW said yesterday?
We should. I don't know if they'll be at the lunch, but
Every
hey.
fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers.
I'm glad you brought that up. That was quite a statement.
It was a strong and powerful one, yeah.
And that sets up this tension of Wall Street, Main Street that Speaker Pelosi highlighted, many others as well. And I just don't think it's a small matter that a Fortress Diamond wanders into Detroit today to talk about the labor markets. What else do we have?
AMH joining us in about 10 minutes on part of that story. Just your earnings after the bell, a little bit later, after the market close. We'll get some earnings from FedEx. Look out for that a little bit later on. Joining us around the table here in London, the conversations continue. Patrick Armstrong, CIO of Plurimi Wealth. Patrick, good to see you.
Good to see you.
Are things good or just terrible? Because I can't decide based on our conversations so far.
Normal. Things are pretty normal. Everything feels so different to how it was, but we've got inflation on a track down to something that's going to be sub 3% next year. I don't think it's going to fall to the Fed's mandate. I don't think they want it to. You've got economic growth that's a potential in the United States. Who would have thought that? You're probably going to grow 2% for the U.S. economy this year. That's probably the long-term potential. Interest rates at 5% on the 2-year. Pretty normal. Doesn't seem normal over recent years, but we're in an environment where things are pretty normal.
We're going back to the old normal.
I think we are going back to the old normal. I think inflation is going to prove to be persistent, sticky, with intermittent spikes, just because the big picture issues are populism and protectionism from governments, and that's just by its nature inflationary. You've got unions coming back like the 70s maybe a little bit. You've got job seekers having some power. That's inflationary. But you've got disinflationary forces coming from China, and you've got Fed policy at a point where it is restrictive. So all of those things, normal.
Your charm is your truly cross-asset. At the margin, how are you changing your cross-asset allocation into the fourth quarter?
So what we've done over the summer months is we've marginally reduced our equities that have just kept drifting to overweight. We wanted to have neutral weight, but just as equities have performed so well, they kept moving overweight. We've moved marginally underweight now. Not so much that we're worried about equities, that we're getting pretty compelling returns on tips right now, that you're getting a 2% real yield. And like I said, inflations are still a risk in the long term, but I'm getting the duration there. If we do fall into a recession, we'll see lower yields on conventionals, and tips will benefit from that.
So talk to our audience on radio and television here, and particularly across America. How does Patrick Armstrong utilize the 10-year inflation-adjusted yield or the 5-year inflation-adjusted yield? How do you use that as a tool to have confidence in market allocation?
Well, the 10-year break-even is 2.3%, and my view is we're going to have persistent above Fed target inflation. So I want to be hedged against that. I'm happy to get a real yield of 2%. You put your capital at risk to preserve capital as a starting point and grow the purchasing power of that over time. The tip provides that to you right now on the 10-year, so I like duration there. But you're being compensated with really high yields on, we talked about Diamond.
Yeah.
JP Morgan bonds, I'm getting 6% on a 2-year, and that's almost a risk.
That's a Chris Whalen moment. Yeah. He's channeling Chris Whalen, those JP Morgan preferreds, Whalen would say.
Should we do single names? A lot of people at the start of the year were getting jacked up on LVMH.
I was one of them.
You were too. You backed away.
Yeah.
You stepped away. The poster chart of the European market now is Novo Nordisk. Where are you on that?
That's my biggest stock right now. And again, it's come from drifting. The pandemic used to be COVID. The pandemic's obesity and diabetes in the West. And Novo Nordisk and Eli Lilly, they don't have monopoly positions, but they got the dominant share here, growing earnings.
If luxury come in enough off China gloom, Bernstein, I believe, was out with a note overnight saying we've got some ratios of luxury back to 2008. Is it pulled back enough for Patrick Armstrong?
No, almost. So I sold LVMH in March. It was at 32 times forecast earnings. We're now in the mid-20s. I bought it in October the previous year when it was at 21 times. That's a small premium to the market multiple. That's where I'd like to buy it. So I think it's fair.
Folks, right there, we don't do much equity chat because, you know, who cares? The answer is what you just heard there from Patrick Armstrong is a clinic on how you bracket a beloved dominant stock.
I was with you. We were talking about it when you backed out of LVMH. You kept Hermes, though.
We did, yes.
Why was that?
Well, I didn't want to move against what I still think is the dominant trend is the spending power of high net worth individuals and also the immunity to input prices. Rishwan talked about inflation hurting spending power of people, but the input prices are things that are hurting mass market retailers, and it doesn't impact the high-end luxury.
So what's a distinctive feature of the Dumas family at Hermes? What are they doing differently? Bloomberg Intelligence, Deborah Aitken is just brilliant on this, and she singles out a few of these names. What is the Hermes model that makes them different from 47 other luxury brands?
The leather goods part of it is incredible. The margins, the growth they get there, and people pay up for that, and there's just waiting lines of queues for that side of things. But it's their brand management, the Hermes scarves and ties and the leather goods. It's all, yeah.
We touched on it briefly. Let's finish there. Novo Nordisk. We're already up 40% this year. The stock's been climbing for 5 consecutive years. Can you spend just a little bit of time, a couple of minutes, just outlining how big this opportunity actually is?
Well, it was a vanity-type drug, their weight loss. It is a vanity product, basically, that people in Europe, America, and China... They spent the money to look good, feel good, but what they found is that the heart disease and the benefits on that, it may become an insurable product as well. So that just expands the potential market where you're not just getting vanity uses, but health uses, which may be insurable as well. So heart and stroke disease, it does expand the market a lot because it's an expensive product that a lot of people can afford. It may move much more mass market because of that.
The run on this stock, Tom, has been phenomenal. Absolutely phenomenal. I'm not sure where we are right now versus LVMH, but certainly at one point earlier this year it was bigger than LVMH, right?
I think it's bigger right now. They're basically the same market caps.
Can there be European exceptionalism without technology? The way we trumpet Apple and the other 18 states.
Well, Novo Nordisk, I think, is a form of US exceptionalism. Yeah, it's just the wrong kind of US exceptionalism, right?
Yeah.
It's buoyant, to say the least.
It's, it's... Exceptionalism is very clear in US in technology. Europe can compete in healthcare. It's shown no ability to
Quickly, are you buying big oil? You buying big oil here with $100 a barrel?
Basically, there's going to be more oil consumed in the next 3 months. We've already had more oil consumed today.
Single best buy. Come on, Patrick Armstrong, single best buy, big oil.
EOG, I like, rather than the integrated exploration production.
Patrick, good to see you. Patrick Armstrong of Plurimi Wealth. If you are just tuning in, welcome to the programme on the S&P 500 right now. We are positive. We're positive by 0.2%. Outside of the equity market and the bond market, yields are a little bit lower by a couple of basis points at 434. Lots to talk about in fixed income. We'll do that with Alberto Gallo of Andromeda Capital Management. That's going to take place a little bit later on this morning. TK, some amazing calls there from Patrick. Novo Nordisk, the European healthcare company at the epicenter of the US health epidemic right now.
Yeah, he's been so on. I mean, the thing about Patrick that's great is a cross-asset view that he takes all the time. And, you know, you mentioned this, I think, yesterday, the day before, John. Everybody's got to recalibrate where the Q4 outlook, September 30 ending Q3, is maybe as important as the year-end outlook this time around.
Well, I think this time around for the Federal Reserve, they're marking to market. Growth has just been so much better than we thought it would be. We already know that. The Fed's just got to update their forecast to take account for that, Tom, into year-end.
You know where I am in the parlor game. I just and thank you for bringing up the dots. Let's review this right now. We've heard this morning that the 23 dot has value. There's a 24 dot. Is there a Draghi 25 dot? Are they going to go up to 25?
So let's just sit on the dots. We've got a couple of seconds. So for 2023, the median dot is expected to still show one hike this year. Might come in. We'll see if it does. 2024 has some easing baked in. But it's what's behind the easing that I think is really important. Is it a collapsing growth that leads to these rate cut calls? Or is it just this idea that inflation comes in, the Fed's focused on real rates and wants to maintain that restrictiveness? They're two very different things, Tom.
I think looking out that far, post-pandemic, as I mentioned to Dr. Kasman, can you look out that far given post-COVID supply and demand dynamics? I don't think you can.
Up next on this program, we'll look out to Detroit, the tension between UAW and the Big Three, and get the latest from the UN General Assembly. Bloomberg's Anne-Marie, next from New York.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
When it comes to China, I want to be clear and consistent. We seek to responsibly manage the competition between our countries. We are for de-risking, not decoupling with China. We will push back on aggression and intimidation and defend the rules of the road.
It's an interesting word that President Biden used addressing the United Nations General Assembly just yesterday. He said we are de-risking, not decoupling. Curious because the Treasury Secretary went to China, Tom, and used the word diversifying. So which one is it? What's the message they want to send to China? Do you want to say de-risking? Because de-risking to me sounds pretty loaded. Are you saying China's the risk?
I think the political football here is substantial, and I'm going to say it's policy made up as you go. I think they're literally making it up as you go based on what China's doing and what the dialogue is. Very importantly, the meeting, Emery Horton talked about the meeting in Malta. Yep. Malta's an island in the Mediterranean. I don't know if you knew that. And
I'm well aware.
They had a meeting there of worthies to get Biden and Xi together, and that would be important. I mean, that's what diplomacy's about.
If we can make that happen, maybe a little bit later on this year. If you are just joining us, welcome. Federal Reserve decision a little bit later on this afternoon. No change to rates expected. Big focus on the forecasts. Growth, inflation, the dot plot. That news conference won't be a snooze fest. A sleepy start to the week so far, though, in the equity market. Futures just a little bit positive here by about 0.2% on the S&P. Yields a little bit lower by 2 basis points on a 10-year. 434, Tom, 0.7.
It is a busy week in New York and the island of Manhattan. It is traffic statist. Pharaoh had a tantrum and said, we're going to London during the UN so we can miss it all. Emery Horton doesn't have that advantage. She is in the heart of Manhattan with the United Nations meetings. A very important interview yesterday with the leadership of Poland, of course, so adjacent to what's going on in Ukraine. But this morning here in London, Anne-Marie, I think we've ignored, I've been wrong on this with the Fed Day and all, we've ignored Detroit and the UAW. Who does the president need to speak to today? When he gets up and dials 1-800-DETROIT, who does the president want to talk to on UAW strikes?
Well, the White House has been talking to everyone, right? They're going to be speaking to the UAW president, Shawn Fain, but they're also talking to the executives of the big three auto workers. This has taken on more importance, this story, because Friday at 10 a.m., we will hear from Shawn Fain. He's going to be holding a Facebook Live, and that's really this new date for the negotiations to look forward to try to strike a deal, or he's going to announce more walkouts at more plants. The administration is in a very difficult position at the moment. Not only is the former president going to be heading to Detroit the day of the Republican debate, so really stealing the show from everyone, but the administration said they would be sending Julie Su, the acting labor secretary, as well as Gene Sperling, a White House advisor, who's the individual who's the liaison between the White House as well as the UAW and the big three. And those two individuals have yet to show up to Detroit. And I was reading a political article yesterday, and Democratic strategist said Trump scooped us. And at this point, it's not even about sending that. Now they look like are they going to be following Trump's tail by sending someone, a high-profile person? But the bigger issue, I think, is the fact that they said they were going to be sending Julie Su and Gene Sperling, and that has yet to happen.
Maybe it's a silliness and symbolism of the Detroit leaders age ago driving to Washington to do whatever they did. Maybe the president needs to get in his Corvette and head up to Detroit. With that said, there's percolation in news. There was a union settlement in Canada overnight. There's also the idea that there's a tangential knock-on effects of the strike where the automakers are shutting down other factories. Do those kind of tea leaves, do they have any impact on the debate?
I'm sure they do. I'm sure Shawn Fain sees all of this. One, the extractions workers were able to get in Canada, but also the fact that this could be impacting the knock-on effect, the supply chain effect that this is going to have on these communities. So they're obviously going to be taking stock of all of this, but he wants to use this moment to extract as much leverage as he can from the big three auto companies, and the big three are saying they're still at the negotiating table.
Where's the leverage, John? 32-hour work week? Help me here.
pay at the moment. It looks like they can get more out of them on that side.
That's it.
Stellantis has certainly come up. Anne-Marie, just to expand on the political conversation, you get the sense from UAW that they are sick of politicians playing politics with their cause. This is what you heard with the UAW president yesterday, and I'll share this quote with our audience, and I'd love your take on it, AMH. Every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. Is the former president still trying to go to Detroit on September 27?
The reports are that he is going to go there, and I think there's two key things we need to look at through the political lens. One is the fact that Trump won Michigan in 2016, a state that the Republicans have been unable to flip since the late 1980s. And a lot of this, if you look at, was potentially some of these rank-and-file members, not the UAW leadership. They would not endorse him. They're not going to endorse him in this round either. But then Trump lost it in 2020. This, I don't need to tell you, is a must-win state for Democrats. That's the first thing. I would also bring up the point that a lot of union leaders remember what Trump said in 2015 when he was campaigning. Remember when a number of automakers were talking about building facilities in Mexico, especially Ford, putting billions of dollars in Mexico. Trump said, why would you do that? Just move to a better U.S. state where you don't have labor, where you don't have union leadership. Get cheap labor, and then those people will realize they've lost their jobs, and then you can go back to your old factories.
Right.
And this deeply annoyed the UAW leadership, who said, philosophically, what is the difference of this? We are not being respected as a middle class, a working class. And those memories, I would say, they are still front and center for a lot of these individuals when it comes to the former president.
Anne-Marie, I got a segue here to your important conversation today. And as the gentleman from Poland was speaking in Polish, for me it was lost in translation, except boy, was there a tension in that conversation. Describe the tension that Poland faces at this moment.
Well, listen, Andrzej Duda has really been lifted by Putin's invasion of Ukraine to this global statesman almost. Remember in the start of the war, everyone was going into Ukraine, they still are, through Poland. He was this conduit between Kyiv and Western leaders, and he had this very close relationship with President Zelensky. He still does, but there is a ton of friction right now in this relationship that is playing out in the media. And what President Duda said to me is that his only plea right now would say, please stop doing this in the media, really taking a swipe there at President Volodymyr Zelensky. And some of the big friction comes down to the fact that we're not seeing a lot of Ukrainian grain moving out of the Black Sea corridor, so it's going into Europe. And Poland is saying, and they refused some of these tariffs at first to make sure they can help the Ukrainian farmers. But now what he's saying is that our farmers are not making the money they need to be making because there's too much cheap Ukrainian grain here. Zelensky wants to take this to the WTO, so they're having this spat about Ukrainian grain. At the same time, there's also debate within the Polish government about the financial aid from the Polish government to Ukrainian refugees who are settling in Poland. Just like you're seeing here in America, people are saying we are dealing with high inflation, we are dealing with higher costs of living. You're hearing this kind of conversation around the globe, whether it's Germany, whether it's Poland, and that is why you're seeing a little bit of war fatigue.
Anne-Marie, this is a wartime president facing a unique situation that these other leaders do not face. I think we have to acknowledge that.
Yes.
He's been celebrated by the West for the way he's spoken about the needs of his own country. I was listening to Speaker McCarthy yesterday. Do you get the sense that a lot of people, perhaps in Washington, of a certain politics are becoming frustrated with Zelensky's approach in the media?
I think some of them think that the approach in the media is a bit combative. And we saw that on display yesterday with the Polish president. He said, wishes, stop playing this out in the media. We've been strong supporters of Ukraine. Speaker McCarthy said yesterday that he just has a lot of questions for President Zelensky about where the U.S. taxpayer dollars are going. And remember, the last time Zelensky was in Washington, he gave this joint address. This is just going to be a huddle between lawmakers.
AMH, thank you. The latest in New York. Fantastic work at the UN General Assembly. Fantastic collection of interviews over the last couple of days. The NATO Secretary General and the leader of Poland. Equities right now positive by 0.2%. Coming up shortly, the brilliant Deborah Cunningham of Federated Hermes. That's next. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Equities positive here by 0.2% on the S&P 500. On the Nasdaq, slightly elevated. Some outperformance on a Russell. The small caps doing better than a good, up by 0.4% on the Russell this morning. We calling that a surge, TK?
Surge.
Is that how sleepy things have been?
Has been
0.4%. It's a surge.
I'm like, when does small cap calm down and actually put it on? And the answer is, there's so much angst out there, small cap really can't get it going.
Jill Carey-Hall of Bank of America has been good on this as well. I want to turn to the bond market briefly as well. 2-year, 10-year, 30-year. We've got a rally in the UK. 2-year yields in the UK down by more than 10 basis points. A soft inflation print. Hot inflation print in Canada yesterday, lighting a fuse under this bond market. Yields shooting higher. New cycle highs on a 10-year. We're back away from it. We're down about a basis point on a 10-year to 434.47. But Tom, looking at that, you'd have to say we really have started to internalise high for longer. When you see a 2-year
strongly agree with
north of 5%.
We are beginning to internalize the yield structures of another time and place, think 2005, 2006, and many of the different measurements. We look like you draw a horizontal line, John, and it takes you back to 08, 07, dare I say even to before August of 2007. What I end up looking at every morning, folks, is the 10-year real yield, and it's sort of in betweeny, 1.96 maybe is where we are right now in USGGT10Y.
Oh, that's the ticker on the Bloomberg. Nice.
But the answer is, that's what I'm going to look at as we go through the press conference today to see what the real yield does.
If you look at USGG2YR, which is the nominal yield.
Good.
Thank you. Thank you. That's just north of 5%. 430s on a 10-year, 440s on a 30-year.
People just drove off the road on Bloomberg Radio.
I mentioned that rally in the gilt market for the UK bond curve. Yields down almost across the curve, particularly at the front end. This move in sterling weaker off the back of that. The pound against the US dollar, 123.65. We're negative by 0.2%. Tom, just looking at the inflation data out of the UK. So the good news is that it's no longer the 7% we expected. The bad news is this number still comes in at 6.7% year over year. And core, Tom, is from 6.4, great, but it's still 6.3. So there's still an inflation problem in the UK, and we're still talking up wage growth that's pushing 8% in the United Kingdom. So the pressure's still on this Bank of England. Goldman's dropped its call for rate hikes for tomorrow, and they think over at Goldman, based off what we're hearing from the London desk this morning, is that the Bank of England is done. This is the peak rate. They're going to stay there. Question I've got, Tom, if you're going to stay there, how long for? With CPI where it is, with wage growth where it is, how long have they got to stay at these levels for?
It's essentially it's a boom economy that everybody's been wrong on. There's been a lot of gloom out there, and it's its own idiosyncratic story here. And part of it, to me, dovetails off Brexit and the relationship with Europe. And, frankly, I think the United Kingdom needs a strong Europe, and it's not there right now.
It isn't at all, based on what we heard from President Lagarde at the ECB last week. Nothing strong about that news conference.
I read Phil Serafino's stuff
last
today.
week. Phil's great. 107.01 on the euro at the moment. That currency pair positive by 0.2%. Under surveillance this morning, the Fed rate decision due out 2 p.m. this afternoon. A pause is widely expected, but a bit more debate around what this Bank of England will do tomorrow after UK inflation unexpectedly fell. Goldman altering their call, writing this: with today's data, 2 out of the 3 indicators that the Monetary Policy Committee has set out to monitor inflation persistence have now shown notably more progress than anticipated since the August meeting. We now expect the MPC to keep rates unchanged. Once you've got through the Bank of England, Tom, it's on to the BOJ on Friday.
Catherine Mann's going to push against that. She is American. Brandeis University, of course, her wonderful work at Citigroup. She is on the MPC, the Bank of England. And I would suggest that Dr. Mann would say, let's watch the data. And to your point on change in vector versus level, to everyone in the United Kingdom, it's that level above 6% that's intolerable.
I'm with you. That split on the MPC, let's see what that split looks like.
Yeah, they never dissent. I mean, they
we get a dissent on Threadneedle. We don't get any dissent over at the
Fed is,
Federal Reserve.
Snooze fest.
Singing off the same hymn sheet, apparently. Oil dipping this morning after a soaring summer rally. Saw prices rise more than 20% over the past 3 months. Crude touching 10-month highs, approaching $100 a barrel. in the last 24 hours on the back of supply cuts from OPEC+, but falling back below 94 ahead of this afternoon's Fed meeting. 93.75 after a sniff,
Right.
Tom, of 95.
Yeah,
on
I
Brent.
think, a bit of the story's missed here. This has to do, again, with oil in the Caspian Sea. This has to do with Azerbaijan. I'm not going to pretend I'm an expert on it, but it is the ageless battle of those Caspian states, Georgia, Nagorno-Karabakh, and the rest. Amory Horton's way better. Maria Tadeo's expert on this. But there was a little bit of war tone yesterday, which got us up to Saudi 97. It got us up to 95 on Brent crude. And there seems to be not peace in the air, but maybe the tensions pulled back off the Caspian Sea today.
Fantastic to catch up with Javier Blas of Bloomberg a little bit earlier today, who basically said it's all about price for Saudis now. And they've got a higher tolerance for economic stress abroad. They want prices near 100. His opinion, maybe that resonates, but that's his view.
He walks in the building and the foundation shakes. I mean, he's huge.
He's a heavyweight.
He's a heavyweight.
A heavyweight in the world of commodities. I want to finish on this, an update on UAW. United Auto Workers weighing in on expanding their strikes as negotiations with Detroit's automakers continue. The union set to hold a Facebook Live event at 10 a.m. Friday, where it's expected they will discuss whether more plants will join the strike. So like we had last week, we have a deadline. It's noon Eastern on Friday, TK, for further progress. If we don't have that sign of progress, ultimately 2 hours before that, we're going to get some kind of Facebook Live event, some kind of news conference from UAW, which may signal a broadening, a deepening of these strikes.
Walter Reuther would have done it this way. I mean, it's not your father or your grandfather's strike of union members. Are these companies the same companies and acting in the same process as they did in 1958 or the tensions of the 70s? I don't think we know yet.
So you can answer that question. I'll answer this one. UAW certainly changed their approach based on the assessment I've seen.
Absolutely.
This isn't targeting one. This is targeting all three simultaneously at the same time.
And they know, they're sophisticated enough to know the knock-on effect. One of the makers came out and said, if you're going to take out my Bronco factory or you're going to take out Michigan Truck, well, then you got to go out and there's this knock-on effect of 14 other factories, and literally in the next 48 hours.
And tons of other companies down the supply chain.
Yeah.
Tom, who are going to be hit by this as well. It's not just Detroit's big three, that's for sure. It's
Continue to follow that
companies.
Great team in Detroit leading that coverage, and we'll catch up with them through the day, this Fed day, I should say. Right now, this is an important conversation, and please lean forward as you figure out what to do with your short-term money. Deborah Cunningham, a fancy title, Global Liquidity Market CIO. It Federated, essentially they invented the money market fund, and with Federated Hermes, she joins us this morning. Deborah, what do you see in money market fund flows? What are we doing as we migrate from banks to a higher yield money market funds?
Well, certainly we've seen it in, full force over the course of the last 6 months. And it's really, it began back in March of 2022 when the Fed increased rates for the first time. You've basically got in its, sort of most inclusive form, money market funds with assets greater than $6 trillion now. So, if you kind of go back to the, days post-Lehman, this is 3 to 4 times what the market was at that point. And certainly what it was in the zero interest rate environment. So at 5+%, money market funds, especially for the retail investor, offer great returns at this point.
Deborah, I look at the Keefe, Bruyette and Woods Bank Index, the so-called BKX, and it's sobering to say the least. What is a Federated belief? And I know you're doing rates, it's maybe outside your remit, but how do you look through the Cunningham prism at what our beleaguered regional banks are doing?
Tom, we do a lot of business with the banking sector from an investment perspective as well as from a counterpart standpoint. So we're always looking at the health of banks and, what their activity in the market might be looking like. And at this point, the largest and what I'll call regional and kind of super regional banks seem to be quite healthy. Even, in the context of the commercial real estate portfolio, there seems to be, a pretty good mix of what I would call the better types of commercial real estate within those larger banks. Now, some of the much more, much smaller, very concentrated regionally and geographically smaller banks that profile is not the same. So I think what you might end up seeing through this next cycle from a banking perspective is a little bit more consolidation of some of those smaller banks into some of those larger, sort of regionals and super regionals in order to keep the market in overall, in an overall healthy sense through, what might be the next downturn from an economic standpoint.
Deborah, we'd love your view on the Federal Reserve a little bit later this afternoon. Andrew Honhorst, the City, just published moments ago. He had this to say: the Fed will skip hiking rates at 2 p.m, but dots will likely signal one further 25 basis point hike in 23. The median dot for 2024, they think over at City is at risk of rising 25 basis points. It's all incremental stuff, Deborah. For you and the team, when you get those projections a little bit later, what are you and the team looking for?
I think definitely a skip, not a pause. And I do think, they're going to emphasize that November continues to be a live meeting. I would not be surprised to see the economic projections and the medium dot to go up by 25 basis points more. Ultimately, although inflation, is lower than it was 3 months ago when these numbers came out, it's still firm. And in the most recent information, CPI, PPI, PCE, retail sales, they're showing the consumer being very strong and some of those numbers playing through to mild increases in those numbers. So we would not be surprised. I agree with you that, the market maybe is finally reconciling with higher for longer, but I'm not sure we've priced in what we think is a real live meeting in November at this point.
Hollenhorst cites three things, Deborah: oil prices, ongoing UAW strike, third thing, renewed advance in house prices. How do you think the chairman navigates those three issues?
I think all of them have to be addressed. I mean, they impact the consumer. And granted, the consumer has, from a wage inflation standpoint, also been improving from, a household net worth standpoint. But they are paying higher energy costs. They're paying higher food costs. They're paying higher shelter costs. And all of that comes out of their discretionary spending. So I think as the engine of growth to keep this economy, sort of above water, there's a little bit of a pullback on that from the consumer standpoint at this time. So, the chairman can't ignore that. But by the same token, are they going to be able to, marginalize and not raise interest rates by another 25 basis points? I think it's going to be a tough decision, but one that will, make the November meeting a little bit more, sort of in the limelight and focus for interest rates in the next several months.
Your view, you're not alone. Mike Gapen, Bank of America, Andrew Honhorst, the City, on the same page. Deborah, thank you. Deborah Cunningham there, Federated Hermes. The Federated Hermes view on the Federal Reserve. If you are just tuning in, welcome to the programme. The S&P 500 right now is just about positive by 0.25%. Outside of that, into the bond market, yields are a little bit lower by a single basis point at 434.47. I mentioned that research from Andrew Honhorst, the chief US economist over at Citi, who had this to say: Chair Powell acknowledged recently softer inflation and lower job openings, but emphasise vigilance, he says, given remaining upside risk to inflation on those three issues that I mentioned, including the rise in oil prices, ongoing UAW strike, third one, renewed advance in house prices. Tom, of those three, what are you focused on? Strike, commodities, house prices?
I'm not focused on the political story. I don't think the Fed really does a mandate off of that. Maybe Greenspan would have a million years ago. I don't see it with Powell. I do see it with the house prices. I think they'll watch it very carefully. And to Paul Krugman's idea of plain vanilla inflation and rents are shocking, yeah, I guess they're down in the West. But the answer to me is you got to get from the soup, the alphabet soup of inflation indicators Deborah Cunningham just brought up, to what our viewers and listeners are feeling. Powell viscerally knows that, and he can't go accommodative until he's got more of a vector in place. It's not in place yet.
So acknowledge progress without signalling victory.
Yeah, exactly.
Ultimately,
he's not going to declare victory as Governor Bailey.
I don't think Governor Bailey can declare victory.
No, but he alluded to it a couple of meetings ago. And none of these people are anywhere near this. It goes back to what Wells Fargo said about the last mile. We're not in the last mile. We're like on the last time zone. We're not there yet.
Sarah House was right. That last mile is going to be tough. Coming up next, the treat here in London. Kathy Wood of ARK Invest. That conversation coming up shortly. Live from the City. This is Bloomberg.
roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
I think tech still has a bit of room to go in the next couple of weeks. There is probably a window around Q4 where I'd be moving more towards really the value side of things, right? Tactically, right? If we get that bump in inflation, particularly in the US a bit higher, you know, you want to probably prefer then for a couple of months things like banks or energy over tech. But for now, I think energy still has, or tech still has a way to go.
Based on what we heard from Max Kettner, the chief multi-asset strategist over at HSBC, it feels like Goldilocks forever for Max, at least Goldilocks for now, constructive on risk assets. If you're just tuning in, welcome. Equity's doing OK, positive this morning by 0.2% on the S&P 500. Going into this Fed decision, cycle highs on a 10-year yield in the last 24 hours. Backing away from that just a little bit, down a basis point on a 10-year, Tom. 434.67 on a 2-year, still dancing in and around 5%.
I'm going to look at the real yield. The oil pullback, oil's been front and center this week, but into these three meetings, I've got to look at inflation-adjusted yields. Patrick Armstrong, I think, was very, very articulate about that. That's where he is. That's where he's finding protection. But to see what the real yield does off the chit-chat today, and I agree with what we've heard on to November and, frankly, a focus to December as well with the Fed.
The risk of one more hike. Andrew Hollenhorst, Citi, Mike Gapen, BofA, Deborah Cunningham there. Same thing.
Yeah, there's a lot of cross currents here. We'll have this for you this afternoon. Remind me what we're doing, John. We're at 1:30. We're starting
Eastern time, so 6:30 London time. We'll start the Fed special.
We'll
get the decision
hour.
30 minutes later.
This. That's good.
And then we'll beat the drum into the news conference 30 minutes after that.
Into the news conference as well. And we'll be with you tomorrow, of course, for Bank of England. And who's on Friday?
BOJ.
BOJ. And that'll be interesting for Mr. Ueda as well. We welcome all of you worldwide on Bloomberg Radio and Bloomberg Television to a conversation of great anticipation. Kathy Wood came out of USC a long time ago, put out a shingle with a Lovelace family at Capital Group, and then built an investment career quite different from others, not so much based on the long-term solidity of a given portfolio, but capturing the trend, going up large, and sometimes going down large. She holds court on the Ark. Noah's Ark is where she is right now. I want to know, with all you've been through the last number of years, are you going to shift to a more long-term strategy? I look at Morningstar, 1 year, 3 year, 5 year, your bottom quartile, but your claim is more short-term. With your new ETF effort and with what you're doing with ARK, are you going to be still on trend, or do you invest more for long-term?
We've always invested for the long term. And what interrupted what was a very nice move up in innovation stocks, especially disruptive innovation, was a massive increase in interest rates, the likes of which we have never seen.
Of course.
24-fold increase. So all long duration assets, especially in 2022, were destroyed, including bonds, which are usually a flight to safety. They had their worst year last year. Since the 1700s. There's no way in that environment that our strategy would have done well. But I do think that what's happening this year is that the market is starting to look over the Fed's moves, whether there's one more or not, into falling interest rates. You know, we started underperforming in 21 just with the anticipation of rising rates, and even more so in 22.
So how are you going to change? I want to know how you're going to change the sobering quarters you've been through. What is the new Kathy Wood approach to macroeconomics, frankly, pandemic economics, intruding on your belief in innovation?
If anything, innovation gains traction during tough times. And if you look at how the reason our portfolios are outperforming this year is... And they are. It is because they are gaining share in what is becoming a difficult environment. Right? And so one by one, we're going to earn our way back. And it's all about revenue growth, margin expansion.
In the Wall Street Journal, they do a fabulous thing with old farts like me, and it's people with over $5 million, and they believed in Cathie Wood. To a person, those retirees bought innovation, they bought tech, they bought Apple, and they didn't listen to financial TV or radio. Can you do the Cathie Wood approach for 1, 3, 5 years, given the volatility you've seen?
Yes, I think we're on the other side of that massive interest rate increase, which did destroy a lot of performance. That's the most important thing. And we are ready for prime time. Many people are concerned about our kind of strategy, and the company we just acquired rises because in Europe, in London here, for all of Europe and UK, they're focused on global megatrends as well. And, you know, interest rates hurt everyone in that space. If we are right, and rates are going to come down at some point in the next year, you know, the market is a discounting mechanism, then I think that the muscle memory that hurt our strategy, and it all has everything to do with the tech and telecom bust, and people thinking, oh my gosh, are we here again? No. What happened during the 20 years that ended in the tech and telecom bubble is the seeds for what is happening now were planted.
Yeah, and this, John, is really important, and that the profitability stream down the income statement of new tech is very different than 2000 tech.
Let's talk about EVs.
Yes.
And not just Tesla.
Yes.
Is it good news for Tesla what's happening in Detroit right now?
Yes, because if there's a strike, of course, there will be more production shortfalls. You know, I think that there's just now the supply chain has freed up, so unfortunately we'll have all kinds of questions about that. But you know, I don't think it has anything really to do with the strike. It has everything to do with a consumer preference shift towards better vehicles, electric, that are falling in price. Tesla is leading that price decline simply by passing cost declines on to its customers. So I think that's what's good for Tesla.
The complaint we hear is that people can't afford these vehicles.
What we're seeing in the news changing.
In the UK, as you can see, Rishi Sunak is pushing back targets to get rid of all of these internal combustion engines to 2035 from 2030. Are we being unrealistic about this transition and how difficult this is going to be?
No, we do not think so. We actually, the total cost of ownership, now this is in the United States, it's a little bit different here, but the total cost of ownership of an electric vehicle fell below that of a gas-powered vehicle about 2 to 3 years ago. Soon, sticker prices.
Does that include insurance?
Yes, includes insurance. Yes, as I said, local differences, but yes, in the United States that does include insurance. And in fact, Tesla is so sure that its cars will have fewer accidents and fewer fatalities that it's willing to provide insurance. So yes, that does include everything, all in.
You were at USC, you didn't get a B. Laffer called up Robert Kirby at Capital Group and said, just shut up and hire her. So you walk into Capital Group, which is the land of an R-squared and 98 Washington Mutual Fund Investment Company of America. Yes. Everything is completely diversified out. You're the polar extreme. They threw you out. You almost fell into the Pacific Ocean. They were so upset with you. So you go out and you say, I'm not going tight R-squared to SPX. I'm going out and do my own thing.
Yes.
People have prospered off of innovation and technology. How does that continue in America? Can you be less diversified and win 5 years out?
Well, you mentioned Capital Group, and that is where I did start my career. And that is where I saw tremendous research and a long-term time horizon. So really what we're doing with ARC is just going back to the future. My initial experience, which was in the late 70s when I was in college, and we're doing deep research, first principles based, white sheet of paper.
But you're away from an R-squared like Washington Mutual or the other funds. What's your R-squared right now?
To be honest, the correlation of our performance to broad-based benchmarks is very low. For better or worse, what it tells our clients and prospective clients is we have a very good diversification strategy. Our our funds, the active weight, if you're comparing to MSCI World or S&P or NASDAQ, the active weight is less than 5%. So really good diversification strategy focused on companies that are going to transform the way the world works. We look at the broad-based benchmarks, and sure, there are companies that are sustaining innovation like an Apple, but they are not going to transform the way the world works from here. Our companies are.
Kathy, thank you. Kathy Wood of ARK Invest. I can't believe it's been 3 years. It was right before the pandemic and New York shut down.
Yeah, well, she ignores us. We've tried to get her
been
out.
That long. You've been ignoring us, Kathy.
No.
That's what this is about. Come on.
We should mention she's got a new ETF in Europe. They're bringing it into the ARK model as well.
And we should talk about
the
growth stocks.
European ISIC. Probably Novo, what's it called? Novo
Growth stocks in
Obesity?
Europe.
Yeah, she'll
Novo
load the boat
Obesity.
on
Is
that.
that what it's called now?
Yeah.
Over at Novo Nordisk.
Yeah.
Alberto Gallo coming up next. Futures positive here on the S&P. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
If you get yields moving higher, that's probably in response to growth doing better.
I worry more about a yield-induced issue somewhere.
I think a lot of our economic models just aren't working now. The pandemic's just thrown them into disarray.
I did raise my outlook for a recession risk from 15% to 25%.
We can't have Goldilocks forever. We are going to start to see biting within the growth standpoint.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television across America, worldwide, from our studios in London. Lisa on assignment here. It's going to be an interesting hour. We start strong here for Global Wall Street. We'll go to bonds here in a moment with Alberto Gallo. But, John, we've got to focus on this Fed meeting coming up, cocktail hour in London. It's a different Fed meeting.
It's a different Fed meeting for us. It's a different Fed meeting for others as well. We do get forecast today. Unchanged is the call, but it's the forecast we want to have the discussion about with Kathy Jones at Charles Schwab, Matt Lazzetti at Deutsche Bank, Diane Swank at KPMG, and Andrew Holdenhorst at Citi. How do these forecasts change? They're going to have to to market growth. Growth has been better. Growth is going to be evaluated higher, we expect, Tom. Inflation may be a little bit lower. That's 23. What about the dot plot for 3 and 24? That's going to be the call here. Where do they see interest rates going into year end? Maybe one more hike. Let's see if they back away from that. Where do they see interest rates going into next year?
That's the Mike McKee guy idea, the parlor game of as we're going to get from Diane Swank. The effect of the UAW strike is one of the worries that are out there. Andrew Hollenhorst lines them up like ducks this morning. His Citibank worries where you stay up at a higher rate. Matt Lazzetti modeling out a slower economic growth. And there's different narratives here that Chairman Powell has to calm. I look for a calming voice
It's
today.
a timely news conference, Tom. Those three issues that Citi talked about, crude in the 90s, UAW strike ongoing, house prices recovering. Do they have the inflation data behind them, the incoming information to say we've made progress? Absolutely. Can they declare victory in a meeting like today? No, they cannot. Which is going to be the story, likely, in the news conference.
In the heart of it, and one of our great themes here, particularly going to Bank of England tomorrow, is this phrase, anchored. Are central banks anchored? Do they have control of the moment now or the moment out 3 years, 5 years? And in England, it's a different challenge. The level of inflation, folks, over here is totally different than in the United States.
Has it improved? Is it lower in the UK? Yes. Is 6 a problem? Absolutely. It's a problem for the Bank of England. I'll give you two names, Tom. Alsa Linyos of RBC. She sat just over there.
Yeah.
Simon French of Panmure Gordon in Alsa's seat a day earlier. Both said the same thing. They think the communication of the Bank of England hasn't been good enough. It's been insufficient, and they face a credibility problem. Now the call from Goldman is no hike at all from the Bank of England tomorrow morning.
I was surprised by
Goldman
that.
thinks
Full
they're
disclosure.
done after that inflation report this morning. So big rally in the UK gilt market, and sterling a bit weaker off the back of that data earlier on.
And let's get to the data, but I really want to say that the communication will be improved at the Bank of England if John Farrow could be in the press conference here that they have to
Next week's
talk
conference in
to
a couple
Governor
of months,
Bailey. They just don't do them every time, do they?
Not every time.
That's the first mistake.
No, you get them when you get the forecast.
In the modern world.
You'd like a regular meeting and news conference from Governor Bailey?
Not really. You know me on communication as well. Let me communicate to you the data check. Oil pulls back a little bit. Yes, Azerbaijan and all near the Caspian Sea comes down, and it surged to 95. John, back a couple dollars, but 90 is a difficult number for Jerome Powell.
Equity session highs. We're looking pretty decent here, up 0.24%.
Dow Jones Industrial Average
on the S&P. I say we're looking pretty decent. I'm leaning on the call there of Savita Subramaniam, who's saying 4,600 on the S&P. That's an upgrade from 43. It's amazing to see these upgrades, Tom, just keep coming through when people are talking about the potential for weakness.
It's that time of year, but
year.
I want to make point that when you have BNP Paribas upgrade in a jump condition to a new level from being very cautious, that's a different upgrade than the marginal upgrade we got from Savita.
True. Savita's still looking for upside, and Greg Bowdle at BNP is not.
Yeah. You know, I think that they can be different and nuanced. We're going to be different and nuanced here as we look at equities, bonds, currencies, commodities, at the dynamics of full faith in credit and the credit market. Expert on this across all geographies, but particularly Europe, is Alberto Gallo. He's with Andromeda Capital Management and joins us today on the tea leaves, John, to see from credit in your Europe.
The CIO and co-founder. Alberto, good to see you.
Thank you.
Why have I not heard the word stagflation more than 2-3 times this week? I thought I'd hear it every 10 minutes.
Well, you're in London and the UK is in stagflation, right? That's the wage dynamics. There's an entrenchment in inflation where you see 8, 10, even 14% wage rises on an ongoing basis. And many of these negotiations embed a forward-looking raise, a forward-looking increase. So they're not just increasing one-off, but they're going to keep increasing. So the dynamics have changed. As a central bank, you should only say that inflation is transitory, if inflation has gone back to target. But calling it transitory ahead of time is obviously a credibility issue. And that's what the Bank of England is dealing with today. Unfortunately, they can't raise rates too much because of the over-levered situation in the property market and the household sector. So it's a lose-lose situation. The growth inflation mix is much worse. And against this, we have a consensus in the market which is very relaxed, with very low volatility, very high equity valuations. Why? At the beginning of the year, everyone was very, very bearish, very positioned for recession. But today, most investors, according to market surveys, are positioned for soft landing. So we've gone from one side of the boat to the other, and we have to deal with with a worse growth inflation mix going forward, both in the UK and the Eurozone.
And Europe, but not the US.
The US went to the party, Europe got the hangover. So the differential in growth between the US and Europe is widening even more. We're seeing it in FX, but the US is not at recession risk. The US here is at reflation risk. Oil is a positive for the US. And inflation is going to be around 3%, but, the economy can live with 5%. In fact, there's too many cuts priced in for the US next year.
Alberto, how do I invest in that world? Stagflation reality that you just outlined, and inflation reacceleration risk on the other side of the Atlantic. What am I meant to do?
So look, for sure, what you don't want to do is have a long only, buy everything. What worked with QE, that kind of strategy is not going to work going forward because there's going to be more volatility, there's going to be more relative value. So you have to be more tactical. Now, today, in an economy which has high inflation and a Fed that's priced for cuts, but it's not going to cut, which is what we think about the US, you don't really want to hold bonds. So we still see a potential for higher yields in the US, in the middle of the curve, in the long end. The BOJ is the elephant in the room for the world, of course. If they exit from zero rates, that creates pressures. In Europe, though, people worry about European recession, European high inflation. Europe, in the end, always grows between -1% and +1%. And, we are seeing a very muted situation. The 4% hike by the ECB is probably going to look like a policy mistake. So, and here, there's a premium. So we like being in Europe in bonds very selectively. And in the US, we think bond yields will keep going higher and spreads as well because there's too many cuts priced for next year.
I would suggest that's an outlier view. And if I look at the Bloomberg Total Return Index, the U.S. Aggregate Index, very few people are really looking at price down. Are you suggesting that price down, yield up can breach the lows of price that we saw, I'm going to say 18 months ago?
We can go wider. I mean, we talked about it. I think long bonds, long duration was probably the most popular view in Q1. A lot of pitching.
Yeah.
And long U.S. investment grade up in quality has been super popular. But in the end, you're not.
But I don't mean to interrupt, but this is absolutely crucial, Alberto, as you take a real minority view here. If I get price down, yield up, no one's looking for that. What will be the market ramifications of a new regime within higher yields across credit and full faith in credit?
What everyone is hoping for is yields will go back down and companies will be able to refinance. But if yields stay, if interest rates stay at 5,
what's the stock market do?
The stock market is a little different from the economy, you see, because large companies have termed out their maturities. But if you're looking at the high yield market, which is smaller caps, then you need to see wider spreads. You need to see a rise in default rates. But yeah, of course, the stock market is complacent.
You've told us a lot about what you don't like. What do you like? I'm assuming you're not just sitting there in cash.
No, we like some areas of European markets and some U.S. areas of U.S. markets too. So we like Ukraine. We think that there is an improvement there. Slow but steady. They're doing the right thing, the right strategy. They're not throwing all the weapons and the resources at once. They're advancing slowly. And it's an opportunity that's been unloved by the market because of the binary risk of the war. We like some countries that are going back into the investable universe, like Greece, which has an investment grade upgrade ahead. And we like some defensive sectors, which in Europe are pretty, well capitalized compared to the US.
I thought I'd misheard you, but I'd like you to repeat it. You like Ukraine.
We like Ukraine.
What does investing in Ukraine look like?
Well, it looks like buying bonds that are essentially left for a very low recovery value. They were at 20 cents on the dollar at the beginning of the year, and now at 30 cents of the dollar. And GDP in Ukraine is not far off from where it was pre-war because of all the support that foreign countries are giving to Ukraine. So,
how do you buy a bill, note, or bond in Ukraine? Do you have to be somebody fancy like you?
No.
Or can one of our listeners and viewers purchase Ukraine this morning?
It is a distressed trade, but it's a dollar security. So it's a New York law security. So like many other emerging market countries, which are restructuring, but the difference is that investors have not
I got to ask a Bramo question. She's on assignment this morning. Help me here. On high yield spreads, how many basis points do they widen out looking at a vanilla index of high yield spreads? I'm speaking as a hack.
Yeah, we're around 400 bips now in high yield. That's where we were in January, February. Yeah. But the difference is that yields on the Treasury are pushing much wider. And spreads have not moved. There is a point where, if rates and yields, long-term yields go wider, at some point something can break in the high yield market as companies need to refinance. And so we're looking for a little bit wider. We're looking for 450 or 500 to go back to a mean.
100 beats. Did I do okay there?
That was
I was trying to channel Bramo.
That Bramo would be proud. Thank you. Alberto, this was great. I always butcher your name. Not the name of yours, but the name of the firm. Andromeda. Yeah. Capital. I've got this. Right. Andromeda Capital Management.
They're in the aluminium business.
Alberto, go. Are you starting? Yeah. They're in the aluminium business.
Aluminium.
I like that. There you go. There you go. I was
at the Dorchester with a cocktail. I was at a miners thing last night at the Dorchester with an umbrella in the drink.
The LME.
And they were talking about aluminium.
Guys.
Yeah, cool. Aluminium.
If you're just tuning in, welcome to the program. TK adopting some English words for metals.
Yes, thank you.
Equity futures on the S&P 500 just about positive by 0.2%. Yields higher, then lower. We're down a basis point this morning, 434.47 on a US 10-year. Alberto, we hardly talked about Chairman Powell later on this afternoon. What's the guide here? Go to the pub, get some drinks, or actually watch this news conference this evening?
I think that his challenge will be to push back the expectations of cuts that are built into 2024 Fed futures. We've got over 100 bips of cuts. We've got oil towards $100. It's not a bad thing for the U.S. We're seeing, according to our models, around 3% headline inflation at the end of 24 in the U.S. So that's above target. But it could be 30, 40 bips higher if oil goes up another $10 from where we're now. So there's a risk that 3% goes to 3.5%.
So pub this evening, right? That's what it sounded like. Alberto, thank you. Jonathan Pingle of UBS is coming up a little bit later. TK is going to be in the pub straight after that news conference begins. We'll run you through and keep beating the drum to that Federal Reserve decision later on this afternoon. 2 p.m. Eastern Time, expecting no change, but plenty of action when Mike McKee has to open up the summary of economic projections and get the outlook for growth, for inflation and for interest rates as well. That so-called dot plot for 23, 24 and perhaps a little beyond too. Coming up shortly, Henrietta Trace of Veda Partners on the looming government shutdown. The shutdown that we just don't really want to talk about, but we've got to talk about because it's real. We're doing that again.
It's real.
I mean,
yeah, it's real.
Really? OK, we're doing that next. From London, this is Bloomberg.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
I don't think anybody wins a shutdown. Think for one moment what a shutdown does. Stops paying our troops. How do you have more leverage in that situation? I've watched shutdown after shutdown. Everybody loses. It's not a continuing resolution in the essence of what you've known Washington to be continuing resolution. This actually cuts wasteful spending. This secures the border. In the past, the continuing resolution was just continuing spending the money.
House Speaker Kevin McCarthy addressing criticisms of a short-term plan to prevent a US government shutdown. It's that conversation all over again. Let's turn to the bond market briefly. 10-year this morning, going into that Fed decision a little bit later this afternoon. 434, yields down a couple of basis points. 2-year, 10-year cycle high in the last 24 hours. The 2-year on a closing basis point yesterday, on a closing basis, 5.09% in yesterday's session, Tom. The 2-year backing away from those levels to about 5.07. But on a closing basis, we're talking about cycle highs at the front end.
Yeah.
And on the 10-year, it's pretty remarkable stuff going into this Fed decision.
I thought it was underplayed yesterday, John. I think you're absolutely on here. We've really seen some movement here in yields. And, yeah, we give it away here, West Texas Intermediate 90.44. I really want to emphasize, folks, still we're in London. Our team is fully focused on the Fed, and we'll be giving you our usual coverage this afternoon. Thrilled to do that from London here. Look for that. Matt Lazzetti, among others, Diane Swank joining us as well. You know, I think, John, and I really want to explain this through a London prism here. What we're seeing is malleable politicians. And in London, we are seeing the Prime Minister of the United Kingdom flat out capitulate in the last 24 hours on the green movement in the United Kingdom, John. It's on the top of every newspaper here.
Some people might say it's being realistic to push back some of these targets
to get re-elected.
2030 to 2035. Perhaps that's part of the equation. I imagine it is, to basically convey some differences between him and the other party sitting across from him. But realistic in the sense that this transition is going to be much, much harder than we make it out to be. That shifting away towards electric vehicles is not going to be that simple, and for many people will be increasingly expensive. Kathy Wood of ARK Invest sat around the table with us in the last 30 minutes and suggested prices can come down a whole lot more, led by the likes of Tesla. But let's have a look at what's happening with the UAW right now and Detroit's Big Three. Do they look like companies that are going to be in a position to drive costs down, given where labour costs might be over the next 4 years and beyond?
And the business realities away from the wage discussion at the UAW. To bring it to America, once again, no, we're not looking at ESG in America. We're looking at government shutdown. We've ignored the story. We're going to dive into it right now with truly an expert, Henrietta Trace, Economics Policy Research Director, at Veda Partners. Henrietta, Washington Post, House flounders. How floundering is our political system right now in America?
They're on the ocean floor, just chilling with the flounders, for sure. It's been a train wreck for 9 months now, and it just will continue to be that way. The one thing I would say to investors watching this is be mindful of the calendar. It's Wednesday. We have 10 days before the government actually shuts down, and it's worth getting specific. That happens on a Saturday. No federal employees actually stop going to work until Monday. So we really have like 12 days to resolve this. That's a lifetime in D.C. I hate to nitpick, but it really is the most effective way to watch Washington, D.C. right.
Henrietta, I had a period where I realized I didn't know much about American politics of the 1890s, and this really harkens back to the vast polarization pre-Teddy Roosevelt, the time of Grover Cleveland Alexander, and the rest. And what I want to know, Henrietta, is with the election coming up, do we get clarity here, or do you suggest more floundering past November of 2024?
I think we're going to flounder until 2024 November because we're going to be dealing with the exact same margins in the House and Senate for the rest of the period before the next election, all the way through January 3rd, 2025. And that is something to really bake in here. So if you don't believe that there's a shutdown happening in September, which is my base case scenario, you know, you really are going to have to adapt to the fact that we're going to be in the same exact boat in December, probably again in April when the sequester cuts might actually go into effect, and then through the summer of next year as we head into the elections. And I think that there are about 5 House Republicans who would happily shut down the government for that entire period of time if they thought it would get them more campaign fundraising and attention.
Henrietta, I got an audience question just seconds ago. I'd like to share it with you, and perhaps you can help us answer it. We say things like government shutdown. They want to know how much of the government actually shuts down.
Great question. It's about 850,000 federal employees. The average salary is about $73,000. The Bureau of Economic Analysis, the Department of Labor will not be able to publish their data. That is hugely disruptive for people watching that on the street, for projects that are not funded independently. So just to be crystal here, the Federal Reserve is funded independently, so they won't have to worry about any of this. But any federal agency that operates via the discretion of Congress, which the majority of them, will see their expire.
Henrietta, Anchor emails in and says, do they shut down customs? Can John and I get back into the country?
You will be able to get back into the country if the FAA employees decide to work without pay. Last time around in 2018, LaGuardia shut down and had a stop flight order because you're asking these FAA folks who are, you know, waving those pistons to say, hey, come in and work for free, because they're not getting paid. They are essential workers, but they will not be getting paid. The risk is real.
Does Speaker McCarthy, is he working for free? What's his shelf life right now? Give us the Trey's analysis of how the Speaker battles through this.
I'm going to keep it real with you. I do not think the House Freedom Caucus has the votes to oust Speaker McCarthy. I spent all day yesterday speaking with former and current Democratic staff. The motion to vacate a chair is the exact opposite of the hurdle for Speaker McCarthy that we saw in January. The burden is on the Freedom Caucus to get McCarthy ejected. They need 218 votes to do that. They probably get a majority, maybe like 45 House Freedom Caucus members, which is their whole caucus. But that leaves 177 other House Republicans who, by the way, just voted to install this man. And there are no other Republican candidates waiting in the wings to take his place for a thankless job. So all that needs to happen, and I think this is what, you know, some of the publications out of D.C. are missing, is Hakeem Jeffries, the new minority leader for the Democratic caucus, who's done a tremendous job keeping his caucus in line so far this year, can allow his members to just vote present. And it is a way for Democrats not to signal their support for Speaker McCarthy, but to force the Freedom Caucus to show that they do not have a majority and are not capable of governing the House either. So I think this motion to vacate piece is underappreciated, how small the force the Freedom Caucus actually has. Frankly, I'd love to see the vote and have McCarthy come out and sort of shut them down. The faster that happens, the better.
Henrietta, I just wanted to finish on this. The quote from the UAW president yesterday. We were looking forward to getting your reaction to that. I'll share the quote again, that every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. What is this going to look like month end in Detroit when on September 27th, the former president is talking about visiting, and at the same time we have a second debate for GOP candidates?
I think it's going to be fascinating to see Trump maybe not show up for those debates yet again, and see if there's fractions between the Republican presidential candidates to see who wants to support the labor unions, who wants to support the auto industry, and who doesn't. That was a huge deal. We talked about this last time. I made an ill-timed joke, but Mitt Romney ran on the campaign platform of the auto bailout was not a good idea. The last time auto workers really embraced a Democratic president and their sort of true star was Obama and the auto bailout. So I think the Republican Party has a very tricky narrative to define here, and Biden continues to be at the table. I don't know that they're moving the needle yet. And to your point, I think that the strike very well could be still going on. But Trump is going to have to walk a fine line that alienates a lot of the Republican platform here, especially with government staying out of business.
Yep. Henrietta, thank you.
Fantastic.
Henrietta Trays there of Vader Partners. Coming up next on this programme, Jonathan Pingle of UBS and a new call from Nomura on why they think this Bank of England is on hold tomorrow. Details of that call up next.
It seems more and more high-stakes decisions are ending up in my hands. While I still love the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Need a countdown clock if we don't have one already. I think we're 5 hours and about 30 minutes away from a Federal Reserve non-decision. Unchanged is the call. Plenty of action expected in the forecast for this year and next. We'll talk about that in just a moment with Mike McKee in Washington, D.C. Equity futures on the S&P just about positive by 1/3 of 1%. We're higher here on the S&P and the Nasdaq up by 1/4 of 1%. The Russell higher by 1/2 of 1%. Talked a lot about the calls coming out of Bank of America. Savita Subramaniam now looking for 4,600 year end, just a couple of percentage points higher from where we are. That call up from 4,300 previously. A couple of revisions there, a couple of revisions from elsewhere as well. BNP Paribas, big bear, Greg Bowdle, throwing in the towel on that bearish call a little bit earlier in the last couple of months. Outside of equities in the bond market, 2-year, 10-year, 30-year, a rally on the 2-year in the UK, a bit of a rally on the 2-year in the US. We're down 2 basis points, 5.07% on a 2-year. We're looking at cycle highs at the front end of the curve, cycle highs on a 10-year at 435. All of that going into the Federal Reserve, Tom, tomorrow.
There was some real jumble here, and Alberto Gallo was shocking there, particularly on EU distress. John, verbatim, David Rosenberg up in Toronto. We take the view that we just experienced phase 2 of an extended bear market rather than the beginning of a bull run. Phase 3 still lies ahead of this. That's from the great disinflationist David Rosenberg.
Let's get to the UK.
Some of the caution there.
The pound, 123.70. Tom Goldman says we're done. The Bank of England is done. Nomura out with their call. This is Mr. George Buckley. He says the Bank of England is on hold tomorrow after the big surprise in CPI today. So we thought downside surprise on inflation would mean potentially a coin flip. Nomura says no hike. Goldman says no hike. The pound's a little weaker, 123.70 on sterling. Jordan Rochester over at Nomura, George's colleague, looking for 122 and staying short sterling.
And is it a stagflation-y lesser growth, as David Rosenberg alludes to there indirectly with his equity market at call? But, you know, here's this trend off of data. I guess it's data dependency. But it really harkens, and then how does it fold over to the growth call? And
this is what Arcelino said, and Lisa mentioned this earlier this morning. I think it's a really good point. If you get a better growth profile because these central banks back off, is that sterling positive or sterling negative?
That's the ambiguity of it.
And she said it was ambiguous.
That's the mix. I'll go with the ambiguity of it. Let's do this. Let's dive into this Fed meeting. We'll again have our full coverage from London this morning and from Washington. Michael McKee is Bloomberg International ambiguity correspondent and joins us right now. Mike McKee, for Jerome Powell today, what is his chief ambiguity?
The fact that the Fed doesn't know what's going to happen going forward, which sounds silly because nobody can predict the future, or as Yogi Berra said, predicting is really hard, especially about the future. But there are a number of things on the horizon that could really mess up what the Fed's forecast for interest rates would be going forward. You've got the UAW strike, for one thing. You've got the war in Ukraine, oil prices, the student loan payments coming back, Russia's war in China's economy. So there are a lot of things they don't know what's going to happen. So the best case for them is probably to sit tight. I don't think they're going to move rates. Nobody really does. But then the question is, do they change the dot plot? Do they suggest that they don't need to cut more?
Right.
And I don't think they'll do that either.
Mike McKee, Fed tradition is you get the last question because of your power, grace, and heritage. If you had the first question today to Jerome Powell, what would it be?
Well, I think a logical first question, although I don't know it would be asked, is how much confidence do you have in anything that you're telling us today? Because there are so many possibilities for things to go pear-shaped that you have to wonder if people could put much stock in what the Fed is forecasting. I think John was making a good point before we came on here when he was talking about the pound. Currencies are probably going to be where you see the reaction this week. On Friday, the dollar's been rising. And is it going to still be rising after the Bank of England makes their decision and after the Bank of Japan makes their decision, and both of them following the Fed? We may be kind of at a bit of a turning point here, and the Fed may become a little bit less relevant.
John, I think we just saw there why McKee gets the last question
I'm going to suggest
and not
that
the first question.
might be why Mike McKee doesn't go first in that news conference, particularly if Mike's planning to ask that a little bit later in the presser. Mike, Citi published early this morning, I'm sure you saw the work of Andrew Hollenhorst. He offered up 3 points, 3 stories, 3 dimensions to the inflation debate. He said oil prices, UAW strikes, and house prices. From your perspective, Mike, how do you anticipate Chairman Powell will navigate those 3 issues?
Well, oil, for the moment, he's got to say we looked through that because we don't know where oil is going and for how long. And we can't lower oil prices by raising interest rates. If it went on for a long time and inflation expectations got unanchored, then the Fed might want to do something. But they're going to put it in terms of the inflation expectations. As far as house prices, they know they've been rising in recent months, but the house prices take a long time, as we've said, to get into the economy and into the data. And right now, it looks like what we're seeing is still declines from the declines that we had over the past year or so. And finally, when you look at the UAW strike, again, that's going to depend on how long it lasts. I would have added the government shutdown, because if the government shuts down, there could be a lot more people along with the UAW if it broadens the strike who are on unemployment benefits. And that could mess up the numbers both for unemployment and employment and make it even harder for the Fed to know what's going on.
Payroll's a few weeks away. Mike, thank you, sir. Mike McKee is going to be with us a little bit later, breaking down this decision and all the forecasts as well at 2 p.m. Eastern Time. Our special coverage begins at about 1:30 Eastern Time. A 30-minute drumbeat into the decision, some 30 minutes of analysis going into that news conference, a special 1-hour programme hosted here in London. Just a programming note, tomorrow we are here for our Global Credit Conference here in London. Tomorrow we'll be catching up with Apollo's Jim Zauter. Jim Zauter joining Bloomberg Surveillance, especially for that conference, Tom. So
and
that'd be pretty
after
cool.
the Alberto Gallo conversation, that's going to be an incredibly interesting conversation, and the ascent of private equity, private companies, and that. The Zauter conversation is going to be important.
Stagflation.
Yeah.
The word that Alberto used for both the UK and Europe. And then he said the prospect of re-accelerating inflation in the United States and the difficulties invested around that.
All the different narratives we've got right now. Let's begin our Fed coverage for this afternoon and into the London evening with Jonathan Pingle, Chief U.S. Economist at UBS. Jonathan, on this Fed, I'm making jokes. It's a snooze fest as we lean to November and December. And as you say in your research note, we are completely data dependent. What data is Mr. Powell dependent on?
Well, yeah, thanks for having me, Tom. I mean, I think first and foremost, obviously, I think it's really the inflation data. And I think this is actually one way in which, you're talking about ambiguity, that Chair Powell today is not going to have the old Chairman Greenspan-like ambiguity. He was pretty clear at his Jackson Hole speech when he laid out the conditions for raising rates further, said they were prepared to do so if appropriate, and all three of those things were related to inflation. One was inflation fails to improve as much as they expect, growth is too strong and puts the improvement in inflation at risk, or the labor market remains too tight and puts the inflation improvement at risk. So I think if you had to think of the summary statistic for Chair Powell and the data, I really do think it's the inflation data.
You survived working with fixed income at BlackRock. For an economist, that's always sport to say the least. Link your world and Jerome Powell's world into what we're going to see in interest rates off this meeting.
Well, I think, going into this meeting, based on, sort of the conversations we've had and our strategists, that, it does seem like a lot of the commentary has people setting up for a hawkish skip or, some sort of incrementally hawkish message here. I'm not actually sure that's really going to be the case. All of the information they've gotten has been pretty positive, actually, since the June meeting, since the July meeting, what they got in the quiet period. I mean, inflation's falling much faster than they had written down in June. Non-farm payroll employment has slowed, quite substantially, but still healthy. But it's really gone a long way towards slowing the way they want it to. And right now, after the CPI and PPI and the other inflation data, we're tracking August core PCE inflation at 3.8%. That's already below their full year 23 projections from the June summary of economic projections. So for the FOMC participants, it does look like they've gotten a lot of good news on inflation without the economy really rolling over. So it looks to me like they're in a pretty good spot with inflation falling faster than they expected.
Well, Jonathan, three-part story today, as you know. Statement, projections, news conference. Would you expect then, and I think this is what people are anticipating, maybe a little bit of a Goldilocks soft landing assessment in the statement, perhaps the forecast, but ultimately in the news conference, that vigilant, more hawkish stance you might get from Chairman Powell? Would that be the three-part act you're looking for?
Yeah, I mean, I think the statement is going to have some changes, but I think the real action is in, as you say, Jonathan, it's going to be in the SEP and the dot plot in particular, and then how Chair Powell frames it in the press conference. I don't think the SEP is going to be quite as hawkish as a lot of the the projections that are circulating around, but I do think in the press conference, Chair Powell is going to say that they are remaining vigilant, and just like he said in Jackson Hole, I think he says the committee's prepared to raise rates further if appropriate, but I don't think he's going to commit to raising rates further. I think at this point they are very data dependent. They're willing to watch the data come in. Inflation's been better than expected. I think they're in a pretty good spot right now. I think they're generally pretty happy with what's unfolding.
When someone stands up in the news conference and says, Chair Powell, look at gasoline prices, look at commodities, look at energy, what do you think the pre-prepared answer he has in front of him is?
Well, I don't want to undo Mike McKee's genius here, but I mean, I do think they're at a point right now where they're going to look through it and wait to see if it's a more sustained move higher. We've had a couple of periods where, Brent has pushed up to sort of $88 a barrel since November. Now it's sort of pushed above 95. We'll see if it stays there. One of the problems they have with the energy prices at this time, they do know that if it just stays there for a year, inflation's a growth rate, so the inflation will go to zero. So far, it looks to us like there's only going to be modest pass-through into core, like pretty minimal, and I think that's going to be their assessment for the moment as well. So I do think that, they're going to look through it and wait to see if it does threaten the progress on core inflation. And as Mike McKee noted, the big thing for them is going to be watching inflation expectations, which thus far, the most recent incoming survey and other data has looked pretty good.
We'll see if Mike McKee's allowed in the news conference a little bit later. Jonathan, thank you. Jonathan Pingle
thank you.
Of UBS. Appreciate it, John. Good stuff as always. Thank you very much, sir. Mike McKee will be in that news conference a little bit later. If you are just tuning in, welcome. The S&P 500 positive here by 0.2%. Yields going, let's say, absolutely nowhere. 434.87, but in the last 24 hours, cycle highs basically at the front end and on the 10-year. On the 2-year through 5% still. On the 10-year in the 430s, on the 30-year in the 440s. Yields are elevated here, Tom. Going into this one with Chairman Powell and the Federal Reserve.
It's a moonshot. They're not elevated. They've been going straight up like oil has gone straight up. And I think this goes back. The thing I would do, John, draw the horizontal line from where we are now on any of those yields. And you go back. And the answer is it's not August of 07. Maybe it's 08, 09. Maybe a few selected ones are back into 07. But Chairman Powell goes into this meeting with a rate regime from our youth. That was a long time ago.
Is that where he wants it to be?
The question, I'm optimistic about that. We've had a lot of optimists on the shows. Ben Laidler starting us off today.
Max Kettner,
and
another.
the answer is we adapt and adjust, and corporations adapt and adjust to that rate. It drives people nuts. Paul Krugman says we're in a disinflationary trend, and we will be with good comparisons going out. People get upset because they're looking in aisle 7 at their grocery store going,
Things
I
are
don't,
expensive.
I'm sorry, this
you
is
and
what
I
it
are on the
costs.
same page about this.
Yeah.
You can't just strip out the things you don't like, energy and food prices, and say, well, look at this, it's not as bad as you think it is.
Yeah. Some breaking news here. This is Zeppelin Foundation, I believe it's called ZF in Tuscaloosa, Alabama. It's a UAW organization and strike. This is Mercedes high-end chassis. But that's that geography of this UAW strike. Is that what we're going to see on Friday?
How much more of this will we see announced by the UAW president at the end of this week on Friday in that Facebook Live event? From London, Mark Cudmore up next.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
It looks like you're going to have a divided committee. We're on the side of them still having the median voter with a dot, but it's a close call. I think regardless of that, and regardless of big changes in the forecast for 23, the 24 forecast is still going to have something close to 100 basis points of easing. It's still going to have a big drop in inflation. It's still going to have an aspiration that we get an unemployment rate up to 4.5% without a recession.
That line there was brilliant from Bruce Katzman at JP Morgan, the head of global economic research. An aspiration. He didn't call it a forecast, he called it aspirational. More on that a little bit later on when we get that Fed call and those Fed aspirations, if you want to call them that, in the summary of economic projections. Equities right now going into the opening bell about 43 minutes away. Futures elevated, positive by 1/3 of 1% on the S&P. Plenty of price action in the commodity market over the last week or so. New highs for the year, 95 on Brent, we back away. WTI still just about in the 90s, backing away by about $1 full. We're down about 1.1% on the session. The headline, though, in the bond market, and I have to say, Tom, it's hardly made any headlines. The fact we're in cycle highs in the last 24 hours.
I agree.
On a 10-year maturity, on a 2-year. Yes, we've backed away from those levels, but shouldn't we be talking about this a little bit more?
I think we should. I mean, the bond market's there, and a 509 in the 2-year yield is there, and I'm going to watch the real yield coming off the Fed meeting. And frankly, as you mentioned, with Nomura and Goldman Sachs going on Bank of England, the Bank of England to a no rate change or a hold. I'll let them nuance that. It's hugely fungible right now, and it makes it for a very interesting Fed meeting this afternoon.
The Goldman say no hike tomorrow. Nomura coming out in the last 10 minutes or so saying no hike tomorrow.
Yeah. We had a listener and a viewer email in. This is Guy from England. And
Guy
says,
Johnson.
Yeah, he said, you know, there's enough football talk, and we did AC Milan and the rest of it, but we've got to really focus here. He wants equal opportunity at the Decathlon Saint-Denis Stade in Paris this coming weekend. Why don't we talk rugby, John? I mean, you taught me about English football
I was a terrible
and
rugby
Formula
player.
One.
That's why I don't talk rugby.
It's huge here. It's like, you know, it's like on TV. It's like there's like a world champion here.
It's a big deal.
We go to surveillance rugby correspondent Mark Cudmore, who joins us right now. Before we get to bonds and all that, you're in Singapore and you're looking at rugby worldwide, and you've got Ireland, South Africa this weekend. Explain the majesty of that to you as an Irish lad.
This is just absolutely immense. Ireland is very rarely the #1 ranked team in any team sport. We just don't have a big enough population. We are #1 ranked in the world. We're on, I think it's a 15-game unbeaten streak. We've beaten all the other major nations when we've last played them. What's the catch? Well, even though we were Grand Slam champions earlier this year as well, the catch is we've got knocked out of every World Cup at the quarterfinals. We've never got beyond that stage.
Because New Zealand's in the way, right?
I'm not that worried about New Zealand. The All Blacks aren't as intimidating as they once were. Right now, it's South Africa and France I'm worried about. The South Africa pack is just so strong, and France have home advantage. So really, I think that Ireland have a great chance, but it's between those three teams. I'm not counting the All Blacks as serious contenders.
Continue. Anything intimidating about these central bank decisions in the next 48 hours?
I'm a little bit disappointed we're switching away from the rugby, but I do need to correct you. 2-year yields are not at cycle highs.
On
I have
a closing
vested
basis,
interest in this.
cycle high,
At the closing
5.09%.
basis. But I have a
Sure.
vested interest because I've actually swiveled my view, because the last couple of years I've been very adamant that yields go much higher, and I kind of really pushed back in the early premature Fed pivot idea because everyone was underestimating the consumer. But now the US consumer is finally going off a cliff, so all those people who were trying to call a recession way too early are now suddenly abandoning their recession calls, talking about soft landing at the exact point when the consumers go off the cliff. So I've just recently changed my view on 2-year yields, which is why I have a vested interest in saying it hasn't yet broken that peak of 5.12%
Oh, Mark, you're kidding
on an
me.
each-day basis.
On a closing basis,
I accept.
cycle high. Okay, 10-year, cycle high. Okay,
Closing basis, I'll accept.
Sure. I think intraday, cycle high on a 10-year.
Yeah,
Thank
yeah.
you. Okay, we can move on. TV doesn't have to be this hard, does it? Does it?
Well, it's Cudmore. You know,
Okay.
what do you want?
All right,
you
Mark.
know?
Let's move on. What are you looking for?
So, out of the central bank meetings, well, because I think that the yields have peaked. I think the price action around that has been very, very kind of impressive at the front end. I do think we'll continue to see the curve to steepen. So I think what we're going to go into is the Fed will probably hike once more this year. I think that's out. And I think the 2-year yields can survive, peak, can survive even another hike in November. They just can't survive if we get a hike and then a promise of more hikes to come. But I don't think that's going to happen, because I think in line with Bloomberg Economics, I think Anna Wong is the best US economist out there, and she has highlighted all along that there isn't going to be a recession all the year, rest of the year, when everyone else is calling it, but the consumer is going to go off a cliff. Starting at the end of the fourth quarter, we'll get a US recession. Yields will come lower. Now, I don't think the Fed actually tonight is going to be the instant catalyst tonight, but what I think is going to be interesting is everyone is geared up, not everyone, most people are geared up for a hawkish Fed, which is why we're at the cycle peak in yields on a closing basis right across the curve, John, is because they're geared up for a hawkish Fed. Therefore, I think the bar to surprise hawkishly is very high. So ultimately, I think the price action after this is yields come lower and the dollar turns lower into year-end as well.
How does the Cudmore world focus into equity markets? How